Dow added 741 points, the S&P 500 was up 119 points, and the tech-heavy Nasdaq up 2.5%, gaining 462 points. Also helping to power the markets on Tuesday, consumer confidence data came in much stronger than economists predicted. That's according to the Conference Board's monthly index, which said much of the positive sentiment came from hopes of a trade deal between the United States and China. President Trump lowered the most severe tariffs against China on May 12th. May's rebound followed 5 straight months of declines. And Disney's remake of Lilo & Stitch helped power a record-breaking weekend at the box office, bringing in an estimated $183 million in North American ticket sales. Paramount's Mission Impossible: The Final Reckoning came in second with $77.5 million. The total domestic haul of $327 million set a record for the Memorial Day holiday weekend, according to ComScore. That's what's happening here in the U.S. Back to you, Mumbai.
Steve Kovac, thanks a lot for that update. And staying with Wall Street then, as hopes of a trade agreement are rising, Kevin Hassett, the director of the National Economic Council, has said that he expects to see a few more trade deals this week. Listen in.
But in Europe, they got all these countries, and each country has a different objective, and they have to aggregate these objectives at the EU. And so while we've been not making the progress we wanted to see, you can sort of understand that they've got a problem where they can't make up their own minds. And so I think having a little bit of a deep breath and waiting for them to figure out what they want, then that should help the negotiations. But the bottom line is, across all the countries, I expect we'll probably see a few more deals even this week. There's some stuff very close to finished, and it's up to the president, of course. But in the end, the other thing I would say is that you should expect the best out of these deals. President Trump wants to put America first. He understands that our trading partners want to put themselves first, and he wants them to be second in our affections and America first, and the things are moving forward very quickly.
Well, the NEC director also spoke about how close the U.S. was to reaching a trade deal with India. Listen in.
You know, I won't talk about a specific country, but I have been meeting with Indian officials. I had dinner with the ambassador a little while ago, and I think, and JD went over there and made a huge amount of progress. Thank goodness for the vice president. So yeah, I would say that it's one of the ones that's on the list of it's close to the finish line.
Let us also now listen in to former Cleveland Fed president giving her views on the tariff impact for the U.S. economy.
Eventually, we're going to feel the tariffs in the U.S. economy, both in terms of price levels and in terms of weakening growth. And you're correct in that we haven't really seen it in the hard data yet. When you talk to businesses and you look at some of the survey data, that and sentiment data, that's where you're seeing it. So again, I think it's too early now to have seen it in some of the hard data, which is backward looking, but eventually we'll see it. Now, how large the effects will be, that's still not determined because we don't really know where the thing is going to land. As you had on Kevin Hassett talking about some of the deals, we have to sort of wait until we see what really is going to be the ultimate tariff landscape. And so that's why it feels like everyone's waiting with bated breath to see what's going to come out.
Well, consumer confidence for the month of May came in much stronger than expected. Let's listen in to Michael Feroli of JP Morgan on why he believes this happened.
Well, we did revise up after the truce in the talks with China. And that may be a little bit of what you're capturing in this latest consumer confidence number, coming off a very low level, but apparently some of the survey respondents came after that truce was announced. So I think maybe some common factors here driving a forecast toward a little less pessimism than we had right after Liberation Day.
Well, European stocks also closed broadly higher in Tuesday's trading session. The DAX also touched new records, adding nearly 200 points at the close of trade. The CAC was a bit of an outlier, ending at the flat line, while the FTSE in the UK also ending with gains of around 0.7%. So a largely positive handover coming in from the European markets as well. But with all of that global market action, how are things positioned for our own markets? Our research team is joining in with the trade setup, the stocks that are likely to be in the news, and of course the setup on the F&O side of things as well. Vinny first up joins in. in to get us all the market cues we need to watch out for. Vinny, good morning. GIFT Nifty pointing towards a subdued start, but what are the cues we need to keep in mind today?
Absolutely, a subdued start maybe is what we are watching out for, given that yesterday also the market closed near the day's lowest point. Sensex was down 625 points, Nifty was down 175 points as well, and Midcap though, we saw that outperformance coming in there. FIIs, they continue to be buyers, 348 crores as FII buy, while domestic buyers were always around 10,000 crores in terms of buy. Yesterday a lot of block deals were also there, so that impact also comes in terms of these numbers of FIIs as well as DIIs. But overall, what we're watching out for in terms of cues, we saw a rebound that came in the US consumer confidence data as well, which you all highlighted a short while ago. Earnings also we are watching out for. Cummins is reporting its numbers, IRCTC as well as SAIL, and industrial production data on the domestic front will be key to watch out for. There's going to be the FOMC meeting minutes also, which will be coming out. So that is also what we're keeping an eye out on. Though right now, in terms of the handover that we had from the US market is positive, Nifty implied open, indicating a muted start for the Indian markets.
Indeed, a muted start for our own markets, almost at similar levels as to where we ended yesterday. But that does not mean that there's not going to be any stock-specific activity. And Ramakshi is here to highlight all of those stocks. Ramakshi.
Well, Hormaz, let me first start off with a few earnings reactions. Then Bharat Dynamics will be in focus today. Strong revenue growth of almost 41% is what the company has reported in FY25. This is well above the guidance of 20 to 25%. But profitability has taken a big hit. FY25 margins declined by almost 850 basis points year on year to 14%. This is much below the stated guidance of almost 20%. In the fourth quarter itself, the margins dipped sharply from 37% to around 17%. The order book, however, is strong at 22,700 odd crores. LIC, on the other hand, reported a good set of numbers. New business premium came in at 70,000 odd crores. This is above what the street was anticipating. Total APE as well at 18,850 odd crores came in above expectations. The VNB margin, though, at 18.75% came in slightly below what the street was anticipating. NMDC's revenue saw an uptick of 8%. This has come in above what the street was expecting. The margins have contracted to 29.3%, and this is slightly below what the street was expecting, and the net profit is a miss as far as the street's expectations are concerned. Hindustan Copper's revenue saw an uptick of almost at 29%. Margins have declined to 36.5%, but the net profit has seen a very strong growth of almost 51%. EID Paddy's revenue saw an uptick of 22%. The margins have contracted by 7.8%, and the net profit is seeing a very strong uptick of almost 30%. And lastly, keeping an eye out on ITC as well, because British American Tobacco is likely to sell 2.3% stake in the company at a base price of 400 rupees per share. But moving on, then we now have Mangalam, who is joining in with cues from the F&O space. Good morning, Mangalam.
Good morning. So if you look at the markets yesterday, there were selling, but it was at the end of the day consolidating for the frontline indices. The broader markets doing slightly better. And what was interesting about yesterday and day before's trading session is yesterday's the lows were bought and day before trading session, the highs were sold. And all in all, the market has been respecting the range. If you look at it, on May 27, the low on the Nifty was 24,704. On May 26, the high was 25,079. What have we been talking about? Nifty is support between 24,650 to 24,700 and supply between 25,50 to 25,100. And that's exactly what where the Nifty was. For the Nifty Bank as well, we've been talking about 55,000 to 56,000 as a range. And that's what yesterday's low and day before yesterday's high indicate. The India VIX has been rallying, so that tells you that volatility, despite the market consolidating, is still on. Yesterday's cash market flows data will not tell you the picture of the overall market because it was skewed by a couple of large trades. So DI has bought 10,000 crores, the FIS 348 crores. Large trades were Interglobe Aviation and PG Electroplast. However, the FIS sold big in index futures. After 3 trading sessions of buying, they sold about 3,000 crores in index futures, where they added 14,000 short contracts. So it wasn't as much of long unwinding as it was of short addition, and most of those shorts were attributed towards the Nifty itself. 2,700 crore worth, the 2,900 crore selling was towards Nifty futures. It could be on account of the next month series because this is the expiry week, so perhaps it's on account of rollover, so we'll keep an eye out on that. But nevertheless, if the market holds on to lows and highs, we may see some of these positions being unwound because we have rollovers at 60% so far, and the FI longs have dropped to 31%. The other thing that may support the market right now is the put-call ratio, which has now moved to the lower end of the range at 0.82. 24,800 call and 25,000 calls extremely active. 24,800 put, equally active as well. Watching out for a bunch of stocks today. We have Chambal Fertilizers, Hindustan Copper, Manappuram and Titagarh, all of them coming out of F&O ban. RBL Bank is the one that still stays in F&O ban. Broad point for the Nifty, 24,650 to 25,100.
Well, thank you so much for those insights, Mangalam. But let's slip into a short break. Up next, we get you more news and updates on the other side. So don't go anywhere. Welcome back. You're watching Power Breakfast on CNBC-TV18. Now getting you some policy updates. The Reserve Bank of India has tightened the default loss guarantee rule. Sources tell CNBC-TV18 that the RBI has instructed NBFCs to exclude default loss guarantees from fintech firms when provisioning for stressed loans. Ritu is here with more details. Ritu?
Well, that's right. Our sources indicate that the Reserve Bank of India wrote to select NBFCs in March, directing them to exclude default loss guarantees provided by fintechs when making loan loss provisions. Simply put, the DLG or the default loss guarantee is a kind of safety net in digital lending where if a borrower does not repay the loan, the fintech or the digital lender promises to cover a part of the loss, which as per RBI rules is capped at 5%. Now, earlier, some NBFCs would simply exclude this 5% DLG amount, which theoretically is available as liquid cash from their loan loss provisioning, but now RBI has prohibited that, and now these lenders worry that this will make DLG model less attractive and more immediately also cause them to incur a hit in order to make this additional provisioning on their loans. Now, our sources indicate that the industry, including NBFCs, fintechs, through their SROs like FACE, have been in talks with RBI over this issue over the last couple of months. Now, while the directive first came from the Department of Supervision following their audits, the matter has now been taken up at RBI's Department of Regulation by the industry. Essentially, they want RBI to consider allowing NBFCs to set off the DLG amount against provision, arguing that even Ind AS accounting standards allow for setting off this DLG against provisions, provided the NBFCs have clear access to cash flow through an escrow account maintained with a bank. But if the RBI directions are implemented as such, it will imply a higher capital consumption for these lenders, which will eventually hamper ROEs and could lead to lower volumes when it comes to fintech lending. Now, we understand that even as the dialogue with RBI is ongoing, some NBFCs have started to make provisions from the March quarter onwards. Paytm, for instance, started DLG in the last financial year, and as per Macquarie, about 80% of their merchant loans are under this DLG arrangement, so there could be a decline in distribution revenues for the likes of Paytm.
Ritu, thanks a lot for that. Now, the private sector's contribution to investments made for the creation of new assets has dipped to the lowest level in 11 years. Now, data from FY24 shows that the government share of the pie has been inching higher, while the household sector share has been broadly stable. Now, Sapna Das is here to break down that data for us. Sapna.
India's private sector investment appears to have lost some steam. According to the Ministry of Statistics, the contribution of private non-financial corporations in gross fixed capital formation, or GFCF, which are basically investments for creating assets and can be seen by the green line, declined to 32.4% in FY24, which is a 300 basis points drop year on year and an 800 basis points drop since FY16, when the share of private investments had peaked at slightly over 40%. Perhaps more significantly, it is also the lowest level in 11 years since FY13, when the private sector share was over 34%.
So while private sector momentum has weakened, the government has been stepping up. The centre and state share in capital formation depicted by the red line was over 13% in FY24, almost 200 basis points higher year on year. It is also an improvement from FY13 when their share was just over 10%. The rise in government investment is further reinforced by public sector enterprises. Public non-financial corporations' contribution in capital formation depicted by the yellow line was at 11.8% in FY24, over 200 basis points higher than FY23. This is also above the FY13 level of 10.5% and probably in line with the government's push to public sector-led capital expenditure. Contribution by the household sector, meanwhile, remains broadly stable and is depicted by the green line. In FY24, households accounted for 41.7% of the gross fixed capital formation, lower than FY23. The sector is also off its high of a 43.7% share in FY13, as private investments took some of that space in the earlier years, as is depicted in the bar graphs, in the line graphs. But, however, households still continue to dominate as the largest contributor in capital formation, with a consistent share of over 41% at least in the last 3 years. To sum up, government data is probably signaling a change in investment landscape, with private sector's share investments retreating to a decade low, while government and public sector units are stepping up and households maintain their dominant, though slightly tapering share. As India navigates its investment-led growth narrative, these shifts are crucial to understand the drivers of capital formation and the implications for long-term growth.
Well, thank you so much for all those insights, Sapna. But let's slip into a very short break. Up next, we get you cues from the commodities market. Don't go anywhere.
Welcome back. Now, in more news coming in from the US, the Trump administration has ordered its missions abroad to stop scheduling new appointments for student and exchange visitor visa applicants. Now, this comes as the State Department prepares to expand the process of going through the applicants' social media activities and then weigh in on whether the students should be allowed to study in US universities. The Trump administration has also cautioned Indian students studying in the United States against skipping classes or dropping out of their program without informing their respective schools. The US Embassy in India, in an advisory post on X, said that the visas of students who report to such actions could be revoked and they may be rendered ineligible for further visas. Now, Indians account for close to 30% of the international student community in the United States. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. Gold is seeing a bit of a floor at lower levels, but the crude oil prices remain in the range.
Well, yes, and I'll start with the crude oil prices because, this is where the major action will happen over the weekend. You have the OPEC ministerial online meeting that's happening on 28th of May, that's today. And then the 8 OPEC members will meet on 31st of May yet again to talk about production going forward. So this is going to be quite volatile going forward.
In the meanwhile, Iran has hiked prices for the Asian buyers. Markets also are looking at potential new sanctions on Russia, and U.S. has been making those statements for some time now. And the U.S. also has barred Chevron from exporting Venezuela crude. So Chevron can continue its operations in Venezuela but cannot export that crude. So that is something that's coming as a bit of a concern for Chevron there. So more developing, clearly a story coming in from there. But in the meanwhile, yes, you have seen the gold prices, silver, platinum, all of that decline overnight. And this is after 5% of gains that the gold prices saw in the previous week. The risk sentiment seems to be improving. You have regional equities doing well. The dollar index has seen a bit of a rebound. And then the markets will watch out for the Fed's latest policy meeting minutes that come in today. And for the rest of this week, it's going to be about the first quarter GDP numbers from U.S., the weekly unemployment claims, PCE data. So the rest of the week clearly quite volatile.
Well, thank you so much for that, Manisha. So crude doing well while gold prices decline. But that's all we have on this edition of Power Breakfast. Don't go anywhere because Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, middle of the week, and we're waking up to a bump up in terms of US equities. So that's the handover, which is positive. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, morning.
Hi, morning. Folks. Bump up, yes, because they're playing catch up, right? Because of that Memorial Day holiday. So finally, they're realizing that July 9 is still some time away. There's a month to play. And I guess equity participants feeling good.
Well, that's right. We'll have to wait by for July 9th to hear. July 4th, I think by then Trump wants a plan as well. So hands full, all eyes on Trump.
All eyes on Trump, and I mean, the man continues to tweet away, not about markets, but about students, immigration.
Yeah.
I don't know if you saw, there was a story which said that he's now threatening students that they must attend classes, otherwise their visas will be revoked. So, I mean, anyway, let's just take it from the top in terms of what you need to know as we start another session. Now, the S&P was up 2%. It climbed over 2%, and it essentially halted what was turning out, which turned out to be a 4-day slide. So 4 days down, and then there was a 2% bump. But remember, this is, of course, we are coming back. This is the first session for US after last Friday. Monday was a market holiday, so there is that bit of a catch-up as well. So S&P was up about 2.05, Nasdaq was up 2.47, the Russell 2000 index was up about 2.5% as well. So that's a broad change. I have to say this. Actually, 2 or 3 things. One, the move might seem very strong, and it is strong. 93% of the S&P 500 stocks ended in the green. But institutional participation apparently was on the lower side. So this was looked like this was more retail and momentum players at play. Then if you just look at it felt kind of squeezy and slightly technical in nature. More than anything, which was sort of, a big time fundamentally driven or anything. So that's the point. Lack of institutional participation and a technical kind of a move on the back of what? On the back of global bond yields sort of starting to fall off a little bit. Now, the 30-year, by the way, which has been the long end has been the focus. The 30-year was down the most. Yields were down there about 9 basis points. We're about 4.95 in the 30-year after staying above 5% for the last couple of days. The 10-year on your screen lost 7 basis points. We're at 4.45%. Come down as well. Now, 2 reasons here. One, of course, is, remember, this is not just the long end rising is not just a US phenomenon, as we've been pointing out. It's been happening in UK, Japan, and the US as well. The Japanese authorities have signaled that they will adjust their debt plan in terms of how much debt they plan to issue, which is, of course, through bonds. That is one. And the second, of course, is that there was an auction, as we said, this week, Tuesday, Wednesday, Thursday, in the US Treasury selling bonds. The long end only comes through on Thursday. Last night, 2-year bonds were sold, and there was decent demand. So those are the 2 reasons. Dollar index was higher, 0.4% or so. This is on the back of slightly risk-off kind of mood, 99.5 plus. Oil prices were down 1%. There is an OPEC Plus ministerial meet today, and the suggestion is, and there are reports which say that a 3rd straight production surge could be possible in July, which of course means more oil in the market and perhaps, a lid as far as prices are concerned. There was also, of course, the US Consumer Conference numbers, the Conference Board Consumer Conference numbers which came through, which surprised on the upside. Now, one component, which is the labor component, was weak. And it kind of does point to the fact that, things on the labor side, unemployment, etc., will rise going forward. But the market, for what it did yesterday, chose to ignore it and focused on the broad headline numbers. I'll just quickly circle the levels in, tie the levels in. So on the downside, for the markets, support stands at 24,627, which is the 20-day moving average. It's about a clean 200 points away from where we left off yesterday, and then 24,462. On the upside, I think it's been pretty clear for a while. We need to take out 25,116. That is the first number, and then the 78.6%, which is 25,310. Only the averages have moved on a day-on-day basis, that too by a couple of points. Otherwise, I mean, the numbers, the retracements stay the same. For the Nifty Bank, support stands at 54,576. Which is the first support, and then the 20-day moving average comes in, which is 54,991. Those are the 2 levels, and immediate resistance here is 55,875. So very, very near term is what we are looking at this point. Gift Nifty will give you a quick sense of how we are starting. It's like yesterday, about 10-point change, absolutely sort of no regard to the 2% bump from last night. But I think that 2% bump last night, it's not showing up in a big way in Asia as well, and maybe for good measure. Surabhi.
Well, Asian market's actually more positive than negative. The Hong Kong market is the one that's under a bit of pressure right now. But the others, I mean, Japan, for instance, is back to gains. The South Korean market is doing very well this morning. The Kospi surging 1.5% thereabouts. And other markets like Singapore, Australia, largely positive. The outlier is the Hang Seng at this point. Now, the whole EU sort of partial rollback, that's been well digested by markets over the last 2-3 days. The next big lookout is the NVIDIA numbers, and they come out tonight. And the thing is that NVIDIA is probably, the estimates are it's probably going to report about 60-65% kind of top line growth, which is great. But look at it, look at the distance from the 200% plus kind of growth that it was reporting up until the year back. So will the market continue to have the appetite? The numbers are also very important this time because the impact of all these restrictions with the US, which the US announced on exporting those NVIDIA chips to China in specific, the impact of those restrictions will play out. In fact, NVIDIA said that it's probably going to be taking a $5.5 billion charge because of those inventory-related issues. And let's see how this plays out. The company's CEO has already gone on record saying that NVIDIA's market share in China has come down from 95% to now just about 50%. So that's the big event that's in focus for markets around the world. Now, in Japan, while the equity market's going up, the yen actually has been cooling off. Yesterday, the yen slipped almost 1% versus the dollar. Today, this morning, it's recovering a bit from that loss. Now, why did the yen fall so much in the last 24 hours? Because of reports that are now indicating that Japan could be cutting back from issuances of long-dated bonds. Remember, Japanese 30-year bonds, 40-year bonds, their yields had started surging. Now, it seems the Bank of Japan is thinking that it will just reduce the issuance a little bit. And that played its part in the bond and the currency markets yesterday. So that's largely the Asian cues. Of course, for us, our market was underperforming all global markets yesterday. Let's see, the bulls will hope it's different this time around with that cut of about 150 odd points. Now, yesterday's flows numbers are very interesting. And remember, they're skewed by those large blocks, whether it was Sagility, whether it was Interglobe, or PG Electroplast. So what we have in terms of the flows picture is a very large DII buy number, 10,000 crores, 10,100 crores of positive DII flows coming in. The FPI number is again a trickle, just about 350 crores. But remember, it's being skewed by the block. So we have to watch out for this. Speaking of blocks, more stocks in focus. British American Tobacco, BAT, could be selling stake in ITC. They've disclosed that they could be selling up to about 2.3% thereabouts. They'll still be the key sort of shareholders of holding in excess of 20%. But that is something that could be weighing on ITC. Last time when they sold stake, it was a massive trade. And even this time, it will be a block of over $1 billion whenever BAT decides to come to the market. In addition, of course, the numbers as usual. I'll look out for market reaction to Bharat Dynamics. Remember all the defense stocks that have been going up. Its revenue has doubled, but margins and EBITDA is under pressure. So let's see how the market deals with it. Nuvama's come out with very good numbers. Profits up 78%, revenue up 15%, and the margin has surged from 31% to 36%. I'll definitely be watching out for this specific earning reaction this morning. So plenty of excitement this Wednesday. Nigel.
Well, that's right. And if you look at the screen, actually, the sense you get is even though yesterday we had a bit of a down day, it's not yet worrying. And, you'd still fancy your chances if you look to buy the intraday dips. Now, since we have expiry tomorrow, let's first focus on the rollover picture. And the Nifty rollovers actually are relatively higher. 2 days before expiry, D-2, it's at around 60%. The last series, it was sub 50%. While the Nifty Bank, well, that's almost in line at around 51%. The last series, it was at around 56% or thereabouts. So what do the FIs do, though? They added short positions in yesterday's trading session. So on index futures, they added close to around 14,000 short contracts. There was some mild unwinding of longs. And even on stock futures, there could be an arbitrage at play out here. But they added close to around 47,000 short contracts in the ratio of 3 shorts for every 1 long call on stock futures. How are they positioned right now? The FIs, well, they are net short with close to around 67,000 contracts on the short side, while you have clients that have almost an equivalent amount on the long side. But since we have expiry that's going to be playing out tomorrow, and that's going to be the big monthly expiry, the options data is important. And the FIs, they're writing more calls than puts, so they believe that maybe the higher levels will get protected, at least in the near term, going by the data points, because yesterday they added close to around three short calls in comparison to, to 1 short put in trade yesterday. The PCR. I like the look of this, right? A few sessions ago, it had danced a bit around 1.2, 1.3. It's gradually coming to the lower end of the range. And if the Nifty dips today, the odds are that it comes closer to around 0.7, 0.75 or thereabouts, which in fact tells you that it's not such a bad cue for you, the PCR cooling off. Now, the options data, 24,800 call, 24,900 call, both of them fairly active. Aggressive writing is what we're seeing out there. But the 24,800 put as well was active in trade. That's telling you that lower levels could get defended. And just looking at the 24,900 call, the premium's around 170 rupees. And you plug in the last 2 sessions, the highs of the day, which comes in that vicinity of around 25,060 to around 25,080. So because of the options data and because of the highs that we saw in the last couple of trading sessions, this becomes the crucial resistance zone in the near term. So that's the mark you're going to be looking at on the upside. On the downside, going by the options data, well, this becomes the important mark, as well as the 20-day MA comes in at around the 24,630. You'll want to buy closer to around this level. So yesterday was a bit of a down day. The data points, though, are not very, very worrying. You'll still say that this market is trending up, and you'll want to buy the intraday dips.
Okay, all right. Got that point. Thanks for that, Nigel. Let's actually get started then with the equity call of the morning. Chetan Chethu for Nomura expects choppy markets over the summer as several risk events are on the calendar. He says their fair value estimates for Asia ex-Japan stocks imply limited potential upside and thus a focus on stock selection. He adds on their assessment, they think India within the emerging market space and Japan within developed markets appear best positioned to recapture any reallocation flows should investors diversify away from the US. So it's Japan and India, which Nomura thinks will get the bulk of the flows.
Okay, all right. Let's actually get that flow picture straight up, right? Cameron Brand is with us now, Director of Research at EPFR Global. Cameron, would you agree with that? And what have you seen in terms of flows actually coming in last week? And just put that in context for us. India through GEM funds and India dedicated.
So India is probably the pick of the bunch at the moment in terms of emerging markets. Certainly sentiment towards individual markets. But it's fairly subdued flows coming principally from dedicated funds. So when people do seek Indian exposure, they're going for India exposure rather than through the diversified GEM funds. Japan, not so much. Certainly, we haven't been seeing those flows. Flows for Japan have been fairly choppy for a while. Last week, we saw pretty big outflows. Japan is squarely in the sights when it comes to angst about fiscal discipline, which is having one of its rearing its ugly head, at least for the moment. So of the two, India certainly had the more positive flows over the past 2 months. Japan was, certainly in the picture there or thereabouts, but concerns that there will be some kind of bond market revolt that keeps interest rates high is definitely weighing on Japanese funds at the moment.
Cameron, hi. Great to be speaking with you. So, what's the sense? Because flows that have been coming into India so far, it's been a patchy picture. It's not like there's a tsunami of dollars flowing in. It's kind of one day up, one day down. What's the sense that you get as some of these trade issues roll on?
So the sense is exactly what you just said, that there's limited appetite for emerging markets at the moment until the overall trade picture becomes clearer. Sort of within that fairly uninspiring context, India is frankly doing the best, though there is some positive sentiment towards Latin America that's been evident in the past couple of weeks. And until the dust settles, that's probably how it's going to continue. The focus at the moment is very much on fixed income markets, the recent US downgrade, the less than stellar sovereign bond auctions that we've seen over the past 2 weeks. So flows. The energy is in the fixed income space at the moment.
All right. Hi, Cameron. Good to see you in as always. Cameron, what about the flows to the United States? They were the only game in town just around 3 or 4 months ago. But are you seeing outflows from the U.S. market?
Modest outflows, but yes, sentiment is certainly very flat. We seem to be seeing, frankly, a plague on both houses in terms of the biggest element of the trade dispute picture, which is the U.S. and China. So both U.S. and China equity funds have seen consistent, though not spectacular, outflows now for the better part of the period since Trump stood up and announced Liberation Day. Within that, there's definitely some shifts. We are seeing a lot more appetite for dividend funds on the U.S. side, certainly. And when the stars realign, the money does rush back in. But so many of the stars are out of their orbit at the moment that it's hard for people to really recommit to the U.S. at the moment.
That's a nice way of putting it. Stars are out of the orbit. Stars are going all over the place, including, I don't know, Harvard University, China, Europe. There's so much going on, right, in terms of all the action. Cameron, thank you very much. Good conversation. We'll leave it there for this morning. Thanks for joining in. Well, let's tell you what all we have lined up on the show today. Plenty of interactions coming up. Starting 8:35, we'll have the management of MedPlus Health Services joining in. They'll talk about the Q4 performance. At 9 a.m., we discuss the aviation space, specifically Interglobe Aviation's massive rise. Jinesh Joshi of PL Capital will join in. At 9:20, Tridib Bhattacharya of Edelweiss AMC is our market master of the day. At 9:30, we speak with the management of Hindustan Copper, talk about the Q4 performance and the outlook for this year. And after that, a special Raghuram Rajan, former RBI governor, chats with us at around 9:40 from the sidelines of the UBS Asia Investment Conference. We talk, of course, markets, monetary policy, and the global tariff tsunami. And of course, at around 10:15, we have Mr. KVS Manian of Federal Bank joining in to talk about the FY26 outlook and the impact of the tariff uncertainty.
Well, time to slip in a quick break. We've got a lot of stock-specific action to track for you today. You get that in just a bit in our special Top 10 segment, where I'm running you through the list. LIC, JK Lakshmi Cement, NMDC Steel, Hindustan Copper, ITI, all of them will be reacting to positive news flow. Add to the list MedPlus Health, Techno Electric as well. On the flip side, ITC, NMDC, and Bharat Dynamics will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. As we've been telling you, a lot of markets across Asia are actually tracking gains, including Japan, Australia, Singapore. The Hong Kong market is the one that's weak, down about 0.5%. The implied open is actually not giving us any clarity in terms of direction. It's very flat. Last time we checked was 9 points lower, 15 points lower now. So that's how the start could be. Lots of stocks to talk about. So let's straight away get to the CNBC-TV18 list of top stocks to watch. Starting first with ITC. Nimesh, it's block season galore. Oh, and this could be a huge one, right? If BAT decides to go ahead.
Absolutely. Another large block. So yesterday we saw Ganwal selling a stake worth 12,000 crores. And today BAT is looking to sell a 2.3% stake in ITC. And they will raise close to 11,600 crores. The floor price is 400 rupees, which is almost a 8% discount to yesterday's closing price. There was an indication that this large block will come. So it's come today. Interestingly, the stock got ex-dividend as well. And the investors who buy today wouldn't be eligible for the dividend. So that's a clarity there. But a large block and finally BAT stake will fall below 25% as well. So that also a bit of a surprising. But yes, a large block. And I understand most of the investors are anchored towards the lower end of the price band. So you might see a bit of a red to start with on ITC today.
All right, Namesh, thanks a lot. We'll keep an eye out on ITC. NMDC is the other one that could start off on the back foot. That's because the operating performance is a little lower than what the street was working with. So you pull up the big numbers in comparison to our poll, you can see the top line was a little bit better, but the operating performance a little bit weaker. Let's explain this to you. Volumes are mildly higher on a year-on-year basis. On a sequential basis, there was a big recovery. However, the realizations was a disappointment because on a sequential basis, you're seeing that the realization has come down by around 350 rupees per ton. Then how come they managed to beat the top line when the realizations are weaker than expected? That's because of pellets as well as other minerals. Out there, you see there was a much larger contribution. It's normally a very small percentage of the business, but this time around, it was much larger. Moving to the reason of the operational miss is because other expenditure spiked up big time. It was up 69% on a sequential basis, and on a year-on-year basis, it's up by close to around 27%. That could be a phenomenon because of towards the end of the year, you see some kind of rebalances, which could probably be the case. Because if you look at other expenditure as a percentage of sales, that's moved up to around 15%, which is much higher than the 10 to around 12% that we normally see. So going with the red tick out here. However, you need to note that Q1 FY26 will be much better because they had gone ahead and increased prices by around 440 rupees at the start of May. So red to start, but expect the stock to recover in trade today.
All right, Nigel, thanks very much for that. So NMDC in focus, lots of interest, lots of trading interest around this one, always. Well, Bharat Dynamics is the next one we want to focus on. Ria is here with details. Ria, morning.
Well, good morning. Let's take a look at how the numbers have panned out for Bharat Dynamics in this quarter. Firstly, for FY25, the revenue has gone up by around 41% over the previous year, which is well above the company's guidance of 20 to 25% growth. But on the profitability front, here's where the company has taken a big hit this time around. The FY25 margins have declined by around 850 basis points over the previous year, coming in at just 14%, which is well below the company's guidance of 20% margins. Even the Q4 EBITDA margins have fallen by over 2,000 basis points compared to the previous year, but historically the quarterly margins have been quite volatile for the company. On the order book front, order book is quite strong at around rupees 22,700 crores as per the provisional update of the company, and this is well within the guidance range of an average 20,000 crore order book over the next 2 to 3 years. Export revenues have also continued to ramp up quite significantly for the company, going up by over 7 times over the previous year, but this was off a low base, and the export revenue contribution has also come up to 36% in FY25 versus just about 7% in the last year. But largely because of the sharp miss on the profitability front, the stock is expected to open lower today.
Okay, all right. Yeah, it's also run up, and now there's a miss on the operational parameters. Got that, Ria. Thanks very much. Let's talk about LIC's numbers. Yash is here. Yash, how's the performance?
Well, Surabhi, the expectation in terms of the estimates that we were working with was quite muted. Now, just to put the numbers in one line, the numbers for the fourth quarter have come ahead of expectations, but still, in absolute sense, they do remain weak. So as far as the new business premium, total APE, retail APE and value of new business is concerned, all of them have come ahead of estimates. Margins have come below estimates as well. But as far as absolute numbers is concerned, a contraction seen on all the fronts. New business premium contracting by 9%, total AP down 3%, retail AP down 9%, value of new business contracting by 14%, and value of new business margin on a year-on-year basis that has contracted 239 basis points, coming in at 18.75% versus 21.1%. I've still gone ahead with green on the stock because A, as per estimates, what the street was baking in, the numbers are ahead of those estimates, and B, the stock has significantly corrected. It's down nearly about 40% from its 52-week high, and hence going with green on this one.
All right, Yash, thank you very much for that. So LIC, I mean, amongst life insurers, and yesterday in closing bell, we had a long discussion with Deepak Shenoy on LIC. It is the laggard amongst life insurers, which have done very well. Nigel, JK Lakshmi Cement, Hindustan Copper, tell us more.
Yeah, and NMDC Steel, what a busy evening. Right? Yeah. All right, let's focus on the good one first. JK Lakshmi Cement, actually a very good set of numbers is what we saw there. Operationally, the numbers were much better. I was comparing it with Motilal Oswal estimates, and the EBITDA estimates actually are 20% better out there. Revenue growth of around 6.5% approximately, which was driven by higher volumes because the volume growth was up by close to around 10%. Let's explain why it was a beat, because if you look at the operational performance, the margins have improved steadily, and on an EBITDA per ton, it's improved from around 660 rupees per ton to around 960 rupees per ton. That's a good 300 rupee increase on a sequential basis, and the street will like that. Yes, they got hit because transport costs did go up, but the benefit of lower power and fuel costs is clearly making the difference, because that was down by close to around 6%. When you have sales volumes going up by around 10%, telling you operating leverage played out there. The profit number as well was up by close to around 19%, while the finance cost was more or less flattish. And they're keeping their debt under check in spite of adding capacity. So the street will like that. They're currently at around 16 million tons, headed to around 30 million tons, going with green on JK Lakshmi Cement. Next up, Hindustan Copper. You know, the stock is already up close to around 10% in the last 1 week or so. But these numbers actually look pretty good. Top line, there's a good growth of close to around 30%. The EBITDA number has jumped up by close to around 17%. So on a year-on-year basis, the margins have come in lower. But on a sequential basis, there's been a good recovery in margins by close to around 300 basis points at around 36%. Other expenditure did dip down by close to around 4%, which is good for them, while the employee cost did move up. However, they got some benefit of lower power cost. So all in all, the numbers actually look good, though the stock has already run up. And valuation-wise, it's hard to justify a stock at more than 50 times its earnings. But we'll have to see if copper prices are going to move up, then this is the only pure play on copper prices. Profit number as well was up by close to around 50%, but that's because the other income did jump up. So going with green on Hindustan Copper. And finally, NMDC Steel. Well, going with green on this one because the EBITDA losses, just take a look at that. We're getting used to seeing a number of more than 500-600 crores thereabout. That's come down to around 291 crores. So you like that? In all probability, Q1 will be even better because prices have improved and demand for steel as well has improved. So that's why going with green on NMDC Steel. In fact, on Hindustan Copper, we'll have a rare exclusive interview with the management at around 9:30 a.m. to talk about their numbers. Don't miss this one.
All right. Well, that's an important one coming up, and you don't hear from them very often at all. Now, ITI is the next one we're going to focus on. Vinny, tell us more.
So in terms of numbers that have come in from ITI, Q4 FY25 numbers, good set of numbers because the narrowing in terms of losses is quite significant. The losses just come in at 4.4 crores in Q4 versus a 238 crore last year. Revenues have jumped up by around 74%. EBITDA losses also narrowing on that front, 28 crores versus an EBITDA loss last year of 174 crores. There is an exceptional gain this time of 62 crores, but even after that, if you don't include that as well, the losses have still narrowed down significantly. So that is something that is very important in terms for the company. Overall, for the full year also, we're seeing good jump up in terms of revenue, sharp narrowing in terms of losses, and in terms of reduction for losses. When you look at it, this is the lowest level in terms of the loss that we've seen coming in since March 2022. That was the time they reported a profit of 356 crore. And after that, there was a sharp amount of losses that they reported through those years. Now, 4 crore is the lowest amount of loss in those couple of years that we've seen coming in. Stock was up already yesterday 10% ahead of its earnings. So it will be interesting to see if they actually keep up with the momentum or there'll be some bit of a profit booking. But given that the numbers were good this time, we could expect some bit of a green.
Okay, all right. Got that. So ITI on our radar as well. Thanks for that, Vinny. Let's move to Ekta. Talk about MedPlus's performance in the fourth quarter. Ekta, morning.
Morning. Well, mixed performance because the margins actually improved, and that was a very strong margin improvement that you've seen on a year-on-year basis. But I'll start with the revenue up around 1.3% on a year-on-year basis, and it was down 3% Q-on-Q. The EBITDA improved by close to 30% on a year-on-year basis, with margins coming in at 9% versus 7.1%, which is a 200 basis points expansion year-on-year and a 50 basis points expansion sequentially. And the profit growth was around 12% Q-on-Q and a strong jump on a year-on-year basis. The company has indicated that there was an 8% increase in the private label sales over Q4 of FY24. Remember, that's a particular segment that they are looking to grow, and they had 100 store additions on a net basis in Q4. So they've met their guidance of store additions, which were around 300 for FY25.
Okay, in fact, we'll have the management of MedPlus Health join us in just a bit at around 8:35. We'll have Mr. Reddy with us to talk about that performance. Okay, more numbers from the mid-cap space. Techno Electric, and we have Vamakshi for the details. Vamakshi, it was looking good?
Well, absolutely, Surbi. You know, it's definitely looking good for this company. When we look at the revenue, very strong growth out here, 86% higher on a year-on-year basis. The gross margins, though, have contracted by around 91 basis points. But nevertheless, the EBITDA margins have improved, given that there was a decline in the other expenses. EBITDA margins have improved by almost 315 basis points. And the net profit, too, is seeing a very strong uptick of almost 74%. It's not just the fourth quarter, but the entire year as a whole has been very good for this company. Look at the revenue for the entire year. It has come in at 2,268 crores. Now, this is the kind of revenue that the company has posted is at a multi-year high. The EBITDA margins too have been improving for the last 3 years for the company, and currently they're at 15% for the year as a whole. This is much better as compared to what we saw in the previous year, and has reached levels that were not seen as until FY22. As far as the net cash flow from operations is concerned, last year it was negative. This time around it has turned positive. That again bodes well for the company. So given the kind of numbers that the company has posted, going with the green for this counter.
Okay, all right, got that. Thanks very much, Vamakshi, for that. So let's quickly recap our list of stocks to watch today. The ones that have positive news flow are LIC, JK Lakshmi Cement, NMDC Steel, Hindustan Copper, ITI, MedPlus Health, and Techno Electric. Stocks with negative news flow would be ITC because of the expected block trade, NMDC, and Bharat Dynamics. Okay, so that's the equity stock list for the morning. Let's now talk commodities. We have Manisha joining in with the latest. Manisha, good morning. So what's the big headline for you?
Well, profit taking across really, because when you look at the crude oil prices, we seem to have come off here as well. What the markets will watch out for is the OPEC and Allies ministerial online meeting on 28th of May. And then 8 of OPEC and Allies members will meet on 31st of May to talk about production for the month of July. So this is where the crude prices will take direction from. Apart from that, there are potential new sanctions coming in on Russia. That is what the U.S. has said. And the U.S. also has barred Chevron from exporting Venezuela crude. They can make it, but they can't export it. So there are some concerns coming in from here as well. The same is the case for many of these metal prices also. We are off the multi-week highs that we were trading at. Copper, for one, is off its 4-week highs. It fell 2% overnight. This is after dollar index is trading off its 1-month lows. There also is a bit of a caution ahead of the U.S. Senate debates on U.S. tax and spending bill. And then the markets also are looking at higher surplus globally coming in for copper. Gold as well has continued to see a decline. We did see a 5% gain in the previous week, but this week has slightly been on the lower side. The rebound in U.S. dollar, the risk-on sentiment coming back is something that's weighing on. And then apart from that, it is all going to be about the Fed's latest policy meeting minutes that are going to be released today. And the street will watch out for the first quarter GDP numbers, weekly unemployment, PCE index. So there's a lot of data from U.S. in the next couple of days. That is where the cues will come from.
All right, lots to track. Manisha, thank you very much for that. So that's commodities in focus. We'll take a quick commercial break here. We come back. We connect with the management of MedPlus Health Services and we discuss their fourth quarter numbers. Very interesting business. So as always, Mr. Reddy will be with us and Himang Jani will be with us on some fundamental stock conversation after that. Stay tuned.
Welcome back. You're with us on Bazaar Morning Call. The first company on our radar this morning is MedPlus Health Services. The growth was a little muted, but margins have improved in the fourth quarter. Profit has been aided by operational improvement as well as higher other income. So that's the Q4 picture that's flashing in front of you. Let's discuss the prospects for FY25. We have Mr. Gagangadi Madhukar Reddy, MD and CEO at the company, joining in. Mr. Reddy, thank you very much for joining in. Good to have you on. So I just read out the fourth quarter performance where margins have improved, profits are looking good. For the year as a whole, FY25, your revenue is up 9%, but the margin has come down from 6.3 to about 4.5% thereabouts. So let's just talk about, the strategy from here on. You've had a very aggressive store rollout, plan as well. You rolled out, I think, 305 stores last year. This year, you plan to roll out 600 stores. So just walk us through the top line growth, how the old stores are doing, the same store sales growth, and how the new stores are faring for you.
So the new stores are on track. Typically, we expect them to break even within 3 months, at least 50% of the stores, and then the balance break even in the 6 months' time. So that's on track. We expect their EBITDA to get to roughly around 10% within the 24 to 30 month time period. So that's all good. The old stores, though, which are actually now growing at inflation plus, I think will probably continue to do that. They probably will end up, of course, it depends on the vintage of the store and all, but typically they will grow inflation plus. And that's what we're guiding, going forward.
So inflation plus, when you say you're expecting same-store sales growth to be inflation plus, when inflation could be falling to as low as 2-3% in the coming quarters. So just some indication. I mean, are you talking about mid-single digits, high single digits?
I would say more like high single digits. Okay. But yeah.
Okay.
Got that. Mr. Reddy, good morning. Always great to speak with you, sir. So how many stores are you opening this year? 26?
This year, we'll probably do around 600 stores. I mean, we have been doing that for a while. Last year was a blip, because of various reasons and because we had to kind of consolidate our back end. And we had to actually increase the capacity of our warehouses and everything else. So that took us a little bit of time. But I think we'll be back on track this year. 600 is a guaranteed, store opening net.
Okay. 2 questions. Where are bulk of these openings going to happen? Let's just get that out of the way first.
Sure. It'll probably be a mix between tier 1 and tier 2. And they will be in the states in which we are, currently present. We are there in 10 states. The new states for us are Madhya Pradesh, Chhattisgarh, and Kerala. So I think a portion of the stores, I would say at least 150 odd stores would come from those places. But otherwise, the balance will go into the states in which we're already there. As I said, we're there in 10 states as of now.
Okay. What about your own, I think this is something we've discussed in detail in earlier conversations, your own generics, private label in that sense.
Yeah.
And you'd said that, it's going to be long-term, hugely margin accretive.
That's it.
What's the share of what you sell now and how is that doing?
Sure. So by volume, and I'm saying volume because, by sales, it doesn't really count. Our drugs sell for roughly half the cost of a branded drug. So if you look at it by volume, I would say even today, roughly 25% of all medicines which we sell come from the MedPlus brand. And this number will be growing, at roughly about 1% every quarter.
Mm-hmm.
So
and how is that?
It'll be 26, every year 100 basis point as a share of the total sales.
Yeah, that's right. Every quarter.
Every quarter. Wow. So that's a very rapid accretion in that sense.
See, we started in June 23 and we're already at around 25% of the overall medicines. So we have had some initial gains. Obviously, the early adopters have come in and now it's going to be slightly slower, but I think it will probably be a slow and steady 1% every quarter is what I'm thinking.
So it's 25%, as a percentage of the overall volume. Sir, as a percentage of the top line, if I talk about your revenue, then how much contribution is coming from private labels right now and how do you see it scaling up?
Sure. So when I said 25% of the overall medicines, I meant, medicines account for 80% of our overall sales and 25% of that would be 20. So if you look at net sales, they'll probably be around 14 or 15%.
14 or 15% of net sales, the top line. Got that. So now, as you grow this, what will be the impact on margins? Fourth quarter, your margins improved quite a bit, but if I see the year as a whole, from that level of about 6+%, you were down to 4.5%. So just walk us through what happened there and what's the outlook on margins this year.
No. Actually, the margins did improve over last year. Operating EBITDA margin actually went up year on year from 3.9% last year this time to 5.3%. So this is margin accretive for us. Every 1% increase in private label increases our overall, this is by volume, increases our overall margin by around 15 basis points. So if I say that we're going to basically increase our overall sales by 4%, that means anywhere from 0.6 to 0.75% would be our overall increase in gross margin for us. Hugely accretive.
So let's just look out. FI, we're already to 26. By end of FI 27, if this accretion goes on, where will margins be?
It's a simple math. So it'll just add.
So 15 basis points every quarter. So 60 basis points a year. And then you, so that's it.
Yeah, that's it. But obviously what will temper it a little bit are the drag of the new stores. Last year we added only 300. This year we'll probably add 600 at least. So new stores, since they don't add as much initially, you will see a small drag. But otherwise, the gross margin itself will increase.
Okay. All right. Gross margins will increase. Fair enough.
Since we're talking about a more aggressive store rollout plan, sir, if you could just update us on the balance sheet as well. Cash, if at all you'll need to borrow this year. And how is the store rollout being funded? Is it all through internal cash?
We have zero debt. We have more than 400 crores in the bank.
Mm-hmm.
And we are, accreting margin every year. We are actually adding, profits to this thing out there. So I see no reason for any kind of bank loan. Our 600 stores typically will cost us around 30 lakhs a store. That includes the working capital and everything else. And that's 180 crores. That's covered well within the cash reserves which we have. Not to count on what we are going to add as we go forward. So I don't see any need for raising fresh capital or taking any loan.
So all things put together, since you're adding 600 new stores and the break-even timeline, I think you said is just about 3 months for a store.
6 months.
Which is really...
Yeah.
3 months, right?
50% of the stores break even in 3 and the balance in 6. Yeah.
The balance in, so 3 to 6 months a store breaks even, which sounds very, very good. So all things put together, plus higher share of private labels. This year, what should the top-line growth expectation be for your stakeholders?
Okay, top line has nothing to do with the private label thing. So it'll actually depress it a little bit, I would say. I would just count on the EBITDA just going up. Given that we are at 6,000, adding 600 stores, which don't really add too much in the first year. So I would still say, probably in the 15-20% kind of growth is what we would expect. 15% is what I'm thinking.
At the EBITDA level?
No, at the top line level.
At the top line.
EBITDA, of course, will, grow for sure. Yeah.
All right, Mr. Reddy, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on the program. That's MedPlus. So interesting company, building out a large footprint of physical, stores, medical stores, in some ways, sort of trying to build out what we have, for example, in the US, etc. Large chains, organized. In that sense, huge. But of course, here we are getting started. 950 on MedPlus. Hemang Jani is with us now with what he's making of things. Hemang, good morning. Good to have you here. I don't know if you have coverage on MedPlus, but if you do, weigh in here.
Yeah, good morning, Prashant. We don't cover this, but I do like the fact that the company, is expanding their store network very rapidly, and consistently, the company has done well in terms of both top line and operating profit. And I just heard, the management saying that the kind of margin outlook that he's talking about is looking quite encouraging, and the break even of their new stores. So I think. Looks to be very interesting from a positioning perspective, but I was a little surprised by the fact that the overall return ratios, despite the pharmacy distribution being a high margin business, is about 10.5, 11%. So that is something that I'm really not very sure why it is so low. But overall, I do think that this kind of companies, in the current scenario, would have a good appetite.
Okay, that's MedPlus. Hemang, hi, good morning. Just checking, have you had a look at Bharat Dynamics recently with this whole buzz around defense?
Absolutely, Shilpi. Good morning. I do think that in the current scenario, people would have a slightly, preferred kind of a bias for the, defense names, given, in Indo-Pak escalation. Globally also, we are seeing that more and more countries are opting for upgrade. So in that kind of a scenario, given the positioning of Bharat Dynamics, the missile-related work that they do, there would be certainly interest. But particularly talking about the numbers, I was a bit disappointed by the margins. If you have a lumpiness as high as 50%, and 37% of the margins can drop to almost sub 17%. It will be difficult to gauge how that scenario is going to play out. Also, the top line growth was not that great. Only thing is order inflow part, they are doing well. They have a certain specific offering on the sell side. So maybe some allocation would be good to have, but I will not be comfortable chasing such stock in the current scenario.
I'm glad you brought this up. That's why I brought up the stock, because the results have been a little disappointing, and the stock has had a massive run up in the last 3-4 months. So take that point. Look at that, 92% in 3 months. That's Bharat Dynamics for you. And it's followed up with Q4 performance that, that's not all full green, you can say. Hemang, speaking of all full green, these power equipment companies, GE, Vernova, T&D, Hitachi, GE Vernova itself is up 40% in 1 month. Your thoughts?
I think the whole theme, Surbhi, is back in the vogue, and I think people earlier had concerns. Let's say for solar companies, the US-related developments were not looking that great. But I think when we look at the numbers, when we look at the management con calls, the growth, I think some of these companies do look quite attractive. GE Vernova is a very niche kind of play, nuclear-related stuff, good strong order book and growth. So we do like that. I do think that, within the themes, let's say if I have to choose between solar and these kind of companies, certainly solar has its own sort of issues in the current scenario. But GE Vernova and power equipment related, stories are looking far more attractive.
Okay, all right. Hi, Hemang. Good to see you in as always. NMDC's numbers a little bit weakish because of other expenditures spiking up. However, Q1 will be much better because they've taken price increases of around 400 rupees per ton, which bodes well for them. Your view on the stock?
So, Nigel, good morning. NMDC numbers not looking that great. Stock has done well in the recent past, but I do think that, the short run, because of the fact that people want to own up some of the commodity names, Speed, SAIL, NMDC, even the large cap names, I would go with something like SAIL or Tata Steel, at this point versus an NMDC.
Okay, SAIL or Tata Steel in comparison to NMDC. Got it. The other set of numbers that we had was from JK Lakshmi Cement. And these numbers actually looked quite good. I was looking at, the last time as well, they delivered pretty okay set of numbers. But this time around, there's a big improvement of 300 rupees per ton on a sequential basis on EBITDA per ton. The street will like it. Your view?
Positive numbers, Nigel, both in terms of top line, even margin side, about 18.5, not that bad compared to Q4. I think we have to see what kind of outlook do we see from the management for this year. But certainly we do like the company and the current performance. Even in terms of valuations, it is looking quite comfortable at this point. But what stood out for me, Nigel, was JK Cement's number. I think both in terms of current quarterly numbers, the growth outlook, that really stood out. Though it's a bit of expensive stock, but I definitely think that people would want to own that.
Okay, all right. Hemang, we got some more questions for you. For the time being, we'll take a snappy break. We'll come back. We'll have our technical experts who will be waiting by. Sudarshan Sukani and Mitesh Thakkar will be there. Welcome back. Hope you're having a good morning. Well, as promised, Sudarshan Sukhani and Mitesh Thakkar join us on the show. Good morning, gentlemen, and good to see you all in as always. Mitesh, hope you had a good trip. I believe you were traveling, and good to see you back. Mitesh, go first. What's your sense on the markets? I think that from the time you left for your holiday to the time you come back, I think we're still in that same range itself. But what's the trade on the Nifty?
Good morning, Nigel. I think on the Nifty, we have seen 25,100 broadly come into play on the upside and about 24,400, 450 on the downside. I think looks like this consolidation phase might continue. Similarly, on the Bank Nifty, it's about 55,600, 650 on the upside, roughly about 54,250. So I think we're still looking at a market which is sideways and consolidative. Next few days, I would want to see how the market goes, take profits around the upper end of the range, and try to buy near the lower end of the range. But all the signals in the short term point out towards more of sideways activity.
Okay, all right. Sudarshan, what about you?
Yeah, good morning. Well, yesterday's price action was very disappointing. The idea was that the Nifty was pushing against 25,000 and any push above that could lead to a breakout of the trading range. But the reverse happened. The markets fell and they are back inside a trading range of about 500 points. 24,500 to 25,000. So now, once inside a trading range after what could be considered as a failed breakout, it becomes difficult to have a view. Unfortunately, today is one of those days when I don't have a view on the Nifty. Well, we'll just wait for a day and see what the market decides to do.
Okay, all right. No view on the Nifty. But Sudarshan, give us a couple of stock picks. I'm sure you have a couple of them for us.
Well, yes, there are stock picks. They are from the mid-cap and small-cap categories, which are still outperforming. So Poonawalla Finance is one of the buys, and I own shares in this company. Buy with a stop under 391. Syngene is a buy, stop under 640. RT Industries is a buying opportunity with a stop under 471. And again, from the same sector, Laurus Labs is a buy with a stop under 591. So broadly, focus on small and mid-caps.
Okay, got that and got the disclosure as well on Poonawalla. Thanks a lot, Sudarshan, for that. Mitesh, what about you?
I have mix of buys and sell with slightly more bias on the long side. Container Corporation had a good breakout yesterday, so buy it at current levels. If you get 1% kind of a dip, add more. Keep a stop below 748, look for targets of 810. Buy on Woodco with a stop at 235 for targets of 250. Similarly, Manappuram Finance is a buy with a stop at 226.5 for targets of 240. And Glenmark is the solitary sell call. Keep a stop above 1410 for targets of 1335.
Okay, all right. And Mitesh, hopefully from that trip, you have taken some really good pictures as well because, I look forward to your photography as well. So hopefully some good pictures is what we could be looking forward to. Thanks a lot, Mitesh, for that. Let's go back to Hemang Jani, though. He's still with us. Hemang, we discussed a couple of metal stocks from the Ferris pack. You said instead of NMDC, you prefer Tata Steel as well as SAIL. What about any view on Hindustan Copper? For the first time in many, many years, actually, we'll be having the management at around 9:30 a.m. on the show itself. Your view on the stock, valuation-wise, not cheap at all at 50 times. However, if you want to play the copper price story, there's only one way. That's Hindustan Copper. The other ones, Hindalco as well as Vedanta, they are more into TCRC. Your take on Hindustan Copper?
I think, as you rightly say, though it's a monopoly and, very low floating stock, small company, but the valuation comfort is missing. Also, when you have this kind of a frenzy for some of the PSU names, I'm not too comfortable chasing these stocks. So I would really want to kind of see a bit of a stability, a bit of a cool off before I really venture into it. But within the pack, I think Nalco really stood out for us in terms of numbers, in terms of growth plans.
Nalco, all right. You prefer Nalco on that one. A quick question on Eternal. Yesterday as well, the stock was a little bit subdued. If you want to look at it from a positive perspective, is this entire rejig of global indices is taking place. But bulk of it is getting lapped up. DIIs have 24% in the company and mutual funds, active and passive together, have 19% out of that. So, the selling is getting absorbed gradually. I think on Friday, we'll have another MSCI rejig, which will be close to $500 million of selling. Post that, it'll be interesting to see what the stock does because the QIP was done at 250 rupees. What's your view at 225?
So, Nigel, as you said, there are technical factors in the selling, and this came as a bit of a surprise because the sense one was getting was that the selling will not be that significant. So, if you see a meaningful correction in the stock, let's say another 3-5%, surely it would present a great opportunity because I think overall, in terms of performance numbers, things are looking good. On the quick commerce side, it may take a while, but I think the market has accepted that, and still people are looking out for growth-oriented, fintech. So surely would be a buyer at any correction.
Okay, all right. Hemang, stay with us. What we're going to do is take a quick commercial break here, but just also want to quickly tease out that we're very excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, which brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime, 12 noon for the Global Reset and then Global Lens at 8:30 every day, Monday to Friday. Okay, welcome back. There's about 3 minutes to go for the pre-open session, and I think the GIFT Nifty is not indicating a big move one way or the other. So that kind of a start. Then we'll see. Overnight, of course, handover has been pretty positive. Let's focus on some primary market action as well. And SEBI is likely to clear HDB Financial IPO. Now, this is a big one from the HDFC Group. Ritu is here with what she's picking up. Ritu, morning.
Good morning, Prashant. This is going to be one of the largest NBFC IPOs that we'll see in recent times, apart, of course, from Tata Capital's IPO, which is yet to be cleared by SEBI. But HDB Financial, which had filed its DRHP in 2023 and had faced a lot of delays because of questions about a potential violation in the Companies Act, which related to a private placement of shares to HDFC Bank employees that had triggered classification concerns. Now we understand all of that has been clarified, and SEBI is set to give its green flag to this $1.5 billion IPO, which will comprise of about 2,500 crores in fresh issue and 10,000 crores offer for sale by the parent, HDFC Bank. Keep in mind, HDB Financial has been identified as an upper layer NBFC, which means, as per RBI norms, it is mandated to get listed by September this year. Apart from that, a draft circular on separation norms will also require HDFC Bank, if it is approved in its current form, to pare its stake in HDB Financial to 20% over a period of time. So therefore, this IPO is very critical for both the parent and and HDB. Apart from this, there are two other IPOs that we understand will also be cleared by SEBI very shortly. One is Hero FinCorp, which had filed papers for a 3,668 crore IPO in August. And the second one is Vikram Solar, which is a PV manufacturer based in Kolkata, for a 1,500 crore IPO. These are the other two ones that are in the pipeline. But for Tata Capital, which again has the September 2025 deadline to get listed, it looks like it may take a little longer.
Okay, all right, got that, Ritu. So plenty of action on Primary Street, it seems like. Thanks very much for the update over there. We still have Hemang with us, and we'll start getting the pre-open rates, any second now. Hemang, so earnings season almost winding up. Tell us, from the mid-cap universe, what were the one or two earning stars that really stood out for you? Where stocks warrant a buy, looking at the numbers?
Yeah, Sukhbir, I think for the overall market, the earnings season has been quite okay, though the expectations were on the lower side. So what stood out for us was companies like UDS, which is a managed services outsourcing part. I think they delivered very good, strong set of numbers. PLS Limited, which is a visa processing company, that also I think the numbers were very strong, and we do like that theme and that entire sector per se. We do like something in the auto ancillary space, company called as SJS Enterprise, which numbers were okay, but I think they have got a big breakthrough. Hero Motor, they have been able to kind of manage to get their client list. So I think these are some of the mid-cap names that we like at this point, where the numbers were very good.
Hemang, I missed the first one. You said BLS and SJS. What was the first one?
UDS, Traded Services.
Okay. Okay, all right. Got that. Before we let you go, we'll be having a full-blown discussion on this in just a bit. So let me ask you as well. Interglobe Aviation, right? And yesterday in Nimesh, we were all just talking about it, that market wisdom used to be that you can never make money out of aviation stocks, and Interglobe has turned that wisdom on its head. What are your thoughts now? Looking at the stupendous rise, is it too late to get in? What to do? They have virtual monopoly, we know that, but it's about the P&L and the operations.
Not just about making money, but making solid money when it comes to Interglobe Aviation. And I do think that this year, this financial year, both in terms of price performance and in terms of earnings, this will be the best performing stock on Nifty by far. Given the, the new airports are being opened up, the international presence, there may be a 1 month kind of a issue because of that airspace thing and, certain cancellations. But Interglobe, I think, by far will be the best performing stock in Nifty this year.
By the way, Hemang, any thoughts on Jio Financial? Was the top gainer yesterday on the Nifty. Of course, that approval has come through on the mutual fund business side. Anything here?
Expectations are high, Prashant, but it's all about, different business company getting the, approvals and this and that. But you can't justify the current valuations in the market cap. So would rather prefer, something which is delivering, this quarter we have a whole host of companies, be it financial services or many sectors, that are performing and available at a much better valuation. So not a big believer of this pedigree and all of that.
Okay. All right. Got that, Hemang. Good to be speaking with you this morning. Thanks for all the discussions and the ideas there. You have a good trading day. Well, the pre-open rates have started to trickle in, and right now it's about a 70-point drop on the Nifty, but let's see, usually it tends to settle. The Sensex is doing better. The cut on the Sensex is just 0.2%, so we'll probably have a quiet start. Watch out for ITC. Because of this BAT trade, British American Tobacco, ITC, in all likelihood, is going to open weak. 3% lower is what we have. Remember, they're looking to sell about 2.3% stake, and the value of it could be well over $1 billion. Aside of ITC, Jio Financial, by the way, the stock that we were just discussing, it's still latching onto some momentum from yesterday. So still about 1.5% on the higher side. Now the Nifty is settled, very quiet, about a 40-point cut. So neither here nor there. Quiet opening is what we're probably in for. But let's go back to that conversation around Interglobe Aviation. Now, the company's co-founder Rakesh Gangwal sold about 5.7% stake in Indigo airline parent Interglobe Aviation for almost 12,000 crore rupees yesterday. This is the sixth large chunk that he has sold since 2022 via block deals. And now he has just under 8% stake in the carrier. Now, how should investors look at the rise of Interglobe Aviation? Almost a five-bagger in the last 5 years. Jinesh Joshi, research analyst at PL, is joining in. Jinesh, thanks for joining in. Interglobe is one of those stocks that has probably many people feeling FOMO. because the narratives always were that, it's too closely linked to the volatility in crude prices, taxation could be changing, it's a sector that could be controlled by government at any point in time. Generally, they say globally aviation doesn't make money. Interglobe has defied all of these concerns. Your thoughts, and whether now there's any point looking at it at all, or is it too late? The parties, is it ongoing? Is it close to getting over, or has it just started?
No, definitely it's not over. If you look at the pricing power of Indigo, if you look at yields over the last 3 to 5 years, they have been in the band of about 5 odd. In fact, even in this quarter, if you look at the yield, it was up by about 2% versus their guidance of about low single-digit moderation. So as long as the pricing power stays and the fact that the AOG is expected to come down in FY26, which is hovering at about 40 odd currently, we think with the improvement in the cost structure and if the pricing power remain intact, you will see the journey of upside continue from here on. Obviously, the month of May will have some bit of negativity come through because of the geopolitical tensions. But I think these are all near-term aberrations, and we believe that the upside should continue from here
on. What's your target?
So our target is about 6,100 on the stock. We value it about 11 times September 26 EBITDA.
Okay, yeah, and so you're in sync with targets on the street. I'm just reading out the targets. Citi's got a buy call, 6,500. Morgan Stanley's got an overweight, 6,500 again, 6,502. Jefferies buy 6,300. PL, we've just heard another target of 6,000 plus. Investec is the only one who has a sell call with a target price of 4,050. And they're saying that the Mahakumbh and the Pratt & Whitney compensation tailwinds, they'll phase out in this year, which is why they're an outlier. They're perhaps the only bear in town. But otherwise, targets are still north of 6,000.
But they're not sky high, on the bullish side even. This is
still about $900 to $1,000 from
10%,
where we are.
12%, 15. max 15%, right, on the upside.
See, that's a bull market. 15% is not enough.
Go big or go home. Anyway, jokes aside, just a quick word on some of the basics, Jinesh. Two things. One, how many new flyers are coming into coming in every year? New flyers. Do we have that data? What's the rate of growth in this market? And the second is, will competition? Do you think it'll get its act together? The Tatas. There is of course. Then there are the other ones, but it's much smaller. That'll take time. What is your sense?
Yeah, so as far as the new flyer question is concerned, if you look at the month of April, we saw about the domestic passenger growth being at about 8.5%. Even historically, if you look at the numbers since the last couple of years, we have seen a mid-single digit kind of a growth in the domestic passenger traffic. So I think that is a pretty good number to look at. Even if you look at their guidance in terms of new plane additions, they are guiding that they'll add about 1 plane each week. So even that is a very good number if I were to think through from a long-term perspective. So overall, I feel in terms of the number of flyers, definitely we are seeing good guidance from their side.
And what about competition?
Competition, oh yeah, sorry, I forgot on that part. So see, if you look at the current market share, it is at about 64%. When Indigo was at 60%, I think Tata's put together were at about 20-25%. And you had a SpiceJet at about 5% and Akasa at about 5%. And then there were questions that from 60%, from here on, the journey could be a bit difficult. But from 60, they were able to kind of claw back their way to about 64% odd. From here on, domestically, no doubt the competition is stiff because the other players are now much better in a much better position than what they were earlier. So to that extent, yes, competition has slightly heated up, but that is why, if you look at their overall trajectory in terms of expansion on the international side, they have about 30% of their ASKM on the international side currently, and the long-term picture is to take that number to about 40%. So international definitely will provide them wings as far as competition is concerned.
All right. Hi, Jinesh. Good morning. Good to see you. If people are going to fly more, they'll require more luggage as well, right? I think you track the luggage space as well. What's your take right now? You've been quite optimistic on VIP. The stock has been a big underperformer, but it's bounced phenomenally from the recent lows. Your view on the luggage space and view on both these two names, VIP as well as Safari?
Sure. So if I look at this quarter, I think the performance was subpar. The EBITDA margin was at about 1% odd. The top line growth was in the negative territory. But if you look at their overall cost structure, we have seen quite a bit of improvement come through, at least in 3Q is what we had witnessed in 4Q, that structure got elevated a bit, and that is why you saw the EBITDA margin succumb to about 1.5%. But from here on, with some kind of price hike that is being taken in the e-com channel, the fact that they are focusing more on premiumization from here on, and if you see some kind of growth come through in FY26, even if it is in a mid-single digit kind of a territory, and if the gross margin improves to say about 48-49%, if you look at FY25, they were somewhere closer to about 46-47%. You can see some kind of an improvement come through in terms of the overall performance and obviously the stock price as well. Safari, I mean, yeah, this quarter they did well. I mean, the gross margin was at 49% despite the competition that we are seeing. Even Samsonite has become very aggressive on the mass side, whereby you are seeing certain ad for convenience come through in IPL as well. So despite a stiff competition, a 49% GM definitely is very commendable. And the fact that now they'll have their new plant operate at full capacity in the next year, at least in the initial 6 months, there could be some minor hiccups. But overall, I think 26 for them could definitely be good, given the fact that their new plant at Jaipur will kind of start kicking in.
Janesh, very quickly, just to wrap up back with Interglobe, just leave us with the key numbers to watch. For this year, what is the kind of top line growth and yields, which were as high as, I think, 5.3%. As of Q4, because there are some brokers indicating that yields will soften in the coming quarters. Where do you see yields this year stabilizing? And the EBITDA margin was, I think, 31% or so. Where should these metrics be in FY26 since you have a bullish call?
Yeah, so if you look at FY26, our top line growth is about 10% odd. So they should be at about 88,000 crores in terms of top line. As far as yield is concerned, see, they ended FY25 with about 5.2, if I remember right. We do not expect much improvement from here on, given the fact that competition is already stiff. So we are at about 5.1. But the improvement will come in the cost structure, given the fact that their damp lease count will come down as AOGs are expected to decline. So an improvement in the cost structure will kind of help improve their EBITDA margins. We are at about 25-26% as far as EBITDA margins are concerned, and our bottom line estimate for FY26 is somewhere around 9,200 crores. So yeah, these are the broad numbers for Indigo.
Okay.
All right. We'll leave it there. Thank you very much for joining us. It's a pleasure, and we'll speak again as we continue to track the journey. And it's been a strong one at that. Let's just get the calls out of the way. Sudarshan is with us with what he'd want you to do. Sudarshan, morning.
Morning. Buy Syngene, keep a stop at 640.
Syngene is Sudarshan's call. Mitesh, what about you?
I'll go the buy on Concor for targets of 810.
Container Corporation, that is Concor, with a price target of 810. Nimesh is here. Thanks very much, both of you, with what the standout brokerage report of the day is. Nimesh, morning.
Hi, morning, Prashant. So today's standout is on Aarti Industries, a double upgrade from UBS to buy from sell, and they have raised the target price to 625. The earlier target, I think, was 615. But interestingly, their earlier sell call was largely on the back of weak chemical cycle and drag on the MMA business. That is going to change from here on. That's a big call from UBS. And they believe steady improvement in terms of businesses on the back of the new CEO's initiative to optimize costs as well as drive growth. So they're expecting three things to happen from here on. One, the chemical cycle to improve gradually because of low inventory. So that's the first thing. Second, they also believe steady uptick in the MMA volumes, and that's clearly visible in the last 2 quarters of the earnings as well. And third, strategic initiatives to improve the efficiency. The stock valuation-wise is still below its 5-year average, EV to EBITDA. But do remember, the stock has rallied in the last 1 quarter from 380 to 480. But a meaningful upside, a meaningful upgrade from UBS today to a buy, and they've raised a target price of 625 on Aarti Industries.
Okay, all right, got that. Ramesh, thank you very much. So Aarti Industries is going to be on our radar. Stocks up about 2.5% in the pre-open right now. The other one that we discussed, Bharat Dynamics, we were discussing that with Hemang. The fact is that the numbers are a little disappointing, more than a little disappointing on margins specifically. And this after a massive run-up. So therefore, watch out for this. Could be starting lower. And the other one, of course, is going to be ITC. Just taking a final check. ITC is down 3.6%. That's how we are gearing up for the start. By the way, a lot of tech is doing well. Nasdaq's up. I mean, not that there's ever any comparison with the Mag 7 or with Nvidia, but in general, the morning seems to be looking okay for Infosys, TCS, Wipro. Looks like the leadership pack, at least at the start.
Absolutely. And that 2% pop on the NASDAQ, I think, showing up in some ways. And yields are off. That's the big trigger for the move that we saw last night. So we'll look at indices first, then we'll, of course, look at individual stocks. We've got a couple of seconds to go for start. We'll look at where we are at. So 24,840, 24,850 on the Nifty. It's absolutely flat. Nifty Bank is up about 0.1%. Sensex is absolutely flat as well. Small cap index is up about 0.4%. And I think the mid cap index will come up as well. By the way, yesterday the Nifty was down 0.7. Bank Nifty was down 0.3. The mid and small cap indices were higher. Small, but small up. The direction was green. So that's the picture. Nifty Bank is now slipped into the red, and so was the Nifty, which is down about 0.16%. Heat map to give you a quick sense of where we are at. By the way, that block deal, ITC block deal has gone through, and 15,000 crores, 3.8% lower, 2.5% equity changed hands. It's there. It's mixed. So you got about 35 odd names which are lower, and about 15 odd names, maybe a little more, which are higher at this point in time. We're just talking about Geo Finance. I think that's the top gainer once again after yesterday. Surabhi.
Yeah. By the way, this is that earnings season where the fag end is also giving you earnings patakas, and we have one today. Techno Electric, look at that stock. 10% on the higher side, moving higher. Actually, a lot of the earnings reactions are positive, and we'll come to that in just a bit. But on the large cap screen, Geo Finance is continuing its good form from yesterday. 1.5% up. Tech, like I said, has started off on a good note. Infosys, Wipro, HCL Tech, TCS, all of these stocks, anywhere between 0.5% to 1% is what you're getting. Good start for Bharti Airtel as well, 0.6% higher for Bharti. Banks are sitting on the fence, not very clear in terms of direction. SBI, 0.2% higher. Let's look at HDFC Bank, 0.25% higher. And then there is ICICI Bank, which is slightly lower. Bank Nifty is absolutely flat. Let's see what's pulling the index on the downside. JSW Steel, 1% lower. There's Titan, there's M&M. Shriram Finance, Hindalco, IndusInd Bank, Reliance itself is slightly lower, and then there is L&T as well. So basically, those are the early trends. Some of the commodity plays like Hindalco, JSW Steel weak. Auto is seeing some profit taking, and big stocks like Reliance and L&T keeping a lid on the gains this morning. Nigel.
Well, that's right. You know, a few stocks actually that are doing well from the broader markets. ITI, the stock was up, but the numbers look quite good. The stock is up another 5%. It's one of the top volume movers today. EPAC, that one as well has opened up, gap up, big gains being seen out there. So good move is what we are seeing. MedPlus, we just had the management on the channel. So that stock, in fact, is reacting favorably. They're talking about the profitability improving in the time to come. Big bazooka move up close to around 8%. Triveni Engineering, we'll have the management in the next 60 to around 90 minutes on the channel itself. Well, they as well reported a pretty good set of numbers, 7.5% up there. LIC, there's always that fear with regard to the supply overhang. Stock has been a relative underperformer, but for now at least the stock has opened up with a gain of close to around 3%. As Yash said, he was going with green. On the flip side, NMDC, other expenditure spikes, realizations took a harder hit than expected. So that's why that stock has opened up with a cut of around 2%. But watch that one. If commodities recover on the whole, then maybe in fact this one could see a bit of recovery because the first quarter of this fiscal will be better. DCX Systems, the stock has opened gap down close to around 5% lower because the numbers were weak. But it appears DCX Systems is the story for FY26 because the order book is the highest that it's seen, close to around 3,000 crores. So let's keep an eye out on that one. Suraj Estates, numbers came out, weak set of numbers. That stock, in fact, is taking a knock as well to kickstart trade. And I think a couple of other notable names that came out with set of numbers. JK Lakshmi Cement, numbers were good, but the stock has seen a 10% run in the last 1 month. So that one, in fact, comes up for you. And Precision Camshaft as well. I think we have a shade of green out there. So it appears the street is looking ahead on a couple of these names. Surabhi?
Okay, just some more names. Sagility, 4% lower. Yesterday, remember, there was this block that happened. Down about 4% again today. And watch out for a lot of the railway stocks. Railway stocks are buzzing. Last I checked, most were up and about. Your Aircon, RailTel. Let's just pull up some of these stocks. RBI is coming up on the screen. There's a bit of a tailwind here. So 2 to 3% on these stocks. PG Electroplast recovering after yesterday's moves. Yesterday, of course, promoters sold a little over 5% stakes. The stock was under some pressure. This morning, it's up about 3% as we speak. Overall, extremely quiet and flat. The Nifty not going anywhere. about 11 points on the lower side. Okay, so let's straight away get to our market master of the morning, Pradeep Bhattacharya, CIO Equities at Edelweiss AMC is with us. Pradeep, thanks for joining in. Let's straight away get to the earnings math. Are you happy with the fourth quarter overall? I can tell you that, we are pleasantly surprised because usually at this time, the fag end of the earnings season, you get all the misses, all the negative numbers. But, look at this morning, stocks like Triveni, etc., MedPlus, plenty of excitement and good movers here.
Yeah, I think in and around the result days, one should look at these movements more as positioning ahead of results more than anything else. But I would say if I look at the result season on the whole, I think after a fairly disappointing December quarter numbers that came through in the form of the gap versus expectations, in this time, it's been broadly in line. So we'll still have on net balance an earnings cut of maybe 1 to 2%. But last time it was kind of fairly varied and fairly strong. So from that perspective, I would say broadly earnings have met expectations. And in the context of what's happening globally on the geopolitics side and also in India, that has held the market's nerves quite well of late.
So for the stocks you own, I mean, whether it's your universe or even if you talk about general Nifty earnings, what is the expectation that you have for this year, FY26? And has the risk of downgrades receded? My basic question is that will earnings give us the ammunition to take the market substantially higher?
Yeah. So I will start with the earnings and then lead it on to the markets. My working hypothesis is that the earnings would actually come back to the fore in the form of earnings upgrade, which we started, on the downgrade cycle somewhere in the middle of last year. And we will kind of cross that over and finally get into an upgrade cycle in the second half of fiscal year 26. This is driven by mostly 3 or 4 positives which have happened in the light of so many geopolitical negatives that we have seen. One is that oil has cracked almost 25% plus, which India being a big importer is a big positive from a consumption standpoint. Second, inflation has come off about 100 basis points overall. And third, rate cuts, 50 bits so far down, probably more to go. And finally, the impact of, the middle class bonanza that we saw in the context of union budget announced by Honorable Finance Minister, that has not yet kicked into gear. So I think from a back half of the year standpoint, the ducks are lining up quite well in general for the economy and particularly for the earnings. Might I add, of late, of course, monsoons have arrived a couple of weeks in advance. If they stick to the plan, then that will also kind of be good from the rural economy standpoint. So I think, give it a couple of quarters, economic decision-making has started in India. We will see that translate into earnings in the second half of FY26. That's why we are not negative on earnings overall. However, valuations today are fairly close to September 24 peaks. And earnings still have a couple of more quarters to go. So net, I think from here till about the time when we see earnings come back, you might see a bit of a plus minus 5% market kind of a situation. That's our prognosis of earnings and markets, Surbi.
By the way, look at MedPlus. I think it's up 6%. We had the management with us. It's back. It's into 4 digits now. So interesting. Off the high, by the way, but still holding above the 1,000 rupee mark at this point. LIC, of course, is the other one. Is the number 2 volume-led gainer right now with a 4% pop. The big underperformer within life insurers in India. The private ones have all done very well. But this one is not. You'll hear from the Hindustan Copper management. That stock is also up about 3%. Techno Electric, I think we spoke about it earlier. PG Electroplus is another one which is up about 2%. There are these RITES and IRCON. RITES is up 6 and IRCON is up about 2%. So there is a fair bit happening, although it's not showing up in any meaningful way as far as the index is concerned. Sudeep, good morning. Anything out of in the defense space that you own, that you like? I was looking at, and it's not just the HALs of the world, right? There are smaller companies. A company called Centum Electronics was up 10% yesterday. 1,200 recently, 2,500 at least till yesterday. And there are many, actually, smaller companies. But, of course, they're all, you've got to focus on the technology and are they the cutting edge? And, not easy for the layperson to assess. I don't know if you've looked at any of these names.
I think very clearly post the recent geopolitical conflict, India's defense companies and their capabilities were tested, and they've actually come out in flying colors. So one of the things that, of course, war means negative. It means from life and geopolitical standpoint, but from a business opportunity standpoint, from a medium term, it opens up exports as an opportunity for defense to come through. That's something that we have been kind of mildly warming up to. We have been overweight into defense heading into the last few months, and not just the two leading PSUs, even beyond that. But we think that a good bit of that rally from a very near-term standpoint is kind of in the price. So we would wait for a bit of a pullback for us to kind of load up again. So to answer your question, structurally positive, Indian defense has come of age. Defense as an exports opportunity will probably kick into gear over the next 3-5 years. But near term, I think the markets capture a good bit of positives.
All right. Hi, Trideep. Good to see you, Ben. Trideep, you're positive on tech post the recent pullback. Tell us, what is your preference in that space?
So tech, in our opinion, at the moment is a game of expectations more than earnings. We think that, this is the worst possible time from an economic decision making from a tech, US and global standpoint. And hence the expectations are very reasonable with regards to earnings overall. Valuations are also in line with that of last 10-year average within pockets. And hence, while we were underweight till about a few months ago, we have covered that, and incrementally we would probably be looking at it, favorably as we get into next year or so, where hopefully Trump's tax cut plans in some shape or form comes into gear, and that would mean better days for US corporates and hopefully as a follow-on on Indian IT companies as well.
Trideep, what's the biggest house overweight? I mean, across schemes, across funds, if I were to ask you about the one dominating sector, what is it? I mean, is it the obvious financial services? Is it something else?
We are heading towards a meaningful overweight towards consumption, Sophie. We are probably not there yet. We want to time it in the sync with so that we get the right prices. Themes are all fine. We have to marry it with valuations so that we kind of get the best of both worlds. But I think we are heading towards probably better days in consumption in our view as we get to the back half of this year. I highlighted a few reasons, and our portfolios are gradually reflecting that conviction over a period of time.
And, consumption is a very big basket. So within that, are you talking QSR, FMCG, jewelers, shoemakers, I mean, or the whole play?
Consumer discretionary and the premium to start with. If the monsoon and the inflation going down sticks to plan, then maybe over time staples. But that's the sequence that we are headed.
Okay. All right, Trideep, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here. And really good to get that perspective as always. Well, I think the market is down about 35, 36 odd points at this stage. 24,780 at this point in time. I think, we can maybe just look at a few names here till I wait on our next guest. I think ITC is down about 3%. It's, by the way, the big volume-led loser. Of course, it's that block, which is, I think, very clear. There is BDL, which is down about 3% at this point in time as well. BEML, Bosch, NMDC are some of the other ones which are moving around. 50 down on the Nifty right now. Well, it is my great pleasure now to welcome Dr. Raghuram Rajan to our program today. Dr. Rajan needs little by way of introduction, but let me be brief. He is one of the world's most respected economists, currently the Catherine Dusac Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He served as the 23rd Governor of the Reserve Bank of India, where he was widely credited for bringing down inflation, strengthening the banking system, and introducing key reforms that have had a lasting impact on India's economy. Dr. Rajan's distinguished career also includes serving as the Chief Economist and Director of Research at the IMF. Dr. Rajan, great to have you with us here on the program. It's an honor, sir. Prashant this side. Dr. Rajan, if I can start by asking you whether, the good news on tariffs, when I say good news, I mean, this handshake type of deal that we saw between the US and China. It's not even a deal, as someone said, not even a framework deal, but at least an agreement to start talking. Or the one with the UK. Have we seen the peak of the good news cycle as far as tariffs go? And will things get more contentious into the rest of 2025? What's your assessment, sir?
Well, I certainly think that what we need to have is more certainty on where the tariffs will land. Right now, we have, as you just said, an agreement to talk. But at the end of this talking, what happens? And talking takes a long time. So even while people are talking, are tariffs going to go back to the Liberation Day level on July 9th, 10th? For the rest of the world, is it going to go back to the Chinese levels on August 10th, 11th? I think the sense is certainly the level of tariffs that were announced in Liberation Day are probably untenable. And so they will have to be negotiated down. But where and when is the kind of uncertainty that harms business considerably also. So a lot of businesses waiting to see, are they going to keep the tariffs, at least while the talk is going on, at the 10% level for most of the world, or is it going to go back up? So some certainty on that would also be most welcome.
Dr. Rajan, when financial markets do well, it kind of papers over a lot of other stuff, some of the underlying issues, etc. And if you look at global, the big markets, they're all a few percentage points away from all-time highs. It's almost as if tariffs really will not hurt. I mean, they're pricing in little to no damage because of tariffs. What is your sense? Is it possible we actually, escape any consequences, or do you think it'll show up? Not now, but maybe a little later.
Well, there is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So when the US raises tariffs on Europe, immediately markets react negatively. The moment there is a discussion of a pause, they react positively. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now.
Just one more question to finish that loop. Do you think the tariffs are being used by the Trump administration as threats to negotiate, or do you think they're very ideological about this? And, as someone said, President Trump, in all likelihood, will not, this is his last term, so it's not as if he's standing for re-election. So he wants to effect change and bring manufacturing jobs, American manufacturing jobs, back to the States. So is this going to be a lasting theme throughout? Or do you think at some point, he's going to give in and then, watch the markets and the good stuff comes? What's your sense?
I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. And that's partly because of the ideological underpinnings of the current administration. They do believe the US has been unfairly treated by the rest of the world, but they also believe that tariffs can give the US a certain amount of sort of playing power. But I also think that right now with the tax bill, the big, beautiful bill under consideration, tariffs also play a role in being a source of revenues. And the US desperately needs a source of revenues to justify the level of tax cuts that are coming in the bill. So for all those reasons, plus the fact that I think it gives the US a lot of power because it's a big market for the rest of the world's goods, I think they're not going to go back to the old levels. The question is, are they going to be uniform across the board? Or are they going to be especially high for certain countries that are disfavored? And what is the longer-term certainty about the levels that are reached? Could it be that the administration turns on a dime and starts elevating them again for a country that it doesn't like or that has antagonized it? So I think a lot is up in the air, but almost surely we're not going back to the 3% level that the US was happy with before. It will be a higher level of tariffs.
Dr. Rajan, good morning, sir. Pleasure to be listening in to you, Surabhi here. And I'm glad you brought up the big, beautiful bill. I have a two-part question. So we're looking at two very big sort of events playing out right now. One is tariffs and whether the Trump administration can bring manufacturing back to the US or not. The second piece is the US deficit. And the bill is only going to be boosting that further. In the near to medium term, let's say if you take a 2 to 3 year view, what is the big economic reset that you forecast for the US economy? And the second part of that question is, and therefore, do you expect a flight of money, maybe not a big flight, a small flight of money, away from US assets, US treasuries, US equities?
Right. First, I think the short run tariffs are disruptive, even to manufacturing. So we will see the consequences in the second half of this year. Will it bring back manufacturing jobs? Probably not a whole lot, because a lot of manufacturing, even in India, has been automated. Look at a cell phone assembly line in India, and you see machine after machine. These are not people screwing in stuff into the motherboard. That job disappeared a long time back. So I think when the jobs come back to the US, to the extent they come back, they have to take into account the high cost of labor in the US, which means it's going to be largely automated jobs. And jobs that will be created will be for technicians who man the machines, not for the guys doing the work directly. So big increase in manufacturing jobs, unlikely. But in the longer run, I think one of the concerns this has created in the rest of the world is, are we overly exposed to the United States? And you can see it in the talk amongst financial investors. 70% of global stock valuation was in the US. And now people are saying, well, maybe we're overly exposed. We need to rebalance our portfolios, both on the equity side, but also on the fixed income side. Are we holding too much in US treasuries? So when you talk reset, I think this portfolio rebalancing will play out for some time. It is one reason why the US dollar hasn't appreciated, even while there are global concerns about economic growth. It's because people are saying, do I really want to put more assets in the US at this point? And many portfolio managers are saying, maybe I need to rebalance, not necessarily because US growth is going to fall off a cliff, but because I just think I am overly exposed to my sense that the US exceptional performance will continue. I think more broadly, we're going to see supply chains move nearer home, wherever home is. That is a process that has been underway, but that'll get a special oomph under President Trump's policies.
Okay, so, sir, do you then see only a mild reset in market flows or in sort of investment portfolios? And what about the deficit? I mean, we're very used to it. Every year there's a debate on the deficit, and then, they sit on the fence. Eventually, the bill gets passed. Just a word on how you see that shaping up, and therefore what happens to yields?
I think it's not a mild reset. I think there is going to be a significant reset, especially as areas like Europe start considering whether they should be spending more, whether they need more financing. And Europe has been sending a lot of capital to the US. As Europe starts doing more infrastructure, as it does more defense spending, some of that financing will go towards financing European asset creation. And so I think there is going to be a global reset in portfolio holdings. And that will also be accompanied by price changes. You're already seeing a somewhat weaker dollar than anticipated at the beginning of the year. And that's something that could possibly continue. So this is on the cards. Sorry, what was your next question?
On the deficit and the direction of US yields, sir.
Yeah, I mean, look, I think the big, beautiful bill is not yet fully done. I think the Senate will have a role to play. And some of the worries in recent days, which has sort of shown up in higher yields, not just for US long-term assets, but also across the world, Japanese long-term bonds. I think people are very wary at this point about being locked in to longer-term investment in government securities, given the uncertainty about fiscal space, both in the US, but also in Japan as well as Europe. So what this means is that you can't take US financing for granted. The US debt to GDP is crossing 100% net in the next couple of years. And add to that a wider fiscal deficit embedded in a big, beautiful bill. And there are some sort of fiscal engineering also embedded in it, which says some of the spending or some of the tax cuts will come to an end at the end of the Trump administration. That is probably unlikely. So when you put it all together, this bill has to satisfy markets that it is not totally irresponsible. And I think the Senate, including the Senate Republicans, will have to play a role there.
All right. Good morning, Dr. Rajan. Nigel on this side. It's an honor to speak to you, sir. Thanks a lot for joining in. Well, I wanted your view on India being able to get a fair share of the global supply chain diversification. Do you think a lot of MNCs will look to set up shop here in India?
Well, it could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them. And if India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment. Of course, industrial countries don't want to see supply chains moving from China to India and not coming back into the domestic market. But if India plays its cards well and doesn't make it front and center all about subsidies, that it is about a better production environment and it offers a very viable alternative. And some of the states in India are very interested in doing this. I think if we can do that, it could be India's moment. But a lot more action is needed, and it has to be proactive, not just reactive. It is about creating a better environment in India for foreign direct investment, something we haven't paid enough attention to in the last few years.
Dr. Rajan, in that context, President Trump's almost warning to Apple, that we've tolerated you making in China, but now come back home. And the iPhones that you sell in America need to be made in America. How much attention should we pay to those kind of statements? And actually, the question is, how much attention will Apple pay or other large global MNCs pay to something to things like this? Because I mean, companies have got to think beyond 4 years, right? Which is the presidential term.
Right. No, I mean, it would be the rare CEO who wants to cross the Trump administration at this point. But it is a negotiation ploy, not so much ploy, but there is room for negotiation. Apple can point to all the work it's doing in the US and the profits it's generating in the US as a result of its creation of new designs, new intellectual property, etc., and say that the manufacturing is essential in a cheaper place so as to get Trump products out at a reasonable price to US consumers, but also to consumers in the rest of the world. That kind of reasonable argument has to be made, but also it does indicate the importance of not trumpeting the fact that you're coming away from China and putting it in India. There is a lot of value to flying under the radar screen at this point and doing what you need to, but also having a frank discussion with the administration on what can be brought back and what can't. Screwdriver technology, assembly, stuff like that is going to be hard to bring back to the US. But certainly Apple can say that there's a lot more R&D going on as a result of its ability to sell its products across the world. And that R&D happens in Cupertino, not elsewhere in the world.
I mean, global captive centers here in India has been a huge growth industry with, I think, pretty much all large MNCs here, American and otherwise. Dr. Rajan, let's talk about the trade deals themselves, right? So we've got one with the UK. The US one, I mean, we heard, I think there were some reports saying that over the next 7 to 10 days, we perhaps will get some sort of a framework deal, like an MOU, and then the actual stuff will take more time. What is your sense? I mean, on the India-US deal per se, but more also about these bilateral deals, right? Because these multilateral kind of setups, trading setups are breaking up. It's all sort of one-to-one, country to country. So just wanted your thoughts there.
Well, yes, it is unfortunate that we're not really talking about a global mega deal. But what I do hope is some of these bilateral deals create the kind of momentum which lead a country to think about the bigger picture. It would not be appropriate for India just to do, tariff deals with the US while inhibiting other countries from benefiting from that. It makes sense for US industry to have the same kinds of rights that, for example, European industry has, which then benefits India because it locates production, it buys from production in the best place possible for India. So, these bilateral deals could get converted into a more multilateral deal, and that would make sense from India's perspective. Now, as you said, these bilateral deals are really, interim arrangements, a statement of principles on where the negotiations are taking place. Actual trade deals take a much longer time to negotiate, while there is an impetus to do it quickly. To dot the I's and cross the T's will take more time. But I do hope that bringing down tariffs with respect to the US gives the impetus for India to bring down tariffs more generally, and thereby reintegrating itself in global supply chains, which it has missed out on. This may be India's moment, and it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way.
That's a strong point, a point very well made, sir, that this could be India's moment. We should not look at protecting specific pockets of industry. We should look at the bigger picture and seizing the global opportunity here. Got your point completely. So moving now to the general sense of, monetary policy and regulation here. We're coming off from a phase where, there was a sense being built up. There was a sense that, unchecked, unsecured lending had to be regulated. And that was done by the previous governor. Since then, some of those prudential norms have been eased out. And now there's an expectation building in the market that we will be in the era of ample liquidity and perhaps big rate cuts as well. In your assessment, does India right now need that level of a monetary growth kicker?
Well, I don't usually comment on Indian monetary policy. I probably know less than I should about it. But let me set it in the global context. Outside the United States, the raising of US tariffs has been a negative demand shock. There's less demand for goods produced by the rest of the world because of the US tariffs. But also, it does give countries like China, which are big manufacturers, the incentive to look for new markets, which is also going to hold down the price of goods. China is going to look to Europe, to India, to other places to send some of the goods that are not going into the US. So all this means that inflation is less of a problem. Of course, there are India-specific reasons why inflation has come down, including the prospect of a good agricultural crop going forward. So for all these reasons, I think countries outside the United States have the ability to ease monetarily, and if that also implies easing on the liquidity front, that's a good thing. But as you caution, we have to also make sure that as we are enhancing domestic demand, it doesn't get imbalanced. We don't see pockets of excessive credit growth as we saw with the unsecured lending. We have to be a little careful as we expect, once again, that credit is reasonably well allocated, which means a continuing role for careful supervision and regulation.
Dr. Rajan, wish we could go on, but I understand you also have a tight schedule there at the UBS conference. I'm going to just ask you one last, if you will humor me, sir. You're at the UBS conference and you're meeting so many investors and so many people who are there. As you kind of sort of soak in all the feedback and all the commentary there, can I get one big non-consensus view from you, sir? What do you strongly disagree with that from everything that you've heard there? If I can ask you that.
Well, let me put it this way, consensus tend to build up, and because they're the consensus, they tend to be wrong. The consensus at the beginning of this year in places like Davos was, US exceptionalism, this is going to continue. And we've seen 5 months later that, it's going the other way. There's enormous skepticism about the US and its policies. And I would say that's again, a reason to rethink that maybe, all this plays out in a reasonable way. And at the end of it, there is still some sort of faith in US exceptionalism, the innovation, the energy in the US, is still maintained, maybe at a somewhat weaker level. You won't see that in current US policy. There is a lot of ferment going on in the US. Administration is trying to do one thing, the courts are trying to do something else. Things will settle down. But if there's one consensus right now, it is everything else is moving up, the US is moving down. And maybe this consensus will prove to be wrong.
It's lovely. And I think it's something we should pay attention to, and we'll keep the back of our mind when we conduct these interviews, because you're absolutely right. That seems to be the prevalent consensus view at this point in time. Dr. Rajan, we'll leave it at that. Thank you very much for taking out the time and joining us here on CNBC-TV18. It's a pleasure, sir, and hope we can do this again soon. Thank you.
Thank you.
All right, we'll take a quick commercial break here. We're going to come back and we'll connect with the management of Hindustan Copper to talk about their fourth quarter earnings. It's a management you don't hear from very often. So Sanjeev Kumar Singh coming up in just a bit.
Welcome back. Well, let's have a very, very special management who joins us on the show, that of Hindustan Copper. The numbers are quite good. Operationally, things have been looking up. And the globe is quite bullish on copper prices as well as demand. To help us out with how he sees things going ahead, we have with us Mr. Sanjeev Kumar Singh, the Chairman and Managing Director at Hindustan Copper. Hi, Mr. Singh. Good morning. First of all, congratulations on a rather good showing. And we request you to join us more often on the show. Well, let's start off with the basics first. I'm looking at the commentary and you're sounding quite optimistic about copper demand. Could you tell us in terms of a price range, what kind of a price band do you expect copper prices to move? Because you're the only play on pure copper prices from a stock market perspective. And also in terms of volume growth, what are you factoring in for FY26?
As far as FY25-26 is concerned, copper prices are going to remain strong because of the demand. And it's a global demand, I should say. As far as infrastructure is concerned, the EV is concerned, artificial intelligence, whatever you talk, anything green energy, it is copper. So demand is very strong, which will convert into the strong prices.
Okay, you want to give us a price range, sir, that we should be working with, given that demand is going to be strong? And as I asked you, can you give us a broad sense about how your volumes will scale up? Last year, as you'll put out in a press release, it was fairly, very good in terms of a volume growth. This year, on the base that you've delivered for FY25, what kind of a volume growth can you deliver?
Volume growth in sense of the ore production, you mean to say?
Yes, yes.
Yeah. We will definitely be going plus 4 million tons in 25-26 as far as ore is concerned. And as far as MIC is concerned, definitely it will be plus 30,000 metric tons.
Okay, all right, 30,000. So ore of 4 million will compare with around 2.73 million, if I got that correct.
No, I'll just clarify 2.73 is the production of one of my mine. There are 2 locations and 3 mining sites. Total production was roughly 3.5 million tons this year, which will scale up to 4 plus. So there will be a growth of 15% from the ore point of view. And from the MIC point of view, that is metal and copper, it will be from 25,000 to 30,000. So there also you will see a growth of more than 15%.
Got it. All right. So volume growth for the year will be in the vicinity of close to around 15%. Could you help us out? Yes, sir. Could you help us out with copper reserves? What is it currently, in terms of already discovered reserves that you have? And, since there will be a lag in terms of a timeline, we have seen globally as well, to ultimately get to those reserves, it takes quite a lot of time. Those timelines have got elongated a little bit. What are the measures that you are taking to go ahead and discover more of the reserves?
I like to put in this way, for last 3 years, our emphasis has been on deep exploration. 3 years back, we started exploring our own sites, and in last 2 years, we have added roughly 123 million tons of resource and reserves. And we will keep on exploring deeper than 1 kilometer, and we'll adding the value of reserves and resource in this way. This 755 million tons is April 24. These years' figures have not come. It will add another 15 to 20 million tons more to what I'm saying. So Hindustan Copper is focusing more and more on deep exploration. For this, we are in touch with foreign companies also.
Okay, and the last recorded reserves number that you have is how much, sir?
It's 755 million tons, April 2024. The figures of this year are going to come shortly.
And it could go up by around 20 million is what you're telling us?
Yes, definitely.
All right, and will you be partnering more with private, MDOs to go ahead and, dig deeper? And, what kind of partnerships have you already struck?
Recently, we have awarded one of our mine, Rakha Chapri, in the MDO mode in a revenue sharing. In fact, I like to mention this is the first mine outside in the metal sector to go for the revenue sharing method. It's a long-term contract of 20 years. Further, it can be increased to 10 years. And they will be producing the peak rated capacity of the mine is 3 million tons. So this will be a new restarting of the product. This was an old mine of ICC group in Ghatshila region. So this will restart. This is one of the mode. And in other mines also, in the Ghatshila region of Jharkhand, they are going to restart very soon. Within 3 to 4 months, another mine will restart.
You're also talking about reopening the Rakha mine. Is this the same mine?
Yeah, Rakha mine. It's two blocks, Rakha and Chapri I mentioned, but basically we say as a Rakha mine. Very true.
So Rakha mine reopens in the next 4 months? So sometime in the middle of this fiscal?
No, it will be in the last quarter, but restarting doesn't mean it will add to the production this year itself. But there is another mine which is known as Kendadi. This will add within 6 months the production.
All right. For this kind of capacity enhancement that you're planning, what kind of a capex plan, sir, have you laid out?
Yes. The capex plan are quite huge. This year we will be at least 350 crores, I should say, and it will go on increasing every year, I should say.
And the capex.
I would like to mention here in Rakha, we are not going to put more money into that because it is in the MDO mode. The whole money will be brought by the MDO itself. But in other mines, I just mentioned we are going to put up a new concentrator plant. We are going to deepen our mines. So these development activities will need at least 350 crores of rupees this year.
All right. Rakha mine, you'll have got into that deal with Southwest Mining Limited, the Jindal group.
Yes.
Got it. All right. And all this capex will be funded via internal accruals because they're throwing up cash flows of around 500 crores plus, right?
Internal accruals plus, you just seen yesterday, we have got approved that 500 crore bonds. We have got a lot of means. Funding is not an issue. We don't have any loan on our books, you can see very well. So the funding is not an issue for Hindustan Copper.
Yes. What kind of cash you have in your books as of now?
About 115 crores, roughly.
115 crores. Got it. And plus you're adding cash flows. What about margin outlook, sir? Could you give us, some kind of an analysis with regard to how do we see the margin trend going? Or if you want to, put up at these copper prices, this is the kind of margin that you can make. A broad analysis will be good.
Yeah, definitely. See, if you on these copper prices, because our copper prices are governed by the LME prices, you see, our EBITDA margin, if you see, it has increased from 36, 4 basis points, it has increased from 34 to 38. So this signifies the operational efficiency of Hindustan Copper also. And you just see the profits of, if you compare with the last years in the totality, the PAT has gone from 295 crores to 468 crores, and PBT has gone from 410 crores to 633 crores. So the numbers themselves speak of the performance of the company.
Okay, so at current prices, and given that you're optimistic on pricing, what kind of a margin band should we work with, sir, for this year?
It's very difficult to say, but the same figures which are going on.
So around 35 to 40% is doable?
Definitely. In fact, we will improve on this. I assure you, we'll improve.
More than 40% margin for this year, correct?
Yeah, very right.
Final question, sir. Since we have you and you rarely talk to us, we hope that changes. But there is some buzz in the last few years that Hindustan Copper could be one of the divestment candidates, or the government could be looking at selling out the company. Have you heard anything, or is it not true at all?
See, on this, I can't speak at all. I can only add to this. This is a divine metal company. We are sitting on the divine metal. The copper is a divine metal. And Government of India, Ministry of Mines in particular, is helping continuously in all aspects, not only reopening of the mines, expansions and exploration. So Honorable Minister, Ministry of Mines, everybody is helping Hindustan Copper. This is what I can add to it.
So it's not a divestment candidate because of all that you said.
I can't say about that. I can only say I earlier mentioned copper is a divine metal. We are working with the divine metal. That's all.
All right, sir. We appreciate you joining in. Volume growth of close to around 15% for the year. You're looking at margins in excess of around 40%. Capex plan for the year of around 350 crores. All of this will be funded by internal accruals. It's a pleasure talking to you, sir. I think the street likes what you had to say because as we had the conversation, the stock has moved to the high point of the day. New listing.
New bell rise, by the way.
Divine metal was a new way of looking at it.
I've heard it being described as Dr. Copper.
Yeah, but it's a divine metal now.
But it is a divine metal. And fascinating conversation. And I love the excitement that the management brought on board. So that's Hindustan Copper for you. Bell rise is the listing, which we're going to focus on. I think started about 12-13% higher. And there were pictures coming through from the exchange, the ringing of the bell, etc. I think it's 10% on bell rise. 8% now, so it's a very good start on a day when the market broadly is lower. What we'll do, of course, is we'll get our research analyst to come in and talk to us about Bell Rise, what are valuations that post the listing, comparables, etc.
Maharashtra-based company into lots of different formats of engineering, part of the engineering chain. Among the things that it's making is sheet metal, casting parts, polymer components, suspension, mirror systems, etc. So
all the right spaces.
Big player in the auto component space as well. That's about 10%. That's Bell Rise Industries. Well, on that note, let's actually go back to the market and take some technical calls as well. We've got Mitesh back with us. 60 points lower on the Nifty right now. Mitesh, hi. I'm talking to you for the first time today, so good morning from my end. How do you assess things and what's the trade now?
Good morning, Sulvi. So, earlier in the day, I was talking about the fact that markets might be range bound and we might see consolidation going on. I think that process is still on, so not much happening, to be very honest. But trading on the stock specific side, I do have a sell on Aurobindo Pharma. That's a stock which is slightly turning negative. So keep a stop at about levels of 1180 weight and look for a target of around 1120 to begin with. And the other one which I like is Deepak Nitrate, where I would recommend buying with a stop below levels of 2040 for targets of around 2130.
Okay. All right, Mitesh, thanks very much for that. We'll connect with you later during the course of the day. Need to take a break right now. On the other side, we get you excerpts from our exclusive conversation with Federal Bank MD and CEO KVS Manian on the quarter gone by and on the impact of tariff uncertainty on private capex.
Okay, welcome back. Let's get an exclusive conversation going. Remember, the fourth quarter earnings season is almost coming to an end. And my colleague Shireen Bhan spoke with KVS Manian, Managing Director and CEO of Federal Bank, and talked about the outlook for the bank, for the sector going forward. Mr. Manian also spoke about the impact of tariff uncertainty on private capex, pain in the MFI space, and much more. Listen in.
Let me start by asking you about what the outlook is for banks, specifically yours, and for the industry in general, in light of what we've seen with liquidity, in light of the possibility of another rate cut, etc. What's sentiment looking like today?
So, Shireen, liquidity is better in the system, and that is good news for the sector. Having said that, we know that policy rates will be cut, and that also means that most banks as a sector will go through some spread compression because regulatorily now 50-60% of the book in any bank is linked to repo rates. So there will be some rate pressures initially. Of course, as the deposit costs catch up over the period, there should be relief on spread compressions. Having said that, I think in general the assumption is that economy remains in good shape, and one can argue whether 6.3, 6.5, but a six-handle growth in the economy continues. And if that continues, I'm assuming that overall prospects for the sector remain.
Speaking of overall prospects, we've got an early onset of the monsoon, even here in Mumbai, for instance, and the expectation is that all of this will bode well as far as consumption, etc. is concerned. But on private capex specifically, because that question mark continues,
yes.
What is the sense that you're getting in light of the fact that we're now in an increasingly volatile and uncertain global environment as well?
Right.
Is that impacting sentiment even further on the private capex side?
So, we've been seeing green shoots on some sectors, but a consistent private capex has not happened. And I think some uncertainty on the tariffs and where it goes does play into this. And my belief is that unless there is clarity on how that is going to play out, I think some capacity creation will wait to see how that pans out.
So pause, wait and watch, that continues to be the feeling?
I would say there is some pause, wait and watch based on how these tariffs, the overall tariff scenario plays out, yes.
Let's talk about the MFI space as well, because that has been a point of stress which has been acknowledged by many banks, including yours. Is the worst behind us? Are we starting to see a course correction?
Yes, beginning to see some improvement, but I would say still not, I would say another quarter or two.
Of pain?
Of some pain, yes.
Of some pain?
Yes.
But you
maybe improving, but to see the bottom of the problem, I think we are a quarter or two away.
Still a quarter or two away.
Is my feeling, yes.
And specifically as far as the gold loan side is concerned, the RBI draft guidelines, you have an exposure in the gold loan market also. What do you see as the implications, the impact of the draft guidelines that the regulator is looking at?
Yeah, the draft guidelines are quite good. Actually, they level the playing field in all ways. So therefore, we see the draft guidelines as a positive development from our point of view, because it also makes the LTV norms common across whether NBFC banks, all of that. So I think it makes the field more level playing, and therefore it's positive.
The deposit fight, and it seems like the banks have won this round at least. What's the sense on that?
Yeah, so if the liquidity is good, I'm more positive and sanguine about the deposit growth scenario, and liquidity is getting better, as we can see. And of course, the rates are lower, and that's not necessarily good for deposits as a product. But two things. One, if there is growth and if there is then I see banking sector in general doing well, and therefore attracting credit side growth as well as some deposit side growth. And I'm reasonably positive on the growth side. Second is if liquidity continues to be good, which is what RBI's intention, clearly stated intention seems. If it remains good, I think it is good for the sector. And overall, banks will still manage to grow their deposits during this.
You talked about factoring in or baking in at least another cut as far as the MPC is concerned. June
cut
6th,
or two.
A cut or two. Is that what you're going with?
Yeah, at least just now the base case is that there is a 50 basis cut from here in 2 steps, whenever those 2 steps through the year are, and hopefully that's the bottom of the cycle is the base case assumption. Of course, we don't know whether there are more cuts than that. That will be looks unlikely today.
Yeah, I think the street is factoring in two cuts as well at this point in time. Savings rate cut. HDFC Bank moved SBI holding. What's your take on that?
No, but SBI is already at 2.7. So we cut our rates as well to 2.75. And see, there is not that much wiggle room there, but can it go to 250 maybe? It will.
So a matter of time, you think?
If 50 basis cut comes, yes, it's probably a matter of time.
So overall, at this point, what do you see as the tailwinds, but also what do you see as the most significant headwinds that you're bracing yourself for?
So tailwind is, of course, the economy at 6.5% growth rate is the tailwind. But headwind is, of course, if the growth doesn't translate into credit growth, because at least many economists have penciled in a growth rate just about the same, or maybe some of them are even penciling a slightly lower growth rate on credit. So that's where I think the headwinds can come, whether it translates into the right amount of credit growth or not. that could be the headwind.
Okay, 50 points lower on the Nifty is what you have. Interesting conversation. And of course, we'll play out snippets of that conversation with Mr. Manian through the course of the day. Let's shift focus to commodities markets. And Manisha is here with what is top of mind for her. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, I'm looking at the crude oil prices right now because we've seen a bit of a gains here. But remember, it's going to be a very, very interesting and important week as far as the crude oil prices go. Well, to begin with, it is OPEC and allies meeting, and a couple of them slated for this weekend itself. So on 31st of May, it is a OPEC and allies, OPEC plus ministerial online meeting, which will talk about production going forward and as far as July and perhaps beyond as well. And then 8 of those OPEC and OPEC plus members will meet on 31st of May yet again, and they would talk about on whether or not they can keep up with these production quotas that have been assigned to them. So interesting cues coming there. Remember, OPEC has started to increase production and intends to increase it to 2.2 million barrels per day by the month of November. Apart from that, we also have seen Iran hiking prices for Asian buyers for the month of June. This is $1.8 a barrel above the Oman averages that India buys in there and most of the Asian countries as well. So that also seems to be supporting the prices. And US has been talking about potential new sanctions coming in on Russia if that ceasefire or the conversation between Russia and Ukraine doesn't happen soon enough. So that is yet another thing. And then the markets also are looking at impact perhaps from US barring Chevron from exporting crude oil from Venezuela. Remember, those sanctions have come in for Venezuelan oil exporting companies there. But US also says that Chevron can continue to hold its assets in Venezuela, but it cannot expand any more activities within that country. So various stuff happening around the world, and that has been keeping the crude oil prices around that $64, $66 per barrel mark. Markets also are then looking at Iran conversations. Remember, we have seen 5 rounds of conversations also already happen. Now, Iran says that it is open to compromise on its nuclear program in talks with the US, but Iran also says that it should be allowed to continue to process its interest in sense of nuclear energy there. So that conversation, while on the positive side, but still is far away from having happened there. The markets then also are looking at Baker Hughes' report, which suggests that there's a constant decline in US oil and rig count. It's to the lowest since November 2021 right now. So this whole conversation about US will increase production a lot isn't really happening, and that's what's supporting the markets there. As I said, OPEC allies meeting is something that the street will watch out for. But apart from that, it also is about the Fed policy meeting minutes. Well, that gets released today. The markets also will watch out for the first quarter GDP numbers from US. It also is about the PCE data that comes in on Friday, and then weekly jobless claims numbers. So lots of data, lots of meeting events, and then of course those statements from US are never ending. All of that impacting the crude oil prices right now.
All right, Manisha, thank you very much for that. That is the triggers to watch as we go forward. We'll take a quick commercial break here. We're going to come back in just a bit from now. We'll have the management of Balrampur Chini joining us as they start production and establish the first polylactic acid plant. It's a project they've spoken about in the past quite a bit. It's coming up in just a bit.
Welcome back to Bazaar Corporate Radar. Let's shift focus now, and joining us is Balrampur Chini Mills MD, Mr. Vivek Saraogi. Remember, the company has signed an MOU with the UP government to establish its first polylactic acid plant with an investment of almost 2,850 crores. Mr. Saraogi, hi, many congratulations. And what really led to a sugar and ethanol company going in for bioplastics to begin with?
Maharashtra being the largest contributor to GDP, and Maharashtra and Gujarat house the maximum MSMEs, our pitch to the Honorable CM was to declare a policy for adoption of bioplastic for the MSMEs. We know his passion for, plastic and the problems caused by plastic. So he also reiterated his thinking, and that was the idea. And to get all the stakeholders in a single room.
Mr. Saraogi, so to begin with, what is the overall capacity for this? The investment numbers, of course, have come out in the press release, but what is the thought behind, and what are the numbers looking like right now?
So as informed earlier, it's 80,000 ton capacity in UP with a capital outlay of 2,850 crores to be commissioned in October-November 26.
Mr. Saraogi, we do understand that when it comes to climate change and renewables and bioenergy, bioplastics even, there is a lot of support and incentives from the government. At currently, the kind of government regulations and incentives that we see, how are you making use of that?
We are seeing a lot of interest both from the central government and state governments. And we're interacting with Ministry of Environment, Ministry of Chemicals, who's our nodal ministry, so as to Department of Biotechnology, that's DBT, under whose stewardship this Bio E3 policy was declared. And I think we are making good progress.
As is with everything, what are the challenges that you foresee onto this one, and how are you dealing with that?
Basically, it's to get the two sides to it. It's to manufacture the 100% capacity of the right quality. We do definitely feel confident. We have the best technology partner, Sulzer. And the other side is to sell it at the correct price. We are working on that, and we're making very good progress. And I'm very hopeful there also. We're hopeful on both the sides. Two separate teams are working on each direction. So it's to manufacture at the correct cost and be able to sell at the reasonably correct price, therefore giving us our margin. To enable us to, if successfully done both, and why if I.
Mr. Saraogi, also enlighten us on the overall market that is there to bioplastics, and what is the entry, or what is the market share that you're focusing on here?
We would definitely look to enhance our capacity. And the market is huge. It's in millions of tons. It's 4 million tons. And we're talking 80,000 tons. So that's the market. The single-use plastic market, and again, is huge. Avantika will give you the details. So everybody says we want an alternate product before we're able to enforce the legislation. So that's how we feel. Once we engage with them and show them the production, it will be quicker. But I'm confident. The interactions with the buyers, converters, policymakers, all are giving a very positive vibe.
All right. I will talk to Avantika about this in detail, but since we have you with us, I also want to talk about sugar and ethanol. And ethanol price revision is long awaited. Last couple of years now, I do understand that sugar as an industry has been making a lot of presentations on this. Where do we stand on that right now?
This problem has cropped up in the last 2 years. The first was the election year, which I think as an industry and responsible industry, there was fear in the mind of government. And therefore, that 1 year was well accepted in our minds. What happened last year was not par for the course. Now we are engaging very deeply with the government. They also, I think, have understood that if they are to sustain this, they would have to match FRP and ethanol pricing. I think it should get back on even keel. However, the timing for that would be September, October. That's when that price is usually declared. So I think I'm very positive. But, last 2 years, 1 year, I've explained, the last year was a bit of a shock. It is digression from a well laid out well-run policy over the last 5 years.
Oh, well, that point is well taken. Mr. Saraogi, what about the sugar exports? And last year they were banned, and this year we saw them start a bit hesitant onto that one. But what are the exact numbers now of the sugar export done from the country? And also minimum selling price of sugar is yet another thing that has been on cards, desired by the industry. What are the conversations, the latest updates on that?
8 lakh tons have gone out against a export quota of 10 lakh tons. I think, 8 lakhs would go out contracted. I think 6 plus has gone out. And your second question was on MSP. So again, this is going to be part of the same same policy paper. They would do it together. But yes, MSP is lying on their desk for a lot longer time. So we are pushing on both the sides.
Mr. Saraogi, a final question then. And while this year for sugar and ethanol has been slightly jittery, we also do understand that ethanol more is about grain and less about sugar right now. But how is the next year's season looking to you? The monsoons have been good. The sowing numbers seem quite strong as well. So any numbers that you can share from next season?
Yes, that definitely would, in my mind, encourage the policymakers to answer this question of ethanol pricing. So I would also feel that, 5 million tons of diversion to ethanol would close the case. I don't think we'll be then standing at a surplus. We have capacity, and we will next year have enough cane to be able to do that 4.5, 5, which should be the maximum available surplus. So if we look at pre-ethanol diversion, I think 330, 335 would be or 33, 33.5 million. If you divert 4.5, you won't be left with any surplus. So that would not then trouble the sugar pricing regime. Having said that, ethanol price must be done to encourage that diversion.
Maybe take that point. Mr. Saraogi, thank you so much for joining us here at CNBC TV18 today. Many congratulations again for that new leadership role that you're playing when it comes to bioplastics and, of course, talking to us about sugar, ethanol and the way going forward. Well, with that, it's a wrap on Bazaar, but Chartbusters comes up next.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the market's a little under the weather today. The Nifty is down close to around 50 points. The Nifty Bank, though, is faring relatively better. And plenty of stocks on the broader markets actually are doing a thing of their own. Hey, Mangalam.
It's been the case, right, Nigel, for the last few trading sessions where the frontline index behaves in a bit of a range, consolidates. There is volatility, no two ways about it, but it is range bound. And in light of that, we have the broader markets which continue to do well. So your portfolios look a lot better than what the screen would show you. Let's get in some ideas for profit then. Bharat Jinani joins in with a stock that he's been tracking. Bharat.
Today's idea is Seller World Limited. The company posted better than expected performance in Q4 with revenue growth accelerating to 15% YOY. The commencement of the new glassware facility at Rajasthan and improved consumer sentiments led to the strong performance. The company expects the growth momentum to continue and has guided for 12 to 15% growth in the current fiscal. The company will continue to introduce new products as well as SKUs to drive the performance. The company is also deepening its network presence and also ramping the modern trade and quick commerce segments. The recent BIS quality norms introduced by the Government of India on steel bottles is expected to curb the imports, particularly from China, and lead to market share shift towards domestic branded players like Seller World Limited. The company is ramping up its production capacity. The new glassware plant at Rajasthan is ramping production, and the company is also planning to set up a new manufacturing facility for steel bottles. The extension of the BIS norms to other consumer wear categories would be a significantly positive development for Seller World Limited. The company has a strong balance sheet with a debt-free status and a healthy cash flow generation. This would enable the company to tap inorganic growth opportunities and boost the growth momentum. The company is also looking to reduce inventory and improve the overall working capital cycle. At the current market price, the stock is trading at a PE of 30 times FY27 projected earnings. Investors can add the stock.
All right, thanks a lot for that. For the time being, though, I'll tell you what, we'll slip into a short break. We've got a couple of big managements lined up for you on the show. So we'll take that break, we'll come back and get chatting with one of them. Welcome back. Well, the breadth of the market is still positive, and we have a couple of stocks actually that are doing very, very well. One such name that's doing well in today's trading session is the new kid on the block. We have Belrise Industries that listed today. It listed at around 100 rupees, which is a premium of around 9% in comparison to its IPO price. And the last time that I checked, the stock was still trading in the green with a gain of close to around 4%. To help us out with the outlook going ahead, we're joined by Mr. Sumit as well as Mr. Swasthit, who joins us on the show. Hi, gentlemen. Good morning and congratulations to y'all. Recall having a chat with y'all, when the IPO opened up. And it seems the street is extremely excited with this listing because volumes are massive and it's been a good first hour of trade for y'all. Let's get a couple of numbers, though, out of y'all. As y'all promised, before listing, that y'all will have the liberty post-listing. So either of y'all can take this question.
Sure.
Y'all mentioned that y'all have outgrown the industry and y'all are quite optimistic about growth. So tell us what kind of growth can we look forward to FY26 on whatever kind of base that you deliver in FY25, and split it up for us. Throw in some color out there. What could the revenue mix look like and how much of it will come in from exports? Go ahead.
So I think we will not be able to give a particular guidance for FY26, but we feel in a medium term, we want to continue outperforming the industry like we have done over the past 8 years or so. We expect to grow much faster in the industry going ahead. And this will be done through a mix of organic and inorganic. I think organic-wise, we have 3 plants coming up, as we discussed last time. And apart from that, the inorganic acquisitions of H1, which was recently acquired, we feel will have very strong tailwinds going forward. So expect outperformance of the industry to remain the way it has in the past.
What kind of growth are you working? What kind of growth are you working with for the industry?
In the two-wheeler industry, we expect, based on CRISIL numbers, we expect it to grow at 7 to 8% CAGR.
And normally you'll outperform by how much? 2 times the industry, 1.5 times? What is it?
I think in different years it's been different. So,
okay, you know what, Swastik, I'll try and help you here. Because the last time Sumedh joined us with your father as well, he said that over the last 10 years or so, the industry has seen volume growth of almost 1.5%, whereas your revenues have grown by about 10%. Now, volume and revenue are not directly comparable, but if you could give us a sense, if you're expecting the industry revenue to grow by 7 to 8%, then how much higher can you typically grow?
I think going back, I think we will not be giving guidance for the immediate term. I think in the medium term, we expect to outperform the industry considerably.
Your CAGR has been 10%, 10.5%. Do you expect to outgrow that, or do you expect to grow in the same range in the medium term?
We'll be going faster than that.
How much faster?
I guess we'll find out.
Okay, all right. What about exports? That's a part of your business that you would like to grow. It's still very, very minimal. So say in the next 3 years, where does exports as a percentage of the contribution go to? And as you all mentioned, because of this inorganic growth that you all have done, currently the highest amount of dependence is on the two-wheeler space. But you'll gradually start ramping up, the four-wheelers as well as, I think, CV we mentioned the last time around. So what kind of a revenue mix can we look at?
You want to take that? Sure. So currently we're about 11-12% in the four-wheeler plus commercial vehicle space. So expect to grow, obviously with our significant presence in the two-wheeler industry right now. We believe we can grow faster in the four-wheeler industry, and that's where our future revenues will come.
So from 11%, what is it headed to?
So for 11%, I think it depends on what the complete business also heads to. So it'd be tough to give you a number as to what the mix will be for four-wheelers and commercial vehicles. What we can say with surety is four-wheeler and commercial vehicle will grow much faster as compared to two-wheelers for us as a company going forward.
When you say much faster, is it a multiple or is it a percentage?
It'll be ideally a multiple, yes.
Ideally a multiple. So suppose 2x, whatever your overall business grows at, this grows at 2x. What does this do to your margins? Because, realizations in four-wheelers are higher. You realize a lot better in terms of the value that you provide there because the overall price of two-wheelers and four-wheelers, four-wheelers and CVs are a lot higher than that of two-wheelers and premiumization too. Your margins in the past have been in that 12 to 14% band. Do you see that increasing to say 14 to 16% and thereafter maybe beyond that higher? Do you all have plans?
So margins-wise, I think we're comfortable at the current margins that we've been. I think last couple of years we've been around that 12.5 to 13% blended EBITDA percentage across all of our businesses, including manufacturing and trading. So I think that's an EBITDA band that we're comfortable with. I think four-wheelers, commercial vehicles may have a potential upside in terms of the EBITDA, but the fundamental challenge over there continues to be volumes across OEMs. So there's a lot of up and down happening between OEMs in the top 7-8 OEMs. So if the volumes do well, there can be a potential upside. But for now, we think we're quite comfortable with the 12.5% to 13% band that we are at right now.
Okay, and exports is the margin accretive business?
Exports is a margin accretive business.
Right.
Okay, and where is that number headed as a percentage of the mix?
We don't have imminent plans for exports to, reach a certain number. I think a lot of it will evolve based on geopolitical situations. For us to give a number before understanding how India is, trading with the world is critical to understand. I think over the next few months there'll be more clarity. Based on that, I think we will further fine-tune our strategy and thus be able to make more informed decisions about what type of geographies we want to work in and what type of customers we want to work with.
Okay.
There's two things I can say. One is we don't have...
Please go ahead.
One, we don't have direct exports to the US, so that allows us to... so the US tariffs don't really affect us directly. And secondly, we have exports to Europe, and the US, the UK, India FTA that is coming into play will help us to grow in that space as well. So two positives on the export front.
Right. If you could give us this number, and this is something that we had asked of y'all when y'all joined us when the IPO was opening as well. This is just to understand your growth going forward. Is that earlier you had a certain realization per vehicle. Over the last 5 years, how has that increased per vehicle in terms of the product offerings that y'all have increased to your clients? And how is that likely to grow? Yes, on the one hand, your growth will be predicated on how the industry grows and how you all get more products coming in for newer vehicles, etc. But how much of your growth will come from you increasing your contribution to the same vehicle going forward?
Correct. So content per vehicle has gone up by a fair bit in the past.
Would you quantify that?
Maybe by close to 40 to 45% over the past 7 to 8 years. Going forward, we have a slew of new product launches or new components that we are offering to our OEMs, including steering columns, some filtration products. We are working a lot with premium vehicle segments in the two-wheeler segment. So we cross almost all of the premium bike makers in the country, and there's a trend towards premiumization that's happening in the past 5 years. People are wanting to spend more on discretionary needs in a two-wheeler. People want to buy a high cc bike that serves a purpose beyond just a necessity. So I think with premiumization, our content per vehicle will also go up because, of course, with premiumization, there is a higher aesthetic quality required on our components, which in general increases content per vehicle. And apart from that, the size and weight of the vehicle, of the components also go up, due to which, again, content per vehicle increases. So a couple of those factors will allow us to continuously increase our content per vehicle going ahead.
All right. So, I'll have to ask you this because you aren't giving us actual numbers. So, hypothetically, the next 100 rupees of sale, if you had to break it up, how much of that would come from the industry growing? How much of that would come from you increasing your, offerings to newer vehicles, say four-wheelers and CVs? How much of that would be via exports, and how much of that would be via, premiumization and contribution per vehicle? If I had to break it up that way.
So we're unable to kind of go into that detail at this point of time. I think it'll be a work in progress as we, increase our content per vehicle, increase the number of OEMs, and increase our exports in the future. I think, the focus remains on outperforming the industry consistently. We've done it in the past as a track record. We'll want to continue doing it consistently in the future also. And as you mentioned, I think the four-wheeler commercial vehicle segment will grow at a multiple as compared to two-wheeler segment going forward.
Okay, all right, gentlemen. Thanks a lot for joining in. Being quite tight-lipped, I would say. But maybe on the next earnings, we remain in hope that, in fact, you'll give us more details. For the time being, enjoy the day, enjoy the evening. It's a great day for you, company. Regards to your father as well, as he was quite passionate when he was talking about the business. Thanks a lot for joining in. Well, time to slip into a short break. On the other side, we'll be joined by the Managing Director of Triveni Engineering. Stay with us.
carefully.
Welcome back. Triveni Engineering, that's the stock on our radar, up over 7.5% as the company reported their fourth quarter performance. The revenue growth at 25%, although there was some contraction in the margins on account of the ethanol business. Tarun Sawhney, who's the Vice Chairman and Managing Director of Triveni Engineering, joins in now to discuss the numbers. Tarun, a lot to speak with you on sugar, on ethanol, on procurement and engineering as well. So let's start with sugar. The street likes what you've said in your performance and what you've done as well. You've seen a near 10% increase in consolidated crush, whereas the industry-wide numbers were a lot lower. How did you manage that and how sustainable is that? That's point number one. And secondly, your sugar inventory was 37.5 rupees per kg, realizations at 41. Is all of that in the price, or is there more scope for margin improvement going forward? So on these two parameters, we'd like your thoughts first.
Good morning. Yes, we're very satisfied with our Q4 performance. It was a challenging year in many respects, but Q4 certainly had a lot of positives, and it also bears well for the immediate future. Now, answering your questions, of course, we had acquired a company during the course of the previous fiscal year, and as a result, of course, that led to a higher total crush number. But on a standalone basis, our crush was, broadly speaking, the same. I think that was still significantly better than the bulk of the industry. We were right at the very top. And I think that was because of years of driven sugarcane development activities that we have across our 7 and now 8 sugar factories. So I think going forward, I do see good signs for sugarcane production this off-season. The rains forecast are significantly higher than the long-term average. That, frankly speaking, as long as it happens over an even period of time, should not be a concern. In fact, it should be a positive. So everything bodes well for the future, and I think the past has been quite comforting. I'm sorry, your second question?
Your realizations and your inventory. Inventory was what, 37.5 rupees per kg, realizations 41.
Right.
Is that all in the price, or there's further room for margin improvement here?
I think going forward, of course, we're in a lean season right now. This is when the bulk of the consumption of the country happens. Prices are always a little soft as we go into the summer, and then they pick up during the holiday season, August, September, and October. I think that there is a little bit of scope for prices to improve. And I think that they do need to increase a little bit, because the long-term averages are actually reasonably disappointing. If you look at 5 or 6 years, the expansion in pricing for sugar as a commodity has been very, very poor. So what we've seen over the last 4 months or 5 months is actually a function, of course, of the balance sheet in the nation. And I think there is scope for a little bit of margin, a little bit of improvement in pricing.
Okay, all right. Hi, Tarun. Good to see you, Ben. Well, the alcohol business profitability has got impacted a little bit, but I think the street is a little bit optimistic on a recovery. Could you tell us what is your procurement strategy and what kind of impact will it have on the margins in the business?
You've asked $1 million question. The challenge in fiscal 24-25 has really been the ethanol business. We've been squeezed from both ends. So you've seen higher raw material procurement prices, the price of molasses that has been procured or even transferred to our distillery has been at a higher base. And of course, we procure an equal quantum of grain, be it maize or rice, from the open market, and those prices have also risen quite substantially as there's been pressure on the system and a new player, the ethanol industry procuring a very large quantum of maize across the nation. Now, I think that has actually impacted the profitability of this business in the year under review. However, going forward, I think what we're seeing is that there are new varieties of maize. There's been better planting, better yields that are coming in on maize, and we've seen the price of maize actually decline quite nicely as we've seen the UP crop at this particular point is being harvested, and we're seeing prices come down quite nicely. So the scope for margin improvement in Q1 is certainly there as far as maize or ethanol produced from maize. However, going forward, I think it's a very difficult scenario. I think procurement strategies are going to be absolutely critical. The fact that we have to employ better warehousing, better storage strategies in terms of ensuring that we can eke out every last percentage of improvement of margin is going to be the name of the game, and that's going to separate the more successful people in the ethanol business going forward.
You preempted my next question, actually. You said procurement strategy. Remember, maize a year ago was 33%, and now it's 51%. What's your procurement strategy going to be here? And to that extent, what is the kind of margin improvement that you see in this year? Last year, you did sub-double digits. Do you think you can go back to above double digits for starters and then maybe look at, low teens to mid-teens towards the end of this year?
I won't comment on the margin, but I think that because that's very difficult. It's a crystal ball. It really depends on where the pricing goes. It depends on, you see, we have ethanol prices that have already been set until the end of October of this year. So 5 months of this calendar year will be with the new ethanol pricing. The hope, of course, is that there will be some increase after 24 months, because for the last 2 years, we've had absolutely no increase in broad pricing as far as ethanol is concerned. So if we do have some increase, then of course that will lead to an expansion in margin. I think that is essential. But let me just pivot the question. As you all know, Niti Aayog has been mandated with looking at what's beyond E20. We've touched E20 pretty much. We're right about there, and we've done this in advance of the Honorable Prime Minister's agenda, which is a huge achievement for the nation. Now, the question, of course, is what beyond it? For any additional ethanol expansion for the nation, we will have to have brand new capital investment. Thousands and thousands of crores need to be invested. For that to happen, we need to have attractive margins. Otherwise, that conundrum, of course, will be there as how will we get the ethanol for beyond 20%? So when we find answers to that question and actually have the mandate for the quantum beyond 20%, I think we will see some margin improvement. And that is my hope for the immediate future for this industry.
All right, Tarun, you've commissioned, I think, a new distillery. So if you could give us a few details. What kind of utilization levels is it functioning at? If you could tell us what kind of ramp-up are you looking at, which would entail, what is the volume target for FY26 with this new distillery in comparison to FY25?
Right. I think the quantum of volume is going to be just marginally higher, single-digit increase in terms of the total quantum of ethanol production, because this distillery did operate for the majority of the last fiscal year. I think Q1 was when there was some commissioning happening, and perhaps the utilization levels weren't at 100% capacity. But for the remainder of the year, we've operated at near peak capacities. So the incremental increase in total quantum of ethanol is going to be marginal for the group. However, I think the balance is really going to be the procurement, the strategies of balancing rice versus maize versus molasses versus, and the two different streams of molasses, B heavy and C molasses, and trying to actually look at a maximization of margins. At Triveni, 60% of our distillation capacity is multi-fuel. So we have the flexibility of changing streams between molasses and grain, and that offers great flexibility. And I think going forward, that is really going to be very important in terms of maximization of results.
And basis your current strategy, how much in terms of cost savings are you expecting on account of these procurement strategy shifts?
So, I won't take all the credit for it. I think the reduction in grain prices is certainly contributing towards the expansion of margins in this quarter. And going forward, if we can see better grain prices, I think that will certainly add to profitability. However, the strategies of storing well, the strategies of maximizing the DDGS, the effluent from grain distilleries is sold as animal feed across the nation. So it has considerable value. And the strategies in terms of developing better quality of this animal feed will certainly expand margins. So there are many moving parts at this particular point. It is a young industry. It's received a tremendous amount of support, but it still requires a lot more support, especially with respect to pricing and with respect to feedstock development on the other hand. But I think there are good things to come. And it will certainly help in terms of, better quality of emissions and air quality, and of course, saving foreign exchange at this very precarious time.
All right, very quickly, Tarun, before we let you go, you were merging one entity into the core business and you were demerging the power business as well. What are the timelines for this particular demerger, and how do you see that business ramping up?
Right. We're awaiting SEBI approval. It's a process-driven strategy, and at this particular point, we're waiting for SEBI approval, post which we then go to NCLT for the other approvals. But I think we're broadly speaking on track. We had anticipated that by the end of this calendar year, early into the next calendar year, we will have this merger and separation, vertical demerger of our power transmission business. The power transmission business, as you asked, actually has done very, very well. So in Q4, we grew it. The quarter-on-quarter growth was over 55%, driven by exports. We're seeing a huge amount of growth over there, especially as far as our European customers are concerned. On the domestic side, yes, there is growth, but it's moving at a different pace. So the market, our canvas, having broadened, and now our addressable canvas being a global one, has really allowed us to expand this.
Right. Roughly, what kind of order inflow are you expecting in FY26 on this business? And also the defense business, because you've already gotten a second propulsion gearbox order from MDL. What kind of expectations do you have for FY26? Quickly before we let you go.
Right. So I think, we don't typically give advanced estimates, but, for the year gone by, we had almost 500 crores of order booking, 475 crores of order booking in the power transmission business, which includes the defense business. And I think that is a sheer sign of what one can expect. That type of growth is what one can expect in this fiscal year as well. Both businesses are doing very well. I think the push on defense has been very exciting. Our majority of our business is with the Indian Navy, which is investing very heavily in capital ships, and we support the mechanical side of it, all the way from gearboxes to shaft lines to stabilizers, etc. The list goes on. So, exciting times, and I think that of course will, private sector participation in defense is just beginning. It's the inception. Right. So I see a lot of positivity going forward.
All right, all round positive news coming in from you. Good numbers, but they can get better with regards to sugar realizations, with regards to your margins in the ethanol business, and more importantly, a better outflow is what you're expecting in terms of orders coming in from the government on both power transmission and defense. The street likes that. Stock up. Wish you good luck for FY26.
Thank you.
With that, we wrap up on this edition of Chartbusters. Stay tuned. Trading Hour comes up next. Thank you for watching.
Good morning. Welcome to Trading Hour. It's a Wednesday morning. The time is 11 o'clock. The markets are subdued for the benchmark indices. Not lost too much, just down about 0.2%. But the story is in the broader markets and its outperformance yet again. Midcap index is up nearly 0.5%. And now so far, week to date, the Nifty is down about 0.4%, while the Midcap index has surged 1%. Hi.
Hi, Rima. And it's been that kind of a week as well, right, for the markets. It's neither here nor there. And this is a very important session also because it's a sandwiched session. We had a Sensex monthly expiry yesterday. We have a Nifty monthly expiry tomorrow. So it would not be a surprise that we remain where we are currently and we continue to be in this dull drab range that we've been in. And the actual action tapers out over the last 2 days. Of course, we are looking forward to some very important global cues as well overnight with the Fed minutes and of course the Nvidia results that will be reported after market hours in US times. So we keep an eye out on that. Of course, not to take away from the fact that, as Rima was highlighting, plenty of action in the broader markets and Techno-Electric is one of them. We'll get Amakshi over the course of the show for more details on this. 10% higher on that stock. It's the top gainer on the Nifty 500. And Triveni Engineering, we just heard the management a few minutes earlier on the channel, 8.5% higher on that stock as well. But can't say the same for Gujarat Fluoro. A downgrade has come in from DAM Capital earlier this morning, so 5.5% lower on that stock as well. And Bharat Dynamics, of course, margins being way off the mark compared to what the management had guided for the full year. That stock trading around 3.25% lower. But so far, so good. There is no reason or no dynamic moves that we have seen in the market so far.
Indeed. And remember, we're coming to you live from the CNBC-TV18 Motilal Oswal studio. And let's get the show started then. And right on top, we've got a conversation coming up as the UBS Asian Investment Conference 2025 is underway. And Naveen Killa, who is the head of APAC Telecommunications, Media and Internet at UBS Investment Bank, is now joining in with his thoughts. Thank you very much, Naveen. Look forward to this conversation. You recently met with 30 investors in US and Canada. And you spoke to them about the India telecom internet space. You compared it with the rest of the Asian peers. What were the big key takeaways?
Absolutely. Still jet lagged, actually. So look, on the India internet space, which is where the conversations are a lot more, I think the discussion centered on two main things. First is the extremely high competitive intensity that we are seeing in the quick commerce space, particularly in the last 6 months with the entry of several new platforms. Investors are obviously a little worried about that. But at the same time, they're also mindful of the long-term substantial growth opportunity in the quick commerce space. And therefore, I think at the end of the day, I kind of sense that there is a positive bias, but maybe they're on the sidelines for a little bit. On telecoms, I would say there are probably three main things that people are discussing. First is tariffs, which have obviously gone up a lot in the last 4 or 5 years, but there is an anticipation that they can keep going up. But as the base gets higher, is it easier to keep increasing prices at the same pace? There's obviously increasingly a lot of questions around satellite broadband, given the recent deals that both Bharti and Jio have announced with SpaceX, and what could that mean in terms of technology evolution and roadmap. And then finally, with telcos in particular, there is always this conversation around cash flow generation, which the sector tends to generate a lot, and what that therefore means in terms of the utilization of that cash for future investments versus dividends.
Okay, so those were the questions, Naveen. Now it's your job to give us the answers to that. So let's talk about the internet space. Without getting into stocks, broadly you're bullish on the two internet, quick commerce kind of stocks like Swiggy and Zomato. The UBS view is a buy call on these stocks. Now, as you pointed out, investors are concerned about the rising competitive intensity. The numbers show the losses are deepening in the quick commerce side of the business. What would your answer be to that? And why are you bullish on this space?
So I would make two observations. One is you do need to look at the size of the pie, which is expanding at the rate of 100% per year. And I think we are constantly redefining what is quick commerce. A year ago, we would have said quick commerce is basically concentrated in 30 cities, predominantly centered on groceries, and mainly focused on 15-minute deliveries. All three of those assumptions are changing today. Quick commerce is available in closer to 100 cities. Categories are expanding way beyond groceries, and platforms are going into 30-minute, 45-minute deliveries as well, which expands the market in a big way. So the first point I would make is that the total addressable market, or TAM, here is very substantial. And that is something that we obviously have at the back of our mind. Secondly, in terms of the cash burn and the losses that you talked about, So there are two drivers of that, right? First is the increase in marketing costs, which we are seeing some signs of stabilization. Again, there will be some quarterly fluctuations, but we think the worst of the competitive intensity is behind us. The second and the bigger driver of margin decline is the rate at which new dark stores are being built, because that brings a fixed cost in the system, and it takes a dark store 3-6 months before it gets the scale that it needs to become break-even. That pace has been extremely rapid in the last 6 months. But our view is, again, that is starting to peak just because of the size that they've reached. As I said, we are already in 100-odd cities. So as these two factors start to play out, again, it's tough to say which quarter it is, but we are probably very close to the bottoming out of that margin trajectory, and that explains our positive view on the space.
Naveen, good morning. Thank you for joining in. Firstly, before I get to more granular details of the telecom space, there has been this lingering threat/opportunity of satellite communication becoming a part of the Indian system, and the incumbent telecom players have expressed their views on what it should be. But do you see this as an opportunity, or do you see this as a threat for the incumbent telecom players in India?
So, I mean, the first caveat I must add is that this technology is evolving so rapidly that we honestly have no idea how things will evolve even 2 years out. But that being said, what cannot be denied is that the cost per GB for satellite will always be a multiple of what it would be using the traditional mobile broadband technologies. And in a price-sensitive market like India, I think that will always be a bottleneck to massive adoption. I think the fact that we have started seeing telcos doing deals with satellite operators rather than the satellite broadband operators coming separately in the market kind of proves that at the end of the day, the telcos start to see this as an additional service. So think of today a network that does not reach maybe 5 or 10% of the population. The satellite technology can help you get there, monetize that part of the business, and also help you manage the capex that you otherwise would spend to cover extremely remote areas in the country. Of course, in return for that, you might have to share some of your revenues with the likes of SpaceX. But in the context of the premiumization from better quality and just the fact that there are extra customers that you can cater to, I think the upsides can easily kind of offset the costs. So as of now, our view is that it's probably going to be incrementally positive. But if the technology evolves to a point where the cost per unit is comparable to mobile broadband, then I think obviously the conclusions could be very different.
But as of now, you don't see that possibility. But are investors baking in any upside for, say, a Jio, Bharti, any of the incumbents on account of satellite communication, or not yet?
I don't get the sense that they are. And I think the reason for that is, remember, at the end of the day, India is a reasonably well-covered market, right? So from a population perspective, you have more than 95% population coverage of 4G and 5G networks. So ultimately, what you're talking about is a very small subset of the customer base that could be incremental. I think the opportunity that could be bigger is if you are able to charge more to the customers by giving them the proposition that you now have 100% geographical coverage. And whether the customers will be willing to pay for that, because you do not always go into areas where there are blank spots. That opportunity could be a lot bigger. The incremental customer opportunity is marginal.
Got that. Well explained. Naveen, one final question. For an emerging market investor who has a choice to invest in India Telecom, India Internet stocks, and the comparables in Asia Pacific, what would the pecking order be? Where would India stand in that? How would the valuations versus growth stacked up?
So I would say, first of all, remember at a time of massive global macro uncertainties, we are definitely seeing investors who are looking for businesses which are immune to some of these external factors like currencies and interest rates and all of that. And positively speaking, both telcos and internet actually fit into that. Domestic businesses, largely local currency revenues and largely local currency cost bases, and much better balance sheets. So I would say the whole space kind of fits in well within that thematic of being unimpacted by the broader macro. That being said, I think in terms of your pecking order, I would say that, from a longer term upside perspective, we clearly have a preference for internet. Both the customer growth as well as the revenue opportunity there is very substantial. Telco is a relatively mature business, but obviously one that gives you solid cash flows. So our pecking order would be India Internet first, followed by India Telecoms.
All right, Naveen, thank you so much for sparing time and joining us today with your views on both the internet and the telecom space as well there from the UBS Asian Investment Conference 2025. By the way, the Nifty continues to remain 50 points lower, 170 down on the Sensex. So it still continues to remain in that very narrow range. Does the index in today's trade as well. Take a short break, but on the other side, all things commodities with Manisha Gupta. Welcome back. Just mentioning a few minutes earlier about Techno Electric being the top gainer on the Nifty 500, 11% higher on that stock. Very strong quarterly results coming in from the company, and Vamakshi is here to decode just that. Vamakshi, good morning.
Good morning, Hormaz. Good set coming in from the company. When you look at the revenue growth, that has come in very strong at almost 86% on a year-on-year basis. When we look at the gross margins, however, they've contracted by around 91 basis points. But given the kind of decline we've seen in other expenses, and the total expenses growth as well was not as much as the revenue growth. So therefore, what we're seeing is that the EBITDA margin has actually expanded by 315 basis points, resulting in a 133% jump in the EBITDA, which came in at almost 127 crores. The net profit too, given the kind of growth that we've seen in the other income, is also seeing a very sharp uptick of almost 74%. In fact, the whole second half for the company has been quite robust. But when we look at the company's numbers on an annual basis, revenue is at a multi-year high at 2,269 odd crores. The EBITDA margins too have improved consecutively for the third straight year, and in fact they are at the highest level seen since FY22, and the cash flow for the company, which was negative in the prior year, has now become positive. All of this bodes well for the company. Therefore, we're seeing a very strong uptick.
Thank you very much for that. Now let's shift our attention to commodities. Manisha is now joining in, and she's looking at gold this morning. Manisha.
Thank you for that, Rima. Well, I am, because we have seen gold prices continue to decline further. Last week was a great one. We saw 5% of gains coming in, and at one point in time, you also thought that we were perhaps heading towards that 3,400 mark. But in last couple of sessions or more, we've seen prices continue to decline. 3,300 just about holding on your screens now, and the markets are looking at the rebound in US dollar index that seems to be weighing on. The global equities are doing better. So the risk-on situation also has led to money coming out of gold and into various other asset classes. The other point also is that there's just so much data coming in between today to Friday, and the street will react to that. You have the US Fed meeting minutes that are going to be released today. It also is about the US first quarter GDP estimates, PCE data, weekly jobless claims. All of those numbers are slated tomorrow and day after as well. So ahead of that, there's a bit of choppiness that you have seen in gold. But interestingly, all the global banks and brokerages that I have been talking about are saying that while, yes, you could be looking at some cyclical bearishness in case of gold prices for the next 3 or 5 months, but longer term, the structural bullishness has just about continued. Citi for one says that $3,500 an ounce is coming back for gold prices. 31 to 3,500 is what they're talking about. Bank of America is talking about $4,000 an ounce in the first half of 2026. You also have Saxo Bank talking about 3,800 as a possibility in the first half of 2026 as well. So bullishness has just about continued. This is a statement from Citi yet again, which says that 0.5% of world's GDP currently is being spent on buying gold, which is the highest in 50 years. So this is inclusive of retail buying, physical buying, central bank buying. We've also seen digital gold buying happening as well. Fund of funds also are reporting big gold buying happening there. So we are looking at very strong buying even as the prices and especially as the prices come off.
Not enough upside triggers, but enough to keep the downside capped. Manisha, thanks a lot for that update on gold. But moving on, then continuing with corporate conversations, Yatharth Hospitals saw a strong year-on-year revenue growth, with a 20% growth there. Margins also expanded on a year-on-year basis. However, the net profit was impacted due to higher depreciation and finance cost. Yatharth Tyagi, the whole-time director at Yatharth Hospitals and Trauma Care Services, is now joining in to discuss the road ahead for the company. Yatharth, good morning. Thank you for joining in. So, firstly, your average revenue per operating bed went up this quarter. Your occupancy also went up this quarter. What would you attribute that to? And what are your ARPOB targets for FY26, if you have set any?
Hi, so it's been a good financial year for us, especially the way Q4 has panned out. The company has, shown upwards of 30% YOY growth, both in terms of the quarter as well as the financial year 25. I think this is primarily due to 2-3 aspects. One is the growth in our Nod extension as well as the Jhansi Orchha Hospital. Both these hospitals have shown upwards of 25 to 30% growth, which has led to the increase in the ARPOB as well as occupancy in these specific hospitals, contributing to the overall performance of the company. As well as if you look at the EBITDA margins, we have been close to 25% at the yearly basis, and this is as per our expectations. Talking about the ARPOB growth has happened, around 8% year-on-year basis. And again, this is what the company has also shown in the past for 2-3 years. We still feel that there's a huge scope in terms of ARPOB going forward, as to 3 major reasons. One is the increase and changes in the case mix. So as most super specialty treatments are now increasing in a pie. So for example, oncology has increased. Now oncology is almost contributing close to 20%. So these are high price specialties. Due to growth in these specialties, ARPOB is increasing, and we do feel in the years going forward we should see a similar trend in the ARPOB growth that we have seen for the full financial year.
Yatharth, hi, Rima here. Just a few questions then. You've been largely maintaining a 30% kind of a revenue growth. Will that sustain even in FY26?
See, we are also adding capacity this year. So 2 of our new hospitals are going to start from literally next month. So their revenue should start flowing at the beginning of Q2. So we are starting a hospital in New Delhi in an area called Model Town. So 300-bedded hospital starting there, as well as our second hospital in Faridabad, which is going to be a 400-bedded hospital, is also going to start. So with 700-bed capacity, being added up for the whole financial year, we do expect a good momentum in our overall revenue growth, and we do expect the trend that we have seen for the last 2-3 years in our year-on-year percentage growth in the revenue should be sustainable for the next few years to come.
Okay, revenue growth sustainable, and that's been about 30% on an average for the last many years. And now that you have, 2 hospitals coming on stream in the next 1 month, will the margins come under pressure? Will you initially face any sort of increase in operational costs, which could hurt margin, or can you hold on to 25% margins for the full year?
So if you look at our margins for the Q4, we are close to 24.5%. And I think the margins in Q4 would be a right assessment for the quarters going forward, because yes, we do have 2 hospitals starting, but the another hospital that we started a year ago in the city of Greater Faridabad. So that hospital has almost EBITDA break even in the latest month. So the losses of that hospital will now stop, and that will start adding to the EBITDA. So overall, even in our existing mature hospital, there's still occupancy ramp up yet to be seen. Both Noida Extension, Great Noida, we do expect occupancy increase further. So that should be, covering up for the losses for the new hospital. So overall, we do feel the EBITDA margins that we have seen in Q4 should be the right, momentum going forward. Would be something similar for the whole year forward as well.
Yatharth, just before we get back to business, there were reports late last year, earlier this year about the income tax department involved with the company, and you had also issued a clarification that there has been no new updates on that earlier this year. What's the status of that currently? If you could share an update on that.
So, as far as the income tax case is concerned, there's a huge positive development that happened for the company in the latest quarter. So one of our subsidiaries, AKS Medica, which comprises of the Noida Extension Hospital business, and it contributes nearly to 40% to the overall group. So the audit for that is almost complete now, largely complete, and the demand there for the tax that the company would be paying is minuscule. It's in the tune of only around 1.5 crores. So we are quite confident now with the subsidy, and our other subsidies contribute very less. So it's mainly the AKS Medica that was contributing 40% of the overall revenue. So the audit for that is largely settled now. So going forward also, we do expect for the parent company, the settlement, to be not impactful for the whole company. And we have always maintained that we do not see any large financial impact coming from the case going forward as well.
You also mentioned that there was some attachments, provisional attachments, and the use of around 6 crores from the pledged amount. Has that issue being resolved, and do you see this entire issue getting resolved in the first half of this year, Yatharth?
We feel that before the end of this, calendar year, we should get this issue should largely be settled, and that is the timeline what any income tax matter takes. So when the case started, we always maintained that before 2 years it should be settled, and we are pretty much on the timeline. So we feel that once that's settled, any attachment will also be removed. Just to remind you, these attachments are anyways provisional attachments, right? So now because the demand for the AKS Medica is there, so once we do that tax deposition, that provisional attachment will also be removed from the subsidies, as well as going forward, as I mentioned, that before the end of this calendar year, we do expect largely for the whole case to be settled very soon.
Got that. Just one word answer, if you could. Do you think you spoke about how RBOP is seeing a positive momentum, will continue to increase? 8 to 10% should be the annual growth one should estimate for an increase in the average revenue per occupied bed?
I think we can take that figure conservatively to be there for the next few years.
Okay.
Because,
right.
Yes, international patients are also going to increase in our hospital. So Greater Noida is coming up with Asia's largest international airport. So we are the closest hospital to the airport. So with that going forward, our RPOP expectancy should increase much higher.
Okay, we'll leave the conversation here, Yatharth. So some of the key takeaways are revenue growth momentum should continue. It's been 30%. Q4 margins around 25% should sustain. The 2 new hospitals, which add 700 beds, should come on stream in the next 1 month. The company conservatively can add about 8 to 10% to its average revenue per occupied bed on an annual basis for the next 2 to 3 years. And the tax matter process is on, but should get fully resolved in this calendar year itself. But that's Yatharth Hospital for you. Moving on, we're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, economists, shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insight. Tune in to CNBC-TV18 Prime at 12 noon every day for the Global Reset, and then again at 8:30 p.m. for Global Lens.
Welcome back. 24,750 is where the index continues to remain. A 70-point downtick so far. The Sensex is down 230. So not significant moves there for the index so far. Currently trading near the lowest point of the day. Mitesh Thakkar joins in for a quick chart check. Mitesh, 24,750, do you see that becoming a support for today's trading session? And if not, what are the key levels for the index and your stock recommendations as well?
I think my belief is that, we might actually see the Nifty do a range of 24,500, 450 to about 25,050. So maybe slightly lower. And on the stock side, I have a buy on Gas Authority of India Limited with a stop at about 193.5 for targets of 202. While DMart or Revenue Supermarkets is a sell. Keep a stop about 4,100 and look for targets of around 39.60.
Thank you. Mitesh, for that, get into a break. On the other side, market discussion lined up with Manish Dangi from Mosaic Asset Management. Welcome back. Manish Dangi from Mosaic Asset Management is now with us to join to talk more about the markets and macros. Manish, thank you very much for joining in. Just last week we were discussing, I mean, not with you, but the markets were worried about the U.S. bond rout. Trump's tax bill, Moody's downgrade of their U.S. credit rating. How are you assessing the U.S. macros first?
Hi. So the U.S. essentially, the whole thing of the MAGA that they've got the tax cuts, but spending cuts are not coming in. And so to that extent, the old US template of good last 10 years of running very high fiscal deficits seems to continue even in this regime, and which is why, bonds are not liking it. Rates have backed up substantially in US since Trump came in, and it continues to sort of happen. All of that actually impact is more visible in places like Japan, where the bonds are actually backing up even more substantially. So in a sense, it's for the bonds. You sort of intermittently in US at least, it doesn't seem to. You don't seem to have policy support. Is how I can read it. Every time it sort of seems like that they're going to be growth slowdown, and which will result in lower rates. And therefore, the long bonds actually start to price in. They price in also, and there comes a little bit of a fiscal googly, and you sort of see rates back up again. So that's how one has to read it. It seems US does not have the sort of appetite to actually tighten fisc at any given point in time. They lose. So that's how, I would read the macro there.
Manish, good morning. Thank you for joining in. Does this mean, with this current bond market volatility that you're witnessing, that the longer tenor bonds are an absolute no-go? Because the 40-year bond auction that just happened in Japan had a very poor response. Even the 30-year bond, the 20-year bond auction that happened in the US earlier this week, that too had a very poor response. But the 2-year bond auction that happened yesterday, that had a very good response in the US. So it means that the shorter tenor bonds, okay, but the longer tenor bonds right now is an absolute no-go, considering you just don't know what's going to happen in that long.
Yeah, so long tenor bonds is where you read the macro right. Short tenor is so much to do with many other things, and of course they are very adjacent to the Fed rates, and liquidity is an issue there. So my sense is that long tenor is where you have a good resolution of how markets at least read how macro would behave over a medium term, and for equities or for general view of that economy over next few years. For mortgage rates, what matters, of course, is what long tenor bonds do. It's a mix of things like, the long tenor bonds refuse to believe that US inflation would sustain at low level, but more importantly, they're actually pricing in much higher real rate given the fiscal pressures. And of course, there also have to be pricing in a sustained possibility of sharp devaluation of dollar at some point in time. And so I don't know, what all Trump would be able to achieve, but for sure, one thing that he will be able to achieve is a significant dollar weakness, I think. And that's how I would read, how the bond and the currency are tangoing right now.
Okay, so you expect the dollar to weaken from here on. On the Indian currency, given the fact that RBI is flushing the system with ample liquidity, what is the call on the Indian currency, say by the end of the calendar year, in terms of more cuts from the Reserve Bank of India, and how it affects the bonds?
So with such sharp easing in liquidity, rate cuts, and of course weakness in economy over last 12 months, we of course initially, we saw our currency weaken, but the fact that it's sort of in some sense unwound some of the losses. Sort of tells you that a big global macro trade is supportive of emerging market currency. So my general view for next couple of years would be that the depreciation run rate of INR would be a lot lesser, and I wouldn't be surprised. I would say sort of 1 in 2 chance that INR remains here or actually sort of becomes stronger over next 1 to 2 years. So that kind of a regime invariably does not happen in weak growth environment, but again, tying it with what is happening in US, it's more to do with dollar, and which is why, INR actually will most probably stay strong. INR strength or INR stability also gives a lot of space for RBI to actually do a lot of things, substantial easing in liquidity, rate cuts, and so on and so forth, and regulatory easing. All of that is only possible in the last 4-5 months because INR has been sort of, last 2-3 months particularly, because INR has been sort of stable or appreciating now.
Since you mentioned the dollar, Manish, I was just reading a note from JP Morgan where they had asked a very pertinent question, that is this the start of the dollar downfall? Where they do say that, of course, they are expecting a few more percentage points of depreciation for the dollar. They don't see a very substantial or a significant crash from these levels. What do you think about where's the dollar headed here? It's been meandering around this 98 to 100 range. But do you see the dollar weakening further, and does that mean that emerging market currencies will fare a lot better this year compared to the dollar?
So a couple of things, right? From purely valuation standpoint, dollar relative to any currency, most specifically developed market currencies, is very strong. And so if fundamentals were to sort of get priced in, dollar should be weaker by 15-20%, depending upon how you sort of look at various indices. So that's fundamental. Two, historically also, last 50-100 years, you tend to see these 10-15 years of strong dollar and thereafter weak dollar markets. We've had a very, very strong dollar market since GFC. This is 2008. I wouldn't be surprised if we are rolling into a period of weak dollar setup. So sort of that's pure empirical way of actually looking at it. Third, of course, is the policy itself. After very long, uh, almost clearly, the U.S. administration seemed to be hinting that they need weak dollar, and to that extent, all policies would sort of align to ensure that their currency actually weaken in order to, of course, get manufacturing back and so on and so forth, whatever they're wanting to do. So all of these things sort of point at a picture, which is perhaps going to drive dollar weaker over next couple of years. So very, very different regime than what we've seen since 2007.
All right, Manish, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. We take a short break here, but just before we do that, here's some good news for our viewers. And India's business news leader is now just a click away. Introducing CNBC TV18's all-new app, where you get instant access to breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screens to download the app. Take a short break. Back on the other side.
Investing.
Welcome back. Still around 70 points lower on the Nifty, 230 down on the Sensex. ITC continues to remain among the top losers. Of course, not just because of the block deal. Also, another factor why the stock is lower is because the stock is trading ex-dividend in today's trading session. So, need to factor that in as well when it comes to analyzing the stock price. Bharat Dynamics, 2.5% lower on that stock as well. And Escorts Kubota is seeing a bit of selling pressure over the last couple of trading sessions, 2.5% lower on that stock as well. But moving on to earnings conversations, then SP Apparel is the next management on the show. The company saw numbers that were stable. Revenues were up 35%. The margins were also remained, they were flat. Mr. P. Sundarajan, who is the chairman and managing director at the company, is joining in to discuss the road ahead. Mr. Sundarajan, good morning. Thank you for joining in. We'll start off with the top line, Mr. Sundarajan. You had reported a top line of 1395. You had guided for around 15 to 1600 crore. What led to that miss, and what are you envisaging for FY26 now?
Yeah, this is, we, after having acquired this young brand, so we have given this new number as an expectation. But in the core business, SP Apparels Limited, there was some challenges in, the shipments, this got deferred, because the customers wanted to push it to the next quarter or something. So that has, some of the shipments have happened immediately after the March. So this will come into this Q1 now. So otherwise, we are in line with what we have expected. And for FY26, yes, as we have been telling in all the investors that we are looking at after acquisition of Young brand apparels, our capacity has grown by about say 1,300 machines, which is about 1/3 of the existing capacity. And now we have gone into Sri Lanka offshore production, where we are planning for, already we have acquired one factory and there are 2 factories already been signed MOU and the 4th one is on the way. So by end of March 26, we will be increasing our capacity by 40 to 45% from offshore production itself, in addition to our India growth, capacity growth. That's our direction.
So would it be fair to assume that you would end the year 2,000 crores plus on the top line?
Yeah, I mean, if the capacity goes up by about 40 to 50%, so I think naturally we should aim for that, because our existing setup with the Young brand one and the Sri Lanka operations, in addition to our increase in our existing setup, why it should not happen? We are aiming for it.
Mr. Sundarajan, you mentioned earlier that there were some delays in shipments that have now happened after March. Could you tell us what led to those delays from the customers? Have you been impacted in any form with this tariff flip-flop that has happened from the US?
No, that's not the case, because we, with regard to that, when we have booked some orders out of Sri Lanka during the last quarter, there are some difficulties in the acquisition setting up this shipments thing. So we had to literally, bring those orders back to India. So that got delayed. And we, as I say, that there has been always challenges in India with regard to the workforces. So the machines did not run as we originally planned. So that was also, there is a small slide. So which we have managed. Now, that's the very reason why we are going to Sri Lanka, is where we are getting skilled up and running factory operators. So that's going to be a fantastic strategy, what we are hoping so.
So what does that do to the entire exports picture, Mr. Sundarajan? Because your exports business was almost around 90% of the overall top line. So what are your plans for exports this year? And if you could also tell us how much of your exports are to the US markets, and considering all of this tariff uncertainty that has been in place, what are the kind of conversations that you've been having with your clients on ground?
Yeah, see, after acquiring Young brand is doing only American business, which contributes about, I would say, 25% of our total business. So American market is about 25 to 30%. The rest of all for the UK and the EU market, including Sri Lanka shipments. So now we are slowly looking at increasing the US customers also, because India's tariff is comparatively lesser. And because of this, anti-China and the Bangladesh thing, so that we are expected to get more business into India. And we are trying our best to increase the capacity in India as well. Because US, out of Sri Lanka, it is not possible at the moment because the tariff is on the higher side. And we are hoping for, bringing the tariff down again, back to 10%. If that goes, then we will have more shipments out of Sri Lanka as well to the US market.
You mentioned the UK as well. So with this free trade agreement that has been signed with the UK, what are the kind of synergies that you are expecting to come to you in terms of business opportunity from that market?
Yeah, see, already that's going to be a benefit to the customers, because we are not going to be benefited. So India will be getting more business as against Bangladesh and Sri Lanka due to the duty-free thing. And the challenge is the capacities for all the manufacturers, garment exporters, the capacity is a big challenge, because the more orders are coming in. So we are looking at all the possibilities, how we can increase the capacities within India.
Right. Mr. Sundarajan, what about margins? You ended FY25 at 17%, but your historical highs in FY22 has been 22%. Do you expect to get back to 20% by the end of this year, or because of the acquisitions that you have made, your margins would remain around that 17-18% mark this year as well?
No, it's like this, our back office expenses are on the higher side for this, for the amount what we are spending in the back office for designing, sample purposes, marketing, and everything. We should be doing at least about 2,000 crores in order to get the better margins. So we have been trying all these years along to improve the capacity up to about 5,000, 6,000 machines. But now by acquiring the Sri Lankan factories, straight away our capacity, we are expecting capacity to be about 7,000 machines from 4,500 in the next 1 to 2 years time. Automatically our back office expenses will hopefully come down by another 2 to 3%, which will in turn help us to improve the EBITDA margin to 20%.
So not this year, but maybe next year?
Yeah, it will start improving from this year onwards.
And what does that do to your debt picture, Mr. Sundararajan? Final question from mine. When do you expect to bring that down? The debt had seen a slight increase because of this acquisition. When do you see that tapering down?
Yeah, I think probably see the fact is what we acquired are already running full, so which means the return on investment, we are expecting it to be about 4 years of time. So in 5 years time, probably we will be able to get back all, including the young brand where we have acquired it. So all of this put together, the return on investment we are expecting to be about 4 years time. So gradually that might come down.
All right, Mr. Sundararajan, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of SP Apparels on the road ahead for the company. Take a short break. Back on the other side with Abneesh Roy of Nuvama Institutional Equities to discuss the ITC block deal. Stay tuned.
To pay a hefty bill of 8,000 crore rupees to reverse flip and move back to India.
If the right answer for a business like ours is to list, then this is the right market. Core business on the path to profitability, being able to actually nurture new businesses is the right time to take PhonePe to the public markets.
Welcome back. ITC is among the top Nifty losers after the company saw a large block deal where 32 crore shares worth 13,000 crore rupees changed hand. In fact, the deal even got upsized. Abneesh Roy, Executive Director at Nuvama Institutional Equities, now joins in with his thoughts and insights. What are the investor implications? Today, the stock price is under pressure on the back of this large supply, but BAT still holds significant stake in the company, which means that future stake sale is also possible. What does this mean for a shareholder in ITC?
Yeah, hi. Good morning.
Good morning.
Yeah, so our thoughts on this is, yes, this overhang of the VAT further, say around 23% stake will be there in the minds of investors because it's very high value. Because in March 2024, when the first tranche of sale happened, that time it seemed that this was a one-time event, and the investors were not expecting this. Now there will be a thought that maybe after a few quarters again, one more tranche can it come, that overhang will be there. On the fundamental side, things were improving. If you see in the cigarette, 5% volume growth in Q4 was a good number. If you see how many FMCG company in their core part of the business have seen a 5% volume growth in Q4, even Marico, which is a top tier volume growth, in the core part of the business, it is largely low single digit kind of growth. That's true even for Tata Consumer, which has also done well, for example. Most other FMCG companies are broadly at low single digits. So 5% volume growth was a good number. And palm oil price correction was a good news for ITC's FMCG business, which has been struggling last 2-3 quarters in terms of margins. We are still expecting that FMCG business will see a revival in terms of margins from Q2. Even paper business, if you see, which has been struggling because of Chinese imports, there we do see that Century Papers, that M&A, the approvals will come, and in H2 we'll see much healthier numbers. But this overhang now limits the stock more towards a bit lower PE multiple than earlier. So we will see clarity from BATs. It's something we need, whether this is the last tranche. Otherwise, you're absolutely right. 23% stake still means a lot of value, right? It's a 5 lakh crore plus market cap. 23% stake is a huge number. So that, I think, in the mind of investor will be a concern. Otherwise, from the government side, government clearly is making sure that the illegal part of the cigarette industry loses market share. And that's why ITC is reporting a 4-5% volume growth. Godfrey Phillips is growing faster in cigarette, but that's because they are a much smaller player and they are doing a bit of more trade incentive. So we are positive on ITC, but this overhang adds one more dimension to the entire aspect.
Abneesh, good morning. Thank you for joining in. In an ideal case scenario that BAT does clarify that it does not intend to sell any further stake in ITC for the foreseeable future, in that scenario, would you value ITC at a higher multiple? Because if that is an overhang that concises it to a lower PE, would that clarification result in a potentially higher PE for the stock?
Absolutely, it works that way because supply of stock for such a large market cap company and such large 23% stake left. Yes, if that clarity comes, the PE multiples, etc., will be higher. Currently, if you see pre this announcement, we were valuing and giving a target price for ITC at around 532, and we were valuing the ITC cigarette business at 23 times PE multiple and the FMCG at 6 times price to sales. Yes, now if that clarity is not there, we will shift towards possibly a lower multiple because that overhang is there. And on the vice versa, if we get that clarity from BAT that now, listen, we are done and dusted, then I think the investors will get a comfort and then the higher P multiple can come. Otherwise, the stock will be a more range-bound stock and it could underperform some of the other FMCG names where this kind of an overhang is not there.
What about ITC hotels? What stake does, I mean, BAT would have a similar stake in ITC hotels as well, mirror shareholding. What is your view on BAT bringing down their stake in ITC hotels?
Yeah, so there I would say that they have clearly maintained that hotels for BAT is not a core part of their business, not a core part of their overall portfolio. So it is a question of time. I would see that as a financial investment. So I would say that there is much more likelihood of BAT completely paring down ITC hotels versus, say, a cigarette company. But currently, if you see what our view is, and I cannot speak on behalf of BAT, the entire hotel industry is seeing very good times. It's in an upcycle. So what we think can happen is BAT would like to ride that upcycle maybe for some quarters and then take a call. But they've clearly mentioned that this is a financial investment, a non-core investment, hotels.
All right, Abneesh, thank you so much for sparing time and joining us today to discuss the news of the morning, which has been that big block deal in ITC. For now, the stock around about 3% lower. Also just mentioned a few minutes earlier that it's also because the fact that it's trading ex-dividend, that's also weighing in on the price.
The dividend amount is?
Almost 6.25 quarter.
So about half of the loss is explained by the going ex-dividend and half because of the supply pressure.
So there you can see there, ITC 3.25% lower, currently at 420. We call time on this edition of Trading Hour. We leave you with the Nifty around 60 points lower, still looking to recover from the lows of the day. From Rima, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.
Midcaps gain even as frontline stocks see profit booking. FMCG metals are the big drags while industrials and utilities clock some gains.
British American Tobacco has trimmed its holding in ITC to under a quarter with sales via block deals worth over 13,000 crores. The sale will help BAT deleverage a part of its transformation plan.
LIC reports a good fourth quarter, expects double-digit growth in FY26 with improved margins. The chairman tells CNBC-TV18 and OFS may be in the works to improve liquidity in the stock.
Federal Bank MD and CEO Krishnan Manian tells CNBC-TV18 savings account rates can drop to 2.5% from 2.75% if RBI cuts rates by 50 basis points. He sees MFI stress continuing for 1 or 2 quarters and expects RBI's draft gold loan norms as a positive for the bank.
Noted economist and former RBI Governor Raghuram Rajan tells CNBC-TV18 this could be India's moment if it lays out the red carpet to draw FDI with proactive policies. He adds that the consensus view of US moving down may be wrong, even as he expects a reset of global portfolios.
A very good afternoon. You're watching Halftime Report on CNBC-TV18. I'm Ekta Batra and with me is Manglam Malu. Well, it is turning out to be a session which is a little mixed at this point in time. While the mid-caps are faring better, we do have the Nifty, which is sulking a little bit. So down around 0.3% as we speak currently for the Nifty, and the Bank Nifty absolutely flat. As always, it's a lot about specific stocks today as well. So, for example, we have stocks such as ITC, which is in focus on account of that large block. But separately, we do have stocks such as Techno Electric, which is buzzing on the back of numbers. So that stock should come up for you, up around 11% odd. MedPlus is doing very well in today's trading session, again on the back of numbers. Dynamic in focus on the back of what was a sluggish set this time. And separately, a lot of stocks in focus on account of what they would be releasing. So SAIL, IRCTC, Cummins India, to name a few. So definitely probably going to be a busy day in terms of numbers, but overall for the markets, consolidatory trend continues. Hi, Manglam.
Consolidatory trend indeed. The good part is that the market is behaving in the range that the Nifty has made for itself, 24,700 at the lower end to about 25,050 at the upper end, and that's what it's been meandering between over the last few trading sessions. Your portfolios feel a lot better. 1,500 stocks advancing for about 1,100 stocks which are declining. So for the second day running, the advanced decline ratio also in favor of the gainers. If you look at a couple of other stocks as well, the ones which are actually seeing some traction, Bharti Airtel is one of them. Yesterday we had Rajiv Jain of GQG say that he's added that stock in his portfolio. Muthoot Finance is the other one which is moving to the high point of trade. And alongside that, we've seen some traction in names like Ashok Leyland as well. Typically, CVs and agri-vehicles should do better on account of earlier than expected monsoons and perhaps better than expected monsoons as well. And today, we are seeing some traction in a lot of these auto ancillary names as well. Precision Camshafts, for instance, up nearly 15% as we speak. And Bellrise was a good listing. That stock too, holding up with gains. LIC is the stock which is surging in trade today. The performance has exceeded street expectations. Management too guides for double-digit growth. Yash caught up with Siddharth Mohanty, who is the MD and CEO of the company, to discuss their performance gone by.
Last year, AP was almost flat. And primarily due to product regulation changes, Q3, that has great impact on our business. If you see past 6 months, up to Q2, we were showing very high growth. And we were to surpass our budget. But due to product regulation changes, our field force, they take some time to adjust to new product regulation, and many products were also redesigned, refiled.
Correct.
So that affected our AP growth. AP was just muted, flat. But current year, 26, FY26, we have taken directional change. We have given direction WRP and AP, that will be our target, not a total premium target. And last year, because of product regulation change, most single premium policies, our agents sold maximum single premium policies. So that also affected AP to some extent. But current year, I am very confident what figures show now. You will also observe after 1 quarter. It is in right direction and will show good growth rate in AP.
Okay. WRP as well as AP. Good growth is what you spoke about. What could be that good growth? Could it go back to about mid double digit?
Our objective is to at least achieve double digit growth in a WRP and AP.
Okay. Now coming to the elements of AP as well, retail and annuity in terms of the term book as well as the annuity book. What is the growth that you expect there for FY26? Because those are the two segments which are picking up very fast.
You see, annuity as well as a term, both we see a great uptick. Because annuity today, our annuity rates are most competitive in the market. And a term insurance, people prefer LIC term insurance because they are assured of whatever risk we cover will definitely fulfill our commitment. So I see good growth rate in both these segments, term as well as annuities.
Okay. Could you quantify? I mean,
it will be difficult, but whatever growth you are seeing, it will further improve.
Okay. I want to speak to you a little about market share also, because market share, both policy-wise as well as premium-wise, has declined in FY25. Policy-wise, the market share declined by more than 4%. Premium-wise, it declined nearly 2%. What is going to be the strategy when it comes to regaining that market share in FY26? Where do you see, what kind of increment do you see yourself making when it comes to the market share front from FY25?
You see, market share is a function of growth. The rate at which small players grow, it will be very difficult for LIC, having a large base, to grow at that stage. But having said that, we have our internal strategy. Up to a level, we must maintain our market share. We will not go below that level internally. Say for individual assurance, we are now focusing 40%. Okay. 2% plus this side, that side, but 40, it should not go below 40. Last time we achieved some 37 point plus something like that. So that is our strategy. But what we are focusing post-listing, profitable growth. Because after listing, every time I have given commitment to everybody that will show growth, profitable growth, that which we have already demonstrated in all our operations quarter after quarter.
Correct. So, I mean, if one has to understand the market share, both in policy and premium terms, in policies, your market share was 65.83%. In premium terms, it was 57%. Would these be the levels below which you would not want to go?
No, markets are difficult to predict, but this figure will grow. Whatever policies we sold last year, definitely current year we will achieve more policy. Because if you see, because of a change in product regulation, many policies ticket size has gone up.
Correct.
Minimum ticket size.
Correct.
And because of many agents are rural agents, they confine only to small ticket size up to 1 lakh policy. But now most of the policies minimum sum assured is 2 lakhs.
Correct.
So that has some impact, but now they have adjusted. Over 1 year, whatever experience we have made, current year that will be visible, so that more number of sale will happen and more premium also will happen.
Okay, so market share from this point
Yes.
is expected to go up. Okay, fair point. In terms of margins, that went up in Q4 to 18.75% versus 17.2% on a year-on-year basis. FY25 margins, that came in at 17.6% versus 16.8%. You are growing your non-par book. That is a continuous process that you're making. But in FY26, you'll also have the implication of higher surrender value regulations coming in full force. For FY26, where do you see margins going? Do you think it could become the year where your full year margins, FY26 margins, could cross that 20-21% mark?
You see, last year we have already shown AP growth in non-par. Non-par share has gone up 27.69%. So, and also 80 basis point increase in our margin from 16.8, we have gone to 17.6. Current year, as I told, since focus will be on WRP and APE, and I am confident that margin will further improve. It will be difficult to quantify, but definitely at least from 17.6 to 3% uptick will be there.
Okay, so it'll cross about 20%.
Around that is our objective.
Now, let's speak about a couple of regulations. The government proposed the insurance amendment bill, the changes that it wants to see. One of those was to allow individual agents to tie up with more than one life insurance company. Now, for LIC, of course, the biggest, about more than 95% of the total business comes from individual agents. In that case, are you in favor of this particular proposal of allowing agents to tie up with more than one life insurance company, or are you against? And have you, whatever your view is, have you put that to the government?
You see, we have already made our view clear to government.
Which is?
And government will decide, because the government is our promoter.
Correct.
And definitely whatever comes, LIC will face any challenge very effectively. We are well prepared. Any regulatory changes so far as open architecture, anything comes, LIC, and I believe my agents are not just agents. They are more than permanent partner with LIC, because we give them so many other benefits apart from commission, unlike others. So I have firm belief whatever comes, our agent will be glued to LIC only.
Correct. But for this proposal, are you for it? Are you against
it? We
have
made our view very clear, because to develop a captive distribution channel, not only for any insurance company, but for any distribution company, it takes a lot of time, energy and cost.
Correct.
Because the captive distribution channel. And suddenly if you allow your channel, distribution channel, to work for others, so that definitely poses some challenges.
Okay, understood. One question that I want to ask you, and this is with respect to certain comments which came from the DIPAM secretary as well. An OFS in LIC, that is in the pipeline. He is on record, mentioned it. 3.5% is the stake which is in the market right now. Do you think a higher float in the market will help LIC and a better price discovery of the shares of LIC? And second, since he's made that comment on record, have you received any communication with respect to preparing towards an OFS?
You see, this DIPAM will decide. So far as OFS is concerned, they will be deciding on that, and will be at appropriate time, will also be intimated.
Correct. But do you think a higher float will help better price discovery?
Definitely, because there is no float at present. If you see, unless there is a good float, difficult to trade. Because many people have asked me privately, we can enter, but how will we exit? There is no such float.
Correct.
So I think that will definitely help.
Okay, so have you put your view to DIPAM saying that we want a higher float?
They will consider. DIPAM is examining from all angles in the best interest of shareholders and LIC.
Okay, all right. So that's the management of LIC. We need to take a short break. But as we do that, there's some exciting news for you all. We're excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m.
Welcome back. CEAT is one of the stocks which has moved to the high point of trade, so just keep an eye out on that one. Also, we're also seeing some traction in all the travel and tourism related stocks. So Thomas Cook, for instance, has moved to the high point, was in the red for most part of today's trading session, has now recovered from the lows, currently at the higher end of today's trading session so far. We had Juniper Hotels as well with a 9% uptick. And if you're looking at hotels and tourism companies, look at the platforms as well. yatraonline.com, for instance, is up about 4% from the lows and is in the green right now at the higher end of today's trading range so far. But the stock on our radar is Coparo India. Recent listing, the management joins us, reported a good set of fourth quarter numbers, but the entire year was fairly flattish. The margins came in healthy. The company said that indirect and direct export activity remains muted. Remember, that accounts for nearly a third of their revenue. So to discuss this and more, we do have Balaji Gopalan, who is the managing director at the company, joining in. Thanks a lot, Mr. Gopalan, for joining in. You've aspired to do 8 to 12% revenue growth in FY26. Could you tell us what are your aspirations in across your verticals? Agriculture, you have construction and domestic, because you believe that exports are going to remain subdued. So if you could break your growth targets up for us across categories and geographies.
Yes, sure. Thank you very much for giving me this opportunity. Very quickly, we are looking at 8 to 12% growth in the current financial year. This is driven largely by the offtake of certain products that we have introduced recently. These are not based on the industry growth targets that we have. We are looking at the segment in which we operate, which is growing. For example, in agriculture, you can see that the four-wheel drive market is picking up in India. It was around 2% about 5 years back, 6 years back. The global average in developed countries is 99% four-wheel drive tractors. And in India, we are currently at 22%. 1 year back, 1.5 years back, we were at 15-16%. So the penetration of four-wheel drive market in the Indian tractor industry is gaining momentum, and Coparo is a dominant player in the four-wheel drive axle. We don't work in two-wheel drive and mechanical gearboxes. We prefer to get into the higher technology ramp-up that is happening in the industry, and we are bridging the gap between what is there available technology in India with what is there globally. Coparo, with its 90 years of global experience and a legacy of experience in all soil conditions, we are able to give to the Indian OEMs a product of four-wheel drive technology that is well established and reliable and quick to market for them. They just have to pick it up from us, build the vehicle and launch it. So four-wheel drive is giving us a strong growth. We have acquired new businesses, new wins for the construction equipment as well in the teleboom handler business. This is at nascent stage, but we have got a very big contract of a supply leading to around 300 crores in 3 years. The ramp up has already started this year, and this is a fully export to one of the largest construction equipment player in the world. So these are some of the things that is adding up to my revenue and also to the export that we are targeting. All in all, considering the ramp up of four-wheel drive in India, the export that we have got for teleboom handler market, we are very confident of growing by 8 to 12%.
Okay. Mr. Gopalan, thanks very much for joining in. Just want to narrow in on this four-wheel drive in the agri segment. You said that it's increased from last year 15 to 16% of penetration to around 20 to 22% already. What are you projecting in terms of, say, FY26 and maybe 3 years down the line? And consequently, what would the revenue addition be because of this specifically?
Okay. See, we are not in a position to classify product-wise the revenue contribution that is coming in. It is a basket that we look at. But in any case, like I said, the four-wheel drive market is gaining strong momentum, and our target in the next 4 years, by 2029, we have a very strong commitment to reach 350 million euro. That is around 3,100 crore by then. And the factors that I explained, technology absorption is the kind of a go-to place for Coparo. And now the stage has come in India where the level of technology in the agriculture, that is tractors and construction equipment, is being absorbed very rapidly. And we are hoping for a kind of a pivot point where it will become very steep. Initial absorption seeding is taking place, and that is what is showing us result. 20% four-wheel drive in a market of tractor, which is 1 million, 10 lakhs, is quite a significant thing. And we expect this four-wheel drive to keep continuing to reach at least 40% in the next 3 years. And Coparo India is a dominant player. We have a significant market share of more than 60% in the four-wheel drive market. So that will give us the growth that we are looking at.
So from 20%, it increases to 40% over the next 3 to 4 years. You have a target that you've given for FY29 as well. Let's talk about the margins. Is there a differential between two-wheel drive and four-wheel drive margins? And you have a medium-term aspiration of mid-teens margin. Last year, you saw an improvement of 200 basis points. How much do you think can increase over the next couple of years? And by when do you reach that mid-teens target?
Okay. See, the growth in EBITDA is something that will happen step by step. Before going to that, I would like to pass the comment about the margin differentiation in agriculture and construction. Ours is a gearbox, ours is axle. The application is agriculture or construction. which thereby means that there is hardly a big difference between the margins. So margins will more or less remain the same. Two-wheel drive to four-wheel drive, Coparo is not into two-wheel drive. That is a very basic technology, and the fact that today we are doing well and the future is looking well is because of that technology change that is happening, and this will happen. If you ask me why am I talking about four-wheel drive growing more in India, that is because, as I said, the global average is 99% for the developed countries. In India, food security has become a focus area. We have to ensure food security, and for food security, the government itself is pushing for farm mechanization, farm efficiency. And the new trend that is coming into the Indian market is contract manufacturing in agriculture. To that reason, you need to take in four-wheel drive vehicles that can support farm mechanization. And that is the basis for us to evaluate and gauge and have a judgment that it will touch at least 40% in the coming years. Coming to the EBITDA growth, we are focusing on localization, which earlier was 67%. Today, we are at 77%. We should be touching 80% this year, and we are targeting 88%. Whenever we localize, we save a minimum of at least 10%, going up to 15% in the cost of procurement. Why didn't we do it till now? That is because the technology upgrade that is taking place, and that is the segment that Coparo specializes and works on. The technology was not available in India because there was no need for such technology. Now, with the growing market with higher technology, we are able to source it locally. International players have set up shop in India, so that is helping us in a big way in localizing. So that will add to my margin. We had in the past royalty payment to our headquarters, but just before the IPO, we got 154 IPs transferred into Coparo India. Thereby, the royalty to headquarters has reduced dramatically. Third, we are giving a very strong emphasis on cost control. Fixed cost remains the same. My revenue grows, and that brings in the margin that I am looking at. So it's a combination of all these factors that will give us, together with sales mix. Higher the technology, it's a black box, and I am able to quote a higher margin for those products, and there is a demand for such products. So these four aspects together will give me at least a 1% increase in EBITDA year on year for the next 3 to 4 years. During this, we are working on all initiatives to maximize our margins.
All right. So we're going to leave it on that note. Thanks very much for joining in and giving us all of that perspective. So around 8 to 12% growth is what the management is expecting, and around a 1% increase in terms of EBITDA margins for the next 3 to 4 years is what they are estimating. Export markets a bit subdued, but they are focusing on segments such as the agri space with the four-wheeler drive segment. Well, that's on Coparo India. That stock just about lower by around 1% We'll take a short break. Up next, we'll get you more on the markets and the F&O cues today.
A big surge in Force Motors is what we're seeing. It's up nearly 5% from the lows. Perhaps some commentary coming in on four-wheel drives doing well in India has the stock excited. I'm not sure whether it's directly correlated. They are into the SUV manufacturing as well as some of the buses, etc. So you'll keep an eye out on how this one pans out. This month has been a good one, up 30% for that stock this month. But the market otherwise is behaving, let's put it that way. There is consolidation, but it's consolidation within those range. So if you look at the Nifty Bank that has been, slightly muted just below the red line, nothing really to worry about. And when there is support which is expected at, lower levels, the mid-cap index is the one which typically outperforms, and that's exactly what is taking place. For not just today, but 2 days in a row, the advance decline has been fairly in favor of advances, making your portfolios feel a lot better. 24,800, that's where the fulcrum is now. 24,800 call has a premium of 120 rupees. We have the 24,800 put coming up for you that has a premium of almost 140 rupees. So put both of these together, you're looking at an expiry between 24,600 at the lower level to about 25,000 at the upper level tomorrow on the Nifty. But a bunch of stocks will be on our radar. Hindustan Copper and SAIL may enter F&O ban given the activity that we've seen in open interest out there. Now it remains to be seen how much of that is on account of rollovers and how much of that will be carried forward to tomorrow. So just as of now, it looks like they may enter F&O ban. And RBL Bank, which is in F&O ban, the only stock in F&O ban right now, may actually exit F&O ban. So just keep an eye out on that one. RBL Bank may exit F&O ban while the others may enter F&O ban. With that, we'll take a short break. On the other side, we have the management of Supriya Life Sciences joining in to discuss their performance.
Welcome back. You're still tuned into Halftime Report this afternoon. Well, it's turning out to be a session where we're seeing a little more traction in the mid-cap, so up around 0.3%. The advanced decline ratio is also holding in positive terrain. So we have around 2,100 stocks advancing to around 1,700 stocks declining. But we do have a lot of companies lined up. Supriya Life Sciences, the next management on the show, had reported what was a good set of Q4 numbers. Margins came in healthy. The company says that they are seeing strong interest across global and specialty pharma segments. Saloni Wagh, who's the MD of Supriya Life Science, now joins in to talk about the numbers. Saloni, hi, welcome to the show. If you could just start by talking about the margins, they've improved quite significantly to around 37%. What led to this margin improvement?
Yes, I think this year has been one of our milestone years, and we have given our best revenue as well as margins. Margins stood at about 37%, which is almost 260 crores of EBITDA. And I think the two main growth drivers for this is one, the backward integrated model that we have, and the other would be our penetration into more regulated markets. If you see our sales in regions like Europe, Latin American markets like Brazil, they have really gone up. I think that is the main reason why the margins have also gone up.
So in that case, what is it that you're likely to sustain going forward, and how much more revenue can you generate from regulated markets? If you could give us that quantifiable number as to this proportion comes now and say over the next 2 to 3 years, this is what your target is?
So currently, almost 50% of our revenue comes in from the regulated markets. Moving forward, I think a more sustainable EBITDA margin for us would be somewhere between that 33 to 35%, mainly because we are expecting new product launches in the next financial year. And we are also scaling up our finished formulation CMO division. So once that comes in, I think 33 to 35% would be a very stable EBITDA margin. Here, I would just like to mention, while you see a little compression on the percentage margin, in terms of the absolute EBITDA, absolute PAT, you're definitely going to see a good growth going forward.
Okay. Well, Saloni, I just wanted to narrow down a little bit on your top 10 customers. That still contributes to around 58% of your sales. You're looking to diversify that base. Tell us how you're doing it and by when we could probably expect it. And do you have that sort of target in FY26?
So actually, our top 10 customers today contribute to almost 50% of our revenue. But what you have to understand that in the top 10 customers, almost 4 or 5 customers out of that are large distributors. So these distributors in different countries are like the representatives of Supriya, and they stock our material and they cater to the small end users in those markets. So those 4 or 5 customers itself are catering to more than 100 customers globally. So as such, although it looks like 10% contributes to 50% of the revenue, as such those in turn are catering to more customers. So it's already a very diversified customer base.
Okay. I just wanted to narrow down on this entire semaglutide opportunity. Would that be something that y'all are looking to partake in, considering that it is going off patent next year in many emerging markets as well as India? How would you participate in that? Are you participating in that?
So peptides is yes in our R&D, not just semaglutide, but some of the other peptides also we are working on in our R&D. But those for us will come at least 2 years later for launch. I think some of the new products what we are launching in the next financial year mainly are therapeutic categories like ADHD. We also have cardiovascular. So these are anesthetic. We are also expanding our portfolio. So I think these are the therapies which would be getting launched in the near term. For the peptide chemistry, I think we are still 2 years away from launch.
So you're not going to be participating in the semaglutide opportunity as of now?
No, not immediately. I think our focus is more on how to strengthen our anesthetic basket. In Q4 of last year, we have already launched one of our products, which has a very large global market, almost 300 million. So I think we would want to focus more on that basket right now.
What sort of revenue growth are you penciling in for the next couple of years? And also, there was a project where you would be the exclusive API supplier for a CMO project in a European company, because you did say that 50% of your sales come in from regulated markets. To what are you looking to increase that to?
So we are expecting this percentage to go up to about 60% in the near term. As far as some of the new products are concerned, specifically that opportunity that you're referring to, it's actually an exclusive contract that we have bagged with a European company called DSM Fairmanage, where we are going to be their exclusive suppliers for a vitamin product for the next 10 years. And we are already seeing some commercial gain from that. At peak, I think this contract will give us about 60-70 crores of revenue. And we can expect that peak to happen in the next financial year itself. As far as the growth is concerned, I think we have always guided that in terms of revenue, we will grow 20% plus. And I think that's the guidance I would like to give moving forward as well. 20% growth in revenue while maintaining a very robust EBITDA margin.
When you say robust, what would it be? You did mention 33 to 35 is sustainable. So robust would mean what?
33 to 35%, in my opinion, is a very good, robust margin.
No, I meant, in comparison to FY25, where you closed at 37% odd, or your exit rate in Q4 was 37%. So 33 to 35 would be lower than that. So in that comparison, what do you suggest?
So I think one has to understand that the 37% margin is at a lower base. When you grow 20% plus in revenue, and I said this before also, although it looks like a compression in percentage margin, if I were to look at the absolute EBITDA value in crores, you will definitely see a very good growth happening there. So from here on, you can expect good increase in EBITDA, PAT, as well as the revenue.
And about these certain projects, for example, the CMO project that you have with this particular company to supply vitamins for the next 10 years, any more such opportunities lined up? Any talks taking place as of now, which we could probably see materialize?
So 2 other opportunities are there, out of which one we can expect commercialization in the next financial year. We are also having a very large opportunity in the anesthetic space, which we are discussing with one of the multinationals. Of course, that will take about 18 to 20 months to commercialize. But we are aggressively working in the background on how we can strengthen our CMO, CDMO. Plus, once the Ambernath facility scales up, which is predominantly a CMO, CDMO site, larger such opportunities will come.
Right. And what about WHO? I remember you saying that in the past you've been looking to reduce your contribution coming in from WHO, and then there's always this hanging sword of news coming in where some sort of funding to WHO would be scaled back. Whether that happens or not, how much does that now contribute to your overall revenues, and has that seen any impact when it comes to the news flow around?
No, I think it doesn't contribute much to our revenue even now. Like I said, almost 55% of my revenue is coming in from regulated markets like Europe and Latin American markets. And other than that, the other markets like Southeast Asian markets also, we have seen good growth. I think from 11% to 16% they have grown. So for us, I mean, they are not a really big revenue impacting factor, at least not in the short term.
Okay. Well, Saloni, before we let you go, I just wanted your sense in terms of an API manufacturer. What are you seeing in terms of trends on the larger scale? On one end, we do have the US, which is in talks with China for the entire trade agreement. So do you think that the opportunity for a 1+ manufacturer in India is still as strong? And separately, considering what is taking place when it comes to tariffs and onshore manufacturing in the US, how would that play out for a company such as yours?
So I think any good manufacturer who has the right kind of regulatory approvals, who has a backward integrated business model which is sustainable moving forward, who has good focus on EHS, aspects, I think they definitely stand to benefit from the China Plus One strategy. At least we have benefited a lot from this in the last 2 to 3 years. With the US, I think for us personally, it contributes a very small portion to our revenue. So we have to sort of wait and watch, because some of the new products what we are launching, they have a very large market in the US. But I'm hopeful with the bilateral trade agreement which is going on between India as well as US, things would streamline. And I still hope, and I'm very confident that Indian manufacturers who have all these right aspects in terms of regulatory and sustainability, they will still benefit a lot from the China Plus One strategy.
All right, take that point, Supriya Life Sciences. That's the management of Supriya Life Sciences. Saloni has joined us. Thank you so much for your outlook. 20+% revenue growth with increased contribution coming in from regulatory markets, and you have 33 to 35% margin guidance as well. With that, we'll slip into a short break. And as we do that, here's some good news for our viewers. India's business news leader is now just a click away. That's the new CNBC TV18 app. You can get instant access to breaking news, in-depth articles, interviews like this, what we did right now, all of that at your fingertips. You can download this app from either the Apple Store or the Google Play Store. Or if you just don't want to do that, scan the QR code which is up for you on the screen, and that will redirect you to the link that gets you to this app. Welcome back. Triveni Engineering, that's the stock that is gaining in trade on the back of their fourth quarter earnings. We spoke with the management as well. Ria joins in with more on what she made of the management commentary and the numbers. Ria.
Well, Triveni Engineering has been trading higher in today's session after reporting its results yesterday. Taking a look at the revenue first, that was up over 9% on a year-on-year basis, which was driven by strong revenue growth across its sugar, alcohol and power transmission businesses as well. In terms of sugarcane crushing, the company has achieved crushing at almost the same level as the previous season, but the gross recovery was lower by around 69 basis points. All of the sugar units of the companies, the operations have been switched to C-heavy molasses from B-heavy in the latter part of the season. In terms of profitability, the segment profits for the sugar business declined by around 12.8% over the previous year due to the higher cost of sugar sold during the year. Looking at the alcohol business, the profitability was adversely affected in this segment as well due to the low margin maize operations and lower sales volume of ethanol produced from molasses as well. But the power transmission business this time around has performed very well for the company. The turnover is up around 26.8% over the previous year, and the profits are also have increased by around 18.4% compared to the previous year, and even the order book has gone up by around 35% compared to FY24. So this is one segment that has performed very well for the company.
All right. Thanks, Ria, for that. We'll take a short break. On the other side, Manisha will join in. She has with her Ajay Goyal of Wheat Products Promotion Society. Stay tuned.
Welcome back, and joining us on the show now is Mr. Ajay Goel. He's Chairman WPPS. Mr. Goel, thank you so much for joining in. And there have been various reports suggesting that the government procurement, which is almost at 30 lakh tons now, is where we could see it now stopping at, capping at perhaps. What is your own sense?
Yes, I think, the procurement activity has almost come to an end, and so have arrivals. And so we're just at the threshold of 30 million tons, and just about a very small number to get that round number of 30 million, but we are almost there.
And the targets of 31.5, do you see that meeting at all? I mean, do you see a drag? Do you see it going above that, or do you think this is it now?
I think this is it, more or less. And I think the target of the government was quite ambitious, and that was primarily fulfilled because of bonuses declared in MP. And if you notice that originally the target in MP was 6 million tons, but looking at the arrivals and the procurement, because of the 175 rupee additional bonus, they raised the target by 2 million tons. And that's also almost there, like you have almost 7.8 million tons in MP. So MP has largely an MP and the bonus, and so has Rajasthan assisted in bringing in near about 2 million tons. So I guess 30 million tons is a good procurement for the government.
With that, Mr. Goel, now is there more clarity on what is the kind of crop that we are looking at? Because when you look at the USDA numbers, the government numbers, the industry and trade numbers, they still quite stand varying in that sense.
So I think one thing common between everybody's stand is that this year's crop is about 3 to 4% higher than last year's crop, whatever everybody's number has been. And that is quite evident in the procurement and in the early arrivals that you will notice. So I guess the number is about 4% higher than last year's number of different various data collectors.
Mr. Goel, there are various reports that, and this is something that we've been hearing from the government as well, that once the procurement is done and the private trade has had its fill as well, is when we could be looking at some limits coming in. Are you hearing anything of that sort? I know it's too early, or it's perhaps preempting it, but are you hearing something at all?
So I think there are 2-3 aspects to this. Number one is the rumor mills in WhatsApp never stop working. And again, today, there are highlighted reports that there would be a stock limit of 3,000 tons on trader. And one trader commented that there should be a permanent stock limit on traders. There's no point removing the limit for a month or two. But I guess the government is quite comfortable. If anything that is lacking is, clear direction of policy. The markets, we are continuously playing a game of dumb charades with the government. And it's high time that the government realizes that and comes out with its clear-cut intentions or policy for this year. Because the government has almost fulfilled its target of 30 million tons. And I think the only thing that moves this market is policy whispers that keep coming in. Otherwise, there is sufficient wheat in the marketplace.
What about the private trade? Because we, in my conversations with you and the rest, the other industry also suggests that the private trade has had its fill as well. As compared to last year, the government has sufficient holdings, and the private trade is quite comfortable as well.
So I think this year, the private trade and government both have more or less fulfilled what they intended to do. And UP is a surprise pack because there was no bonus in UP. And if you look at UP's procurement or into the government kitty, it's, I guess, around 1 million tons, which is considering it is the largest producer. So the stock is in UP. And that could, fulfill the market's needs in the coming months. And plus, there's the hope of government releasing its excess quantities at some point of time. So I guess it's a comfortable situation.
What is also your sense about the wheat product exports? I mean, this is a time that the government said it would start reviewing that too.
I think, the government wants to make itself very comfortable, not bring in any triggers for a price rise, and wheat product exports could become a trigger for that. But definitely the industry is clamoring for atta exports. As we all know, atta is a uniquely Indian product used by the Indian diaspora. And there is a need for the government to look into it because, a lot of money has been spent, effort has been made to create the marketing network, the distribution, the logistics, the entire supply chain. And for 2 years, it's quite a rigid policy to import wheat, to export atta for people who have created that marketplace. So we are still hopeful that the government at some point with some restrictions will open up wheat atta exports on a quantitative restriction.
What also is your sense on prices from here on with the in light of things that we've been talking about, enough a good production, a bumper crop, enough inventories with the government, with the private trade as well? Where does that leave the prices then?
So I think the prices currently, if you consider the bonuses paid by the government in MP and Rajasthan and the base price, are ruling in tandem with that. So it's about 2750 in Delhi, which I feel is like the appropriate price considering the government's bonus in MP and Rajasthan. So we are around the same price levels at which the government has procured. And I think now it will be demand that will take over the price scenario. If we have a very strong demand in the coming few months, you will definitely see markets move up a bit above cost of carry.
That was my next question really, on what is your sense on the demand going forward? Because yes, we have good stocks, we have a great crop, and with the kind of monsoons that we have, perhaps the next season would be quite positive as well. But what about the demand?
So I guess as far as demand is concerned, large users are well covered. Everybody has taken from a 40 to 60% hedge in terms of physical stocking, the large pan-India players. But demand is, expected to go up, move up in the coming few months if the weather, as we have early monsoon. So definitely we would see a spurt in demand in the next 15-20 days.
What is the average increase in demand growth that we have seen collectively for wheat and wheat products in India?
About 1.5%, I would say.
And that has been ongoing for a decade, would you say, or there's been a move there?
No, so it's quite flattened now, but definitely during Corona times, sales of noodles went up. Otherwise, the biscuit industry has had a good run where biscuit demand was going up by almost 7-8% per annum, but that's almost 5 or 7 years ago. But there are new segments where demand is high. But overall, the total quantum of demand, I guess, is about 1 to 1.5% per annum moving up.
And the production increase has been to what tune?
So production has kept pace. This year we have caught up well for whatever additional demand we have. So I guess this year we would be a slightly surplus year. Even last year was a surplus year as far as government stocks are concerned. But of course, the price levels were a bit high.
Point taken, Mr. Goyal. Thank you so much for joining in. So strong numbers coming in from wheat there. A couple of factors. One is to watch is on what do we see in sense of product exports. And the second is whether or not the government brings in any restrictions in sense of holdings there. Mr. Goyal, as always, thank you so much for joining in. And with that, that's all the time that we have on the show. Business Lunch will take all the action ahead.
Midcaps gain even as frontline stocks see profit taking. FMCG metals and auto are the big drags, while industrials, utilities clock some gains. British American Tobacco has trimmed its holding in ITC to under a quarter, with sales via block deals worth around 12,000 crore rupees. The sales will help BAT deleverage as part of its transformation plan. LIC reports a good Q4 and expects double-digit growth in FY26 with improved margins. The chairman tells CNBC-TV18 that an OFS may be in the works to improve liquidity in the stock. Federal Bank MD and CEO Krishnan Manian tells CNBC-TV18 savings account rates can drop to 2.5% from 2.75% if RBI cuts rates by 50 basis points. He sees MFI stress continuing for 1-2 quarters and expects RBI's draft gold loan norms as a positive for the bank. Noted economist and former RBI Governor Raghuram Rajan tells CNBC-TV18 that this could be India's moment if it lays out the red carpet to draw FDI with proactive policies. He adds that the consensus view of US moving down may be wrong, as he expects a reset of global portfolios. Hello, good afternoon. You're tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, a muted day that is coming in for the markets today. 24,850, around that mark is what we opened up in today's trading session. Then we went down as much as to 24,750. Some bit of a recovery that came in, but still 24,800, around that mark is what we're holding on to. We're waiting that if it actually goes up to the green as well. As of now, almost near that flat line is what the benchmark indices are trading at. Let's look at what the broader end of the market is doing, because it seems like that's holding on to better performance than what we're seeing coming in for the benchmark indices. Look at the Nifty Midcap holding on to gains of 0.4%. So yes, that's some bit of a gain momentum and outperformance that we're seeing continuing in the mid and small cap space. Small cap holding on to gains of 0.2% as well. Nifty Bank today, that's the outperformance coming in there as well. Up 0.2%, 55,480 levels is what the Nifty Bank is approximately trading at, recovered sharply from the day's lowest point. So that is interesting to watch out for. I would like to see the contributors that are coming in for the Nifty 50 as well. So we have some of these private bank names like ICICI Bank that is managing to, actually pull up the charts. So in terms of contributors, ICICI Bank, Bharti Airtel, Infosys, Bajaj Finance, these are the names that are supporting the up move in terms of the markets, while the drags coming in for the Nifty 50 today is obviously ITC. That's down and out. So yes, ITC is under pressure because obviously what we're seeing in terms of a sale that is coming in by BAT in ITC. So that is something to watch out for. Reliance is also under pressure. So that's a heavyweight that impacts the market overall. So overall, that's the scenario that currently we're seeing coming in. An advanced decline ratio just a short while ago, always almost in line is what we're seeing. But there are a lot of stocks that are moving in today's trading session as well, right? And which are these buzzing stocks? We have Vamakshi here as always to take us through the stocks that are in the news flow today, what is happening in the market as well. Good afternoon, Vamakshi.
Well, good afternoon, Vinny. Let me first start off with Techno Electric. The company had a good quarter in the quarter gone by. Revenue saw an uptick of almost 86% on a year-on-year basis. The net profit too saw a very sharp uptick of 74%. If we look at the FY25 year as a whole, the revenue stood at a multi-year high, and the EBITDA margin saw an improvement for the third consecutive year, standing at the highest level that we've seen since FY22. As far as LIC is concerned, good growth out here as well. New business premium came in above estimates. The total APE as well came in much above what the street was anticipating. However, the VNB margin at 18.75% was slightly below our own poll. BDL, on the other hand, very strong revenue growth of almost 41% in FY25, well above the stated guidance of 20 to 25%, but the company has taken a big knock on profitability. FY25 margins have declined by almost 850 basis points year on year to 14%. This is much below the stated guidance of 20%. DCX System 2 saw a dip of almost 26% in its revenue. For FY25, the revenue as a whole was down almost 24% as compared to their expectation and own guidance of almost 35 to 40% growth. So they missed that big time. Q4 EBIT margin too seeing a downtick of almost 150 basis points to 5.5%. And lastly, keep an eye out on Apollo Micro. They bagged an export order worth 114 crores for development of an avionics system, and therefore the stock is seeing a very sharp spike in trade today.
Okay, Mamakshi, thank you so much for that. Keep an eye out on all those stocks in the trading session and the second half of the trading session as well. But let's move on because we had an exclusive chat with the noted economist and former RBI Governor Raghuram Rajan, and listening to his comments that are coming in, especially in terms of how tariffs may not reproduce exact effect Trump was hoping for and how the trade negotiation offers India a global opportunity. Listen in.
There is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now. I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. I think the short run tariffs are disruptive, even to manufacturing. So we will see the consequences in the second half of this year. Will it bring back manufacturing jobs? Probably not a whole lot. Jobs that will be created will be for technicians who man the machines, not for the guys doing the work directly. So big increase in manufacturing jobs, unlikely. In the longer run, I think one of the concerns this has created in the rest of the world is, are we overly exposed to the United States? And you can see it in the talk amongst financial investors. 70% of global stock valuation was in the US. And now people are saying, well, maybe we are overly exposed. We need to rebalance our portfolios, both on the equity side, but also on the fixed income side. Are we holding too much in US treasuries? So when you talk reset, I think this portfolio rebalancing will play out for some time. It's because people are saying, do I really want to put more assets in the US at this point? And many portfolio managers are saying, maybe I need to rebalance. If India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment. And it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way. I think if we can do that, it could be India's moment. But a lot more action is needed, and it has to be proactive, not just reactive.
And moving on, India's capital market regulator SEBI is poised to approve 3 major IPOs in the coming weeks, according to sources. Ritu Singh is joining in with us to give us details on this front. Ritu, over to you. What are we expecting? Which are these 3 IPOs?
Well, yes, big moves in the primary market, with SEBI set to clear 3 IPOs very soon. First of the block is the much-awaited $1.5 billion HDB financial IPO, which is set to get SEBI's go-ahead very soon, paving the way for what is going to be one of the largest IPOs we'll see from any NBFC in recent times. Their offer will comprise of 2,500 crores of a fresh issue component and 10,000 crores offer for sale by the parent HDFC Bank. Now, while HDB had filed its DRHP in October last year, the offer was under SEBI scrutiny over a potential violation of Companies Act, which related to a private placement of shares to more than 50 employees of HDFC Bank, which has since been resolved. Keep in mind, HDB Financial will have to list by September to comply with RBI's upper layer NBFC norms. In addition to that, if RBI's 2024 draft circular on bank subsidiaries is finalized, HDFC Bank will also have to bring its stake down to 20% in HDB, where it currently owns more than 94% stake. Another reason why this IPO is crucial beyond just its size. Now, apart from HDB, we've been given to understand SEBI is also set to clear Hero FinCorp's 3,668 crore rupee IPO, the papers for which were filed in July last year and faced delays because of compliance-related questions around unlisted entities. Now, Hero FinCorp is backed by Chris Capital and part of Hero Motorcorp Group, and the offer will also comprise of a fresh issue along with an OFS. Then we have Vikram Solar, one of India's leading solar PV module manufacturers that is based out of Kolkata. The company filed its draft papers in September last year, looking to raise 1,500 crores through a fresh issue along with an OFS by promoters. Now, the SEBI approval for this one is also expected soon. Finally, an update on Tata Capital's mega 15,000 crore rupee IPO. They filed their papers with SEBI just last month, so this will take a little more time, but the clock is ticking for them because Tata Capital is also under RBI's upper layer NBFC listing mandate with a deadline of September this year to hit the public markets.
Thanks so much for that, Ritu. But do wait by with us because it seems like the Reserve Bank of India has tightened the default loss guaranteed rule. Now, this is what sources are telling CNBC-TV18 that RBI has instructed NBFCs to exclude default loss guarantees from fintech firms when provisioning for stressed loans. Ritu, take us through these details. What are you picking up here as well?
That's right. Our sources indicate that the Reserve Bank of India wrote to select NBFCs in March, directing them to exclude default loss guarantees provided by fintechs when making loan loss provisions. Simply put, the default loss guarantee or DLG is a kind of safety net in digital lending where if a borrower does not repay the loan, the fintech or the digital lending partner promises to cover part of that loss, which is capped at 5% according to RBI rules. Now, earlier we had NBFCs simply excluding this 5% DLG amount, which was theoretically available in cash from their loan loss provisioning, but now RBI has prohibited that. Now, these lenders worry that this will make the DLG model less attractive and more immediately cause them to incur a hit in order to make this additional provisioning. Now, our sources indicate that the industry, including NBFCs and fintechs, through their SROs like FACE, have been in talks with RBI over this matter, and they want RBI to consider allowing NBFCs to set off this amount, arguing that even India's accounting standards allow for setting off the DLG against provisions, provided that NBFCs have clear access to this cash flow through an escrow account with a bank. Now, if the RBI directions are implemented, it will imply higher capital consumption for these lenders. That in turn will hamper ROEs and could lead to lower volumes. Now, we understand even as the dialogue with RBI is ongoing, some NBFCs have started to make the provisions from the March quarter. For instance, Northern Arc disclosed that it had to make a provision of 68 crores because of RBI's DLG accounting guidelines in the March quarter, which impacted its profits. A Macquarie Notes also points out that Paytm started DLG in the last financial year and about 80% of its merchant loans are under the DLG arrangement, so there could be a decline in distribution revenues for them as well.
Thank you so much for that, Ritu. But on that note, we're going to slip into a very short break. More news and updates on the other side. Welcome back to Business Lunch on CNBC-TV18. Now let's move on. The Income Tax Department has sent notices to several non-resident Indians and companies who claimed benefits under tax treaties with tax havens. Sources tell CNBC-TV18 that the Income Tax Department suspects some may have to set up shell companies in an attempt at treaty shopping. Timsi is joining in with us to give us updates on this one. Timsi.
Well, that's right. The Income Tax Department is understood to have sent notices to several non-resident Indians and entities based out of Singapore, Cyprus, Mauritius and other such tax havens who have claimed benefits under the tax treaties. Sources have shared that the Income Tax Department is suspecting treaty shopping by these non-resident individuals and entities using tax residency certificates from tax havens to file lower taxes. The Income Tax Department notices have cited that these tax residency certificates from tax havens alone are not enough as a proof to claim treaty benefits under DTAs. Also, these foreign companies must substantiate commercial rationale for investment in India to claim tax treaty benefits. The tax department has also questioned that the tax residency determined by these factors like control over investors, decision-making authority, economic substance, and not just these residency certificates. The tax department suspects that intermediate holding companies in tax havens may be shell companies set up to avoid paying higher taxes, and thus these entities and individuals must answer key questions such as who is the real beneficiary of the Indian investments made by these intermediate holding companies set up in tax havens, what is the commercial rationale for setting up these intermediate holding companies in tax havens, who are the key decision makers at these companies, what is the board composition, employee strength, premises occupied for business purposes, nature of business of these intermediate holding companies in tax havens, and much more. Now, to be seen is how these notices are able to find peace with the investments and these NRIs and non-resident entities, along with the tax outgo that the tax department has to manage. Back to you.
Thank you so much for that. But let's move on. The Trump's administration has ordered its mission abroad to stop scheduling new appointments for students and exchange visitors, visa applicants. Watch this report on that front.
Today to honor U.S. President Donald Trump's administration has ordered its missions abroad to stop scheduling new appointments for student and exchange visitor visa applicants. That's according to an internal U.S. cable seen by Reuters on Tuesday, which also indicated that the State Department is preparing to expand social media vetting of foreign students. It's the latest step in the Trump administration's efforts to fulfill the president's hardline immigration agenda. That's included ramping up deportations as well as revoking student visas. Last week, the administration moved to revoke Harvard's ability to enroll international students entirely. Those roughly 6,800 students make up about 27% of Harvard's total enrollment. What do we do? On Tuesday, several hundred protesters, including Harvard students and professors, demonstrated in support of foreign students at its Cambridge campus.
We stand here today to affirm that international students are our peers, our classmates, and our friends.
In the cable that Reuters saw, U.S. Secretary of State Marco Rubio said that available visa appointments for student and exchange visitor applicants that were not already scheduled should be pulled down. He also said the department plans to issue updated guidance on social media vetting for such applicants. A senior State Department official confirmed the accuracy of the cable. Trump administration officials have said student visa and green card holders are subject to deportation over their support for Palestinians and criticism of Israel's conduct in the war in Gaza. The administration has called their actions a threat to U.S. foreign policy and accused them of being pro-Hamas, while critics have called the effort an attack on free speech rights under the First Amendment of the U.S. Constitution.
And meanwhile, the United States State Department has reiterated that it will continue to use every tool to assess who is coming in, whether a student or a tourist. It said that the department takes the process of vetting people seriously, adding that applicants must follow the normal process for getting a visa. And on that note, we're going to slip into a very short break. But before we slip into the break, we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m.
People talk about the Flipkart mafia and all the startups that came about. I think
You're part of the mafia.
I think it's the startup university. Equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey.
I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO.
I think the business is in a good place, the org is in a good place, the sector is in a good place. If you're a market leader in the growth sector, I think it's a good time.
Who's the maverick and who's the goose, since we're talking about the
he's
wing?
the maverick.
He's the maverick.
You're both pointing at each other.
I think we have more conversations with each other than our wives.
You've known each other longer than you've known your wives, so it makes
That is true.
kind of makes sense.
That is true.
Thanks for staying tuned into Business Lunch on CNBC TV18. Now let's move on and let's get you the latest update on West Asia conflict. Chaos erupted after thousands of Palestinians stormed into the newly opened aid disruption site backed by the US and Israel in Rafah in desperation for food after 3 months of blockade. Take a look at this report.
Thousands of Palestinians rushed into an aid distribution center in Rafah on Tuesday, desperate for food after an almost 3-month-old Israeli blockade. The aid was being distributed by the U.S. and Israel-backed Gaza Humanitarian Foundation, or GHF. Large parts of a fence appeared to be torn down as people jostled their way onto the site. GHF said the number of people at one site was so great on Tuesday that its team had to temporarily pull back and allow people to, quote, take aid safely and dissipate to avoid casualties. The Israeli military said its troops fired warning shots in the area outside the compound and that control was reestablished. GHF said it began operations on Monday, but Palestinians appeared to have heeded warnings, including from Hamas, about biometric screening procedures employed at the foundation's aid distribution sites, and stayed away. On Tuesday, many seem to have dropped those concerns.
We are dying of hunger. The children are saying, Father, I want to eat, so I want to sell even my blood to feed them. We can't find anything to eat. I saw the youth running, so I wanted to come. Some were afraid, but I thought, let it be. I need to feed the children. We have starved, died. Stop the war.
By late Tuesday afternoon, GHF said it had distributed about 8,000 food boxes, equivalent to about 462,000 meals. Israel and the GHF said, without providing evidence, that Hamas had tried to block civilians from reaching the aid distribution center. Hamas denied the accusation. Israel says the Switzerland-based GHF is a U.S.-backed initiative, and that its forces will not be involved in the distribution points where food will be handed out. Humanitarian groups briefed on the foundation's plan say anyone accessing aid will have to submit to facial recognition technology. Palestinians worry the technology will be used by Israel to track and potentially target them. The United Nations and other international aid groups have boycotted the foundation. They say it undermines the principle that humanitarian aid should be distributed independently of the parties to a conflict, based on need. UN spokesperson Stéphane Dujarric called the situation heartbreaking.
As the Secretary General noted last week, we and our partners have a detailed, principled, operationally sound plan supported by member states to get aid to desperate population.
And with that, we'll wind out this edition of Business Lunch on CNBC-TV18, leaving the Nifty below the 24,800 levels. Thank you so much for tuning in. Up next, your Midcap Radar.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Doria, and with me is Mangalam Malu. Good afternoon to you, Mangalam. It's so good to have you on the show. Really excited to anchor with you. But you know what's not exciting is the markets right now. They have been consolidating since morning in a very narrow 100-odd point range.
Well, I'll tell you one thing. When I started out in CNBC-TV18, the first show that I anchored was Midcap Radar. So it's always, it feels very comfortable, feels like it's home to come back to Midcap Radar. And it's a show that's very close to my heart as well. Speaking about close to your heart, there's some midcaps which are doing actually well. So the frontline indices, while they are slightly subdued, they are well behaved within the range that we spoke about earlier as well. The broader market is doing well with nearly 1,400 stocks which are advancing as against 1,100 stocks which are declining. Tells you that your portfolios are looking better. But all that and more in just a bit. First up, all the top stories that we're tracking this afternoon. Midcaps gain even as frontline indices consolidate in a narrow range. It's the FMCG, metals and auto pack which are the big drags, while PSU banks and financial service, they clock some gains.
Techno Electric up over 12% after reporting their Q4 numbers. Revenue comes in at multi-year high in FY25. EBITDA margin at highest level seen since FY22.
Triveni Engineering up over 9% after reporting their fourth quarter numbers. Revenue up 25%, EBITDA surged 21%. The management tells CNBC-TV18 there is scope for margin improvement, particularly in the ethanol business.
Defense sector stocks Bharat Dynamics and DCX Systems react to their Q4 numbers. Bharat Dynamics reports strong revenue growth of almost 41% in FY25, but profitability takes a big hit. Meanwhile, DCX Systems reports a sharp miss on guidance of 35 to 40% growth.
ITI, that's the stock on our radar after their fourth quarter earnings. We had the net loss, which narrowed to 4.5 crores versus about 230 crores last year. And that on the back of a revenue surge of 75%. That stock up 8.5%.
Well, 24,798 thereabouts, that is where the Nifty is at. It did attempt to recover from the day's lowest point, but it's still trading in the red. The mid-cap end of the market, though, is doing quite well. The mid-cap index, as of now, is trading with a gain of nearly 0.3%. But as far as some sectoral indices are concerned, it's a mixed picture. Nifty Media is doing well, so is the PSU Bank Index. We also have the FMCG Index, which is down and out in trade today, mainly dragged by ITC. But, there's a lot of action happening in the mid-cap space. And in our special segment, Mid-Cap Movers, we now have Hormas to take us through the mid-caps that are moving around in trade. Good afternoon, Hormas.
Good afternoon, Vamakshi. And a sandwiched session brings no surprises between two expiries. And you're seeing the moves on the index as well. But, of course, there is plenty of stock-specific action in the broader markets. It starts off with those that are on the losing end, or gaining end of things actually. It's Schneider Electric building on to the gains after its results yesterday, 8% higher on that stock. And look at Hitachi Energy, Bharti Hexacom is continuing to move to new highs as well, 4.5% higher on that stock as well. Earnings reactions in today's trading session have not been any surprise. LIC, of course, being the stock of the day now, 7.5% higher on that stock, nearing in on its original IPO price of 949. Techno Electric, of course, the top gainer on the Nifty 500 remains so, 13% higher. Triveni Engineering and Gujarat Fluoro, after the downgrade that came in earlier in the day, is also down 5% in today's session. A lot of these smaller PSUs have done well in today's trade. ITI, of course, an earnings reaction, 8% higher, and that has reflected on some other names like IFCI and MMTC as well, both of them trading with gains of 11 to 15% in today's session. Onto the volumes then, stocks that are doing well on the back of volumes. Look at MRPL, the spike that came in on the stock towards a few minutes earlier, 5% higher on that stock. Similar move seen on Chennai Petro as well, and Welspun Corp too at the highest point of the day on very strong volumes. And lastly, some stocks that are on the losing end of things. Look at IKS Health. AS, of course, after its results, dragging to lows of the day, and Escorts Kubota too at the lowest point of the day. Some selling pressure intensifying in that stock, 4% lower here. Back to you guys.
All right, Hormas, thanks a lot for that. Spoke about a bunch of stocks. Just keep an eye out on Precision Camshafts, up 16% now, reported its numbers post-market yesterday. There was a big jump in consolidated profits, and that's reflecting in the way the stocks moved right now. Also keep an eye out on a couple of these, SUV makers. Over the last hour or so, we've seen some purchase in Force Motors, which has moved to the high point of trade, and SML Isuzu, of course, CV maker more than an SUV maker. That stock too has moved higher. About 5% recovery from the lows is what we've seen. And before we, talk about something else, just watch out for Godfrey Phillips as well. On a day where ITC has seen some selling pressure, maybe because of the overhang of selling on ITC going forward, investors, are they looking at Godfrey Phillips? Over the last 12 or 13 quarters, the company has reported better volume growth than ITC, and Godfrey Phillips as a stock has returns to show for it as well. But we are excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime. This brings you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon daily for the Global Reset and Global Lens at 8:30 p.m. on weeknights. Investing. Well, we were talking about some of the stocks doing well from the broader markets. Escorts Kubota on the other side has seen some sell-off, so at the low point of trade. IRCTC reports its numbers today, is also seeing some bit of a sell-off, and VIP, which has been quite an underperformer, rank underperformer, has continued to see some traction by and large, in a range, but keeps seeing these sporadic moves every once in a while. This month, it's up 16%, but remember, from the highs, it's seen a big cut as well. But stock on our radar is Gateway Distriparks. Reported a soft set of fourth quarter numbers. The bottom line was impacted by an exceptional loss of over 250 crores. But the consolidated results were actually supported by, the consolidation of Snowman itself. Let's talk about their main organic business, which is that of inland container depots as well as container freight stations. Samvit Gupta, who's the joint MD at the company, joins in now. Thanks a lot, Samvit, for joining in. Let's start with the targets that you have set for yourself for this year. Rail volume for FY25 was down 2%. CFS was just about flat. For FY26, what is it that the street should anticipate? And EBITDA per unit, if you could give us a sense.
Hi, good afternoon. Thanks for having me on the show. So we are looking at double-digit growth on the rail side. The CFS side will probably see some minor growth of about 2 to 3%. But all this depends on long-term, factors like geopolitical situation, also the tariff situation, which we'll get clarity in July. But there are some positives like the FTA is being signed by India and UK, India and EU also in discussion, India-US trade deal, whatever ends up happening. There should be a realignment in global trade in favor of India. So we're positive on the long term, but double-digit growth is still on our minds overall.
And what about EBITDA
And
per
on the
unit?
EBITDA per TU on the rail side, we're looking at about 9,500. Hopefully, we can push that to over 10,000 per TU after the JNPT leg gets connected on the DFC. And on the CFS side, it'll be about 1,500 per TU.
All right, and what is the kind of double stacking that you managed to achieve in FY25, and what would be your target going into FY26?
So our average was 40% for the year. And this was basically dragged down in Q1 when the whole Red Sea crisis was going on. So Q1 was at about 33%, but we've managed to consistently do over 40% in Q2, 3, 4. So our target for next year is about 45% on double stacking.
All right, double stacking 45%, 40% is what you've done. You spoke about briefly, the impact that, the JNPT being connected to the Western Dedicated Freight Corridor comes by. There were reports that suggested that it actually is, the opening is likely to be brought forward from December to October. Have you heard something on that? And if that were to happen, what could that do to your volumes and market share?
So it really depends. I mean, 2-3 months here there won't make a large difference, but basically this will be an alignment of trade again, shifting from other ports to back to JNPT over a period of say 1 or 2 years. So we don't expect any immediate ramp up like that, but over time we think we would benefit as it's longer distance. So longer lead distance would mean better revenue and margin for us. As well as where we have a pan-India license, and not all rail operators have a pan-India license. So we'll be one of the fewer operators out of JNPT.
Sure, and how many terminals and ICDs have come on stream in FY25 for you, and how many more are likely in FY26 then?
So we have 5 ICDs and 5 CFSs. We don't have any new ones opening up this year. We have plans for 2 new locations, but land acquisition has been a challenge, so we've not been able to finalize yet. Whenever we do finalize, it'll take 2 years minimum for those to operationalize. Meanwhile, what we've started looking at is some asset-light options where we operate out of third-party terminals or third-party sidings, which we weren't doing in the past. And some domestic movement as well. So hopefully 1 or 2 of those locations should come in within this FY.
So what should that do to your total overall handling capacity? That's point number 1. And secondly, what does that do to your market share? I mean, I briefly did ask you about that because, a week ago we got Container Corp. They said that they've maintained their market share, whereas everyone else is claiming that they've gained market share, which is the other players. So have you gained market share? Is it at the expense of Container Corp? Or what is really happening in the market?
So our NCR market share has gone up from say about 16%, close to almost 17.5 to 18%. It's not specifically come from one operator, it's come from all across. Ludhiana, we went down to 21%, but this year we've gone back up to 27-28%. Again, it's from multiple operators that we're doing. We don't measure on a like-to-like basis with Concor our market share since they operate out of a lot of more locations. So we only focus on the regions where we're operating in. So these asset-light locations again would be new geographical locations for us. So that would increase our pan-India market share, but not again at the expense of anyone else.
So in the regions that you operate with Container Corp, where does your market share stack up against? How does that stack up against them, and how has that moved?
So NCR, we've gone from 16 to 18%. Concor, I'd say, still dominating the NCR market share with over 50%. And they've been stable at that figure. Ludhiana, like I was saying, 21 to 28% we went, and all the operators would have lost some market share while we did that. And Uttarakhand, we've gone up to almost 37% in this last quarter, which we were at about 28% the year before. But overall markets of Ludhiana and Uttarakhand have actually degrown. So that's also playing a factor in why our volumes are not rising up as much as our market share.
Sure, and what happens to your profitability when you have, an asset-light approach? when it comes to your additions, and what does that also do to your return ratios?
So there's no capex involved in those sites, and the rakes are also on lease basis. So that way the ROCE would improve. But the EBITDA per TU would be lower, as we're not going to get any handling income or any first last mile income. But it would still be to the order of about 25% margin that we'd be operating at.
And with the freight rates the way they are, with your increased volume targets, etc., what's the kind of revenue growth that you're penciling in for FY26?
Again, like I was saying, it depends on the geopolitical situation and the tariff situation, but we are looking at least a 10% growth, and this is not counting the Snowman consolidation coming in.
You gave us a nice setup with the Snowman thing there. Over the last 1 year or so, 45% has gone up to 50%. Last 2 years, 40% has gone to 50.1%. Where do you take it from here? I mean, do you intend to take it beyond 51% or just hold it steady for now?
So we're not against the idea of increasing our stake. We basically first we'll take care of Gateway's capex plans and the dividend that we pay out regularly. And if there's a free cash flow situation, then we could look at increasing our stake. But again, no immediate plans on it.
That's not priority. After having raised it with so much, you don't intend to rush into buying more of Snowman, right?
Actually, yes.
All right. Thank you so much for joining in and giving us all those updates. With that, we'll simply do a short break, get you more on the markets and a lot of stock-specific action. Stay with us.
People talk about the Flipkart mafia and all the startups that came about. I think
You're part of the mafia.
I think it's the startup university.
Still are.
Equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey.
I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO.
I think the business is in a good place, the org is in a good place, the sector is in a good place. If you're a market leader in a growth sector, I think it's a good time.
Who's the maverick and who's the goose, since we're talking about the
He's
wing?
the maverick.
He's the maverick.
You're both pointing at each other.
I think we have more conversations with each other than our wives.
You've known each other longer than you've known your wives, so it makes
That is true.
kind of makes sense.
That is true.
Welcome back. You're watching Midcap Radar on CNBC-TV18. And now from one management to another, Info Edge reported their Q4 numbers and the company saw muted revenue growth in the quarter gone by. Their margin also came under pressure. My colleague Vinny Motiwala spoke to Chintan Thakkar, whole-time director and CFO at Info Edge, and began by asking him about hiring trends across sectors such as IT, BFSI, healthcare. Listen in.
When you look at the overall trend, yes, April, is slightly, like you suggested, that it could be slightly slower. But if I take a very broader look of the jobs quick index, as well as what we are seeing in terms of we have just recently announced the results. So what we have seen in terms of the monetization, I think we are seeing that it has been a strong quarter in the past, and what we are hearing from the market, is that this seems to be a kind of a momentum which is continuing. Well, I know that this is not exactly what the overall scenario looks like, but on the ground, it seems that we seem to be doing better than what probably JobSpeak Index suggests. And this is yes, IT. When I speak of IT is a very large sector, but if you kind of slice and dice, for example, GCC seems to be doing much better, right? Some of the IT product companies seem to be doing much better. IT services, which are mainly the export-driven kind of a segment, I think there, it seems to be a little, sluggishness. That seems to be a little slowdown over there, and that has been the trend, past, many quarters. So, but otherwise, non-IT, for example, you talked about the BFSI, the healthcare. I think they all seem to be suggesting, that there's a momentum. Tier 2, Tier 3 towns seem to be suggesting that there's a momentum. So, given the fact that our billing has last quarter grown by almost like overall recruitment solution has grown by 18% plus, I think that indicates that the otherwise the on the ground, I think there seems to be a good uptake.
Are we seeing any sort of an impact because of this uncertainty of Trump tariff? So my question comes in, are we seeing any impact of that? And are you also seeing any impact given that AI also is coming in? So in terms of the trend, is there a clear shift on that front as well? And do you expect that billing growth, like you mentioned as well, around 18% that you saw this time in Q4, will that continue in FY26, or a better growth is what one could envisage now?
Yeah. So the impact of, let's say, the technological development that are happening, right? AI is something which is most talked about, and it's a mixed bag. There are certain segments where, let's say, the guys who are there in areas which are related to AI, right? Machine learning, data science, some of those jobs, I think they are highest in demand. I'm sure this year their increments and everything also would be very high. So there seems to be a demand-supply gap where demand is very high and supply is limited, while some of the segments, like which is more like a PPO type of segment, customer support segment, that's where we are seeing that there could be some impact of AI. Although even in that segment, in terms of the quarterly numbers that we have, I think there seems to be a bit of growth over there as well. But we do hear some kind of slowdown in some of those type of segments that we anticipate. But in the high end, I think there's going to be a much more demand. I think there is a kind of a shift that may happen in terms of the job profiles, but overall we are not seeing anything which we would indicate that AI is kind of impacting us directly, right?
Absolutely. And billing growth, sir, will we expect this 18% rate that we saw in Q4 to continue for this segment?
Look, most of our billings happens in the last few days of the end of the quarter, right? So this is little too early for me to say that what the billing would look like.
Mr. Chintan, what I want to know is in terms of 99 acres, real estate trends, how did that shape up quickly in Q4? And, losses seem to have, quarter-on-quarter basis, I'm saying, has seemed to have expanded a bit more or increased a bit more. So, what are we expecting there as well? On the PBT front is what I'm looking.
Yeah. Again, when you look at the this quarter picture as well as the full year picture, I think we are, for the full year, and we had promised this earlier that our goal is that we kind of become EBITDA neutral, and I think that's what we seem to have achieved. We are almost there. And if you look at the billing and the total expenses and the total cash expenses, if you look at it, then on cash basis, we are kind of EBITDA neutral. In fact, in this quarter, in Q4, we have generated cash, which kind of offset some of the cash burn that happened in the previous quarters. So I think this quarter has been encouraging. Also, what our understanding is that we seem to be gaining in market share, which is even far more important than just the cash break even that we are talking about. So it's very encouraging. We'll continue to push the pedal to gain more and more market share. And again, I think I must add here that AI is really helping us in getting the cost efficiency, whether it's marketing or whether it's also in terms of how we go to market.
Sure.
I think it's really helping us. It's also helping us in business like Jeevan Sathi in terms of how our algorithm works. I think they are far more sophisticated than what it used to be in the past.
So for Shiksha, a quick question. There's higher visa rejections now in the US as well. There's so much uncertainty over there in terms of universities. Are you seeing any change in terms from that front, in terms of customer trend moving more towards the domestic market? And also the billing growth, that's 16% for Shiksha, while revenue growth is at 1.6%. So what is the reason for this gap, that I'm seeing in billing growth as well as revenue growth?
Yeah, so again, a great question, because when you split the Shiksha into domestic business as well as the study abroad, like you said, we have a lot more headwinds, and this is actually kind of declining. But domestic business is growing at a much faster rate. So right, when we aggregate, I think the real growth story of domestic business actually does not come out. So domestic business is doing very well. The difference between the billing and revenue, like I said, that look, billing is the lead indicator. Revenue is what happened in the past few quarters. So I don't see there's too much of a gap over there. But I think one should really look at from the business analysis standpoint, one should look at the billing, because that it tells you what actually happened in the quarter and what the trend line for future looks like. That sets the tone for future.
Okay. And sir, last question on Jeevan Saathi. Obviously you spoke a bit about it. The losses have also narrowed down. So can we expect in FY26 Jeevan Saathi, in terms of the PBT level, we would see some profit there, as well as competition? How is that shaping up right now? Outlook for FY26.
Yeah. So look, when you look at Jeevan Saathi, there are different markets. There is no one national market.
Yeah.
Market is split in terms of the different communities and geographical regions and linguistic kind of different classes, right? So where the place where we are stronger is mostly it's Hindi belt, and Hindi belt seems to be growing, and we seem to be cementing our leadership position over there, right? So in some ways it is very it's not appropriate comparison to look at us directly with the competitors. Let's take Bharat Matrimony, which has got a strong brand in the southern region, but we don't have much presence in the south, right? So we are far more north and in the belt, so it's very hard for us to really compare that.
Okay.
But we made certain changes. There's about how we go about our platform. We made it about 3 years ago, and that seems to have worked for us, and that's why now we are seeing that not only the revenue and the billing seems to be growing. For example, this year, overall we have grown, for the full year we have grown at like about 30% plus. That's a very healthy growth, and with that growth we have been able to achieve EBITDA neutral.
Well, that was the management of Info Edge. The stock as of now is taking a hit. The stock is down almost 1% in trade, but has seen a recovery from the day's lowest point. But that's all we have on this edition of Midcap Radar. From Mangalam, me and everyone who put the show together, thank you for tuning in. But don't go anywhere, because we have your stocks up next.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Markets where we left it, right? 24,773 is what it's trading. That's below the 24,800 level. We've not seen any much sharper fall coming in right now as well, but 24,700, 800 around that mark is what we are seeing in terms of the trading coming in for the Nifty. The broader end of the market continues to perform better. Nifty Bank, that's managing to do well today, holding on to that green on the Nifty Bank as well. So 1/10 to 0.2% of gain that we're seeing coming in for Nifty Bank. As of now, some bit of a fall from the day's highest point. So yes, that's something we're watching out for, whether Nifty Bank now will be able to sustain the green in the next 1 hour, 1.5 hours of trading session as well. But yes, that's how the market setup is looking like. Broader end continues to outperform the benchmark indices. But this is a show where we solve all those stock-related queries that you all send us. And to solve that, today we have Asta Jain of Hem Securities as well as Saumil Mehta of Mirai Asset Share Khan joining in with us to answer all your stock-related queries. Asta as well as Saumil, very good afternoon and thank you so much as always for joining in with us. Saumil, before we go to the queries, a quick check in terms of the markets. You know, seems like the Nifty is not managing to hold on to that 25,000 mark. Now 25,800, also 850, we touch that and now we go below that as well. What are the levels we should keep an eye out on, both as a resistance as well as a support?
This is the third week that we are in this range of 500 points range, and I totally agree that we are not able to hold on to 25,000 levels. But the good news is that we are able to hold on to 24,500 levels as well. So that's a good part. And overall, the undertone still remains positive. So I think the strategy should be to buy on declines. 24,500 remains a very, very crucial support. Banking is looking great. So I think from here, smaller banks, PSU banks would be doing great. Stock specific and sector specific should be the focus for some time, probably for another 1 week. And then probably I'll be expecting this range to break on the upside for a target of 25,300, 25,400.
Okay, keeping an eye out on those levels over there for the Nifty Bank, Sensex. Keep an eye out on that. But let's move on and get started with all the stock-related queries. And the first query for today coming in from Sulochna, who's writing to us from Kolkata. She's holding 200 shares of Praj Industries. This is at a price of 500 rupees per share. So right now also the stock is trading close to a buy price, but she's bought it around last year. Now she's asking if she should continue to hold the stock for another year. Asta, afternoon and Praj Industries, they had reported the numbers as well. I don't think it was that exciting in terms of the numbers that came in from Praj Industries. What should the viewer do now? Should they continue to hold it for 1 more year, or do you think this price around that 500 is something that will continue for the company in the next year as well?
Hi, good afternoon to all of you. Talking about this counter, I think viewers should hold this counter with a price target of 530 to 540 at the initial level. Now, why I am asking him to hold this counter? Because what we believe from the management commentary, which they have came out after the result declaration, is that they are still confident of, executing their guidance of tripling the revenue by FY 2032, and that is on the basis of diversification from the sugar-based ethanol business. So I think that is because now management is trying to reduce its dependence on that business. And I think that is the major lever for me, which can be a growth driver for the company in the coming years. So my idea here is that, yes, the results were not in line with the expectation. There was a decline in the revenue, but the kind of commentary which we have seen from the management side and the management reduced dependence on the ethanol business will definitely going to provide some cushion to the business performance in the coming time, and hence we are recommending hold on this counter. Price target which we are setting for this counter is 530 to 540 at the initial levels.
Okay, 530, 540 at the initial levels is the price target what you are setting. Saumil, what's your view coming in? Because the fall in the stock was quite sharp, right? At the beginning of the year, it was somewhere around the 799, 800 mark. And now today at 490. So, that does give a bit of a worry on that front. What should the viewer do?
In the very short term, it's a small consolidation between 500 and 450, but 450 is a very, very crucial support. There is a multiple support zone at 450 levels. So I don't expect stock to go down below 450 levels and close below 450. I think that will be a great time to buy. My suggestion would be to hold on to this stock, and I'll be expecting this stock to go till at least 600 levels, which is the 200 daily exponential moving average. But this is a medium to long term targets and medium to long term view. In the very short term, I'm not expecting too much from the stock and probably will be in the range between 500 and 450.
Okay, 500 and 450 is the range in the short term is what you are expecting for the stock coming in. Let's move on to the next query for today. We have P. Suresh, who's writing to us from Andhra Pradesh. He's asking if he can invest now in NTPC at the current levels. Asta, on the fundamentals, how is NTPC looking like in terms of overall numbers for Q4 FY25? There's a bit of a miss that came in terms of the commissioning target. Commentary overall after that, they said that they expect this to actually come in FY26 would be better. What are we watching out for? NTPC a good bet in the sector, or maybe there are other options which the viewer can look to invest in?
I think why management is confident about the coming years is that the kind of capacity addition they are coming in. I think they have a plan for the capacity expansion of 76 gigawatt, which is currently there, to 130 gigawatt by FY32. So I think this type of a capacity addition, which the management is doing, and with that, what we are seeing that there is a continuous increase in the power demand, and we are expecting it to increase by the 7% CAGR. So I think both these points bode well for the long-term or a brighter prospect of this company. However, in the medium term or a short term, the company may not show so much rise in the stock prices. But in the longer term, we are confident of this company to move till the level of 400. However, at the initial level, we are giving the price target of 380. So my idea here is to add this counter and keep the price target of 380 to 400 for the long-term perspective.
Okay, that's the view coming in on the fundamentals front for NTPC. But on the technical, Saumil, what's your view coming in? Is this a good price to enter NTPC? Because somewhere around in Jan, beginning of the year, also it was a bit lower than this, also around the 300 mark. So should we wait out for that? Do you expect a bit more of a fall? Or this is a good entry level right now?
This is one of my favorite stocks to invest, actually. Large cap in the uncertain markets. NTPC always performs well, stays, it was consolidating. It is still consolidating in a range. However, at these rates, I think it's a great buy. The bounce which we saw from 300 to 370, the entire bounce was an impulse. And I think now we'll be expecting a new all-time high. This is a great time to buy, and 300 levels would be the stop loss for me. I'll be expecting in the very short term, I'll be expecting 370, 380 levels. In the medium term outlook, at least 400, 410 levels in the next coming probably a couple of quarters.
Okay, keep an eye out on NTPC. It's Saumil's favorite stock, so the disclosure also comes in there from Saumil as well. But yes, NTPC can look to buy and keep an eye on those levels over there. Let's move on to the next query for today is coming in from Matthew, who's writing to us from Bangalore. He's saying that he's holding 500 shares of Eternal, that's Zomato, known as Zomato previously. Price is 240 rupees per share. So he's asking whether to stay invested or sell at the current levels. Asta, obviously we had seen those changes that came in the index as well, and some bit of an outflow that came in from Zomato because of the changes in the MSCI FTSE as well. So what are you watching out for right now from Eternal, and should the viewer continue to hold these?
I think viewers should continue to hold this counter, because what we have seen in the fundamentals, if I talk about particularly, that the Blinkit is showing very, very strong performance. Despite of the fact that there was a dark store addition, we have seen there was an increase in the contribution margin, or a contribution margin expansion was there. In fact, their GOV has also shown an increase. So I think that this counter and whatever losses they have shown, I think this is the peak losses which we are seeing right now. And going ahead, we expect the company to show some sort of reduction in their losses as well. So my idea here is to stay invested in this counter purely on the basis of fundamentals, and we are giving a price target to 260 to this counter as of now. So stay invested in this counter.
stay invested in the counter. That's a word on the fundamentals. And on the technicals, is that a similar trend that we are expecting there as well?
For Eternal, not very bullish on the stock. Low top, low bottom formation in the short term, in the medium term outlook as well. There was a small consolidation which has broken on the downside. So even in the short term, I think the sell-off will continue. The next level in the medium term outlook would be 190, 195 levels, which will be previous swing lows. So I'm not very bullish on in the short term, in the medium term outlook both. The resistance would be around 240 and 248.
Okay, not too bullish on Eternal on the technical front, but fundamental, continue to keep Eternal. That's a view there. Let's move on and talk about Cochin Shipyard. That's the next query coming in on, and we have Gaurang, who's writing to us from Chennai. Holding 100 shares of Cochin Shipyard, price is 1,464 rupees, making a profit on this one. Future prospects of Cochin Shipyard as an investment proposal. Your view, Astha, Cochin Shipyard, the shipbuilding stocks, defense side, all this comes into play, right? And we have seen them buzzing in the last 1 month specifically. What is the view now?
So view is positive because the kind of order backlog these companies are having, they have got a very strong order backlog, especially if I talk about Cochin Shipyard, 5x of FY25 revenue is the kind of orders that they are having right now. So strong order visibility is there, capacity expansion is there, and they're getting good orders from the ship repair front or a ship repair point of view. So I believe that it is a good stock to remain invested in, and hence recommending a hold with a price target of 2190 to 2200.
Okay, keep an eye out over there for Cochin Shipyard, 21, the levels that Astha mentioned as well, 21,190. But on the technicals, what are the levels that we should keep an eye out on? And is the chart on the technical level still indicating a run-up?
Absolutely, I'm bullish on this Cochin Shipyard. There are other stocks as well and defense sector, but Cochin Shipyard has just started the momentum in the last couple of weeks, and I think the momentum should continue. The medium-term outlook would be positive. Short-term outlook would be positive. Medium-term targets would be around 2,400. Short-term targets are definitely 2,150, 2,200, which Astha also mentioned. Support would be around 20 daily moving average. 1720 would be my stop loss in the very short term, and buy on decline should be the strategy. Absolutely, every time it takes support at 20 daily moving average, it starts moving on the upside with good momentum and very good strength.
Okay, that's a view coming in there on Cochin Shipyard. But on that note, we're going to slip into a very short break. But as we slip into the break, we are excited to unveil a brand new global business news channel. The all-new CNBC-TV18 Prime brings you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset and Global Lens at 8:30 p.m. Welcome back to your stocks in CNBC-TV18. Let's keep it going with all your stock-related queries. And our experts for today are Asta Jain as well as Saumil Mehta, who are still with us. The next query for today coming in from A. Subramanian, who's writing to us from Chennai, holding 100 shares of Coal Patil Developers. Price is 552 rupees per share. He's asking whether he should book his losses or stay invested in the stock. Asta, he's bought it at 552. Coal Patil Developers. There's so many, announcements that come in on the development side as well. So much happening across developers, right? They're entering new areas, new geographies. Premium continues to do well. Coal Patil Developers, stock move is not that exciting. So what should they do?
I recommend to hold this counter. There is no need to book losses at this point of the time, because what we believe that this counter has a potential to move upwards in the level of at least 460 to 480. So I think it's better to remain invested in this counter. Now, why we are so much optimistic? Because what we have seen that the results were exceptionally well. And in fact, what the management is confident about is that they have seen a very strong or healthy registrations, customer engagements, and in fact, they have signed 122-acre JDA, Joint Development Agreement in Pune. So I think all these developments which are going on in the company will definitely yield a strong results to the company, despite the fact that we know, in fact, they have seen some healthy increase in their pre-sales numbers and their realization number also, because their realization has improved by 8%. So overall, what I find is that results were quite good, and this is the stock to remain invested in, although not a very strong bet in the real estate space. But yes, there is no need to book losses at least. So idea here is to hold this counter with the initial price target which we are giving is 460 to 480 levels.
Okay, keep an eye out on those levels over there for Coal Patil Developers. Hold, because the numbers were good. Commentary is also good, is what Asta is highlighting on the fundamental front. Saumil, on the technicals, what's the story that's playing out for Coal Patil Developers? Last 1 year, obviously till Jan-Feb, we saw it seeing a bit of a decline, and then that recovery has started coming in. So what should the view now do? Though they are making a loss on this one, should they continue to hold?
I think you should continue to hold till the time it holds the 200 daily exponential moving average. It's been almost the market, this stock has been below 200 daily moving average for a very long time, probably more than 6 months. And very recently, in last couple of weeks, it has moved above 200 daily moving average. And I think that's a very good sign for the stock. A high top, high bottom formation on the weekly chart as well, taking support at the averages. So overall looks great. Should not book out from here. Hold on to this stock till the time it is above 200 daily exponential moving average, which is 357. That will be my stop loss in the medium term outlook. And on the upside, I think the targets would be around 460 and 480 levels, and that's the time probably you should book it out. I like Lodha and Oberoi more than Coal Patil, so probably you can switch it that time.
Okay. You can look at that as well in terms of switching also. Saumil is liking Lodha more than Coal Patil, but keep an eye out on those levels that were mentioned there. Let's move on to the next query for today. We have this coming in from Gautam, who's writing to us from Mumbai. He's asking what is the view on Aditya Birla Sun Life AMC for the next 12 to 18 months, fundamental as well as technical levels, and wants to know if it's okay to buy at this point of time. Fundamentals first, Asta, your view?
Fundamental seems to be strong for this counter. So I think, yes, one can buy on the dips as well as remain invested in this counter for the price target of 780 to 820. Now, talking about the fundamentals, what we have started seeing, again, there is a rebound in the SIP flow. So that is acting as a major positive. And in fact, this counter has seen a market share improvement across the segments, because 85% of their funds have beaten the benchmark. So I think that has also created an attraction for this company. And I think going ahead, this will perform strongly, because in fact, capital markets have started showing some sort of positive momentum. Overall, long-term prospect seems to be okay for this counter. Remain invested in this counter, or buy on dip strategy can also be applied. However, we are giving the initial price target of 780 to 800.
Okay, keep an eye out on those levels over there for Aditya Birla Sun Life AMC. Saumil, on the technicals also, does it merit a buy?
play. In the short term, looks great. It's just, I think, broken out of a small consolidation. Very good risk reward, a very small stop loss of 721, and I think the targets would be at least 780 levels in the very short term. In the medium term outlook, the support should be around 20 daily moving average or 200 daily exponential moving average, which is around 678, and the targets would be much higher, probably around 860, 850 levels. So that would be a good level on the upside for the medium term outlook.
Okay, keep an eye out on those levels over there. Good chart on the short term as well as what the highlight is coming in from Somil. Let's move on to the next query. We have Ritu Ahuja who's writing to us from Pune. She's holding 60 shares of Delivery and this is at a price of 270 rupees per share, making a profit on this. Wants to know whether she should continue to hold or book out her profits. Astha, your view, Delivery.
Continue to hold this counter with a price target of 400 at the initial level, 400 to 420 at the initial level. Now, talking about this counter, yes, we have seen their B2C segment growth was muted, but PTL segment is looking good to us, and in fact, some market share gain is also there in that segment. So we believe, and in fact, they have done the acquisition of Ecom Express. So I think that is also now started helping the company in showing good numbers going ahead. Overall, we are positive on this counter and hence recommending good with a price target of 400 to 428.
Okay. On the charts, Somil, your story, what is it playing out there? Because last 1 year, 15% decline in terms of a stock move. Though last 1 month or so, we've seen some bit of an up move coming in. Does this indicate that we could see a bit of a breakout here?
It's a breakout definitely in the medium term outlook, but if the trade is for short term, then this is the right time to book out the profits. But if the trade is for a medium term outlook, you can definitely hold on to this stock with a stop loss of 330 levels. And on the upside, I'll be expecting at least a target of 400, 420 levels. So that would be my medium term outlook levels, and the stop loss should be very strict because we've seen a very sharp decline in the stock, and if it holds on to 200 daily exponential moving average, then this medium-term breakout could lead to very good levels on the upside.
Okay, medium term, you can continue to hold 400, 420 is what Somil has highlighted. Short term, then get out of it, book your profit out. That's the view there. But that was the last query for today. So Somil as well as Astha, thank you so much for joining in with us and helping our viewers solve all their stock-related doubts. Thank you so much, viewers, for sending us your query. Keep sending them to us. You're seeing the email ID that's flashing on your screens as well. So you do send us your queries and we'll solve them Monday, Wednesdays, Fridays on CNBC-TV18. But with that, we'll wind down this edition. Thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Most of the Asian markets are trading above the flat line and with healthy gains as well.
For the markets, support stands at 24,627, 24,850 on the Nifty. It's absolutely flat. ITC block deal has gone through and 15,000 crores, 3.8% lower, 2.5% equity changed hands.
I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%.
Copper prices are going to remain strong because of the demand.
10% on Bell Rise, 8% now, so it's a very good start.
Liquidity is better in the system, and that is good news for the sector.
The markets are subdued for the benchmark indices, not lost too much, just down about 0.2%. But the story is in the broader markets and its outperformance yet again.
Last year, because of product regulation change, most single premium policies, our agents sold maximum single premium policies. So that also affected AP to some extent.
What's not exciting is the markets right now. They have been consolidating since morning in a very narrow 100-odd point range.
All right, that's the day so far, and indeed it's been a market that's been trading in a narrow range. Not too much has happened, direction is not very clear, and we've spent the whole day pretty much flip-flopping around the flat line. I'm Surabhi Upadhyay, with me Nigel as always, and we'll have Prashant as well as Rima join in just a second. Oh, okay, black and white. I think that's the color of the afternoon, Nigel. But for the market, it's been green and red. It's just flip-flopping, lack of direction, and I must add that even global markets, after the big bumper move on Wall Street last night, US futures are flattish, European markets are flattish. So it's just wait and watch and pause ahead of the big event. And the big event today is the Nvidia numbers. The earnings come out today. So let's see, maybe then we get some more direction. Nigel?
Well, that's right, Surabhi. But, a lot of viewers will be wondering what Surabhi talking about, when she's saying that it's just wait and watch. Look at the portfolios. Many portfolios will be looking good today. Because a lot of earnings reactions, a lot of news flow, and a lot of stocks, in fact, are up 5 to around 15%. So a lot of portfolios will be feeling good, telling you that, in fact, the domestic money is pretty much at play. And for the Nifty, it seems, on the downside, that 24,600 odd mark should hold out till tomorrow at least. That's the sense you get at looking at the options data, looking at the 20-day MA as well. And the good news today is the Nifty Bank as well, it's holding its own. So that is well protecting the lower levels. But let's find out, how do you trade from here on? We have Mitesh Chakar, I think, who's with us on the show. Hi, Mitesh. Good afternoon. Good to see you win. What's your take, Mitesh? Nifty is down 50 points. The screen is telling you, though, that those dips are getting bought into. What's the likely move? Breach past the 25,200 odd mark, or do you think we're going to go ahead and breach the lower level?
Yeah. Good afternoon. My take is that we will possibly be consolidating, and that process will go on for maybe a few more days. Broadly, as long as we are not breaking 24,450, 480, so on, which is 24,500 to round it off, I think we should be pretty okay. And on the upside, 25,000, 25,050 is the level. So I think over the next few days, avoid the index, trade on stock-specific basis. I have one buy and one sell call right now. Havells is breaking down, so sell here. Keep a stop at about 1568. Look for a target of below 1500, so 1490. And Bharti Airtel is on the positive side. That's a buy. Keep a stop below levels of around 1842 here and look for targets of 1910.
Okay, all right, got that. Mitesh, just before we let you go, any specific word levels on ITC? Obviously, it's a stock in news today, and this pressure on the stock is because of that action from British American Tobacco. Just levels, what to keep in mind?
The ITC, had some kind of a breakdown, but secured from the base low. I think there is very good support around the levels of 415. We got a low 413. If you break below that, I'll be worried. But till that happens, I think the stock is not breaking down. It's just giving you some kind of a choppy consolidation. So I think traders should look at 415, 413 as the level below which shorting can be done. Otherwise, it's a market. It's a stock which will just drop around between 415 to about 430.
Okay, all right. So basically, more or less in a range. That's what ITC has been doing for the last several months as well. Got that, Mitesh. Thanks very much. We'll come back to you in a bit. But let's talk about the buzzing stocks. Like Nigel was saying, that if you look at it, beyond the headline index, there's so much action in this market. I completely take that point. Let's get some stocks on the board as well to illustrate that point. LIC right now is up almost 7%. So it seems the management commentary is something the market is really latching on to. Look at something like a Schneider Electric. Yeah, that's LIC 7%. Now look at Schneider Electric, 9% on that stock. Edelweiss Financial. Remember the story that Yash had put out earlier, that Edelweiss could be looking at selling some chunk, a bit of stake in its mutual fund business. Today the stock's very, very active, 6% up on Edelweiss. We could go on and on. Today's listing, by the way, continues to hold with decent gains. Bellrise is still up about 10%. And then, of course, you have the big earnings hits as well. There's Triveni Engineering, there's Techno Electric. These are stocks that are in double digits. So absolutely, the mid-cap and the small-cap market is thriving. It's alive and kicking. Let's address some of these stocks, and starting with Triveni Engineering. Now, the company came out with fourth quarter numbers that definitely look good. Even the management commentary seems to be indicating that there are better times ahead. Not only that, the management seems to be sounding a bit optimistic on their the defense side of their business. It's small right now, but they see potential going ahead. Ria, tell us more.
Well, Triveni Engineering has been trading higher in today's session after reporting its results yesterday. Taking a look at the revenue first, that was up over 9% on a year-on-year basis, which was driven by strong revenue growth across its sugar, alcohol and power transmission businesses as well. In terms of sugarcane crushing, the company has achieved crushing at almost the same level as the previous season, but the gross recovery was lower by around 69 basis points. All of the sugar units of the company's the operations have been switched to C-heavy molasses from B-heavy in the latter part of the season. In terms of profitability, the segment profits for the sugar business declined by around 12.8% over the previous year due to the higher cost of sugar sold during the year. Looking at the alcohol business, the profitability was adversely affected in this segment as well due to the low margin maize operations and lower sales volume of ethanol produced from molasses as well. But the power transmission business this time around has performed very well for the company. The turnover is up around 26.8% over the previous year, and the profits are also have increased by around 18.4% compared to the previous year, and even the order book has gone up by around 35% compared to FY24. So this is one segment that has performed very well for the company.
Okay, all right. Thanks a lot for that, Ria. Well, let's focus on another one, Techno Electric. That as well is buzzing away post its numbers. Vamakshi joins us to help us out with a quick analysis. Vamakshi?
Well, Nigel, very strong set coming in from Techno Electric. When we look at the revenue, that saw an uptick of as much as 86% on a year-on-year basis. The gross margins, however, have contracted by 91 basis points, given that the growth in the cost of goods sold was much higher as compared to the revenue. But the company has more than made up for it as far as the EBITDA margins are concerned, because we've seen an uptick of almost 315 basis points on a year-on-year basis. The margins now stand at 15.5%. As far as net profit is concerned, we're seeing very strong growth here, and some of this growth is also being driven by the up move that we're seeing in other income, which saw an uptick of almost 70%. As far as the annual trend of the company is concerned, the revenue for FY25 stood at 2,268 crores. When we look at it, compared to several other years in the past, it does seem like it is at a multi-year high and possibly at an all-time high for the company. The EBITDA margins too have improved for the third consecutive year, now stand at 15% for the whole year. And in fact, this is the highest level that we've seen since FY22. And as far as the cash flow of the company is concerned from operations, that has also turned positive this time around. So that again bodes well for the company. So overall, a good set of numbers, pushing the stock higher in trade today.
Absolutely, 13% and counting. Vamakshi, thank you so much for that. So let's discuss some of these active buzzing mid-caps with our guest on the show, Siddharth Khemka, Head of Research Wealth Management at Motilal Oswal Financial Services, is with us. Siddharth, great to have you on. I don't know if you look at either of these, Triveni or the other one, Techno Electric. And even if it is not these two, we have lots of other stocks today we can discuss because the mid-cap space is so buzzing.
Yeah, hi, good afternoon. Unfortunately, both the stocks are not under coverage. We can select from other list.
Okay, let me ask you about today's listing then, in case you have any thoughts. Bellrise, it's after listing, we're talking about a 9,000 crore rupee market cap. They're into various micro segments of engineering, auto components, etc. Any views here?
So again, we did not have a detailed view there, but definitely if you look at, there are two things. A, from the broader market, a lot of interest has come up, especially because of the institutional activity. There are only a few periods of time in the market where we have both FIs and DIs buying. And I think that could continue for a while. And because of that, a lot of these mid-cap ideas where the fundamentals are good, business models are good, that will see strong buying interest. And on back of that, we are seeing many IPOs lining up in the mid-cap space, and B, a lot of promoters or PE investors are looking to cash out on this momentum in the liquidity. So coming back to Bellrise, I think looks a decent business model, definitely worth looking at from a long-term perspective.
Okay, all right. Hi, Sid. Good afternoon. Good to see you, Ben. Sid, there was a blast in China, and because of that, there could be some shortage in the entire supply chain, and that sometimes gives a bit of an opportunity to some stocks. You're talking about it being positive for stocks like Dhanuka, PI Industries. Tell us more. How do you analyze this news piece, and have you got some numbers on this?
Yeah, sure. Thanks, Nigel. I think, if you look at that is definitely a short-term disruption in the global chemical supply chain. We have seen some of the Chinese chemicals companies, other than the one which had the blast, seeing a sharp rise, almost up to 20% in the exchanges there in China. What we see is that some of the chemical prices might go up in the global markets, and because of which Indian chemical companies could also benefit from this phenomena. Also, some of these companies are related to the agri segment, where we see a strong monsoon this year. So companies like a PI Industries, or you have a Dhanuka Agritech, Deepak Nitrite. So we believe that some of these companies could benefit from A, increased demand, and B, improvement in the global pricing for some of these commodities.
Okay, so that is how some of the commodity players are in focus as well. Back to the buzzing stocks this afternoon. LIC, Siddharth, I mean, what's the take? Very, very rare to see this PSU insurance giant move the way it's moving today. But what do you think of the numbers? More importantly, do you like the stock?
Yeah, I think within the overall life insurance space, our preferred ideas or the top picks would be HDFC Life followed by an SBI Life. But we also have a positive view on Life Insurance Corporation. Q1 numbers were decent enough. The important part is that the VNB margins that expanded, and that is mainly on back of the improving or increasing contribution from the non-par insurance business. What we see is that the management expects the premium growth to recover, and they are also the management. I think the street is excited about LIC getting into the health insurance and the other insurance space, which could boost up profitability. Overall, what we see is that LIC continues to have an industry-leading position and has focused on achieving recovery in its growth because of a wider products offering, higher ticket size, and a shift especially in the product mix towards non-participating insurance space. So we like it. We have a buy rating and a target price of 1,050.
Okay, all right. That's a view on the insurers. Got that point. Let's again focus on more stocks that are buzzing around, because it is that kind of an afternoon. It's mid caps and small caps galore. The next stock on our radar is Apollo Micro. We have Ria joining in with the latest developments. Now, there's a big order win that this company has reported, and that seems to be working very well. Look at that, 13 to 14% higher. Ria, tell us, what is this order and how important is it for Apollo Micro? I think it's an international order, right?
Well, yes, Apollo Microsystems is in focus yet again today. Today, the stock is up over 16% after receiving a major export order worth about rupees 113 crores. And this order is for the development of an avionics system, which is intended for both civil and military aircraft applications as well. Now, this new order makes up over 18% of the current order book of about rupees 615 crores. And remember, on Monday in the earnings call, the company had said that this order book is also expected to triple by the end of FY26, which means it will land up at approximately rupees 1800 crores by the end of this year. Even the current revenues are slated to double in this year, and the operating margins are also expected to improve in the first half of FY26, although there will be some moderation in the margins going into the second half of this fiscal and into FY27 as well. There are also some other huge orders on the anvil for the company. They're expecting some orders related to QRSAM from Bharat Dynamics within the next 2 quarters itself, and they're also expecting some orders for subsystems for Project Kusha as well. So all in all, positive updates for Apollo Micro, and the stock is up 16% today on the back of this.
All right, Sid, any view on this one, Apollo Microsystems?
Nigel, unfortunately, we don't cover this stock as well.
All right, a few other names. DCX Systems, do you all track?
Again, we don't cover DCX.
Okay, all right. Siddharth, I don't know whether you have a view on Force Motors, but you know the stock, when there was a big correction, the stock pulled back 25% very, very quickly. And on Midcap Microscope, in fact, we had highlighted that it seems the street is coming to terms with their Urbania product that's got a good amount of acceptance. There's a defense vertical as well that could possibly scale up out there. And valuations have become more palatable. We covered it at around 9,000 rupees and explained the stock here on CNBC-TV18. Today, the stock has made a fresh all-time high. Any view on this name, or from the space itself, what do you like?
Yeah, Nigel, I think if you look at the overall auto space, a lot of companies are getting into the defense opportunities, and even the latest news flows suggest that government is trying to open up a lot more opportunities for the private defense players apart from the public sector. So that is definitely a good growth opportunity. Coming to Force Motors, I think the new product has been well received by the market, and not only for the urban transportation and the lot of ambulances and other utilities for these products have definitely picked up the prospects for Force Motors. Unfortunately, we don't have coverage in the space. What we like, we believe that in the current environment, tractors is something that will far outperform in the entire auto segment, and our top pick or the preferred pick is M&M. It is even, despite being a market leader, the tractor segment growth for M&M is far outpacing the industry tractors growth. That apart, in the passenger vehicle segment also, their leadership growth in terms of SUVs as well as the recent launches in the EV segment, that keeps us excited that this is the story which would continue to do well. We have a buy rating on M&M and a target price of around 3,500.
3,500 being the target price on Mahindra. Got that. Yeah, it's been a fantastic wealth creator, no doubt about that. On defense itself, Siddharth, before we let you go, given that things have run up so much, I mean, it's a pretty red-hot market, right? So you have to buy now with a fair amount of discretion and caution. What would you still say would be your topics? For instance, look at Bharat Dynamics today. We all know, great company participating in all the critical missile programs. But then the issue is P&L has to match up, and that has to justify the valuation. So does Bharat Dynamics make the cut? Would it be BEL, something else? What are your top picks?
Yeah, Sulvi, I think that's the dilemma, especially for a sector which has seen a sharp rally in a short span of time. What we believe is that the long-term structural story in defense continues to be very strong, and the earnings growth, if you look at for a company like Bharat Electricals, we are forecasting about 18-20% earnings growth. For Hindustan Aeronautics, I think it is about 15 to 18%. While in terms of valuations, there is a little bit of more headroom, I think, but the upside is limited. For Bharat Electronics, we have a target price of 410, while for HAL, we have a target price of 5,650. One should approach a gradual, you can say, accumulation strategy for defense and keep accumulating these stocks on a staggered way, and buy and hold them for the next few years. That should make good money for retail investors.
Okay. And last but not the least, let's talk about ITC. I was just getting a technical check done with our technical expert a while back, but fundamentally, the stock's again got into a range. And ITC does that, right? It can be in a trading range for a long time, and then suddenly it bursts up. What's your view?
I think ITC is the classical value stock which keeps surprising us when the entire street becomes negative. I think the block deal is done with. The recent earnings were pretty good in terms of the core cigarette business, where we saw strong growth in volumes as well as margins. The staples is something that we have seen weak numbers across the FMCG space, but we continue to like ITC. We believe that the core business that continues to provide strong support, and especially if the mid-single digit volume growth in cigarette that continues, margins in FMCG is likely to improve in FY26, and that could trigger a valuation re-rating. The dividend yield is also strong, so we maintain a positive view on ITC with a buy rating and a target price of 525.
525 on ITC. Okay, got that. Thanks very much, Siddharth. Good to have you on today. Quick fire hits and misses of the result season. Thank you for taking up the questions. We'll take a break on that note, come back on the other side. Rahul Singh, CIO Equities at Tata Asset Management, will join in with some perspective.
Welcome back. Well, the markets are trading with a mild cut of close to 40 points, but the point we've been making is plenty of stocks actually from the broader markets. They're doing a thing of their own, and a lot of stocks, in fact, have moved to the high point of the day as we speak. Case in point being a Bank of India. Just pull up that stock. It's up only around 2%, but majority of that move has come in the last few minutes. So I think we should get an intraday chart of that particular name as well. Rahul Singh, CIO at Equities at Tata Asset Management, joins us on the show. Hi, Rahul. Good afternoon. Good to see you win. Well, what are you making of our current market setup? You're at around 21,700. Things were eye-poppingly much more attractive, and that's why we did see that a lot of interest came back in, and the markets have bounced close to around 15%. But earnings have still been rather subdued, maybe on expected lines, expected to pick up from year on, though flows have been quite good. Both domestic flows and the FIs are making their way back. How are you feeling about the Indian markets as of now?
Yes, I think the markets or the valuations are at an interesting point, because from here on, the earnings outlook for next year becomes important. Obviously, the global liquidity environment has turned positive for emerging markets, including India. So that's a good news, and that kind of puts some kind of a floor to valuations in my mind. But whether we give what kind of returns we can give from here is going to be totally dependent on the earnings outlook for the next financial year, because we've not had a great performance from earnings in fiscal 25. But the good news is that all the things which were going wrong in fiscal 25 in terms of liquidity, in terms of the government spending, I think are normalizing very, very fast this year. So I remain more optimistic about this year's earnings growth rate for Nifty, more in maybe around the low teens number, is looking like a possibility, which is compared to last year's weaker base. I think consumption is also being pushed a lot through both monetary and fiscal policy. So there are building blocks for earnings to look better, not supremely better than last year, but significantly, materially, I would say, different from how last year panned out. So to that extent, I think markets are looking reasonably stable with not with not too much of downside risk at this point of time, in my view.
All right, that's good to know, Rahul. Great to have you on the show this afternoon. Thanks for joining in. So there's not much downside risk. Then let me flip that question then. Then what's the best upside play? I mean, having gone through the earnings season, looking at the second half of the year perhaps, where do you see the maximum prospects for growth? Which segments or sectors?
Well, definitely, I think large caps are looking much better from a risk-reward point of view. I think that's where the downside risk is the minimum. It's probably much higher in mid caps, the downside risk from a valuation point of view. So I would like to make that distinction very, very clearly when I said that about the downside risk. And also from a segmental point of view, from a sectoral point of view, I think we have been saying about BFSI, but things are finally playing out. And if you look at the performance of banking as well as the insurance sectors, they've been one of the more solid performers in this volatility of the last 3 to 4 months. I think there's been more steady performance from BFSI, and I think it's just the beginning. We're probably going to see next 1 or 2 years of this whole performance percolating down to different categories of BFSI as we speak. Also, I think selectively, given the push both on the fiscal and the monetary side, consumption is something where we need to watch out for in terms of early signs of revival. And I'm talking of the whole spectrum of consumption, not just FMCG. So these are the two kind of buckets I would focus on.
Okay, all right. What about some domestic-facing themes, Rahul? Something that will be reasonably protected from what's going on in the globe. Case in point being cement or maybe real estate. From the domestic-facing themes, what do you like?
Yes, those are two sectors which definitely come to mind, clearly from a domestic point of view, or even though banks are also mostly domestic plays. So to that extent, it kind of qualifies for domestic play also. But cement, yes, I think it's been a sector which is promised so far and not delivered on earnings. So to some extent, I think if the pricing discipline comes back and the prices are under control, the input prices are under control thanks to lower commodity prices, this could be the year when earnings finally start to deliver for cement. As far as real estate is concerned, I think we are well and truly into the mid to late cycle of the growth. So from here on, I think we are very, very selective on real estate, even though the demand momentum continues for real estate across the various markets. The valuations and the risk profile of each real estate company is now very different compared to at the beginning of the cycle. At the beginning of the cycle, everyone benefits, but at the mid to late end of the cycle, you need to become more cautious given the profile or given the mix of the geographies and given what's happened in each of those micro markets or geographies.
Rahul, on the financial space, what part of it do you specifically like more? I mean, is it large banks, private PSU? Is it non-banking lenders? Or, I mean, then there's the other related parts as well, right? There's wealth management, capital marketplace, brokers, etc. So it's a very vast spectrum. What is your order of preference here?
Yes, you're right. There is a vast spectrum, and that's the good news because the whole valuation and the growth outlook kind of changing has to percolate down to the last possible segment of the lenders at least. And that's where I think the opportunities and the excitement is. And obviously, large private sector banks are now a consensus view, so I'm not going to repeat that. But I think there is also opportunity in the NBFCs because they will start benefiting from the lower rates sometime in the second half. There is also, I think, from an NPL perspective, there has been a lot of tightening of controls by the regulator, which is resulting in, I would say, not very volatile NPL as we used to see earlier. So that's also something which is positive for NBFCs. And the other segment, which is time corrected for a significant amount of time, is the housing finance companies, the small and mid-sized housing finance companies. So these are some of the segments which we are focused on.
Okay, all right, Rahul, the renewable sector theme that was in flavor, just not too long ago, 18 months or so ago. But that seems to have been put on the back burner. So some of these companies are guiding still for very, very good times ahead. Is that a sector you're interested in, or do you think the good times have passed? There's too much of uncertainty. You'd rather stay away?
So renewables went through a euphoric period, you're right, and I think the valuations crossed certain limits. So, it's a cycle. I think the build cycle for renewables is probably going to peak out in the next 2 to 3 years. So you have good earnings momentum, but you don't have sustainability of those earnings for some of those equipment suppliers. So one will have to be extremely careful about when these companies peak out in terms of valuations, if they have not already. Because ultimately, some of the barriers to entry which were there earlier may or may not sustain. So to have lofty valuations with these kind of business models is a challenge. As far as the utilities are concerned, on the renewable side, there are a few pure plays, but what we like in the power space is the utilities, whether it's the fossil fuel or the renewable energy. I think that is where the valuations are reasonable after correction. And I would, we are more focused on that segment as compared to the equipment manufacturers in the renewable space.
Rahul, hi. Afternoon. This is Rima here. On IT, where do you stand? Numbers have been disappointing. FY26 is going to be a challenging year. But on the other hand, there is that argument that these are dividend-paying companies. And now, with the correction, the dividend yield is fairly attractive. So yes, it's going to be a low growth year for the companies, but the downside may be protected. Considering the volatility, would you look at IT stocks?
Yes, I think you summarized it very well, that it's become a range-bound sector. I don't see a lift in revenue profile for the sector as a whole from mid-single digits to 15%. Unless that happens, it's very difficult to go overweight on this sector. Today, the downside risk and the upside risks are kind of balanced because, as you mentioned, on the downside, at 10-15% lower levels, the dividend and the free cash flow yield starts to provide a flow to the valuations. But on the upside, we need to see reasons, or we need to see the logic for growth to revive for the sector as a whole to mid-teens for us to start looking at a valuation re-rating. Otherwise, it's going to be a little bit of a range-bound sector for now.
Okay, all right, got that point. Thanks very much, Rahul, for joining us today. Good to get that perspective from you on the market and all the themes and sectors that we've discussed. Thanks for joining in. Need to take a quick break, come back on the other side. As always, a check on all the dealing room chatter coming out with Nimesh, and then we'll get some final trading ideas with Mitesh as well.
investing.
Welcome back. You're tuned into Closing Bell, and we are coming to you live from the Motilal Oswal studio. Well, it's around 3 p.m. and that's the time when Nimesh joins us to tell us what is he picking up in terms of the flows and how are the markets moving. Nimesh, tell us, well, what's the feedback you've received?
Well, Nigel, today is an extremely quiet day. In a very, very narrow range since morning. The Nifty has been pretty much flat, so to speak. The Nifty is down just 0.2%. But, even the broader market index may look very flat, but there are a lot of individual names which are buzzing in trade in the broader markets, largely reacting to either news or to earnings or to some, flows. So that's pretty much, sums up that there is a lot of action in the broader market names. From a flow perspective, again, it's a muted day. As I've been saying, in the expiry week, don't count too much into the flows. And again, today you'll see a large number because of the ITC block, right? So X of that, we might not see a big number today. So that's overall feedback. But within that, I guess it's the PSUs which continues to witness buying interest. Today, it's a case for PSU banks to see a bit of traction now. Again, defense PSUs continue to outperform. So the PSU as a basket is doing good, but otherwise it's been a very, very quiet day with some very selective broader market stocks outperforming.
Okay, all right, Nimesh, what about individual stocks? What are you picking up?
I'll start with block deals. So the first name on my list is Tata Tech. Again, the stock is marginally under pressure today. The volumes are pretty much muted, but there is a very strong indication of a large block deal coming in Tata Tech very soon. The private equity is a large holder there, and that could be a potential seller. So that's the buzz there. The second stock is Protein Egg. That's been buzzing in trade. The volumes are also picked up today. And I understand, in general, there is a bit of interest back from larger HNIs in Protein Egg. So that's second stock. The third stock is HDFC Life. I've been saying for the last few days that there is a bit of traction back in the insurance names, and those are well bid. Today stands out for HDFC Life. There was block bids at lower levels, but it looks like that's been bought, and since then, we've seen a bit of recovery in that name as well. And last couple of stocks where there is selling today, surprisingly, Hoodco and ONGC may not see that big reaction on the stock price, but there is delivery-based selling happening in both these names from larger FIs. So expect high delivery volumes, but on the sell side in Hoodco and ONGC today.
Interesting list as always, Nimesh. And then in the evening, we come to know D Street confirmation, right?
Absolutely.
D Street chatter confirmation. But you've had a fabulous, fabulous streak. Always look forward to this segment. Mitesh Thakkar is now back with us for a few BTST calls now. Mitesh, things are very, very quiet. We have to look at individual stocks for action now. What would you advise for trade?
Yeah. Well, see, I think, as I said, the market will be subdued and within a range. So I think it has to be stock-specific kind of basis on which you can trade. Right now, I have a BTST on Hindustan Copper with the stop at about 246 half for targets of 252. The stock has done well, but is giving a pullback from the day's high. So I think it could be a good trade on the upside. And the other one is BTST on IGL. I would actually want to see the stock get past 204. So buy about 204 with the stop at 211 and targets of 220 can be looked at.
Okay, all right, Mitesh, thanks very much for all the trading advice today. You have a good rest of the afternoon and evening. We'll connect again tomorrow. For the time being, let's move to the big exclusive. Earlier, we caught up with former RBI Governor Raghuram Rajan on a whole host of issues, including Trump tariffs and the state of the global economy. Listen in to some of the highlights. Here's him talking about the India opportunity when it comes to global supply chains.
Well, it could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them. And if India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment. Of course, industrial countries don't want to see supply chains moving from China to India and not coming back into the domestic market. But if India plays its cards well and doesn't make it front and center all about subsidies, that it is about a better production environment and it offers a very viable alternative. And some of the states in India are very interested in doing this. I think if we can do that, it could be India's moment. But a lot more action is needed. And it has to be proactive, not just reactive. It is about creating a better environment in India for foreign direct investment, something we haven't paid enough attention to in the last few years. I mean, it would be the rare CEO who wants to cross the Trump administration at this point. But it is a negotiation ploy, not so much ploy, but there is room for negotiation. Apple can point to all the work it's doing in the US and the profits it's generating in the US as a result of its creation of new designs, new intellectual property, etc., and say that the manufacturing is essential in a cheaper place so as to get Trump products out at a reasonable price to US consumers, but also to consumers in the rest of the world. That kind of reasonable argument has to be made. But also, it does indicate the importance of not trumpeting the fact that you're coming away from China and putting it in India. There is a lot of value to flying under the radar screen at this point and doing what you need to, but also having a frank discussion with the administration on what can be brought back and what can't. Screwdriver technology, assembly, stuff like that is going to be hard to bring back to the US. But certainly, Apple can say that there's a lot more R&D going on as a result of its ability to sell its products across the world. And that R&D happens in Cupertino, not elsewhere in the world.
Okay, interesting conversation there. Prashant is also now joining in, and you've been having a slew of conversations, including on how much Europe is spending on defense and what it means for us.
By the way, it was 3:10, right? So
good. So late now.
Yeah, maybe we can get Nigel as well on the window.
Late appearance.
Late appearance, but now
it's a house full.
Now it's
house full.
Rima, Hindi and all.
A sitting sandwich between both of you all now I've picked up.
Okay, so yeah, I mean, this Europe rearmament is a big talking point, and so many companies that we have spoken to, and just yesterday, I think, which was the company in the morning, Jyoti CNC, out of the blue, I mean, they spoke about how Europe and European defense is a big opportunity. They've got a plant in France, is what they told us, and that they're not even a defense company, and so many other defense companies have also said that it's a source of demand in that sense. Europe and what Europe will spend as far as defense is concerned. So this was a conversation that I had with Benjamin Heelan. He's the European defense analyst at Bank of America. And the crux of that conversation is this. Europe last year spent 450 billion euros on defense in 2024. Trump is nudging them to push higher. And according to Mr. Heelan of Bank of America, he says that if Trump has his way, that $450 billion can go up to 850 to 900 billion euros in the next 2 to 3 years. And that is only just like 1 percentage point extra of the European GDP. And a lot of it will be spent on fresh procurement, not just in things like pensions and paying salaries, etc., actual capex, which is what companies are concerned about. So I just want to play this soundbite out, the conversation that we had with Benjamin Heelan of Bank of America in terms of the opportunity and the spending increase which is projected. Listen in. Benjamin, if you have any estimates at your end, what was spent, say, on defense? How much did the EU spend on defense? What could that number go up by over the coming years? I mean, if you have some broad numbers.
Yeah, so Europe was spending roughly 1.5% of GDP in 2021, and at the end of last year, 2024, it was, like you mentioned in your introductory remarks, it was roughly 2%, just slightly below 2%. That's about 450 billion euro, of which roughly 20% was spent on actual kit procurement, right? Now, if you're going to go to 3%, that would be roughly 750 billion euro. If you're going to go to 3.5%, you're talking 850 to 900 billion euro, depending on how aggressive you want to be in terms of what Europe's growth rate is going to be. But that's the sort of step up that you are going to see. I think what's also important here is that the amount that is going to be spent on procurement is also going up. So when you think about Germany as an example, right? So Germany spent roughly 60 billion euros on defense in 2021. It had procurement spending of roughly 8 to 9 billion euro, so roughly 15-ish% of the overall defense budget. If you believe in 2030, 2032, Germany is going to be spending 3% of GDP. That would be roughly 130 billion euro on defense. But it would be, if they spend roughly 30% on procurement, you're talking about 60 billion euro. So you can see why the stocks in Europe, the industry in Europe has done what it has done, because not only do you have growth in the defense budget, 450 billion as a block going to 800 billion, 850, potentially even 900. But you also get this real compounded effect in terms of the amount that is going to be spent on procurement is going up as a proportion as well. And so that's why you're seeing the growth rates that we're seeing across the sector. We put out a piece last week looking at benchmarking all of the European defense names. 2019 to 2021, they grew, mid-single digit, 4-5%. They will be growing low to mid-teens in the next 4 years. And I think what you will also see is that 2027 through to 2030, there will be another acceleration in growth, because the orders that are coming today will only start to hit the P&Ls in 2027 and 2028.
Okay, so that's a view from Bank of America Securities, talking about the defense opportunity, specifically with an eye on Europe. All right, back to our markets here, and the cut on the Nifty is around 70-odd points. The Midcap index is slightly better off. It's flat. Bank Nifty also ditto. A little bit of a splash of green on the Bank Nifty as well. We have Mayuresh Joshi of William O'Neill join in. Mayuresh, the market at the index level is getting extremely narrow. Now, it's all about individual stocks, right? And individual stocks have been moving 10, 15, 20% in a span of a week. So give us some new ideas. What's fresh on your, on your radar?
Afternoon, Surabhi. So again, I think we are focusing primarily in terms of where earnings stability and earnings growth might continue happening at a decent pace. And therefore, I think selectively within BFSI, over the past few weeks, we've obviously added leadership stocks like ICICI Bank onto our domestic as well as our global portfolios. But I think within the broader markets itself, I think 3 or 4 ideas. One, I think healthcare as a space, and within healthcare, hospitals as a space, is still showing signs of relative strength, and the expectations largely getting baked in, is that the earnings momentum that has continued into Q4 might very well continue into the next few quarters. And therefore, I think stocks like the Krishna Institute of Medical Sciences, where numbers have been decent so far, or even an Apollo Hospital out of the leadership names, where our own expectations is the kind of bed additions that can happen over the next few quarters in an asset-light mode will probably not add much leverage to the balance sheet. And at the same time, with operating leverage kicking in, as more hospitals mature, the average revenue per operating bed, the key number in terms of the average length of stay, and key areas that they're probably operating out of should actually start playing out quite positively. Again, within pharma, our own sense is that Strides Pharma in the broader markets has reported a decent set of numbers. The guidance that they've probably given is very encouraging. US sales itself expected to be around 400 million odd. They reported 293 million for the year gone by. And therefore, I think the massive growth that can come through with 10 or 12 ANDAs expected to get launched, the nasal spray, which is expected to get launched with the US FDA as well, can be huge enablers for the US business. The other regulated markets also expected to do reasonably well. The ratings, rankings, the earnings profile as we see it for both these spaces continue to be growing in a very robust fashion. The third space that we're probably looking at, which we have looked into and selectively adding more names, has been the agrochemical stroke fertilizer space. And within this, again, I think names like Coromandel is something we continue holding on to our portfolios. But Deepak Fertilizer is one new name which we're probably looking at. Obviously, I think the leadership position that Deepak has in technical ammonium nitrate, in diluted and concentrated nitric acid, where it holds leadership position in South Asia, Southeast Asia, and the capacities that they're probably adding both in TAN as well as the nitric acid capacity with backward integration. I think the numbers over the next few quarters can be relatively stable and strong as well. I think that is where I think we're looking out for areas where earnings momentum and earnings trajectory can remain strong. So I think a few sectors and a few ideations within those is what we are like.
In the agrochemical space, have you looked at this company called Bayer Crop Science? I think it's a German MNC company. Came out with numbers yesterday. The stock skyrocketed about 12%. It's predominantly owned by the promoters. About 72% is held by the promoters. But they do have some FI and DIA holding. Any thoughts on Bayer if you've looked at it?
Absolutely. So again, I think same space as I just said. I think good set of numbers. In fact, very good set of numbers by Bayer. And again, I think the logic and the rationale remains the same. The expectation with better monsoons, which have already started across the length and breadth of our country, I think is expected to be very, very positive as the monsoon season progresses. And therefore, I think the Tariff season should be extremely well laid out. The farm gate prices, as we have been doing our channel checks, suggest are firming up as we speak. And at the same time, input costs have remained relatively benign. So the expectation in terms of input costs remaining benign might very well continue, including the likes of phosphoric acid, ammonia, potash to a large extent. And therefore, I think the basket of raw materials being relatively lower might mean EBITDA margin expansions happen onto the balance sheet. Obviously, we've been also hearing in terms of how government incentives can probably play out in terms of the subsidy payouts. And because of the DBT transfers that are probably happening over the last few years, the working capital cycle has probably got reduced for most balance sheets within this space itself. Return ratios remain strong, balance sheet remains extremely strong. And the kicker outside the monsoon is obviously going to be the next Rabi season, which might be equally good. So I think we're probably looking at a base case scenario where the next few quarters, volume-led price growth might actually play out on numbers. And therefore, I think what numbers Bayer has probably put out might actually continue. And as a space, I think we're generally optimistic looking at the ratings, rankings, and institutional holding that presents.
Okay, all right. What we're going to do is take a quick commercial break here. Mayuresh, stay with us. There's 10 minutes to go for market closing. We had the management of Hindustan Copper with us earlier. It's a rare appearance. So just want to quickly play out some sound bites. By the way, news at the bottom of the screen. SEBI has approved Hero FinCorp's 3,670 crore IPO. It's something which our colleague Ritu reported in the morning, and the approval has now come through. But let's take that break. More on this on the other side, leaving you with some sound bites from the Hindustan Copper management.
We will definitely be going plus 4 million tons in 25-26 as far as ore is concerned. And as far as MIC is concerned, definitely it will be plus 30,000 metric tons. The production of one of my mine, there are 3 locations and 3 mining sites. Total production was roughly 3.5 million tons this year, which will scale up to 4 plus. So there will be a growth of 15% from the ore point of view. And from the MIC point of view, that is metal in copper, it will be from 25,000 to 30,000. So there also you will see a growth of more than 15%. Capex plan are quite huge. This year we will be at least 350 crores, I should say. And it will go on increasing every year, I should say. In Raka, we are not going to put more money into that because it is in the MDO mode. The whole money will be brought by the MDO itself. But in other mines, I just mentioned we are going to put up a new concentrator plant. We are going to deepen our mines. So these development activities will need at least 350 crores of rupees this year.
Welcome back. Well, a few minutes to go before we wind up trade, and a few stocks actually that are calling for attention in today's session. And one such stock is Welspun Corp, one of those numbers that will be out post-market hours. The stock has been steady, but it's not moved in either direction actually. Dips have got bought into its consolidated around this 800 rupee odd mark. Mayuresh, y'all were quite positive, I think, on the pipe space. Now, this one has the tailwind because of the orders they get from the United States. And FY26 in all probability should be better than FY25 because there were no orders from the United States. Any view on this name?
Nigel, I think as a clear compliance disclaimer, we continue holding these stocks in our domestic and global portfolios. And you're absolutely right. I think the expectations in terms of more orders coming their way from the US market as far as more capex is expected out of the Permian Basin is something to be watched out for. And it can be a key player because of the subsidy that it runs out from the US as well. At the same time, if you probably look at the Middle East, the expectations in terms of orders from Saudi Aramco, specifically in the Saudi market, can be substantial ones as well. And the existing order book that they're probably having might cater to the execution there over the next few quarters as well. When it comes to the domestic market itself, the expectations in terms of both pipelines being laid, both for the CGD network as well as for waste and water management network, the expectation largely is that another 12 to 14,000 kilometers of pipes will need to get added over the next few quarters and years. And therefore, I think Wellcorp, having leadership in this parts of the market, might actually do well. From a balance sheet construct, again, I think reasonably placed as we speak. And therefore, I think the opportunities that present itself, both domestically and globally, make us believe that earnings should come out very, very reasonably for this counter over the next few quarters. So yeah, I think we continue holding this stock, as I said, and probably remain optimistic. Let's see how numbers probably play out.
Apollo Micro, Mayuresh, have you had a look at it? In 2 days, the stock has surged close to about 25-26%. This is a company which grew, I think, 51% last year. And the company is talking about a revenue CAGR of 45 to 50% over the next 2 years. That's some solid growth. And plus, they won that big export order today. Analyze this company?
Sorry, Rima, it's out of our coverage area. So
out of your coverage. Okay. What about Schneider Electric? Big move today.
No, so decent set of numbers. And again, I think it's an absolute proxy in terms of expectations of the infra/stroke manufacturing story for India. And therefore, I think as numbers are playing out and as numbers are expected to be, our own sense is that it shall be a top-down outperformance that can probably come through. Now, the only risk for this company as we see it is, I think input cost inflation starts going higher. And that probably takes a little bit of a toll in terms of how the operating performance will be, specifically in terms of absolute EBITDA and the margin numbers as well. And second, I think execution. I think if they're not able to execute in terms of market expectations, in terms of revenue growth, in terms of margin performance, somewhere I think the outperformance that the stock has probably delivered because of lesser execution capabilities, if that probably comes through, I think that just might play out on the price. Apart from these two, our own sense is that as a base case scenario, I think there are sufficient tailwinds in terms of what opportunities the industry has to probably offer. And they've probably got the expertise to probably deliver. So again, I think rating rankings look absolutely spectacular as we see it. And therefore, anybody holding can hold on. These are the only two risk factors which we will be continuously monitoring for this stock under consideration.
Okay. All right, Mayuresh, thanks very much for all that analysis. Just give us a minute, we'll recap the day. And it's been a quiet day. Actually, in sync with many of the other markets, especially the Western markets. We are ending the day down about 0.3% on the Nifty, which is in sync with how Europe is trading. Most of the markets there are down 0.25%. US futures are also down about 0.2, 0.3%. Slightly cautious approach to trade today. That's what the setup seems to be for Wall Street. Anyway, for our market, let's talk about the large cap losers first. ITC obviously a stock in news, 3% lower on that BAT block trade happening. Apollo Hospitals, IndusInd Bank, Ultratech Cement. These are some of the other names on the downside. Nestle, Tata Consumer. These are also names on the lower side. M&M and Eicher from the auto space, along with Bajaj Auto, seeing some profit taking. Bajaj Auto lower by about 1% ahead of its numbers tomorrow. So this is where the weakness was. On the flip side, HDFC Life up 1.6%, but it pales in comparison to LIC. Look at the gains on LIC today, 7% up on that big stock move have been coming through. Talk about the other movers, Bajaj Finance, BEL, Hero MotoCorp were the other few gainers on the Nifty, and then it kind of trickles down. Otherwise, it's been either flat to slightly negative. But the mid-cap market was soaring. Lots and lots of big movers and shakers over there. I've named LIC. There are other names like Schneider we were just discussing, and a whole host of others, including Techno Electric and many other names. So overall, the mid-cap market was buzzing around. MRPL, Concord Biotech, Astra Micro, Triveni Engineering 6%, and of course today's listing as well, 7% up on Bellrise Industries.
Just a bit disappointing the way the mid-cap index came off from the highs as the day progressed. The mid-cap index ended about 350 points from the day's high. In the morning, the mid-cap index was outperforming the benchmark indices, but finally it closed in the red with a cut of close to about 0.1%. So it's a fairly decent come-off in the second half of the trading session. Some of the other big movers include insurance companies, LIC, HDFC Life, LIC up nearly about 8%, and even brokerage names, whether it's JM Financial or Edelweiss, had a very good session. JM Financial and Edelweiss both ending with a gain of nearly about 5%.
No, absolutely. And actually, it's a broader market story today. Look at advanced decline, at least on my screen on the NSE, 1400 up, 1359 down. So just is that close? But, you know, if you give it a second look and look at volume, you add volume to the price action, and then it becomes very clear which side, momentum was, and it was clearly on the side of what was up. So that kind of a day. Directionless largely, and no real big signals to take away from the way we've left off things. About a third of a percent down, 24,752. Not at supports and not at resistance, somewhere in between. We'll take a break. Thanks very much for staying with us on Closing Bell. Markets Forward. We'll pick up on the action in just a bit from now. Stay with us.
The Lal Street ends lower in a range-bound session. Nifty and Sensex fall 0.25%. Midcaps do mildly better. It's the banks that outperform. That index ends in the green.
British American Tobacco has trimmed its holding in ITC to under quarter with sales via block deals worth over 12,000 crore rupees. The sale will help BAT deleverage as part of its transformation plan.
LIC reports a good fourth quarter, expects double-digit growth in FY26 with improved margins. The chairman tells CNBC-TV18 that on OFS may be in the works to improve liquidity in the stock. The stock sees highest volumes since listing. You're watching us here on a fresh new edition of Markets Forward. This is your go-to show where we aim to get you all the key points to gear up for the next trading day while we wrap up today's trading day as well. I'm Mangla Malu, with me as always, Vinny Motiwala. Vinny, what a day it's been. You know, the frontline indices have been behaving in that range, though we saw a mild bit of a sell-off. Nothing really to worry. The broader markets did a lot better, with the advanced decline actually marginally outperforming.
But from the day's highest point, right, the broader markets, at least the mid-cap, that's what it closed below.
It was just slightly below the red line, but nothing really to, again, once worry, because we saw nearly 1,313 stocks in the green for about 1,300 stocks in the red. And over the last few trading sessions, we've seen the broader markets actually outperform the frontline index, and that tells you that the lower end in the frontline index is supported. We saw that for the Nifty Bank as well. 55,400 is where it is. The range over the last few trading sessions at the lower end has been 55,000. At the upper end has been 56,000. Even the Nifty, the range earlier has been 24,650 at the lower end and 25,050 at the upper end. So it's been meandering between the range where the street was expecting. Tomorrow is obviously the May series expiry.
Absolutely, and that's expecting some bit of a volatility, I believe, as well, right? But interestingly, today also what we're seeing is Bank that managed to outperform the benchmark indices. Nifty Bank managed to hold on to and close with gains of 0.1%. We also, will watch out for PSU banks. They did better in terms of a performance that came in, so that's interesting to watch out for over there. What didn't do well was the auto. So keep an eye out on Nifty Auto as well as Nifty FMCG, which were the top tracks coming in today's trading session. But yes, that's how the market setup is looking like today. It was more of a day coming in from the broader end of the markets today. So will be interesting to see how it shapes up in tomorrow's trading session. But we have a very exciting lineup for you all in the next 20 minutes of the show. We'll start with the top movers and shakers of the day with Hormaz, and then move on to the stocks on our radar, which include ITC, which slipped after British American Tobacco offloaded 2.5% stake in the company. Meanwhile, LIC reported its Q4 numbers. We'll bring you other top stories in just a bit. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But on that note, let's get started with our first segment for the day. And Hormaz is joining you with us now from the big wall and to tell us which are the top stock movers of the day. Hormaz.
Oh, well, some interesting earnings reactions that came in today's trading session. Of course, can't not talk about LIC, the stock of the day in today's session, 8% higher on the stock, and also the highest ever traded volumes on the stock since its listing back in 2022. So good going for LIC, closing just below its IPO price of 949. Techno Electric too, the top gainer on the Nifty 500 all through the day, 15% higher on that stock. ITI, Triveni Engineering and DCX Systems also earnings reactions, but of course DCX Systems ending lower, one of those that bucked the trend in today's trading session. Now ITI's earnings had a cascading effect on a lot of these other smaller PSUs, IFCI and MFTC being a case in point. Both of them saw double-digit gains in today's session. There was a sharp spike towards the close of trade in MRPL, a similar spike in Chennai Petro as well, and some railway names like RITES and Railtel also saw gains of around 4% in today's session. Newsmakers, of course, you mentioned ITC with regards to the block deal, also ex-dividend in today's session. Schneider Electric building on to yesterday's gains after earnings, another 12% surge today. Apollo Micro winning an export order and ending 14% higher. Gujarat Fluoro recovering from the lows of the day, still ending 4% lower. But Shree Cement, after that tax demand notice, ending 3.5% lower in today's session. A lot of stocks ended at a 52-week high today from the broader markets, and Deepak Fertilizers was one of them, 7% higher on on the stocks. GSK Pharma too gaining a similar quantum. Hitachi Energy, Bharti Hexacom and Eris Life too ending at a 52-week high today. And lastly, some stocks that did well on the volumes front, and Concord Biotech was one of them, 6% higher on that stock as well. Jubilant, Alok Industries, Welspun Corp and Sobha, all of them saw gains of anywhere between 4 to 8% on very strong volumes. Back to you guys.
Bunch of stocks on our radar, Hormaz. Thank you so much for that. Let's welcome our guests as well. We have Mayuresh Joshi, Research Director at MarketSmith India, and we also have Shrikant Chauhan of Kotak Securities joining in. Thanks a lot, gentlemen, for joining in. Good afternoon. Your thoughts, Shrikant, on the market first. We are consolidating. Where do we go from here?
Good afternoon, Mangalam and Vinny. I think the Nifty is it's consolidating. It is not crossing its previous high of 24,950, 25,000. At the same time, it is finding difficulties to sustain above the important support levels of 24,750. So while looking at the entire setup of the market, I am of the view that tomorrow as the expiry day, we may see some volatility at the beginning, but later I'm expecting market to enter into trending mode. So in case tomorrow, because of any reason, we see the market falling to the levels of 24,600 or 500, where the market is having excellent support, there we should look for taking contra bets in the market. I'm not expecting market to cross this level so easily, but at important support levels, certainly we should look for taking some contra bets in the market.
All right, and what would those contra bets be?
Yeah, I think at these levels, we need to focus again on PSU banks, because there we are seeing consistent buying interest in the market. Stocks like Canara Bank, PNB, they are doing really well. But as I'm expecting market to again rebound from the lower levels, we should look for even taking contra bets on State Bank of India to buy even at current levels. I'm expecting this stock to move towards 820, 815 sort of levels. Bajaj Finance also looks good. And from the auto space, we like Tata Motors.
Okay, surely we'll keep an eye out on those names over there. But Mayuresh, your thoughts just coming in on the markets. We're seeing a bit of an underperformance coming in from the FMCG side. Obviously, we'll talk about ITC in a bit about in terms of the details there. But other than that, FMCG, when do you think, you would start looking at these other names? I think you're on mute.
Right.
Yeah.
No, so two things. One, I think the entire expectation in terms of consumption coming back very, very strongly for a whole host of reasons, including the tax cuts that have come through in the budget, where urban consumption was lagging, is expected to come back strongly. And with better monsoons, rural consumption expected to come back strongly as well. I think the base case scenario being made out is that the second half, earnings should show a significant amount of reprieve, specifically for the FMCG sector, which has clearly been lagging because of all these factors put together. And that has played out in terms of tepid volumes, that has played out in terms of pricing, and that has played out in terms of input costs being relatively higher and margins not being able to pass on. Now, the expectation is that volume should recover, pricing should come back. Whatever modifications they are done in terms of SKUs, either by reducing grammage or to a certain extent tweaking prices for certain SKUs as well, I think that should probably come back to normalcy. And therefore, I think within the consumption basket, FMCG, as you asked me, should show strong signs of revival. I think within the pack, I think Marico is something which has posted a decent set of numbers. The commentary has been strong as well. And all these tailwinds should effectively pay out for the entire sector. But for Marico, our own sense is that earnings should probably remain extremely stable. And within the alcohol beverages space, something like a Radico Kheta, our own sense is that the premiumization story continues, price size expected across states, input cost expected to remain benign. And because of the entire operating leverage scenario getting played out, numbers should be relatively stronger for the alcohol beverages space and Radico in particular. So I think these are a couple of names within the broader FMCG theme of the consumption basket that we're lacking.
What a wealth creator Radico Khaitan has been 25 times in the last 10 years, Mayuresh, and for Marico, diversification doing well for them as well. But let's talk about ITC. That optically fell over 3% in today's trading session. But if you adjust for the ex-dividend amount, the stock was lower by about 5 or 6 rupees. If you take the dividend factor out, the stock was down by about 13 rupees, but 7.5 rupees was the dividend that the company gave today. So that's what it went ex off. Why is it that the stock fell today, it's because BAT, or British American Tobacco, sold 2.5% stake worth nearly 12,100 crores. The question, why did they sell it? Because, they have been intending to improve their balance sheet. They have been going on a transformation journey, and they've, managed to sell this by increasing, or rather, they managed to increase their buyback program by about $200 million by selling this stake in the company itself. Post this deal, BAT, or British American Tobacco, now holds just under 23% stake in the IPO in ITC, which is worth close to 1.2 lakh crore. They had earlier sold 3.5% stake in March 2024 itself. What is the key thing that we need to watch out for? Their commentary on further stake sale, because the previous time they sold, they said they would like to hold up to 25%, but they've gone ahead and negated that. Secondly, they hold stake worth nearly 7,000 crores in ITC hotels as well. Will they continue to hold that, or will that supply come in as well? And the third thing, from an ITC standpoint, we have to look at ITC, which has about 2 members of BAT on their board as representatives. Would that stay as 2 seats, or would that be culled down to 1 seat with their stake coming down or not, is the big question. However, the important thing for ITC, given the supply event and whether this companies or not, just keep an eye out on their valuations. The stock trades at 22 times FY27 earnings. The fourth quarter cigarette volumes were up 5%. That was good. FMCG margins, which were slightly disappointing, are likely to improve as palm oil prices have cooled off. Agri-business has been doing well. The environment is a lot more conducive for better growth out there. And paper business, which is at the weak end of the paper business cycle, if that turns around, gives a bit of delta as well. So all things, all things considered, it may look like a long-term buying opportunity for those who went ahead and bought in today's trading session.
Absolutely. So that is about ITC, but there's another stock that was in focus today, and we should put the spotlight on that. That is LIC, because that rallied as much as 7%, and this came in after a good set of numbers in Q4 FY25. The firm also expects to see double-digit growth in FY26 with improved margins. And speaking to CNBC-TV18, Siddhartha Mohanty, the firm's MD and CEO, said that they expect market share to grow in FY26, and that an OFS or an offer for sale maybe is in the works to improve the liquidity in the stock. Listen in.
Markets are difficult to predict, but this figure will grow. Whatever policies we sold last year, definitely current year we will achieve more policy. Because if you see, because of a change in product regulation, many policies ticket size has gone up.
Correct.
Minimum ticket size.
Correct.
And because many agents are rural agents, they confine only to small ticket size up to 1 lakh policy. But now most of the policies minimum sum assured is 2 lakhs.
Correct.
So that has some impact, but now they have adjusted. Over 1 year, whatever experience we have made, current year that will be visible, so that more number of sale will happen and more premium also will happen.
Okay, so market share from this point is expected to go up. Okay, fair point. In terms of margins, that went up in Q4 to 18.75% versus 17.2% on a year-on-year basis. FY25 margins, that came in at 17.6% versus 16.8%. You are growing your non-par book. That is a continuous process that you're making. But in FY26, you'll also have the implication of higher surrender value regulations coming in full force. For FY26, where do you see margins going?
You see, last year we have already shown AP growth in non-par. Non-par share has gone up 27.69%. So, and also 80 basis point increase in our margin from 16.8 we have gone to 17.6. Current year, as I told, since focus will be on WRP and APE, and I am confident that margin will further improve. It will be difficult to quantify, but definitely at least from 17.6 to 3% uptick will be there.
Okay, Mayuresh, your thoughts coming in on LIC as well as any other insurer that you would look at? Would you prefer more life insurance players, general insurance players? And I think today only there's some report that has come in also that said that the life insurance sector is expected to grow at around 10 to 11% on against the global average. So what's your thought coming in here?
No, so generally I think the numbers have been very encouraging, Vinny, for all players considered. And therefore, I think the net premium growth that has happened for the quarter gone by has been an encouraging sign. The value of new business margins have held up pretty well. The companies are tweaking to the product mix that they had to undergo a year and a half with the budgetary changes. And therefore, I think the kind of operating stroke marketing expenses as a ratio compared to the overall top line had got elevated. I think HDFC Life, ICICI Approved had one of the largest ratios when it comes to marketing stroke commission spends. And therefore, if I stack up all these parameters put together and then lay out expectations in terms of how VNB margins are expected to play out, what kind of an impact will that have in terms of the overall growth dynamics on the embedded value? And therefore, what kind of return on embedded value numbers can get played out? I think SBI Life probably looks top of the stack as I speak compared to the life insurance players, putting in perspective all these things put together, including the persistency, which has remained very, very strong. So I think this is one name from the life insurance players that we'll for mind. On the non-life insurance side, I think ICICI Lombard would be on our watch list. Obviously, it needs to gain a little bit more in terms of price strength. But the expectation is the stagnancy that you've probably seen, probably in terms of, say, a third-party auto insurance as an example. Those prices have remained largely stagnant. There is a lot of buzz that there might be some element of revisions that happen, not just in this segment, but other parts of the market as well, which might give some element of an embedded growth for the non-life sector as well, where I think ICICI Lombard, a player like GIC, can be watched on this.
Take that point, Mahesh. Thanks a lot for that. LIC, the volumes today actually crossed that of the listing day as well. So highest traded volume since the day of listing. And HDFC Life is something that he spoke about as well. After 3 years, the stock has gone ahead and hit an all-time high. But let's get in some overview on the markets, but more importantly, the economy as well. Noted economist and former RBI Governor Raghuram Rajan says markets don't price in economic outcomes, but continuity is what matters. He also believes that there will be a significant reset in global portfolio holding as many portfolio managers are pivoting away from US assets. He also asks India to be more proactive than reactive, which he believes will then attract more foreign direct investment in the country. The ongoing tariff war, on which Raghuram Rajan says that it will disrupt manufacturing. Listen in.
There is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now. In the longer run, I think one of the concerns this has created in the rest of the world is, are we overly exposed to the United States? And you can see it in the talk amongst financial investors. 70% of global stock valuation was in the US. And now people are saying, well, maybe we're overly exposed. We need to rebalance our portfolios, both on the equity side, but also on the fixed income side. Are we holding too much in US treasuries? So when you talk reset, I think this portfolio rebalancing will play out for some time. It's because people are saying, do I really want to put more assets in the US at this point? And many portfolio managers are saying, maybe I need to rebalance. I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. I think the short run tariffs are disruptive, even to manufacturing. So we will see the consequences in the second half of this year. Will it bring back manufacturing jobs? Probably not a whole lot. Jobs that will be created would be for technicians who man the machines, not for the guys doing the work directly. So big increase in manufacturing jobs, unlikely. If India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. it could result in a significant increase in foreign direct investment. And it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way. I think if we can do that, it could be India's moment. But a lot more action is needed, and it has to be proactive, not just reactive.
All right, so that's some words of wisdom coming in from Raghuram Rajan. But from macro, let's get micro. We had Bellrise Industries. It made its D-Street debut at about an 11% premium listing today. However, it closed lower in trade, much like the market, eventually with an 8% gain. The management joined us here on CNBC-TV18, said they're optimistic about growth in the automotive manufacturing industry. In fact, they will outperform in the medium term. Listen in.
In a medium term, we want to continue outperforming the industry like we have done over the past 8 years or so. We expect to grow much faster in the industry going ahead. And this will be done through a mix of organic and inorganic. I think organic-wise, we have 3 plants coming up, as we discussed last time. And apart from that, the inorganic acquisitions of H1, which was recently acquired, we feel will have very strong tailwinds going forward. So expect outperformance of the industry to remain the way it has in the past.
Okay, on that note, we're going to slip into a very short break. Thank you so much, Mayuresh, as well as Shrikant, for joining in with us today. And with that, we'll slip into the break. We'll get to top corporate voices, key market events to watch out for after the break.
Welcome back. You're watching us here on Markets Forward, the day of trade where we saw some consolidation. The broader markets mildly outperformed, as did the Nifty Bank. Let's look at some of the key corporate voices we had over the course of the day and what they said to us. We had the management of Federal Bank, the managing director KVS Manian joined us and said liquidity conditions have improved. He called it a positive sign for the sector. He expects a base case of 50 basis points rate cut by the central bank, and it's likely in the next 2 phases over the year. But he adds that more than 2 cuts by the RBI appear unlikely. He highlighted that the biggest tailwind for the bank is the economic growth of 6.5%, but the key headwind would be if the growth does not translate into sufficient credit demand.
Moving on, Hindustan Copper shared its FY26 guidance. The company is targeting a 15% increase in terms of volumes, aims to maintain margins above 40% and has planned a capex of 350 crore rupees. So Hindustan Copper was some important commentary coming in there.
Finally, InfoEdge reported muted growth in the 4th quarter. The management told CNBC-TV18 that April hiring trends were slightly slower than expected, though there was good momentum in BFSI and healthcare. They also saw encouraging trends in 99 acres, and they're gaining market share out there. Okay, with that, we are coming to a close on this edition of Markets Forward. But before we wrap, we bring you some key market events to watch out for. Riya Bhatia standing by with the key events to focus for tomorrow. Riya.
Well, yes, let's take a look at the key events to watch out for tomorrow. In the US, there are three important things to be keeping an eye out on. The GDP data, initial jobless claims, as well as the crude oil inventories. In India, we have a lot of companies reporting their quarter 4 numbers, which include the likes of Bajaj Auto, Mazgon Dock, Samvardhana Motherson, Suzlon Energy, Alchem Labs, Amara Raja Energy, Vector Foods, and Prestige Estates as well. There are also a lot of companies that will be holding board meetings to consider a fundraise. There's Prestige Estates, SJVN, Varroc Engineering, Vardhaman Special Steels, Wockhardt, Samvardhana Motherson, and Motherson Sumi as well. And of these both, Samvardhana Motherson and Motherson Sumi will also be considering a bonus issue.
Thank you so much for that, Ria. But with that, we'll wrap up this edition of Markets Forward on CNBC TV18. Thank you so much from Mangalam, myself, as well as the team who put this show together. But don't go anywhere. Up next, you will get more news and updates, so stay on.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The U.S. halts student visa appointments as the Trump administration looks at expanding social media screening of applicants. A U.S. Embassy spokesperson tells CNBC-TV18 students can continue to submit visa applications and scheduled appointments will not be impacted. India and the U.S. likely to sign the first tranche of a trade deal by the last week of June. The director of U.S. Economic Council, Kevin Hassett, says India is close to the finish line.
It could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them.
Former RBI Governor Raghuram Rajan says this could be India's moment if it lays out the red carpet to draw foreign direct investment with proactive policies. Adds India must use trade negotiations wisely to seize the opportunity. That's an exclusive. The Sensex and the Nifty end with minor cuts after a range-bound session. Bank stocks bucked the trend. Mid-caps relatively outperformed the blue chips. British American Tobacco trims its stakeholding in ITC with sale of shares worth over 12,000 crore rupees. This comes a day after another 12,000 crore rupees stake sale in Indigo by co-founder Rakesh Gangwal as promoters continue to cash in. The government hikes the minimum support price for the Kharif crop by 7% compared to last year. Rabi gets the highest hike of 14%. The government also imposes stock limits on wheat. The co-founders of edtech firm Unacademy set to exit the company. Sources say Gaurav Munjal and Roman Seni are in talks with the board to spin off the language learning app AirLearn as a separate company. Also on the show, India's competitive edge is driving Apple's appetite to assemble more iPhones despite warnings from President Trump. We analyze why Make in India is more cost-effective for Apple. Well, let's go straight to the top story this evening. President Trump has ordered embassies to stop scheduling new appointments for student visas. Now, this is the U.S. government prepares to implement comprehensive social media screening for all international applicants. Scheduled appointments are expected to go ahead as per plan. The U.S. State Department spokesperson Tammy Bruce said that students, tourists, or any visitor to the U.S. will be screened thoroughly. Take a look.
We use every tool in our tool chest to vet anyone coming in who wants to come into this country, and in order to do so, it has to apply for a visa to gain access to our nation. So every sovereign country has a right to know who's trying to come in, why they want to come in, who they are, what they've been doing, and at least hopefully within that framework, determine what they will be doing while they're here, whether they be student or if you're a tourist who needs a visa or whoever you are, we're going to be looking at you. I think why that would, it seems to be such a controversial thing that's going on, but it shouldn't be.
And the U.S. Embassy in India has responded to President Trump's crackdown on student visas. Responding to a CNBC-TV18 query, the embassy spokesperson has said that visa applicants may continue to submit their applications, and scheduling of non-immigrant visa interview appointments is dynamic. Parikshit standing by now with more details. So, Parikshit, take us through what the embassy is saying and what all of this really means now for students specifically who are waiting for appointments.
A move that has sparked worries among students who are planning to apply to universities in the United States. The Trump administration has ordered embassies to stop scheduling appointments for student visas as it prepares to expand social media vetting of applicants. According to reports, an internal memo sent to all diplomatic missions, signed by the Secretary of State Marco Rubio, says that there will be a pause on all appointments until further guidance is issued. The memo says that social media vetting would have to be stepped up for student and foreign exchange visas. CNBC-TV18 reached out to the US Embassy in Delhi to confirm this and also for a response. The spokesperson said that the State Department does not comment on internal communications, but all visa applicants may continue submitting applications. When it comes to scheduling of non-immigrant visa interview appointments, the US Embassy in Delhi said that the situation is dynamic and depends on the time required for consular officers to adjudicate cases before them for full compliance with the US law. Consular officials will be working to ensure that applicants don't pose a risk to the United States. Also, consular officials constantly adjust schedules to make sure they have sufficient time to vet cases before them. We also learned that US State Department has been asking visa applicants to provide their social media handles on both immigrant and non-immigrant visa application forms since 2019. Now, just for context, in 2023-24, the total number of international students in the US increased by 7% to a record high of 1.1 million students. Indian students accounted for 29% of total enrollments and were the largest international student community. Their numbers increased by 23% over 2023. International students accounted for 5.9% of the total US higher education population of 18 million students. According to a report by the Association of International Educators, international students at colleges and universities in the US contributed $44 billion to the US economy during the 2023-24 2024 academic year and supported more than 378,000 jobs.
Parikshit, many thanks for joining us. Let's now delve deeper into the issue. How will the Trump administration's crackdown impact prospects of Indian students eyeing a seat in American universities? Remember, as Parikshit was pointing out, India accounts for 30% of the international student community in the US. Shilpa joins us now to bring us a quick pulse check. Shilpa, you've been talking to experts. What are they telling you?
Well, you know, the pause on the new student visa interviews has caused somewhat of a panic amongst prospective students in India who have already secured admissions and are set to start college in August or September. Now, most of these students would have already finished their admission process, their loan documentation, and just have the student visa application process left. Now, we spoke to some education consultants, some students and parents, and the sense that we're getting is that students and parents are worried that not getting the student visa at this juncture would mean that they will have to defer their admission by a semester or even take a gap year. Because, you know, at this point in time, it is also too late to consider other options in other countries unless you already have backups. Because in other countries, most deadlines for college applications, especially in Europe, etc., have already passed. Now, all overseas education consultants are also now advising all prospective students to keep their social media profiles, what they call clean, and to avoid any political commentary, to avoid any issues with the visa going forward. Now, even students who are already studying in the US are also anxious and fearful of any behavior actions that could be deemed as potentially violating visa norms, and also about their careers after finishing college amongst this current situation. And as for students who are still in their planning stages, consultants say that many parents are now inquiring about colleges in other countries like UK and Australia, citing lower risk and better stability. Now, why this is significant is, like my colleague pointed out, that Indians at 29.4% account for the highest number of international students, and this is followed by China and Korea. Now, currently, there are about 3.3 lakh Indian students who are studying in the US as well, and this is a number that has been consistently growing over years. And despite uncertainties, US is still the most preferred destination for overseas education, and many consultants say that this uncertainty is largely temporary in nature. Now, my colleague Reema Tendulkar spoke to an educational consultant, Viral Doshi, about this. Listen in.
US colleges depend on international students, both financially and for the well-being of the university. So it has to be sorted out. Not even the embassies know what is going to happen. So it's going to be something that's going to come out from the administration, and it will be a question of time. So be patient, and I'm sure the patient will be rewarded by interviews in the next 2 months. Nothing to worry. This sort of a issue, what they're looking at, of looking at policy on social media, I'm sure will be sorted out. I'm quite confident of that, because as much as we want to go to a good university, they also want good students. And also remember, it's not only impacting us in India, it's impacting all over the world.
Well, a fair degree of uncertainty there, especially when it comes to students being able to access visas to get to universities in the US. And staying with the US, students of Harvard University held a protest against the Trump administration's crackdown. Hundreds of students were seen gathered inside the university after the US government announced it will cancel all federal contracts worth $100 million with the university. They were also protesting Trump's move to block the enrollment of all international students. Remember, the university sued the Trump administration last week after they were given 72 hours to respond to a list of demands laid out by the Department of Homeland Security. An interim trade agreement between India and the US may be finalized in the last week of June. This development comes after Commerce Minister Piyush Goyal visited the US earlier this month to bolster trade ties between both nations. The director of the US National Economic Council, Kevin Hassett, said that he had met Indian officials and that India is close to the finish line.
You know, I won't talk about a specific country, but I have been meeting with Indian officials. I had dinner with the ambassador a little while ago, and I think, you know, and JD went over there and made a huge amount of progress. Thank goodness for the vice president. So yeah, I would say that it's one of the ones that's on the list of it's close to the finish line.
Close to the finish line, and we are expecting at least the first tranche of the India-US trade deal to be closed by the end of June. Now, India's Foreign Secretary Vikram Misri met US Undersecretary Jeffrey Kelser to boost cooperation in critical and emerging technologies. The two officials also discussed early convening of the India-US Strategic Trade Dialogue to deepen tech and trade collaboration. Misri is in the US till the 29th of May. Let's talk about the markets now. Minor cuts today after a range-bound session, the Nifty ending below the 24,800 mark. The Nifty Bank, though, closing in the green. The Sensex was down by about 240 points. A flat close there for the Sensex, and the Midcap index closing just about in the red. Former RBI Governor Raghuram Rajan says India's moment is here to capitalize on shifts in the global supply chains as companies search for longer-term opportunities beyond America. Speaking exclusively to CNBC-TV18, Rajan said that India can seize the opportunity by laying out the red carpet to draw foreign direct investment with proactive policies. Take a look.
It could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them. And if India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment. And it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way.
Well, that's the former RBI Governor Raghuram Rajan. Now, shares of ITC slipping in trade today. This after British American Tobacco, or BAT, sold 2.57% equity in the company. The transaction is worth 12,000 crore rupees at an average price of 400 rupees per share. BAT has said the proceeds of the sale will provide greater financial flexibility for the company. BAT will, of course, continue to hold 23% in ITC, but a big block being done there. We told you first, and it is now official, Hero FinCorp has secured SEBI's approval for its 3,700 crore rupee initial public offering. The market regulator is also set to clear 2 more major IPOs. Sources tell CNBC-TV18 this includes HDB Financial's 12,500 crore rupee issue, which could be the largest NBFC listing in recent times. Ritu's here with more on these potential listings. Ritu.
Well, big moves in India's primary market, with 3 IPOs getting SEBI's green signal. And first of the block is the much-awaited $1.5 billion HDB Financial IPO, which is set to get SEBI's go-ahead very soon, paving the way for one of the largest IPOs that we're going to see from any NBFC in recent times. The offer will comprise of 2,500 crores of fresh issue and 10,000 crores offer for sale by the parent, HDFC Bank. Now, while HDB had filed its DRHP in October last year, the offer, we understand, was under SEBI scrutiny over a potential violation of Companies Act, which related to a private placement of shares to more than 50 employees of HDFC Bank, which has since been resolved. Keep in mind, HDB Financial will have to list by September in order to comply with RBI's upper layer NBFC regulations. Apart from that, if RBI's 2024 draft circular on bank subsidiaries is finalized, HDFC Bank, which owns more than 94% stake in HDB, will also eventually have to bring its stake to below 20% to comply with the norms. And that's another reason why this IPO is crucial beyond just the size. Now, apart from HDB, as we have been reporting, and it is now confirmed, SEBI has given a go-ahead to Hero FinCorp's 3,668 crore rupee IPO, which was filed in July last year and was facing delays because of compliance-related questions for unlisted entities. Hero FinCorp, remember, is backed by Chris Capital and, of course, part of the Hero Motorcorp group. And its offer will also comprise of a fresh issue along with an OFS. Then we have Vikram Solar, one of India's leading solar PV module manufacturers based in Kolkata, also getting the go-ahead. Its papers were filed in September last year for a 1,500 crore rupee issue. And finally, an update on the Tata Capital IPO, a mega 15,000 crore rupee IPO. The company had filed its papers with SEBI just last month, so this may take some more time, but the clock is ticking for them because Tata Capital is also under RBI's upper layer NBFC listing mandate, with a deadline of September to go public.
Well, plenty of activity expected there as far as IPO corner is concerned. Ritu, many thanks for joining us. Decisions being taken by the cabinet today. The government has hiked the minimum support price for kharif crops by 7% year-on-year. The MSP of ragi has seen the highest increase of 14%. The government has also imposed stock limits on wheat. Manisha standing by to explain to us what all of this means. Manisha, decision by the cabinet there. Take us through the impact.
Well, yes, the government has hiked MSP of 14 Kharif crops for the marketing season 2025-26, and this comes quite timely because the sowing is just about begun. And this also is a good year because we're looking at a monsoon forecast of above normal at 106% of LPA. So one, it's timely, the announcement of MSP. Second, the sowing will get impacted because of this, because we're looking at good monsoon and very strong MSP numbers as well coming in. Also, the government procurement in the last couple of seasons has been quite strong. So with higher MSP, better sowing could be done, and that would mean that the government, as has mandated, that many of these crops would be procured at MSP or even at market prices for that level is on the higher side. Just to give you a sense on a couple of these crops where we have seen the highest MSP come in. By the way, it's anywhere between 50 to 68% on the higher side from cost of production. So the numbers in that sense are good. But the best of MSP clearly has come in from Niger seed, up by nearly 820 rupees per quintal, and 500 to 600 rupees a quintal of a gain has been given to ragi, cotton and sesame. Strong numbers is what we are also looking at in sense of maize, because remember, a lot of maize is now getting used for ethanol as well, apart from feed and food as well. So fuel is yet another reason that you have seen maize consumption growing up, and we've seen MSP hike quite strong on that. Pulses MSP hike has been on the higher side as well, and this is where the government has been talking about self-reliance in pulses production by the year 2030. So this step perhaps comes in that direction. And then in sense of edible oils, we've seen soybean, groundnut also given a very high MSP there. It's good monsoon, good MSP and strong government procurement are a few cheers that the farmers clearly are looking at this point in time.
Manisha, many thanks for joining us. We will head into a break, but up next, the co-founders of EdTech firm Unacademy set to exit the company. That and more when we return. In international news, Israeli forces have continued to bombard Gaza, killing at least 8 people. This has taken the total death toll to 15 just since dawn. Israeli military has also opened fire on crowds who rushed to an aid point run by the controversial Gaza Humanitarian Foundation. At least 3 people were killed, 46 injured at the scene. Russia said that a major Ukrainian drone attack on Moscow led to the suspension of flights from 2 airports. The defense ministry said 112 Ukrainian drones targeted 6 different regions in the 3 hours up to midnight. Meanwhile, Russian drones hit the Ukrainian city of Kharkiv, injuring 8. The co-founders of EdTech firm Unacademy are set to exit the company that they founded. Sources have said that Gaurav Munjal and Roman Seni are in talks with the board to spin off the language learning app, which is called AirLearn, as a separate company. Rachna standing by with more. Rachna, what does this mean for Unacademy, with the founders looking at a possible exit?
Well, Unacademy, once a high-flying edtech unicorn, is now undergoing a deep leadership and strategic reset. Co-founder Gaurav Munjal has stepped down as CEO, and Roman Seni, another co-founder, is also exiting from active duties. The reins have now passed to Sumit Jain as the company doubles down on its pivot to physical learning centers and its language learning app branded AirLearn, moving away from the online test prep segment that originally made Unacademy a household name. So this isn't just a leadership shuffle. It's a culmination of mounting pressures over the last 2 years. Back in April 2022, Unacademy terminated around 1,000 full-time and contractual staff. A year later, in March 2023, another 350 were let go, including members of the leadership, tech and online test prep teams. By August and October 2023, COO Vivek Sinha and CFO Subramaniam Ramchandran had also resigned, indicating a steady churn at the top. Funding has also been tight, despite marquee investors like Facebook, Bloom Ventures, Nexus Partners, General Atlantic, Sequoia Capital and Peak 15 backing the company. Unacademy has struggled to secure fresh capital. It was last valued at $3.4 billion, but hasn't raised funds since August 2021, when it secured about $440 million, bringing to total funding to $880 million. Internally, Unacademy has tried to reassure stakeholders. In December 2023, Gaurav Munjal claimed that the company had reduced cash burn by 60% and had a runway of over 4 years. And in July 2024, he tweeted that Unacademy was poised for its best year in terms of growth and profitability, asking people to ignore the rumors at the time. But the ground reality tells a more complex story. In the funding boom of 2020, Unacademy made about 12 acquisitions to expand its reach. By most accounts, many of these acquired companies have either shut down or become dormant. While Munjal initially dismissed such assessments, he later admitted that Unacademy would narrow its focus to just 2 or 3 core projects. Crucially, online test preparation, once its flagship segment, is no longer among those core bets. The company's future now hinges on its offline pivot or through AirLearn, a major strategic departure from its digital-first origins. Now, according to sources, over the past 2 years, Unacademy has also held unsuccessful bailout talks with players like Allen, PhysicsWala, K12 Techno, Bodhi Tree Systems, Veranda Learning, as the pressure to restructure and find new growth avenues have mounted. Sources also tell CNBC-TV18 that the company still continues to look for a bailout. Now, as Sumit Jain takes the helm, all eyes are on whether this reset can bring Unacademy the stability and credibility it needs in a far more cautious edtech landscape in the country.
Rachna, many thanks for joining us. Another troubled firm there in India's edtech sector. India's competitive edge is driving Apple's appetite to assemble more iPhones, this despite warnings from US President Donald Trump to shift production back to the US. Ashmit joins us now to decode why Make in India is more cost-effective for Apple. Ashmit.
On May 1st, in an earnings call, when Apple chief Tim Cook was asked about plans to make in India, he responded by saying that we do expect the majority of iPhones sold in the US will have India as their country of origin. But even without Tim's confirmation, Apple's India blitz was already visible on the ground with increased Apple production. Here are the numbers. In FY25, Apple production in India clocked a phenomenal $22 billion. That's a YOY growth of 60%. Similarly, iPhone exports for the very same fiscal, that's FY25, came in at 75% YOY growth, clocking $17.5 billion. But outside of these national numbers, the iPhone push was also visible at the retail level. In the Jan to March quarter of 2025, Apple clocked in shipments of an unprecedented 3 million iPhones, and this translates to a YOY growth of 23%, which is remarkable given that the overall smartphone market was down by 6%. But then came Donald Trump's comments, and suddenly all bets appear to be off. On May 15th, Donald Trump issued a statement saying, "I don't want you building in India. They can take care of themselves." He essentially told Tim Cook that he was free to make in India for India, but not too happy about making iPhones in India for the US market. Now, on May 23rd, Donald Trump doubled down, now threatening a 25% tariff on phones made outside of the United States. Now, while Trump was muddying waters, the messaging in India is that Apple is not going anywhere, and this confidence may be stemming from some interesting numbers. For an iPhone retailing at $1,000, Apple takes home about $450. Taiwan provides those chips and therefore takes home $150. As far as South Korea is concerned, South Korea provides for various inputs such as memory chips. They take home about $90. Japan provides camera systems. They take home $85. Suppliers such as Qualcomm and Broadcom, they take home about $80. There are some critical components that come out of Germany, Vietnam, Malaysia. They clock in about $45. And that's where it gets interesting. India, for manufacturing and assembly done here through Foxconn and Tata, India gets only about $30. And even this 30, most of it is given back to Apple in the form of PLI benefits. So essentially, India is a cheap destination to make iPhones. A $1,000 iPhone will mean that India gets only about $30, making up for just about 3% of the retail price. But Donald Trump wants Tim Cook to make America great again by manufacturing iPhones in the United States. But is it that easy? Well, a large part of India's competitive edge is enabled by low cost of labor. On an average, the workers in India get about $230 per month. And let's change the scenario now. Imagine iPhones set up and being made in the state of California in the US. Well, the cost of labor, even by minimum wages standards, would be around $2,900 per month. That difference is 13x the labor cost in India. Now, this spike in labor cost would mean that a $1,000 iPhone is being made in India for $30, while the same in the US should be as high as $390. And this shift will cost Apple heavily. Currently, it clocks a profit of about $450 for every $1,000 iPhone sold. With labor cost as high as $390 per iPhone, the profit margins could drop from $450 all the way down to $60 for an iPhone. Now, this is causing some leading industry analysts to argue that even with a 25% tariff, it would make sense for Tim Cook to continue making in India instead of the US.
Well, Ashwat, many thanks. Well, those are the numbers that Tim Cook is perhaps trying to convince Donald Trump with on why Apple cannot shift its manufacturing base entirely to the US at this point in time. It just will not make business sense. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay with us. We're back in a moment.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. As savers and investors, we spend most of our lives trying to create wealth. But perhaps knowing the rules that govern the transfer of this wealth within the family or maybe even outside the family is perhaps as important. And that is what we are aiming to do on the show this week. The idea is to understand the laws that govern succession and the importance of creating a will to ensure smooth succession of assets. Joining me to do that today is Neha Pathak, Head of Trust and Estate Planning at Motilal Oswal Private Wealth. Neha, thank you so much for coming in. Welcome back to the show.
Thank you.
Always a good thing to have you on. I remember it was an earlier show where we were generally talking about what women need to do, and we had you on as a teaser. And I remember saying that to viewers that we need a full-blown classroom on this. These are legal matters, can get quite tantalizing to say the least, I'm guessing.
Absolutely, it's tantalizing. You're so correct with that word.
The idea is that, let's start with some broad thoughts. When we talk succession, at some point in life, it's about knowing what's my due. Will I get my share? Because I am due to get some inheritance. And then beyond a certain stage in life, it's about how I need to plan the transfer of my assets to the next gen or to, whoever might be the intended beneficiary. How should one overall look at the concept of transfer of this wealth?
So see, if let's understand this, that in India, there are many personal laws. So multiple religions are there are multiple personal laws that are there. If I have got assets and if I pass away, what is the law that's going to govern me? And if I die without having anything in place, so be it to say that if I don't have a will in place, I pass away as an intestate without anything in writing. Now, when I pass away without a will, my personal succession law will come in. For Hindus, it's going to be a Hindu Succession Act. If I'm a Muslim, then it's a Sharia law.
Sure.
If I'm a Parsi or a Christian, then probably the Indian Succession Act.
Okay.
So that is what is going to govern what happens to your assets if you pass away without anything in writing. So it becomes pertinent for all of us to actually make a will, so that we can mention things, how they should be done and what should be the procedure of doing that.
Sure. Right. So we'll obviously come to that, and that's the bread and butter of what we're trying to do today. But just to understand the law, like you said, if someone passes without a will, then it's called, passing away intestate, right? Yeah. So these succession laws between different religions, are they tremendously different? Or is the Indian succession law somewhat similar to, say, the Hindu succession law?
I would say Indian succession law and Hindu Succession Act are pretty much similar.
Okay.
It's a little different from the Muslim succession law, with Sharia Act rather.
Right.
The main thing is mostly it's the family member that is covered.
Right.
The near and dear ones who are covered in the law. It says that if a person passes away, how much share will go to his wife, how much share will go to his mother or to his children. That is written in pretty much most of the laws.
Sure.
So that is what a personal succession law is.
Got it. So for the sake of understanding, now viewers remember this is what we're trying to understand, that if you or if we pass away without a written, clear, stated will, then how do the succession laws come into play? So let's take the Hindu succession law as example. If I pass away, I've not made a will, who gets my money or my wealth or my property and my assets?
So depending, if I talk about a male Hindu, if a male Hindu passes away without a will, his share gets equally divided between his mother, his wife and his children in equal proportions.
Okay.
In case either one of them is not there, then the remaining people will get it in the equal proportion.
Okay.
If none of them are there, then their children, so if my the man's grandchildren are there, they will get it. Or else if he has nobody, then there is something called a class 2 heirs that are defined under Hindu law. They will be getting the assets of the deceased.
Okay. Now, do these legal heirs, do they have to prove that they're legal heirs to get these assets? For instance, if this Hindu man passes away, will the children or the grandchildren, what do they have to do? Or is it simply passed on because it's built into the law?
No, it doesn't get passed on because it's built into the law, because there is going to be an equal proportion of everything. So generally people have these common consensus amongst themselves that let's distribute assets, father's assets between us in this manner. However, there are certain places like maybe a bank locker or a property where you would require a legal document to state that I'm a legal heir of a such and such person. Now these legal documents can be procured by a court. So one has to go to the court to get these assets transferred in their name.
Okay, all right. And what's also important to note, like you said, the succession laws, I think, were amended a couple of years back. You're saying it's equal proportions. So sons and daughters, technically as per the law, are entitled to an equal share of the assets.
As much as mother and wife.
As much as the mother and the wife. So mother, wife, the children, which might be son or daughter, everybody is entitled to an equal share of assets. Okay, now we come to the operative part. If this is already clearly defined in the law, then why is it so important that we make a will regardless?
So we'll continue with the same example. This man has passed away. His assets are going to 4 people. Now, he may not want that. His mother is quite old and he might be having some other siblings also. Probably his idea of earning the assets was giving it to his wife so that one can take care of his children and his mother, and his wife is capable of doing that. He didn't want that his assets are divided 4 ways equally between 4 people. So it becomes important for him to have that thought in place and have that writing in place that in case something happens to me, my assets go to my wife. And in case she is not there, then it goes to my children. Probably he doesn't want to give anything to his mother. So that probably he wants somebody to take care of his mother. So think about it that way. Also, there is a possibility that one may want that a certain portion, like people say that I want to give back to the community. I want to give back to the community. Now, if this man's wish was that I want to give a certain portion to the community or to an institution, then that will not come true if he has not done anything in writing.
Oh, absolutely. So, I mean, that has to be a starting point. You have to state your intentions in the form of a will. Okay, so let's move to the next brass tacks questions then. How is the will created? I believe you need 2 witnesses. How complex or easy is the process? So how should one go about it?
So it's a fairly straightforward process. When you are looking at creating the will, there are certain basic guidelines you should follow. When I talk to my clients also, I tell them that when you are thinking of creating a will, put down who are the beneficiaries, who are your family members, or who are your beneficiaries. It may be a possibility your beneficiaries and your family member are different people.
Correct. You want to give it to some non-blood relative, your assets or
it
part
can
of
be
your
a
wealth.
friend, it can be an institution, it can be anybody. Write down what your assets are. So my assets are real estate, investments. If I have got investments, where do I hold them? If I have real estate, what is my property? Where is it held? What's the complete address? Write down my bank account details, write down my insurance details, write down the details of the locker. Very important to write down the details of the locker. Where is it held? Write down where, if I have art or artifact, how have I procured them? Who has made it? So you should be as elaborate as possible when you are making the list of these assets. Even the shares that you hold of, if you are running a company, the shares of the company, you should mention the details of the shares. Right? Partnership firm or an LLP, put in the details of that. Post that, you put in front of every asset, you write who's going to get
the
this
beneficiary.
asset. Yes.
And
next to that, put in that, what if this beneficiary is not there, then who will it go to? Most likely the beneficiary is the spouse. Spouse will be pretty much the same age group as you are. If the spouse is not there, then who will you want this asset to go to? Very important aspect. Put in a residuary clause when you make a will, that if I have not mentioned something in this will, it will be covered by this residuary clause. Put in an executor. Executor is a person who takes the will to the court after the person who has made the will is not there anymore. This is an important person. Most likely it is again going to be your spouse, but preferable will be person younger to you, much younger to you, who can do all these things for you.
Usually the executor of the will is a family member. Can it be a non-family member as well?
It can be a family or a non-family member. Okay. Absolutely no issue.
And the executor can be one of the beneficiaries of the will as well?
Absolutely.
Okay.
Thereafter, you should have your PAN card, Aadhaar card mentioned in the will so that one can figure out where your investments are if they are linked to the PAN or Aadhaar. And always mention that in case the executor is not there anymore, then who's the next in line executor who will be taking care of these things. Now, we have made the will, we sign the will, the person who's making the will should sign it. The two most important people again are the ones you just said, the witnesses. So 2 or more witnesses can sign the will. That is what validates the will.
Okay.
After that, you can look at registration or you can just keep the will at your house in a safe place.
The witnesses?
Yes.
Do they have to be non-related, related, family members,
Ideally,
non-family
they should
members?
not be the beneficiaries in the will.
Yeah.
They can be relatives or non-relatives, doesn't make any difference.
Okay.
But they should not be beneficiaries of the will.
Okay, there should be independent witnesses.
Yes.
Got that point. So this is pretty much how it can be drafted. There's also a lot of talk of adding at times maybe a medical certificate, proving that the person who's making the will is of sound mind.
Yeah.
Why is that important and how does one prove that?
So one goes to the medical practitioner and he gives a certificate that a person is of sound mind and is physically able to go ahead and register the will or make a will.
Okay.
If you are of unsound mind, then you surely can't draft any document. So it's important that one gets this kind of document from the doctor.
Okay, fair enough. You brought up the point of registration of a will. And I know that I think it's not mandatory to register every will, but why is it then advisable to do so? And when you say register a will, is it registered in a court? What's the process like? And what's the upside of doing this?
Okay, so registration under law is not compulsory.
Okay.
Why do we register the will? The first and most important point is that it gives me satisfaction that I have registered it with some government authority. Now, registration is done either at the sub-registrar's office or there can be a lower court in different jurisdictions. It's a different place. It can be a lower court that is registering the will for you. It creates a copy with the government.
Okay.
So if the person who has made the will is not there anymore, but he has informed his family members, I have made the will and I have registered it, the beneficiaries can go to the registrar's office and can get the will, copy of the will.
Okay.
It provides a sense of security that I have done something right and it is there in the, and people are aware that I have done something right. Also, when you go to the registrar's office to register the will, they actually ask you these questions that do you know the contents of the will, are you aware what is written over here, show your identification and then they register the copy.
Okay. So, but a non-registered will is also legally binding?
Absolutely. Absolutely binding. So, say for example, I made a will and I registered it.
Yeah.
But 2 years down the line, my asset base changes. Then maybe I might want to change my will. And I will change my will. So, in that case, the will that I have made subsequently becomes the recent will.
Correct.
And that's going to be my will and not the registered will.
Okay. All right. Got that. So, those are the nuts and bolts of making a will, which maybe is the easier part. Yeah. The harder questions are when to make, how to discuss it with your family, how to ensure that, there's as less acrimony as possible, what to do about existing nominations, all of those technical questions we discuss with Neha after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we're discussing how creating a good, solid, foolproof will is probably the cornerstone of any plan when it comes to transfer of wealth, assets, or succession planning. And of course, I'm in conversation with Neha Pathak. Neha, before we continue, question cropped up in my mind in the break. We're talking about the interstate laws, which define how wealth will be transferred if there is no will. And they say, for instance, it will be shared equally between the deceased wife, spouse, and children. Where do nominations feature in all this? Because for all our assets, mutual funds, fixed deposits, everywhere, there's always a nominee. So how does that nominee tie in with the interstate laws and, of course, the will?
So if I talk about nominee, a nominee is a legal representative of the person who was the owner. He's the person who's supposed to hold on the assets as a custodian and thereafter transfer it to the legal heirs. A lot of times it so happens that the nominee and the legal heir is the same person, or there might be more legal heirs. So if I have nominated my husband as a nominee, but I have got kids, then in that case, my legal heirs are my husband as well as my kids. Right. However, nominee is only him. So he is supposed to hold on to the assets and distribute it amongst himself and the children.
So nominee does not, that's really important. Nomination does not mean that you get the asset.
Yes, it does not mean that. It means you get the asset to hold it in as a custodian.
As a custodian. It is not for you to use and for you to, throw away the wealth or enjoy its benefits. So all you nominees out there, please realize that you're only the custodian of that asset. You cannot hold on to that asset as your own or use it as your own. Very, very important point there. Which gets us back to then, therefore understanding that the will is, making a will is the way to go. Just explain to us this concept of probate. And we keep hearing that despite a will, there are disputes in the family. The will is getting challenged, so on and so forth. Yeah. How can one try and minimize all of this?
So will is a challengeable document that we have seen. Yeah. Now, what happens is that when one makes a will, there can be an concept of fraud or coercion that may have played. And that is why, and some of the beneficiaries in the will might feel that I am getting less as compared to the other one, or I should have gotten that particular asset and not the other person. And which is why a person might contest the will. Now, when does this come? So when does a will come to light? I made the will, I have kept it in a safe storage. However, my executor will bring it out after me, after I'm not there. He would have to take the will to the court and get an order from the court, which is also known as probate, that this will is right, the contents are perfect, and the assets should be distributed between the beneficiaries that are mentioned in the will.
So this is really important. The will cannot be implemented, quote unquote, till there is a probate or this order from the court. Is that right?
Exactly. Not for all the assets, probably. Some of the assets can be distributed between the beneficiaries if they are of the like mind or they think that it should be distributed.
When it's amicable, yeah.
But when it comes to real estate specifically, the asset would be distributed only after probate, and it's safer to do so.
Okay. Okay. All right. So therefore, you go to the court.
You get an
order saying that the will is, has been sort of approved by the court, so to speak.
Yeah.
And then it can be implemented and the assets can be distributed. Got that. So that clears up a lot of the technicalities. Now, just some, life situations as we're coming to the final leg of this conversation, Neha. And life can be very uncertain, right? There could be cases where you are creating a will, whether it's for your children or, family members. There could be separations, there could be divorces. So what do you do in such a case? Because in a happy situation, you wouldn't mind the asset being shared by your son or daughter and their spouse. But in a different situation, you might want that asset to be secured only with your own child.
Right. Now, two aspects of divorce. Either the parents are getting a divorce or the child is getting a divorce or a separation, right? These are the two aspects.
Yeah.
Either which ways, I think the best way to move forward would be to ensure that the child is well protected, is well taken care of. So there should be enough insurance to cover his medicals. For his education, there should be a fund. There should be fund for his education, medical and maintenance. Maybe sometimes people do create a certain portion for his marriage. So all these things are very important and they cannot be just be done by a will. Maybe one can look at creating a private trust where these assets can be housed and they can be secured against anybody getting a separation. And they are used specifically for the child or children and their well-being. So,
okay, that's how it goes. From a broader legal sense, whatever are the assets that I own as a male or a female, going back to the interstate laws, they typically go to, like you said, spouse, mother and children. Do the spouses of my children also have any direct rights on the family assets, my assets?
So, spouse of the family, of course, yes, they have a direct right if my child is not there anymore.
Oh, if the child is not there, only then in that case.
In that case, he might get a right over there. So, one needs to be careful about what is written in the will. So, when I said that the first leg of beneficiary, you should identify that who's going to get the asset. The second leg also should be identified, that what if my spouse is not there, what if my child is not there, then who will the asset go to?
Okay, all right, fair enough, got that point. Last but not the least, the assets once they're transferred, are they still subject to any kind of scrutiny? It could be, you know, the authorities, it could be the income tax department, ED, anyone. Are inherited assets still subject to government scrutiny?
So, if the government thinks that you have received the funds and these funds were tainted funds, yes, there can be a scrutiny on that.
Okay.
So, sovereign is always above
everything.
Yeah. So, yes, that can come.
And
However,
taxes?
Taxes in India, we do not have inheritance tax or estate duty. So, one who's inheriting doesn't have to pay tax on the inheritance.
Yeah, so far so good, fingers crossed.
Fingers crossed for that one. However, there is, if there is any income that is earned on the estate before it was distributed, that tax has to be paid. So, income tax or capital gains has to be paid. After it is distributed, it is upon the inheritor, whether he's selling it, he's keeping it, he's earning rentals or dividends, then there might be income tax or capital gains,
whatever. I mean, then it's your asset and you have to pay taxes as per the applicable laws. Got that. Now, finally, to sum it all up, I mean, what's your final advice? I'm sure you've seen enough families, enough situations out there. I mean, usually is it simple and clean with a will? What can be done to ensure? And it's also taboo subject. I also come across people who don't want to discuss the division of assets, right? It's a difficult topic to broach with the family.
Yeah.
And usually it's left till the very last minute or it's not openly, I mean, no one knows if there's a will or not.
Yeah.
How can this best be handled?
So, I think the best way and the most straightforward way is be practical about this approach. People tend to get very emotional about it. But till the time you are practical about it, you can go ahead and finish this process. And it's a fairly straightforward process. Do it, finish it, keep it aside. People think that when I am about 80 years old, that's when I'll make the will. It's not going to happen. You don't know when you might die. So might as well create a will and put it aside. So that's the simplest and the most straightforward way, whatever your age group is. If you have assets, might as well create a will and keep it aside.
Okay, all right, do it now.
Yes.
And then sleep easy, sleep in peace, so to speak. All right. Neha, thank you very much. This was a good, quick crash course on the basics at least, enough to get us started, to take appropriate advice and to ensure that succession planning is far more structured and clearly done. Thank you for joining us on this.
Thank you very much, Surbhi.
All right, folks, hope you found this conversation fruitful, useful. I certainly did. Keep sending us your feedback, comments, queries, and as usual, we'll see you again next week with another theme.
Let's talk money.
Hello and welcome to News Center. I'm Parikshit Luthra. The top story this evening. The Trump administration has ordered embassies to stop scheduling new appointments for student visas. This as it prepares to implement a comprehensive social media screening process for all international applicants. Scheduled appointments, however, are expected to go ahead as planned. The US Embassy has told CNBC-TV18 that visa applicants may continue to submit applications. An embassy spokesperson went on to say that scheduling of non-immigrant visa interview appointments is very dynamic. So what does this really mean for Indian students that are set to start their academic year in September? Indian students account for 30% of the total international student population in the US, followed by the Chinese, who account for 24%. We will discuss that and much more. But first, here's the US State Department spokesperson saying that whether students or tourists, everyone will be screened.
We use every tool in our tool chest to vet anyone coming in who wants to come into this country, and in order to do so, it has to apply for a visa to gain access to our nation. So every sovereign country has a right to know who's trying to come in, why they want to come in, who they are, what they've been doing, and at least hopefully within that framework, determine what they will be doing while they're here. Whether they be student or if you're a tourist who needs a visa or whoever you are, we're going to be looking at you. I think why that would, it seems to be such a controversial thing that's going on, but it shouldn't be.
We're now joined by former Indian ambassador to US, Arun Singh. Ambassador Singh, this is a big source of revenue for America. Foreign students bring in at least $45 billion in revenue for the US government, and they created over 300,000 jobs in the last academic year. Why would the Trump administration crack down and slow down the visa appointment process and approval process for international students?
So, Parikshit, as you mentioned, foreign students are clearly a very important source of revenue, particularly for universities, because the foreign students are charged at a much higher rate, and $45 to $50 billion is what foreign students are paying just as tuition fees. And then there is the additional expenditure on their stay, families visit, and they spend more than that. So it's several times that, the infusion that takes place in the US economy. But that having been said, clearly the Trump administration has taken a certain position that the kind of protests that had happened in the US last year in response to some of the actions happening overseas, including the action that Israel had taken in Gaza. So in response to that, they have been cracking down on students. You would have seen reports that several students have had their visas revoked. Universities are under pressure to prevent this kind of protest happening again. Several universities have been fined. Grants to several universities have been stopped. So there is a certain approach that the administration has been taking. Now, at one level, as the spokesman of the State Department said, it is certainly the sovereign right of every country to decide who they should grant the visa to. But that having been said, the expectation is that when students go to universities, it's not just the subject that they're learning. They are participating in a certain campus atmosphere of expression of opinion, free speech, interacting with each other, learning from each other, learning from the different discourses that are brought to the table. Now, this kind of attempt would suggest that the kind of free expression that US was known for earlier, for some time, there's going to be restriction on that. And I think students have to factor in what kind of learning, what kind of campus experience they should expect if they do go to the United States. So that's the sort of dynamic that's playing out now.
You know, what is your understanding of this internal memo that foreign papers have reported on? When we reached out to the US Embassy in New Delhi, they did not deny it. They said we cannot comment on internal memos. Students can still submit their applications. Appointments are dynamic. It depends on the capacity of the consular mission, amount of workload they have, and the time needed to vet an application thoroughly as per US laws. What does this really mean for someone who is awaiting a nod for his visa, for his US visa to study in the United States?
So the two things are very clear. So unless the US position changes, the number of students who would be getting visas to go to the United States would be much less than last year. Because if you remember, in the earlier years, when the US did have a problem of capacity for grant of visas, for a couple of months, they used to just reserve the slots for granting student visas because they wanted to make sure that the students got the visas to be in time for the semester. Now, this time the position is different. So they don't want to expand capacity. And as a result, the number of students getting the visas would be less. Second, I think a lot of uncertainty for the students because you need to plan, you need to take admission. And if you're not sure that you're going to get a visa, then you need to work out alternatives. So I think this element of uncertainty in student planning would come in, and I think that's a complication.
You know, Ambassador Singh, as someone who has seen the different administrations in the US over the years as a diplomat, what would be your advice to students aspiring to study in the US? Now we've seen social media vetting. If you fill up any kind of visa form for the United States, even if it's a B1, B2, or an I visa, or a J visa, H1B visa, you have to provide your social media handles or identifiers, and this has been happening since 2019. What would be your advice to students who are now applying as to how they maintain or have a social media profile of their own?
So look, for one, the US education system still had strengths that other education systems don't have, including in the science and technology stream. So there are certain advantages. Second, traditionally, after having studied in the US, the kind of experience that student absorbed, then either they were able to get good jobs in the US or come back to India, get good jobs here, or start their own business and work on building business relationships between India and the US. So there are many ways they were contributing either to the US or to the India-US relationship, other than the broader societal contributions in India. So that dimension was there. Now, with this uncertainty coming in, clearly the students would not want to lose a year or lose a semester. So I think it would be useful for them to have alternatives also in hand. The alternative could be either a course in India, the alternative could be a course in some other country. And I think with the uncertainty that has been injected in the US system, even the universities are under pressure. You know, the president has said that he will not authorize grant of student visas for Harvard University. Of course, that has been stopped by courts, but it injects an element of uncertainty. So US universities also may be more open to partnership with other universities for setting up campuses. Now, under our new education policy, we had allowed the setting up of campuses of foreign universities or partnership between Indian and foreign universities. So perhaps this is an opportunity for Indian entities to see if they want to build partnerships with US universities, looking at the uncertainty in the years ahead, so that the pressure on the students to go abroad could become less.
Okay. So what do you feel? Which are the countries which could benefit as a result of this new policy by the US government? They've not formally announced a pause, but clearly things are going to slow down as far as visa appointments go. What's your sense as to which countries could benefit indirectly?
Well, first of all, I hope India benefits the most. And if we can expand capacities in India for providing education, that would ultimately be the best option. But other than that, UK has options. Recently, India and the UK have signed a free trade agreement, and the legal aspect is being finalized. But there are provisions for student visas, for mobility. So UK certainly is an option. Germany has been very much more open to Indian students and skilled Indian professionals going to Germany. France is a good option. So there are options certainly in Europe. And I think it would also work for India because there has been a certain strength in the India-US relationship because of the people-to-people dimension. In the European context, as there is much more scope to build that, because in some cases like France and Germany, to some extent, language has been an issue. But if you can bypass that and build more of the people-to-people relationship, more links at the technology level, skilled personnel, I think it will deepen those partnerships. And then, of course, Australia has been a traditional option. Ireland is an option. So there are many options, I think, for Indian students. Although I must say that the US option has certain strengths that we should not ignore.
Right. Do you feel that the Indian government will be able to work out an understanding with the US on this?
Well, I can't speak in terms of what the government might do, but I think the US, as you see, has been taking very unilateral measures at the moment, not consulting or coordinating with other governments. So as of current indication, I think there doesn't be much scope for that, but we'll have to see. The US government decisions are evolving from day to day. And so we'll have to see how it proceeds on this.
what about this entire move, this internal memo to pause student visas temporarily till they get a new social media policy in place? Do you feel that this is something that could get challenged in court? Enhanced social media vetting? Or it's
it could be challenged in court, but if you see the system in the US right now, many courts are allowing many things that the administration wants to do to go ahead. In some cases, they are stopping them. And in some cases, the administration is not fully implementing the directives of the court. So it's a very complicated situation. And of course, social media vetting, there could be issues about privacy, about data protection. So those issues would be there. And again, so far, as you know, in the US visa application, you have to fill in a large number of data pertaining to what you've done, what kind of organizations you may be involved with. So this is an additional dimension of vetting they're bringing in. But I would say so long as the right to privacy of an individual is maintained, I think that would be important.
Right. And of course, the uncertainty for the students continues in the meanwhile. Do you also feel that consular officers, US embassy officials dealing with visas, student visas, have the required capacity to do such additional checks and background checks, such deep checks?
Well, I wouldn't have personal experience of that, but I'm sure, you can build capacity. That's not an issue. And if they don't have the capacity, it will only delay processes. So, today with technology, with artificial intelligence, it's not difficult to get the kind of information that you're looking for.
How long do you feel this uncertainty is going to continue? Because yes, students around the world are going to be impacted. Do you feel that this is something we would see clarity on, possibly in the next 1 month or so? Because even now, when we hear from experts, from those who are applying independently, we're told that till now, those applications are still being taken. Appointments are being honored for the moment. By when do you think all of this will get clear?
One doesn't know. And we can only hope that it is cleared soon so that the uncertainty and the anxiety for the students is brought down. Beyond that, it's difficult to say anything at this stage.
All right. Ambassador Arun Singh, thank you very much for joining us. Clearly a very difficult time for Indian students wanting to go to the United States, and there is going to be extra social media scrutiny for them and their applications in the days to come. Thanks once again for being with us. Let's also stay with the story and get you another view. Renowned educational consultant Viral Doshi believes that the visa issue will be sorted out by the Trump administration in the next couple of months. Speaking to Reema Tendulkar, he also added that the visa applications of over 50% Indian students seeking admission in the US colleges this fall have already been processed.
I would say more than 50% of students have got their visa calls. I think 50% still remain pending, especially for students from state universities where the I-20 takes a little longer time. They're still pending. International students make the core of American college experience. So obviously, they will sort it out. So question is, when will it happen? Nobody knows. But I think it will be done very, very quickly because they do understand that most schools open in August and September. So whatever interviews which still remain have to be done in June, July. So I'm very confident that we will get a message from the administration that they've sorted out the policy and embassies will start doing their interview calls in the next 2 months. US colleges depend on international students, both financially and for the well-being of the university. So it has to be sorted out. Not even the embassies know what is going to happen. So it's going to be something that's going to come out from the administration and it will be a question of time. So be patient. And I'm sure the patient will be rewarded by interviews in the next 2 months. Nothing to worry. This sort of a issue, what they're looking at policy on social media, I'm sure will be sorted out. I'm quite confident of that because as much as we want to go to a good university, they also want good students. And also remember, it's not only impacting us in India, it's impacting all over the world. This year, I would say hardly any of my students have got internships in the last couple of months, and hardly 50% of my students have got jobs in America. This is a new America. So that whole dream of going to America, doing your undergraduate degree, working for 3 years, doing your postgraduate degree, getting a job there, it's all going to change. So be mentally prepared that you will have to come back to India and do a survey of the Indian students out there. I guarantee you more than 50% say we're still looking for a job.
Time for a short break, but coming up, India and US likely to sign the first tranche of a trade deal by the last week of June. Details when we're back. Welcome back. India's industrial output in April grew at a slower rate compared to March. As per data published by the Indian government, the index of industrial production grew by 2.7% on a yearly basis in April. This was the slowest pace of growth in 8 months. Manufacturing activities, which is the largest component on the index, saw an expansion. Electricity production, mining saw a slowdown and contraction respectively. Let's move on. Focus on the India-US trade negotiations. An interim trade agreement between India and US may be finalized by the last week of June. This development comes after Commerce Minister Piyush Goyal visited the United States earlier this month to bolster trade ties between the two nations. Abhimanyu Sharma joins us with the details. Abhimanyu, what are you picking up?
India and the United States are likely to sign an interim trade deal by the last week of June 2025. Now, earlier, it had been indicated by several government sources that both the sides are negotiating a bilateral trade agreement, which they are looking to sign in 3 parts. The first of that is going to be an interim trade deal, which would be followed by the first tranche of a BTA, which both the sides are looking to sign by September or October this year. The third would be a full-fledged bilateral trade agreement in which the approval of the US Congress would also be required, since the current Trump administration does not have the backing of the US Congress to bring tariffs lower than the MFN tariffs. It remains to be seen how early both the sides are going to reach some degree of an agreement. While India has offered several concessions across sectors, but wants to keep issues like dairy and agriculture out of the potential deal, whereas the United States wants all sectors to be covered as part of the deal. India has also sought removal of basic customs duty of 5% to 7% for labor-intensive sectors like leather and textiles, and has also sought a minimum import price on several sensitive commodities to protect the interests of domestic industry. It remains to be seen how early both the sides are going to chalk out a plan, even as both the sides are looking to sign the interim deal before the 9th of July to avert the applicability of reciprocal tariffs.
All right, let's move on to another contentious issue between India and the United States right now. Yes, this is about Apple. India's competitive edge is driving Apple's appetite to assemble more iPhones, despite warnings from Donald Trump to shift the production back in the US. Ashwin Kumar joins us now to decode why Make in India is a more cost-effective option for Apple. Ashwin.
On May 1st, in an earnings call, when Apple chief Tim Cook was asked about plans to make in India, he responded by saying that we do expect the majority of iPhones sold in the US will have India as their country of origin. But even without Tim's confirmation, Apple's India blitz was already visible on the ground with increased Apple production. Here are the numbers. In FY25, Apple production in India clocked a phenomenal $22 billion. That's a YOY growth of 60%. Similarly, iPhone exports for the very same fiscal, that's FY25, came in at 75% YOY growth, clocking $17.5 billion. But outside of these national numbers, the iPhone push was also visible at the retail level. In the Jan to March quarter of 2025, Apple clocked in shipments of an unprecedented 3 million iPhones, and this translates to a YOY growth of 23%, which is remarkable given that the overall smartphone market was down by 6%. But then came Donald Trump's comments, and suddenly all bets appear to be off. On May 15th, Donald Trump issued a statement saying, "I don't want you building in India. They can take care of themselves." He essentially told Tim Cook that he was free to make in India for India, but not too happy about making iPhones in India for the US market. Now, on May 23rd, Donald Trump doubled down, now threatening a 25% tariff on phones made outside of the United States. Now, while Trump was muddying waters, the messaging in India is that Apple is not going anywhere, and this confidence may be stemming from some interesting numbers. For an iPhone retailing at $1,000, Apple takes home about $450. Taiwan provides those chips and therefore takes home $150. As far as South Korea is concerned, South Korea provides for various inputs such as memory chips. They take home about $90. Japan provides camera systems. They take home $85. Suppliers such as Qualcomm and Broadcom, they take home about $80. There are some critical components that come out of Germany, Vietnam, Malaysia. They clock in about $45. And that's where it gets interesting. India, for manufacturing and assembly done here through Foxconn and Tata, India gets only about $30. And even this 30, most of it is given back to Apple in the form of PLI benefits. So essentially, India is a cheap destination to make iPhones. A $1,000 iPhone will mean that India gets only about $30, making up for just about 3% of the retail price. But Donald Trump wants Tim Cook to make America great again by manufacturing iPhones in the United States. But is it that easy? Well, a large part of India's competitive edge is enabled by low cost of labor. On an average, the workers in India get about $230 per month. And let's change the scenario now. Imagine iPhones set up and being made in the state of California in the US. Well, the cost of labor, even by minimum wages standards, would be around $2,900 per month. That difference is 13x the labor cost in India. Now, this spike in labor cost would mean that a $1,000 iPhone is being made in India for $30, while the same in the US should be as high as $390. And this shift will cost Apple heavily. Currently, it clocks a profit of about $450 for every $1,000 iPhone sold. With labor cost as high as $390 per iPhone, the profit margins could drop from $450 all the way down to $60 for an iPhone. Now, this is causing some leading industry analysts to argue that even with a 25% tariff, it would make sense for Tim Cook to continue making in India instead of the US.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Well, it is my great pleasure now to welcome Dr. Raghuram Rajan to our program today. Dr. Rajan needs little by way of introduction, but let me be brief. He is one of the world's most respected economists, currently the Catherine Dusac Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He served as the 23rd Governor of the Reserve Bank of India, where he was widely credited for bringing down inflation, strengthening the banking system and introducing key reforms that have had a lasting impact on India's economy. Dr. Rajan's distinguished career also includes serving as the Chief Economist and Director of Research at the IMF. Dr. Rajan, great to have you with us here on the program. It's an honor, sir. Prashant this side. Dr. Rajan, if I can start by asking you whether, the good news on tariffs, when I say good news, I mean, this handshake type of deal that we saw between the US and China. It's not even a deal, as someone said, not even a framework deal, but at least an agreement to start talking. Or the one with the UK. Have we seen the peak of the good news cycle as far as tariffs go? And will things get more contentious into the rest of 2025? What's your assessment, sir?
Well, I certainly think that what we need to have is more certainty on where the tariffs will land. Right now, we have, as you just said, an agreement to talk. But at the end of this talking, what happens? And talking takes a long time. So even while people are talking, are tariffs going to go back to the Liberation Day level on July 9th, 10th? For the rest of the world, is it going to go back to the Chinese levels on August 10th, 11th? I think the sense is certainly the level of tariffs that were announced in Liberation Day are probably untenable. And so they will have to be negotiated down. But where and when is the kind of uncertainty that harms business considerably also. So a lot of businesses waiting to see, are they going to keep the tariffs, at least while the talk is going on, at the 10% level for most of the world, or is it going to go back up? So some certainty on that would also be most welcome.
Dr. Rajan, when financial markets do well, it kind of papers over a lot of other stuff, some of the underlying issues, etc. And if you look at global, the big markets, they're all a few percentage points away from all-time highs. It's almost as if tariffs really will not hurt. I mean, they're pricing in little to no damage because of tariffs. What is your sense? Is it possible we actually, escape any consequences, or do you think it'll show up? Not now, but maybe a little later.
Well, there is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So when the US raises tariffs on Europe, immediately markets react negatively. The moment there is a discussion of a pause, they react positively. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now.
Just one more question to finish that loop. Do you think the tariffs are being used by the Trump administration as threats to negotiate, or do you think they're very ideological about this? And, as someone said, President Trump, in all likelihood, will not, this is his last term, so it's not as if he's standing for re-election. So he wants to effect change and bring manufacturing jobs, American manufacturing jobs, back to the States. So I think, is this going to be a lasting theme throughout? Or do you think at some point, he's going to give in and then, watch the markets and the good stuff comes? What's your sense?
I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. And that's partly because of the ideological underpinnings of the current administration. They do believe the US has been unfairly treated by the rest of the world, but they also believe that tariffs can give the US a certain amount of sort of playing power. But I also think that right now with the tax bill, the big, beautiful bill under consideration, tariffs also play a role in being a source of revenues.
and the US desperately needs a source of revenues to justify the level of tax cuts that are coming in the bill. So for all those reasons, plus the fact that I think it gives the US a lot of power because it's a big market for the rest of the world's goods, I think they're not going to go back to the old levels. The question is, are they going to be uniform across the board? Or are they going to be especially high for certain countries that are disfavored? And what is the longer-term certainty about the levels that are reached? Could it be that the administration turns on a dime and starts elevating them again for a country that it doesn't like or that has antagonized it? So I think a lot is up in the air, but almost surely we're not going back to the 3% level that the US was happy with before. It will be a higher level of tariffs.
Dr. Rajan, Surabhi here. I'm glad you brought up the big, beautiful bill. I have a two-part question. So we're looking at two very big sort of events playing out right now. One is tariffs and whether the Trump administration can bring manufacturing back to the US or not. The second piece is the US deficit. And the bill is only going to be, boosting that further. In the near to medium term, let's say if you take a 2 to 3 year view, what is the big economic reset that you forecast for the US economy? And the second part of that question is, and therefore, do you expect a flight of money, maybe not a big flight, a small flight of money, away from US assets, US treasuries, US equities?
First, I think the short run tariffs are disruptive. Even to manufacturing. So we will see the consequences in the second half of this year. Will it bring back manufacturing jobs? Probably not a whole lot, because a lot of manufacturing, even in India, has been automated. Look at a cell phone assembly line in India, and you see machine after machine. These are not people screwing in stuff into the motherboard. That job disappeared a long time back. So I think when the jobs come back to the US, to the extent they come back, they have to take into account the high cost of labor in the US, which means it's going to be largely automated jobs. And jobs that will be created will be for technicians who man the machines, not for the guys doing the work directly. So big increase in manufacturing jobs, unlikely. But in the longer run, I think one of the concerns this has created in the rest of the world is, are we overly exposed to the United States? And you can see it in the talk amongst financial investors. 70% of global stock valuation was in the US. And now people are saying, well, maybe we are overly exposed. We need to rebalance our portfolios, both on the equity side, but also on the fixed income side. Are we holding too much in US treasuries? So when you talk reset, I think this portfolio rebalancing will play out for some time. It is one reason why the US dollar hasn't appreciated, even while there are global concerns about economic growth. It's because people are saying, do I really want to put more assets in the US at this point? And many portfolio managers are saying, maybe I need to rebalance, not necessarily because US growth is going to fall off a cliff, but because I just think I am overly exposed to my sense that the US exceptional performance will continue. I think more broadly, we're going to see supply chains move nearer home, wherever home is. That is a process that has been underway, but that'll get a special oomph under President Trump's policies.
Okay, so, sir, do you then see only a mild reset in market flows or in sort of investment portfolios? And what about the deficit? I mean, we're very used to it. Every year there's a debate on the deficit, and then, they sit on the fence. Eventually, the bill gets passed. Just a word on how you see that shaping up, and therefore what happens to yields?
I think it's not a mild reset. I think there is going to be a significant reset, especially as areas like Europe start considering whether they should be spending more, whether they need more financing. And Europe has been sending a lot of capital to the US. As Europe starts doing more infrastructure, as it does more defense spending, some of that financing will go towards financing European asset creation. And so I think there is going to be a global reset in portfolio holdings. And that will also be accompanied by price changes. You're already seeing a somewhat weaker dollar than anticipated at the beginning of the year, and that's something that could possibly continue. So this is on the cards. Sorry, what was your next question?
On the deficit and the direction of US yields, sir.
Yeah, I mean, look, I think the big, beautiful bill is not yet fully done. I think the Senate will have a role to play. And some of the worries in recent days, which has sort of shown up in higher yields, not just for US long-term assets, but also across the world, Japanese long-term bonds. I think people are very wary at this point about being locked in to longer-term investment in government securities, given the uncertainty about fiscal space, both in the US, but also in Japan as well as Europe. So what this means is that you can't take US financing for granted. The US debt to GDP is crossing 100% net in the next couple of years. And add to that a wider fiscal deficit embedded in a big, beautiful bill. And there are some sort of fiscal engineering also embedded in it, which says some of the spending or some of the tax cuts will come to an end at the end of the Trump administration. That is probably unlikely. So when you put it all together, this bill has to satisfy markets that it is not totally irresponsible. And I think the Senate, including the Senate Republicans, will have to play a role there.
Well, I wanted your view on India being able to get a fair share of the global supply chain diversification. Do you think a lot of MNCs will look to set up shop here in India?
Well, it could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them. And if India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment. Of course, industrial countries don't want to see supply chains moving from China to India and not coming back into the domestic market. But if India plays its cards well and doesn't make it front and center all about subsidies, that it is about a better production environment and it offers a very viable alternative. And some of the states in India are very interested in doing this. I think if we can do that, it could be India's moment. But a lot more action is needed, and it has to be proactive, not just reactive. It is about creating a better environment in India for foreign direct investment, something we haven't paid enough attention to in the last few years.
Dr. Rajan, in that context, President Trump's almost warning to Apple, that we've tolerated you making in China, but now come back home. And the iPhones that you sell in America need to be made in America. How much attention should we pay to those kind of statements? And actually, the question is, how much attention will Apple pay, or other large global MNCs pay to something to things like this? Because I mean, companies have got to think beyond 4 years, right? Which is the presidential term.
Right. No, I mean, it would be the rare CEO who wants to cross the Trump administration at this point. But it is a negotiation ploy, not so much ploy, but there is room for negotiation. Apple can point to all the work it's doing in the U.S. and the profits it's generating in the U.S. as a result of its creation of new designs, new intellectual property, etc., and say that the manufacturing is essential in a cheaper place so as to get Trump products out at a reasonable price to U.S. consumers, but also to consumers in the rest of the world. That kind of reasonable argument has to be made, but also it does indicate the importance of not trumpeting the fact that you're coming away from China and putting it in India. There is a lot of value to flying under the radar screen at this point and doing what you need to, but also having a frank discussion with the administration on what can be brought back and what can't. Screwdriver technology, assembly, stuff like that is going to be hard to bring back to the US. But certainly the Apple can say that there's a lot more R&D going on as a result of its ability to sell its products across the world. And that R&D happens in Cupertino, not elsewhere in the world.
I mean, global captive centers here in India has been a huge growth industry with, I think, pretty much all large MNCs here, American and otherwise. Dr. Rajan, let's talk about the trade deals themselves, right? So we've got one with the UK. The US one, I mean, we heard, I think there were some reports saying that over the next 7 to 10 days, we perhaps will get some sort of a framework deal, like an MOU, and then the actual stuff will take more time. What is your sense? I mean, on the India-US deal per se, but more also about these bilateral deals, right? Because these multilateral kind of setups, trading setups are breaking up. It's all sort of one-to-one, country to country. So just wanted your thoughts there.
Well, yes, it is unfortunate that we're not really talking about a global mega deal. But what I do hope is some of these bilateral deals create the kind of momentum which lead a country to think about the bigger picture. It would not be appropriate for India just to do, tariff deals with the US while inhibiting other countries from benefiting from that. It makes sense for US industry to have the same kinds of rights that, for example, European industry has, which then benefits India because it locates production, it buys from production in the best place possible for India. So, these bilateral deals could get converted into a more multilateral deal, and that would make sense from India's perspective. Now, as you said, these bilateral deals are really, interim arrangements, a statement of principles on where the negotiations are taking place. Actual trade deals take a much longer time to negotiate, while there is an impetus to do it quickly. To dot the I's and cross the T's will take more time. But I do hope that, bringing down tariffs with respect to the U.S. gives the impetus for India to bring down tariffs more generally, and thereby reintegrating itself in global supply chains, which it has missed out on. This may be India's moment, and it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way.
That's a strong point, a point very well made, sir, that this could be India's moment. We should not look at protecting specific pockets of industry. We should look at the bigger picture and seizing the global opportunity here. Got your point completely. So moving now to the general sense of, monetary policy and regulation here. We're coming off from a phase where, there was a sense being built up, or there was a sense that, unchecked, unsecured lending had to be regulated, and that was done by the previous governor. And since then, some of those prudential norms have been eased out, and now there's an expectation building in the market that we will be in the era of ample liquidity and perhaps big rate cuts as well. In your assessment, does India right now need that level of a monetary growth kicker?
Well, I don't usually comment on Indian monetary policy. I probably know less than I should about it. But let me set it in the global context. Outside the United States, the raising of U.S. tariffs has been a negative demand shock. There's less demand for goods produced by the rest of the world because of the U.S. Tariffs. But also, it does give countries like China, which are big manufacturers, the incentive to look for new markets, which is also going to hold down the price of goods. China is going to look to Europe, to India, to other places to send some of the goods that are not going into the US. So all this means that inflation is less of a problem. Of course, there are in India specific reasons why inflation has come down, including the prospect of a good agricultural crop going forward. So for all these reasons, I think countries outside the United States have the ability to ease monetarily, and if that also implies easing on the liquidity front, that's a good thing. But as you caution, we have to also make sure that as we are enhancing domestic demand, it doesn't get imbalanced. We don't see pockets of excessive credit growth as we saw with the unsecured lending. We have to be a little careful as we expand, once again, that credit is reasonably well allocated, which means a continuing role for careful supervision and regulation.
Dr. Rajan, wish we could go on, but I understand you also have a tight schedule there at the UBS conference. I'm going to just ask you one last, if you will humor me, sir. You're at the UBS conference and you're meeting so many investors and so many people who are there. As you kind of sort of soak in all the feedback and all the commentary there, can I get one big non-consensus view from you, sir? What do you strongly disagree with that from everything that you've heard there? If I can ask you that.
Well, let me put it this way, consensus tend to build up, and because they're the consensus, they tend to be wrong. The consensus at the beginning of this year in places like Davos was, U.S. exceptionalism, this is going to continue. And we've seen 5 months later that, it's going the other way. there's enormous skepticism about the US and its policies. And I would say that's again a reason to rethink that that maybe all this plays out in a reasonable way, and at the end of it, there is still some sort of faith in U.S. exceptionalism, the innovation, the energy in the U.S. Is still maintained, maybe at a somewhat weaker level. You won't see that in current U.S. policy. There is a lot of ferment going on in the U.S. Administration is trying to do one thing. The courts are trying to do something else. Things will settle down. But if there's one consensus right now, it is everything else is moving up. The U.S. is moving down. And maybe this consensus will prove to be wrong.
It's lovely. And I think it's something we should pay attention to, and we'll keep the back of our mind when we conduct these interviews, because you're absolutely right. That seems to be the prevalent consensus view at this point in time. Dr. Rajan, we'll leave it at that. Thank you very much for taking out the time and joining us here on CNBC-TV18. It's a pleasure, sir, and hope we can do this again soon. Thank you.
Thank you.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The U.S. halts student visa appointments as the Trump administration looks at expanding social media screening of applicants. A U.S. Embassy spokesperson tells CNBC-TV18 students can continue to submit visa applications and scheduled appointments will not be impacted. India and the U.S. likely to sign the first tranche of a trade deal by the last week of June. The director of U.S. Economic Council, Kevin Hassett, says India is close to the finish line.
It could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them.
Former RBI Governor Raghuram Rajan says this could be India's moment if it lays out the red carpet to draw foreign direct investment with proactive policies. Adds India must use trade negotiations wisely to seize the opportunity. That's an exclusive. The Sensex and the Nifty end with minor cuts after a range-bound session. Bank stocks bucked the trend. Mid-caps relatively outperformed the blue chips. British American Tobacco trims its stakeholding in ITC with sale of shares worth over 12,000 crore rupees. This comes a day after another 12,000 crore rupees stake sale in Indigo by co-founder Rakesh Gangwal as promoters continue to cash in. The government hikes the minimum support price for the Kharif crop by 7% compared to last year. Rabi gets the highest hike of 14%. The government also imposes stock limits on wheat. The co-founders of EdTech firm Unacademy set to exit the company. Sources say Gaurav Munjal and Roman Seni are in talks with the board to spin off the language learning app AirLearn as a separate company. Also on the show, India's competitive edge is driving Apple's appetite to assemble more iPhones despite warnings from President Trump. We analyze why Make in India is more cost-effective for Apple. Well, let's go straight to the top story this evening. President Trump has ordered embassies to stop scheduling new appointments for student visas. Now, this as the U.S. government prepares to implement comprehensive social media screening for all international applicants. Scheduled appointments are expected to go ahead as per plan. The U.S. State Department spokesperson Tammy Bruce said that students, tourists, or any visitor to the U.S. will be screened thoroughly. Take a look.
We use every tool in our tool chest to vet anyone coming in who wants to come into this country, and in order to do so, it has to apply for a visa to gain access to our nation. So every sovereign country has a right to know who's trying to come in, why they want to come in, who they are, what they've been doing, and at least hopefully within that framework, determine what they will be doing while they're here, whether they be student or if you're a tourist who needs a visa or whoever you are, we're going to be looking at you. I think why that would, it seems to be such a controversial thing that's going on, but it shouldn't be.
And the U.S. Embassy in India has responded to President Trump's crackdown on student visas. Responding to a CNBC-TV18 query, the embassy spokesperson has said that visa applicants may continue to submit their applications and scheduling of non-immigrant visa interview appointments is dynamic. Parikshit standing by now with more details. So Parikshit, take us through what the embassy is saying and what all of this really means now for students specifically who are waiting for appointments.
A move that has sparked worries among students who are planning to apply to universities in the United States. The Trump administration has ordered embassies to stop scheduling appointments for student visas as it prepares to expand social media vetting of applicants. According to reports, an internal memo sent to all diplomatic missions, signed by the Secretary of State Marco Rubio, says that there will be a pause on all appointments until further guidance is issued. The memo says that social media vetting would have to be stepped up for student and foreign exchange visas. CNBC-TV18 reached out to the US Embassy in Delhi to confirm this and also for a response. The spokesperson said that the State Department does not comment on internal communications, but all visa applicants may continue submitting applications. When it comes to scheduling of non-immigrant visa interview appointments, the US Embassy in Delhi said that the situation is dynamic and depends on the time required for consular officers to adjudicate cases before them for full compliance with the US law. Consular officials will be working to ensure that applicants don't pose a risk to the United States. Also, consular officials constantly adjust schedules to make sure they have sufficient time to vet cases before them. We also learned that US State Department has been asking visa applicants to provide their social media handles on both immigrant and non-immigrant visa application forms since 2019. Now, just for context, in 2023-24, the total number of international students in the US increased by 7% to a record high of 1.1 million students. Indian students accounted for 29% of total enrollments and were the largest international student community. Their numbers increased by 23% over 2023. International students accounted for 5.9% of the total US higher education population of 18 million students. According to a report by the Association of International Educators, international students at colleges and universities in the US contributed $44 billion to the US economy during the 2023-2024 academic year and supported more than 378,000 jobs.
Parikshit, many thanks for joining us. Let's now delve deeper into the issue. How will the Trump administration's crackdown impact prospects of Indian students eyeing a seat in American universities? Remember, as Parikshit was pointing out, India accounts for 30% of the international student community in the US. Shilpa joins us now to bring us a quick pulse check. Shilpa, you've been talking to experts. What are they telling you?
Well, you know, the pause on the new student visa interviews has caused somewhat of a panic amongst prospective students in India who have already secured admissions and are set to start college in August to September. Now, most of these students would have already finished their admission process, their loan documentation, and just have the student visa application process left. Now, we spoke to some education consultants, some students and parents, and the sense that we're getting is that students and parents are worried that not getting the student visa at this juncture would mean that they will have to defer their admission by a semester or even take a gap year. Because, you know, at this point in time, it is also too late to consider other options in other countries unless you already have backups. Because in other countries, most deadlines for college applications, especially in Europe, etc., have already passed. Now, all overseas education consultants are also now advising all prospective students to keep their social media profiles, what they call, clean, and to avoid any political commentary, to avoid any issues with the visa going forward. Now, even students who are already studying in the US are also anxious and fearful of any behavior actions that could be deemed as potentially violating visa norms, and also about their careers after finishing college amongst this current situation. And as for students who are still in their planning stages, consultants say that many parents are now inquiring about colleges in other countries like UK and Australia, citing lower risk and better stability. Now, why this is significant is, like my colleague pointed out, that Indians at 29.4% account for the highest number of international students, and this is followed by China and Korea. Now, currently, there are about 3.3 lakh Indian students who are studying in the US as well, and this is a number that has been consistently growing over years. And despite uncertainties, US is still the most preferred destination for overseas education, and many consultants say that this uncertainty is largely temporary in nature. Now, my colleague Reema Tendulkar spoke to an educational consultant, Viral Doshi, about this. Listen in.
US colleges depend on international students, both financially and for the well-being of the university. So it has to be sorted out. Not even the embassies know what is going to happen. So it's going to be something that's going to come out from the administration, and it will be a question of time. So be patient, and I'm sure the patient will be rewarded by interviews in the next 2 months. Nothing to worry. This sort of issue, what they're looking at, of looking at policy on social media, I'm sure will be sorted out. I'm quite confident of that, because as much as we want to go to a good university, they also want good students. And also remember, it's not only impacting us in India, it's impacting all over the world.
Well, a fair degree of uncertainty there, especially when it comes to students being able to access visas to get to universities in the US. And staying with the US, students of Harvard University held a protest against the Trump administration's crackdown. Hundreds of students were seen gathered inside the university after the US government announced it will cancel all federal contracts worth $100 million with the university. They were also protesting Trump's move to block the enrollment of all international students. Remember, the university sued the Trump administration last week after they were given 72 hours to respond to a list of demands laid out by the Department of Homeland Security. An interim trade agreement between India and the US may be finalized in the last week of June. This development comes after Commerce Minister Piyush Goyal visited the US earlier this month to bolster trade ties between both nations. The director of the US National Economic Council, Kevin Hassett, has said that he had met Indian officials and that India is close to the finish line.
I won't talk about a specific country, but I have been meeting with Indian officials. I had dinner with the ambassador a little while ago, and I think, and JD went over there and made a huge amount of progress. Thank goodness for the vice president. So yeah, I would say that it's one of the ones that's on the list of it's close to the finish line.
Close to the finish line, and we are expecting at least the first tranche of the India-US trade deal to be closed by the end of June. Now, India's Foreign Secretary Vikram Misri met US Undersecretary Jeffrey Kelser to boost cooperation in critical and emerging technologies. The two officials also discussed early convening of the India-US Strategic Trade Dialogue to deepen tech and trade collaboration. Misri is in the US till the 29th of May. Let's talk about the markets now. Minor cuts today after a range-bound session, the Nifty ending below the 24,800 mark. The Nifty Bank, though, closing in the green. The Sensex was down by about 240 points. A flat close there for the Sensex, and the Midcap index closing just about in the red. Former RBI Governor Raghuram Rajan says India's moment is here to capitalize on shifts in the global supply chains as companies search for longer-term opportunities beyond America. Speaking exclusively to CNBC-TV18, Rajan said that India can seize the opportunity by laying out the red carpet to draw foreign direct investment with proactive policies. Take a look.
It could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them. And if India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment, and it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way.
Well, that's the former RBI Governor Raghuram Rajan. Now, shares of ITC slipping in trade today. This after British American Tobacco, BAT, sold 2.57% equity in the company. The transaction is worth 12,000 crore rupees at an average price of 400 rupees per share. BAT has said the proceeds of the sale will provide greater financial flexibility for the company. BAT will, of course, continue to hold 23% in ITC, but a big block being done there. We told you first, and it is now official, Hero FinCorp has secured SEBI's approval for its 3,700 crore rupee initial public offering. The market regulator is also set to clear 2 more major IPOs. Sources tell CNBC-TV18 this includes HDB Financial's 12,500 crore rupee issue, which could be the largest NBFC listing in recent times. Ritu's here with more on these potential listings. Ritu.
Well, big moves in India's primary market with 3 IPOs getting SEBI's green signal. And first of the block is the much-awaited $1.5 billion HDB Financial IPO, which is set to get SEBI's go-ahead very soon, paving the way for one of the largest IPOs that we're going to see from any NBFC in recent times. The offer will comprise of 2,500 crores of fresh issue and 10,000 crores offer for sale by the parent, HDFC Bank. Now, while HDB had filed its DRHP in October last year, the offer, we understand, was under SEBI scrutiny over a potential violation of Companies Act, which related to a private placement of shares to more than 50 employees of HDFC Bank, which has since been resolved. Keep in mind, HDB Financial will have to list by September in order to comply with RBI's upper layer NBFC regulations. Apart from that, if RBI's 2024 draft circular on bank subsidiaries is finalized, HDFC Bank, which owns more than 94% stake in HDB, will also eventually have to bring its stake to below 20% to comply with the norms. And that's another reason why this IPO is crucial beyond just the size. Now, apart from HDB, as we have been reporting, and it is now confirmed, SEBI has given a go-ahead to Hero FinCorp's 3,668 crore rupee IPO, which was filed in July last year and was facing delays because of compliance-related questions for unlisted entities. Hero FinCorp, remember, is backed by Chris Capital and, of course, part of the Hero Motor Corp group, and its offer will also comprise of a fresh issue along with an OFS. Then we have Vikram Solar, one of India's leading solar PV module manufacturers based in Kolkata, also getting the go-ahead. Its papers were filed in September last year for a 1,500 crore rupee issue. And finally, an update on the Tata Capital IPO, a mega 15,000 crore rupee IPO. The company had filed its papers with SEBI just last month, so this may take some more time, but the clock is ticking for them because Tata Capital is also under RBI's upper layer NBFC listing mandate with a deadline of September to go public.
Well, plenty of activity expected there as far as IPO corner is concerned. Ritu, many thanks for joining us. Decisions being taken by the Cabinet today. The government has hiked the minimum support price for Kharif crops by 7% year-on-year. The MSP of ragi has seen the highest increase of 14%. The government has also imposed stock limits on wheat. Manisha standing by to explain to us what all of this means. Manisha, decision by the Cabinet there. Take us through the impact.
Well, yes, the government has hiked the MSP of 14 Kharif crops for the marketing season 2025-26, and this comes quite timely because the sowing is just about begun. And this also is an good year because we're looking at a monsoon forecast of above normal at 106% of LPA. So one, it's timely, the announcement of MSP. Second, the sowing will get impacted because of this, because we're looking at good monsoon and very strong MSP numbers as well coming in. Also, the government procurement in the last couple of seasons has been quite strong. So with higher MSP, better sowing could be done, and that would mean that the government, as has mandated, that many of these crops would be procured at MSP or even at market prices for that level is on the higher side. Just to give you a sense on a couple of these crops where we have seen the highest MSP come in. By the way, it's anywhere between 50 to 68% on the higher side from cost of production. So the numbers in that sense are good. But the best of MSP clearly has come in from Niger seed, up by nearly 820 rupees per quintal, and 500 to 600 rupees a quintal of a gain has been given to ragi, cotton and sesame. Strong numbers is what we're also looking at in sense of maize, because remember, a lot of maize is now getting used for ethanol as well, apart from feed and food as well. So fuel is yet another reason that you have seen maize consumption growing up, and we've seen MSP hike quite strong on that. Pulses MSP hike has been on the higher side as well, and this is where the government has been talking about self-reliance in pulses production by the year 2030. So this step perhaps comes in that direction. And then in sense of edible oils, we've seen soybean, groundnut also given a very high MSP there. It's good monsoon, good MSP and strong government procurement are a few cheers that the farmers clearly are looking at this point in time.
Manisha, many thanks for joining us. We will head into a break, but up next, the co-founders of EdTech firm Unacademy set to exit the company. That and more when we return. In international news, Israeli forces have continued to bombard Gaza, killing at least 8 people. This has taken the total death toll to 15 just since dawn. Israeli military has also opened fire on crowds who rushed to an aid point run by the controversial Gaza Humanitarian Foundation. At least 3 people were killed, 46 injured at the scene. Russia said that a major Ukrainian drone attack on Moscow led to the suspension of flights from 2 airports. The defense ministry said 112 Ukrainian drones targeted 6 different regions in the 3 hours up to midnight. Meanwhile, Russian drones hit the Ukrainian city of Kharkiv, injuring 8. The co-founders of EdTech firm Unacademy are set to exit the company that they founded. Sources have said that Gaurav Munjal and Roman Seni are in talks with the board to spin off the language learning app, which is called AirLearn, as a separate company. Rachna standing by with more. Rachna, what does this mean for Unacademy, with the founders looking at a possible exit?
Well, Unacademy, once a high-flying edtech unicorn, is now undergoing a deep leadership and strategic reset. Co-founder Gaurav Munjal has stepped down as CEO, and Roman Seni, another co-founder, is also exiting from active duties. The reins have now passed to Sumit Jain as the company doubles down on its pivot to physical learning centers and its language learning app branded AirLearn, moving away from the online test prep segment that originally made Unacademy a household name. So this isn't just a leadership shuffle. It's a culmination of mounting pressures over the last 2 years. Back in April 2022, Unacademy terminated around 1,000 full-time and contractual staff. A year later, in March 2023, another 350 were let go, including members of the leadership, tech and online test prep teams. By August and October 2023, COO Vivek Sinha and CFO Subramaniam Ramchandran had also resigned, indicating a steady churn at the top. Funding has also been tight, despite marquee investors like Facebook, Bloom Ventures, Nexus Partners, General Atlantic, Sequoia Capital and Peak 15 backing the company. Unacademy has struggled to secure fresh capital. It was last valued at $3.4 billion, but hasn't raised funds since August 2021, when it secured about $440 million, bringing to total funding to $880 million. Internally, Unacademy has tried to reassure stakeholders. In December 2023, Gaurav Munjal claimed that the company had reduced cash burn by 60% and had a runway of over 4 years. And in July 2024, he tweeted that Unacademy was poised for its best year in terms of growth and profitability, asking people to ignore the rumors at the time. But the ground reality tells a more complex story. In the funding boom of 2020, Unacademy made about 12 acquisitions to expand its reach. By most accounts, many of these acquired companies have either shut down or become dormant. While Munjal initially dismissed such assessments, he later admitted that Unacademy would narrow its focus to just 2 or 3 core projects. Crucially, online test preparation, once its flagship segment, is no longer among those core bets. The company's future now hinges on its offline pivot or through AirLearn, a major strategic departure from its digital-first origins. Now, according to sources, over the past 2 years, Unacademy has also held unsuccessful bailout talks with players like Allen, PhysicsWala, K12 Techno, Bodhi Tree Systems, Veranda Learning, as the pressure to restructure and find new growth avenues have mounted. Sources also tell CNBC-TV18 that the company still continues to look for a bailout. Now, as Sumit Jain takes the helm, all eyes are on whether this reset can bring Unacademy the stability and credibility it needs in a far more cautious edtech landscape in the country.
Rachna, many thanks for joining us. Another troubled firm there in India's edtech sector. India's competitive edge is driving Apple's appetite to assemble more iPhones. This despite warnings from US President Donald Trump to shift production back to the US. Ashmit joins us now to decode why Make in India is more cost-effective for Apple. Ashmit.
On May 1st, in an earnings call, when Apple chief Tim Cook was asked about plans to make in India, he responded by saying that we do expect the majority of iPhones sold in the US will have India as their country of origin. But even without Tim's confirmation, Apple's India blitz was already visible on the ground with increased Apple production. Here are the numbers. In FY25, Apple production in India clocked a phenomenal $22 billion. That's a YOY growth of 60%. Similarly, iPhone exports for the very same fiscal, that's FY25, came in at 75% YOY growth, clocking $17.5 billion. But outside of these national numbers, the iPhone push was also visible at the retail level. In the Jan to March quarter of 2025, Apple clocked in shipments of an unprecedented 3 million iPhones, and this translates to a YOY growth of 23%, which is remarkable given that the overall smartphone market was down by 6%. But then came Donald Trump's comments, and suddenly all bets appear to be off. On May 15th, Donald Trump issued a statement saying, "I don't want you building in India. They can take care of themselves." He essentially told Tim Cook that he was free to make in India, for India, but not too happy about making iPhones in India for the US market. Now, on May 23rd, Donald Trump doubled down, now threatening a 25% tariff on phones made outside of the United States. Now, while Trump was muddying waters, the messaging in India is that Apple is not going anywhere, and this confidence may be stemming from some interesting numbers. For an iPhone retailing at $1,000, Apple takes home about $450. Taiwan provides those chips and therefore takes home $150. As far as South Korea is concerned, South Korea provides for various inputs such as memory chips. They take home about $90. Japan provides camera systems. They take home $85. Suppliers such as Qualcomm and Broadcom, they take home about $80. There are some critical components that come out of Germany, Vietnam, Malaysia. They clock in about $45. And that's where it gets interesting. India, for manufacturing and assembly done here through Foxconn and Tata, India gets only about $30. And even this 30, most of it is given back to Apple in the form of PLI benefits. So essentially, India is a cheap destination to make iPhones. A $1,000 iPhone will mean that India gets only about $30, making up for just about 3% of the retail price. But Donald Trump wants Tim Cook to make America great again by manufacturing iPhones in the United States. But is it that easy? Well, a large part of India's competitive edge is enabled by low cost of labor. On an average, the workers in India get about $230 per month. And let's change the scenario now. Imagine iPhones set up and being made in the state of California in the US. Well, the cost of labor, even by minimum wages standards, would be around $2,900 per month. That difference is 13x the labor cost in India. Now, this spike in labor cost would mean that a $1,000 iPhone is being made in India for $30, while the same in the US should be as high as $390. And this shift will cost Apple heavily. Currently, it clocks a profit of about $450 for every $1,000 iPhone sold. With labor cost as high as $390 per iPhone, the profit margins could drop from $450 all the way down to $60 for an iPhone. Now, this is causing some leading industry analysts to argue that even with a 25% tariff, it would make sense for Tim Cook to continue making in India instead of the US.
Well, Ashwat, many thanks. Well, those are the numbers that Tim Cook is perhaps trying to convince Donald Trump with on why Apple cannot shift its manufacturing base entirely to the US at this point in time. It just will not make business sense. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay with us. We're back in a moment.
Welcome to Startup Street. I'm Ritu Singh, and with me is Arundhati Ramanan. Here are the top headlines from the startup space. Myntra secures $124 million from Singapore-based parent entity FK Myntra Holdings. This comes at a time where the company expanded its services to the Singapore market and follows Flipkart's earlier investment worth $81 million in Myntra's Singapore holding firm.
Gaurav Munjal to step down as Unacademy CEO, Roman Saini to exit active role. Sumit Jain takes charge as Unacademy focuses on physical centres via Airlearn. VCs question Munjal's sudden exit, calling it irresponsible. Board unanimity is under the lens. Sources tell CNBC-TV18.
Sarathi Finance, a newly licensed greenfield NBFC, has announced the successful closure of its inaugural funding round, raising a total of 475 crore rupees. The funding round was led by prominent investors, including TVS Capital Funds, Low Capital, Evolvence Equity Partners, Paragon Partners, and Angels, collectively contributing 350 crore rupees.
Protective farming agri-tech startup Growit India has raised $3 million in a Series A funding round led by GVFL with participation from Velos Opportunities Fund, Jito, We Found a Circle. The funds raised will be directed towards Growit's aggressive expansion plans, deepening its R&D capabilities and strengthening its technology infrastructure.
Microsoft and Yotta Data Services join hands to drive artificial intelligence adoption in India. Under this, Microsoft will bring its Azure AI services to Shakti Cloud, which is Yotta's AI cloud platform, to offer advanced capabilities to developers, startups, enterprises, as well as public sector organizations in India.
Those were the headlines that we're tracking for you from the startup world. But on what's brewing today, the co-founders of edtech firm Unacademy are set to exit the company. Sources have said that Gaurav Munjal and Roman Saini are in talks with the board to spin off the language learning app Airlearn as a separate company. Rachna Dhanrajani joins us now with more details. Rachna, what does this mean for the company now?
Unacademy's Gaurav Munjal's decision to step back from day-to-day responsibilities has caught some investors off guard. Speaking to CNBC-TV18 on conditions of anonymity, a leading venture capitalist involved with the company expressed deep concern over the abrupt shift. Founders often reassess their journeys, especially when they feel they have multiple options ahead of them. But this isn't just a pivot. This feels like walking away from accountability after raising over $1 billion. The investor quoted to CNBC-TV18. The source emphasized that Munjal, until recently, had been actively communicating company's performance and was deeply involved in operations. The investor added that to go from that to saying, I don't care what happens, bring in whoever you want to run the company. Now that's bizarre, the investor said. You don't see founders at this scale opting out like this, they added. Concerns have been flagged around governance issues with questions on whether the board was unanimous in this transition.
Well, that was Aishwarya reporting on the venture capital, one of the investors' reaction to Gaurav Munjal and Roman Saini deciding to step down as, active founders on Unacademy. Now, moving on to what else is brewing today, digital healthcare platform Practo has launched operations in the UAE and claims to have more than 31,000 doctors and 3,000 healthcare facilities that are discoverable on its platform there. This launch also builds on Practo's 10+ years of presence in the region through Insta by Practo, which is their hospital management software, and the company is now expanding the footprint to consumers with more than 50,000 monthly users already accessing their platform in the region. For more on the significance of the development, joining me now is Shashank ND, the co-founder and CEO of Practo. Shashank, welcome to Startup Street. Thanks very much for your time here. Let's begin by, answering what really were the key factors that made UAE the next logical international market for you and the expected boost to business you get from expanding in that region.
Thank you. Good evening, and thank you for having me over. Practo has been on the journey of improving health outcomes for over a decade. And the last year has been a very transformational year for Practo. We turned profitable in the last quarter of FY24, and the full year of FY25 was a fully profitable year for Practo. And post this, we've been always looking for more growth opportunities, and UAE presented itself as the perfect location where the Indian diaspora, Indian doctors, medical tourism, a lot of these factors played into our thoughts of expanding from India to add UAE to our consumer portfolio. We've been live now for many months, and the response from both consumers and providers has been really heartening. As you mentioned, already on an annualized basis, we are seeing close to 500,000 users coming in. And this only goes to show that what technology we built for India is now serving the needs of multiple countries.
All right. Well, Shashank, I read that you say that you have about 13 crores in GMV and about 250 plus paying customers in UAE already. How do you expect this number, both in terms of customers and revenues, to evolve in the next 12 months or so?
Yes, absolutely. I mean, 250 plus customers, and just to correct you there, we've actually just missed to add there that it's close to being 10 crores monthly right now. So we are trading at close to 100 crores on an annual basis from a GMV standpoint. And over the last and just from a revenue standpoint, we are closing on over $200,000 on an annualized basis. So yeah, a very, very exciting last few quarters for us in this market and region. But it just goes to show that we're going to double down on this region. We have expanded and launched in Dubai, Abu Dhabi, and Sharjah, and almost 10% of the population is already using us on an annualized basis. So it's an exciting and promising start. But all I can say is that this is the first stop of Practo in its global expansion. We definitely look to add more countries after we stabilize this one.
And what are those countries, Shashank, that you're looking to add to once you stabilize the new entry in the UAE region?
We certainly see our solution, which is to help provide the best possible matching the consumer need to the right healthcare provider as the need that's there across the globe. So as you can see, Dubai and the region of UAE were one of the first few developed markets that we entered. We expect to enter more developed markets because this need comes in handy when there's a choice in front of the consumer, and the consumer can then opt for the best solution that offers the best health outcome for him or her. So we expect to be in more developed markets, and I think that is something that over the next few months we should be rolling out.
Which developed markets are you talking about, Shashank?
I'll try to hold that close to my chest right now. We always pilot. We're already piloting a few countries right now.
Sure.
And we'll share them once we are extremely sure of how the consumer as well as the supply response has been. So as we speak, we're in a few markets where the pilots are running, and once we've established them in its full force, we'll definitely come and share more. It will be certainly developed markets, and you should be hoping to hear from us in the next few quarters.
Well, let me then move back to this cross-border continuity of care as your proposition then, and especially in the light of you looking at more developed countries to enter into. Can you elaborate on how Practo is integrating, integration rather between Indian and, for now, UAE healthcare systems for patients as well as providers?
That's a great question. First thing for in healthcare is that trust needs to first be established. So trust will only emerge when you're able to serve the local population with their local providers. So the first thing that we've done in the UAE is to make sure that local doctors, local hospitals, local clinics are now available for the consumer in UAE to choose from. So that's where the first stage is, and that's where we are right now. As we gain trust in the market, we then are able to address the needs of that geography and connect them to the providers that are there in India. So that could be either the Indian diaspora, who often travel back to India for their healthcare treatment, or the local diaspora of UAE who wish to get more sophisticated and advanced treatments done in India. And similarly, in other markets, our first protocol would be to establish trust in that ecosystem by connecting local population with local doctors and hospitals and clinics, and then post that explore options of both value-based medical tourism or even advanced medical tourism as deemed fit. Once this is also established, we also venture into providing teleconsultation services. I think the Indian doctors are some of the best in the world. They're renowned for their knowledge and skill, and we want to make sure that Indian doctors get access to patients across the globe to serve. So those are the phase-wise manner in which we unlock our value propositions for any given market.
Well, Shashank, very briefly, how much of your business could come from these, international markets in the future as you plan this expansion?
I think, Practo has been providing B2B solutions to more than 20 countries. Today, already 20% of our revenues comes from international, but that's B2B business and not from B2C. Our today's launch is to provide B2C solutions now. Very, very proud moment for an Indian consumer internet platform to expand globally. And so through that, we are able to reach out to more people. On this front, we expect that this 20% that's there, would ideally move towards 30-40% over the coming years. We certainly see a very, very big opportunity in this vertical of consumer internet in the healthcare side. If you think about it, in the logistics space, you have multiple global players as well as Indian players. But when it comes to digital healthcare, you'll find very few players, especially in the provider marketplace. And that's where we feel a very big opportunity for Indian company like us to fill in the opportunity.
All right. Well, running out of time, Shashank, very briefly, you've turned profitable recently and you have positive cash flows now. How is that financial stability informing your investment appetite in the Middle East? And does your budget allocation, what does that even look like when you're planning these kind of international expansions in the consumer space?
It's a great question. So, one of the main reasons we started to expand was only after we turned profitable that we started reallocating started funding our new expansion projects. And this profitability that we are now reporting for FY25 is after the investments that we have made for expansion. So we believe that our ability to expand globally will be taken care by internal cash flows, and that's how we see the company moving forward. The company will remain profitable and fund its expansion globally.
Well, Shashank, plenty more to talk about, but unfortunately, we've run out of time. Thank you so much for joining us here today, and we wish you the best with your UAE expansion.
Thank you so much.
Moving on the Investor Eye, India's startup engine just got a fresh boost. 247 VC, a new seed stage fund founded by two veteran operator VCs, has launched its 250 crore rupee India Fund 1, aiming to back 30 daring startups over the next 3 years with a sharp focus on themes like deep tech, consumption and Industry 5.0, and a track record of 70x returns from early bets. This fund promises high conviction capital and hands-on founder support. To decode their investment theses, founder filters, and why they believe this is Bharat's decade. Joining me now to discuss this further is Yagnesh Sangarajka, the founder and managing partner at 247 VC. Thank you so much for joining us on the show today. You've launched this maiden fund and you're targeting 30 startups in 3 years. If you could talk to us about how you'll, pick the startup. You've also mentioned backing bold insurgents, rewiring Bharat's destiny. What specific founder qualities or ideas are exciting you the most right now?
Well, a lot is happening. I think, the startup ecosystem has kind of matured. Firstly, thanks for having me on the show. We are looking at founders now of a different breed than what was coming to us in 5 years back when we started our earlier fund. Now we are seeing founders which are matured. They understand the ecosystem, challenges of the system, and that kind of brings us to very high quality founders. And that's what we are looking for. Somebody who has the conviction and the persistence to stay on the course. And that is what is most important in early stages. And I would say, this is rather a skill than anything else. It's more of an art than science.
Sure, it's more of an art than science. But, if you could sort of tell us while launching this fund, right, what's the kind of appetite that you're seeing for Indian startups? Like you said, it's a matured ecosystem now, but, lots of seed stage companies looking very exciting there. Are investors still excited about this round of funding? And, when will we see you close the first round?
Well, I'll answer the first question and then, of course, the first close. We are looking at various themes here, as I said, and what kind of startups are we looking at? A lot of deals have come through. In fact, just in a week of our launch, we already have more than 500 opportunities reaching out to us inbound. So I think good quality deals will have to be picked up. The essence will be on deal selection. I think that is going to be very important going forward for us. And we're hoping that with the traction that we have, I think the first close is very close. I think in a quarter or 4 months, we are looking at our first close. We don't know what that amount is right now, but depends on the investor appetite. And a lot of investor appetite is increasing. I think the numbers and the stats of funding will support this. And, the ecosystem is getting more and more buoyant as we go forward. The funding stats are also, much buoyant here.
Right. And what will the check size of these investments be? Have you already, identified any startups that you hope to deploy these funds to? When will we see you start making these deployments?
Yeah, so as per SEBI rules, as you would know, Arundhati, normally the investment starts after the first close. So that's why we're hoping that if we can do closer faster, we can start deploying. However, from the pipeline that we already have, we have some very interesting themes that are coming out, and we are shortlisting startups like in the space of Industry 5.0, which kind of includes logistics, supply chain, energy savings, drone tech, 3D printing. Some of these ideas are coming to us, and we are shortlisting them. And we feel very excited and waiting for our first close so that we can start deploying.
All right. And, like you mentioned, right, consumption, deep tech, enterprise tech, and Industry 5.0 are your broad themes. If you could take us through why these sectors are looking the most exciting for you guys?
I think, as India is converting itself into a developed economy in another 20 years, currently the opportunities are many, right? And these 4 sectors we feel pretty much cover all the innovation that is happening in India. So, for example, in frontier tech, you're looking at deep tech, climate tech, biotech, which are emerging areas where founders are taking bets and putting their careers at risk and building stuff. And this kind of innovation, India needs more and more seed funds to kind of come in and back these founders. And you will see the next decade, and as I call it, this is like the startup wave 2.0. First wave was between 2012 to 25, and you're looking at next 10 years to be the startup wave 2. And this will bring to fore much more companies which will turn unicorns very soon. And we hope we get a couple of them from our 30 portfolio.
All right, Yagnesh, we're completely out of time, but thank you so much for joining us on the show today. And we wish you all the best with these funds and hope to speak to you soon when you do have that first close.
Thank you so much. Thanks for having us.
Absolutely. On that note, it is time for a short break. But coming up next, D2C home care brand Coparo has raised nearly 15 crore rupees in an extended pre-Series A funding round. We speak to the founder, Simran Khara, on the other side. Stay tuned.
Welcome back. You're watching Startup Street. Now, millennials and Gen Z are shifting to eco-friendly home and personal care products like your detergents, floor cleaners and hand washes, etc., ditching traditional brands and opening doors for new age startups. One such brand is Coparo, which raised 14.5 crore rupees in an extended pre-series A round earlier in the month of March. My colleague Aishwarya Anand caught up with the founder Simran Khara to discuss the fund allocation plans, the pricing strategy, demand trends in the market, and a whole lot more. Take a look at that conversation.
You've recently raised 14.5 crores in your extended pre-series A round. Help me understand where have you allocated, what are the plans of allocating those funds, and give us a sense of your business model.
We're a toxin-free cleaning brand. We make products like utensil cleaners, like floor cleaners, like liquid detergent. So basically any surface of your house that you need to clean, you can now clean toxin-free using Coparo products, and that's sort of why we exist. Our name is Coparo, comes from the root word copra, which is coconuts, because we use coconut-based surfactants and a bunch of plant-derived ingredients, which are far safer than, you know, the ordinary run-of-the-mill routine legacy brand offerings that you have. And the idea is over the next couple of years to continue to offer world-class products, do it across profitably, you know, across multiple channels, right? And each of these requires more and more investments in brand, more and more investments in working capital. So it will go towards a combination of working capital and towards marketing, because we are fundamentally actually quite a lean team and our margin profile is healthy.
Tell us what are the top 3 selling products on the platform, and what does an average cart value order would look like?
My top products are, my number 1 product is my dish gel, second product is my liquid detergent, the third is the floor cleaner, and the fourth is the hand wash, right?
Okay.
Together these are about 72% of my overall revenue. We sell on Amazon, we sell on Blinkit. Over there obviously I don't have a sense of what the cart values would be, but on my own website, which is like about 31-32% of overall contribution for me, our AOVs are upwards of 960 rupees.
And any plans of partnering with B2B players?
We're happy to partner with B2B players. I think now is the time where, you know, we have established some trust on the B2C side, and I think certain partnerships, basically like-minded B2B players who care about protecting their surfaces, who want to reach a higher sort of standard on sustainability, who are bothered about such things, would be the right partners for us, right? Okay. It could be schools, it could be certain chains of hotels and things like that, as could be co-working spaces. So we will look at that opportunistically, but obviously the bread and butter is a consumer brand which is facing, you know, consumers. But of course, these are newer revenue pools, and you know, these are more profitable revenue pools, and these are repeat revenue pools.
I want to understand, what does your demography look like? I mean, where are you getting most of your consumers from? And if I can say this, you're playing in the mass premium range, or you're in the premium range. How do you position yourself?
So I think we're in the mass premium range from a price point perspective, right? Like if I was to just sort of strictly say, if you know, a Vim or a Surf Excel or a Lysol are X, we're probably a 1.1X in terms of pricing, right? Or maybe 1.15X at max.
Are you seeing a lot of consumers now buying from tier 2, tier 3, really small towns? Have you already penetrated that market, or are there plans to go deeper into those markets?
So we go wherever our channels take us, right? So for example, Amazon ships pretty much any pin code that is possibly serviceable, right? So we're obviously available over there. Now it's about creating demand in those pin codes. I don't think there is a lack of fulfillment and availability. It's about creating demand, right? So in all D2C brand journeys, right, particularly if you're mass premium, right, or premium or luxury, you will always be in the initial years over-indexed on the top 4 or 5 cities, right? Then you will start seeing your tier 1 cities fire. So we're sort of in that zone right now where we're seeing the next set of cities also fire for us. I wouldn't say we still have great demand in a tier 4 city.
And with that, it is a wrap on this edition of Startup Street. From Ritu and me, goodbye and many thanks for watching. More news and updates coming up on the other side.
The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021, when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC-TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. You know, together with partners, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and, we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
Now, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. Although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. So in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm, super excited about what we can achieve in these next 20 years.
Bill, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got childhood deaths down from 10 million to under 5 million a year. And we also took the 2 other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. We hope to be able to cut the number of children who die more than in half again, and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there. And we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over 200 billion in resources, double what we spent in the first 25 years, we'll be able to partner with scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
You know, Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine. Then with other partners like Bharat, a rotavirus vaccine that also brought prices down. So it's the vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had. Vaccines, you need to keep them refrigerated, you need to make them cheaper, you need to convince mothers to bring their children in. So, there are plenty of challenges just in that one area.
Bill, you talk about India. Now, you've been spending a fair amount of your time here in India, and of course, the foundation has been working in India for a good part of the last 25 years. Let me ask you about what excites you about what's happening in India today. How important is India going to be for the Gates Foundation over the next 20 years?
Well, certainly India's a very, very important place for us. It's our biggest overseas office, and it plays two big roles. One is that the Indian government has very aggressive goals for improving health, and so we get to partner and try out the latest advances in medicine, and that we've seen great results from that. But the actual creation, the R&D of the new tools, whether it's diagnostics, vaccines, drugs, new seeds to help farmers, or ways of taking AI and helping with health and agriculture as well as education. India is going to be a place where there's so many smart people, so much desire to see these improvements that will pioneer a lot of things first in India, and the brilliant work there will then benefit the entire world. Paradigmatic of that is the work in digital finance, where Aadhaar and the ability to pay digitally, India really did an amazing job on that, and now we work with the Indian government to make that available to all countries.
But Bill, you've been spending more and more time here in India and doing lots of fun, interesting things, not just linked to the foundation, but even outside of the work that the foundation is doing. What about being in India, about making the connections here in India, the people that you're spending your time with inspire you today? I mean, is this a new romance with India that started over the last few years?
No, I've always been fascinated by India, and of course Microsoft has had a fantastic relationship in terms of the huge development offices that we have in India, as well as amazing people like Satya Nadella that have come and made huge contributions to the company. And so as I moved from Microsoft to the foundation, I took that understanding of the great talent that's there with me. And so, I I get to India on a regular basis and get to meet with the partners there. You know, the majority of the world's vaccines by volume are made in India. We've had, you know, so many important partnerships with that, and that's really growing. You know, the quality of research in India, you know, its desire to go even beyond vaccines with the tools that are provided, you know, it's very timely. And, you know, part of that is Prime Minister Modi's been very generous at sharing with me his goals, and so we can talk about how the foundation helps with that.
You know, Bill, you've referenced vaccines, and I want to ask you this in the context of the last conversation you and I had, which was in September in New York last year. Now, there you had talked about being a salesman for Gavi, the Global Vaccine Alliance, in its quest to raise funds. You've been central to Gavi's ambition and aspiration of providing affordable vaccines to the world. At this juncture, with the very real possibility of funding drying up, specifically from the US, how concerned would you be about Gavi's future?
Well, I'm very, very concerned. It would be tragic if Gavi weren't able to raise as much or more money for this next 5 years as it's had for the last 5 years. And yet, it's pretty clear that we're going to see a reduction. You know, I continue to talk to all the governments about the impact. You know, there's nothing more amazing than you know, making sure all the children of the world have these miraculous vaccines. So we'll see what we're able to raise, but it's looking tough. You know, I'd say the next 5 years, the whole aid picture, whether it's Gavi or Global Fund, are going to mean that, you know, we might go backwards a little bit before we resume the progress we've seen since the turn of the century. And, you know, that's just a mistake, and I'll be speaking out very loudly, you know, try to get the U.S. back in, try to get others to maintain or even increase, in some cases, their giving.
But do you feel confident or optimistic about that? You said you're going to try and draw people back to the table. But at this point, with the global retreat that we are seeing, especially from development goals, Bill, how much of a slide back do you believe we should be prepared for? Are we set for?
Well, we have two forces. One is the power of innovation, you know, that is new tools, whether that's new drugs, new vaccines. We have AI to even help with the delivery, to talk to patients and give them advice about care seeking, you know, things like the ultrasound that'll help figure out about the whether a pregnancy needs special care. You know, so the innovation side is, if anything, going faster than ever. The generosity on resources for the delivery side, the next 5 years are going to be tough. And that might mean some of our statistics that have been improving, we might have a period where they'll get somewhat worse, particularly in Africa. And that's tragic. That shouldn't happen. If you look at the full time frame that all my money, you know, will be given over, I'd say we will be much better off by the end of that than we are right now, despite this period where the aid budgets are really going to hurt our work, particularly, as you said, things like Gavi and Global Fund not being fully funded.
Well, we are going to head into a break and continue our conversation with Bill Gates on his big pledge to spend $200 billion as part of the Gates Foundation over the next 20 years. Welcome back. You're watching the CNBC-TV18 exclusive. We're in conversation with Bill Gates on the big pledge of accelerating the spending being done by the Gates Foundation, $200 billion over the next 20 years. You know, Bill, the last 25 years, the Gates Foundation has worked very closely with Warren Buffett. He's been instrumental in the $100 billion that you've spent in the journey so far. Is there a disappointment that he isn't going to be a co-traveler, a fellow traveler over the next 20 years for you at the foundation?
Well, I'll certainly be very sad not to have Warren's regular advice. I mean, Warren is so wise, so generous. He's been a great friend to me. He's his example as a philanthropist, I think, has influenced many people besides myself. As you say, he's a huge contributor to the foundation. His family is very committed to the causes the Gates Foundation works on, and so they'll continue to be, his children will be great partners of ours in many of these areas. But no, it'll be tragic if Warren's not around. He's 94. I hope he lives this whole 20 years, but he might not.
Well, speaking of milestones, it's 25 for the Gates Foundation, it's 50 for Microsoft, and it will soon be 70 for you in October. As you look back and reflect on the many milestones that you've achieved personally and in your careers, if you had a chance of a do-over, would there be anything that you'd change, anything that you'd do differently?
Well, I'd be very reluctant to go back and change things since I've been so unbelievably lucky. My parents, who I got all my values from, and they made sure I got a great education. I've had amazing friends like Paul Allen, who helped found Microsoft, Steve Ballmer, who allowed Microsoft to be so successful, and now an unbelievable number of great partnerships at the foundation with the incredible team there, and partners all over the world. So. I'm the luckiest person in terms of what I've been able to be involved in. So yeah, I've made plenty of things that I've had to learn and do better, but I don't think I'd want to risk going back and making any changes.
Well, speaking of wanting to do better, you're no stranger to criticism, and it's been constant, but perhaps post-COVID even more so. Questions about the influence that organizations like yours build on decisions that have been taken. Many call it the tyranny of the unelected. How do you now respond to that criticism, Bill, and how do you believe the foundation should learn and position itself over the next 20 years to take some of that feedback and criticism on board in some constructive way?
Well, I think the agenda of saving children's lives, and making sure they're well nourished so that their brains and bodies fully develop, fortunately, that's not a super controversial agenda. All the governments we work with, including India, have goals to reduce those deaths, and so we're able to work together. Vaccines themselves, we test them to make sure they're incredibly safe, and so there is some controversy about those. But for example, with polio, there's not a single kid in India who's been paralyzed since 2011, when the final case, which was tragic, was taken care of, and so we get pretty strong support for the work we're doing. Sometimes seed technologies or contraception, we have to make sure we're communicating well about those things. I wish there were more people involved in, critiquing what we're doing in malaria and TB and HIV. Some of the work we do can actually be pretty lonely because it doesn't get the attention, the resources or the number of people engaged. So, I'd love somebody to criticize our TB drugs or vaccines or diagnostics and, share their ideas, because TB is back to being the world's biggest killer, and there's just so few people funding the work there that we wish there were more.
You talked about TB, malaria, and you're hoping that we see breakthroughs on both those fronts. But outside of health, the innovations on energy, the R&D work that's happening on Alzheimer's, I know that there's been a large part of your mind space and as well as your resources that have occupied these areas in the last few years. What are you most optimistic about, both on energy, specifically nuclear energy, and the work that's happening on things like Alzheimer's, the tuberculosis vaccine, etc.?
Well, if I had to pick one, I'd say, getting to the bottom of malnutrition and really solving that might get to the top of the list. It's a tough competition because we've got a HIV vaccine, a TB vaccine that you mentioned, a malaria vaccine, all very important. I also support new energy innovation. I do that through for-profit investments, including, for example, TerraPower, that's working on new lower-cost nuclear reactors. And so climate change, avoiding the worst of that, and getting cheaper energy is important. But I'd say the malnutrition would be at the top of the list.
Well, it's clear that you're definitely not retiring anytime soon, Bill. What keeps you going? I know pickleball is definitely not going to be something that's going to occupy a lot of your time outside of the foundation's work. But what keeps Bill Gates going today?
Well, I'm very lucky. I love reading. I love, traveling. I have great sisters and friends, and I love tracking the innovation, meeting people who are out in the field doing the tough work. So it's fascinating, and even though we'll have setbacks overall, the possibility of what we can achieve in these next 20 years keeps me going, makes me want to travel and work hard.
And the possibilities that you alluded to, what we're seeing on the AI front at this point in time. But for AI to really address the world's real challenges, healthcare, finding solutions to the many access deficits that exist, what are we talking about? Are we 5-10 years out before we start to see an inflection point on some of these big, real transformational challenges?
Well, there's no doubt in the next 5 years it'll be pretty radical, both in terms of how we discover new things, where the AI will help, and even healthcare delivery, where the patient will be able to talk with the AI and share everything that's going on with them and how they should interact with the health system. And so, no, that's near term. We have a lot of partners who are doing pilots even this next year.
Well, you've been part of the private sector and, of course, then moved to the development world. If I were to ask you for your message to the private sector in the current volatile environment that we're in, to other philanthropic organizations as well, organizations that you're perhaps partnering with or you're hoping to partner with in the future, what would your message be to them? What would your message be to governments today? You said you want to ensure that your voice is heard. What would you tell governments around the world today as we perhaps face what could loosely be called a leadership recession?
Well, the value of helping other people is pretty strong in all the world's religions. And so, that should extend to the poorest, those most in need. And so the idea that we're having less money to buy vaccines for the world's children is a bit of a surprise. And my advice is, hey, let's reverse that and accelerate the progress we've seen, which we should all be so proud of.
Well, Bill, with that, thanks very much for joining us here on the Global Dialogue today. Thanks very much for giving us a roadmap of where the Gates Foundation is headed. It's going to be an accelerated timeline for you to spend $200 billion over the next 20 years. It's a significant amount of money and, of course, a big change as far as the foundation's charter is concerned. Bill Gates, always a pleasure. Many thanks for joining us here. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment with more. The Gates Foundation, one of the largest charitable foundations in the world, is marking its 25th anniversary. Now, the Silver Jubilee comes with a big commitment. Bill Gates is pledging to give away, in his words, virtually all of his wealth over the next 20 years, which means the foundation plans to spend $200 billion over the next 2 decades. Now, this accelerated timeline has meant a change to the foundation's charter, which had stated that the organization would sunset 20 years after the death of Bill Gates. The last big change to the foundation had come in 2021 when Bill and Melinda Gates announced their divorce. Melinda Gates resigned as co-chair in 2024, which left Bill Gates as the sole chairman of the Gates Foundation. Now, from combating infectious diseases to agriculture research and reproductive health, the Gates Foundation has been at the forefront of solving some of the biggest issues in the world today. And joining me now to discuss the foundation's future and his pledge to give away virtually all of his wealth is the man himself, Bill Gates. Bill, many thanks for joining us on CNBC-TV18. And let me start by congratulating you on 25 years at the Gates Foundation. But Bill, why this decision to set yourself a new deadline of 20 years to give away virtually all of your wealth? What has prompted this decision? Why this change from the original position?
Well, looking back on these 25 years, it's amazing what we've been able to accomplish. You know, together with partners, just, you know, the one statistic of cutting the number of children who die every year in half has been phenomenal to be part of that. And so as I was thinking about that, I decided that we should essentially double down and spend all the rest of the money I'm lucky enough to have through the foundation on these causes over the next 20 years. And that'll allow us to be very aggressive, make some fantastic progress, and, you know, we'll have real clarity. A lot of resources for 20 years, and then others can step in with whatever we haven't been able to finish off.
If I may, Bill, is this decision to accelerate or speed up the giving that you're doing linked to the overall environment that we're currently seeing, where there is a retreat from multilateral institutions, from multilateral arrangements, from development aid? How much of this acceleration perhaps is also linked to the change in the environment as we see it today?
Now, this decision was made before all of these reductions were clear to us. I would say in the short run, it means the work we do is going to be challenged. You know, although I expect every year we'll have progress in India and some of the countries we work in. In Africa right now, these cuts to the aid budgets, the debt situation, some of the instability means the next 4 or 5 years will be difficult. But over the time period that all my money will be given, I still expect to see pretty incredible progress. You know, so in the short run, I am very disappointed that aid generosity is down. But with the innovations in the pipeline, you know, with, I think, going to people and saying that those aid budgets should come back to some degree, I'm, you know, super excited about what we can achieve in these next 20 years.
Bill, you know, you talked about doubling down on the significant resources that you've already committed. $100 billion was the previous amount that you did over the last 25 years in spending. You're doubling down on that, $200 billion between now and 2045. So help me understand, these are big numbers. Prioritize for me how you intend to use this money and what are you hoping to achieve in terms of impact?
Well, the first 25 years, we got child-to deaths down from 10 million to under 5 million a year. And we also took the two other diseases, HIV and tuberculosis, and the deaths were cut substantially for both of those. We also came up with ways to save mothers who are giving birth. And so we're really putting most of the resources into the global health work. You know, we hope to be able to cut the number of children who die more than in half again, and also to make dramatic reductions in all infectious disease. We need to finish our polio eradication. Still a lot of hard work left there, and we also think some other eradications, guinea worm, malaria, a number of diseases could be taken all the way to zero. And so by having, for the next 20 years, over $200 billion in resources, double what we spent in the first 25 years. We'll be able to partner with, scientists, and we have a great partnership with the Indian government to help them achieve their ambitious health goals. And, this field, the field of global health, will be able to perform miracles, and our resources will be a meaningful part of that.
Bill, you spoke about the ability to deliver miracles. What have been some of the hardest fought battles over the last 25 years? You talked about some of the important outcomes, especially on the global health front, that you've been able to achieve. What's been the hardest part of making those a reality? Resource is one thing. Execution is another thing altogether. What's been the tough part on the execution front?
Yeah, so for the foundation, we both work on the R&D side, so like creating new vaccines. And so, with Serum, a great Indian partner, a meningitis vaccine was one of the first new ones the foundation did. Later, a rotavirus vaccine that was very low cost, a pneumococcus vaccine. Then with other partners like Bharat, a rotavirus vaccine that also brought prices down. So it's the vaccine work, both in the R&D and the delivery, is probably at the top of the list of the impact that we've had.